So hi guys, welcome to the marathon lectures from Srestha CA and CMA by Srestha faculties. Okay, so right now you may be watching the accounting or auditing or law, whatever the subject. Out of 8 subjects, you may be watching any subject. I don't know. This is just an introduction video from me. Now, what important thing that you need to do right now is don't directly skip to the subject. Don't directly fast forward the video. Please watch this video without any interruption. Even when you're watching the marathon, we have given below the description timestamps. If you click on a particular timestamp, you will go to that particular chapter. But what I sincerely advise you, please watch this entire marathon in the same order. Suppose we uploaded 12th hour, don't directly go to the 5th hour and start watching. Watch in the same order because there is a structure that we follow so that you get the best understanding. Getting it? And further, after this 1 or 2 minutes, getting it, there is my another video which is merged, which is already merged. Please watch that also because that is an instruction to be followed while watching the marathon, what material to be used, all that also I covered. So the initial 5-7 minutes of my content, please do not skip. Please do not skip. So you're going to get some guidance on how to watch this marathon. Then you can directly start with the subject. That's it. Getting it? So take care. Continue watching. And please do not watch at higher playback speed. Some students think watching at higher speed, 1.5 times, 2 times the speed, dangerous approach. See, your objective of listening to the marathon class is not to listen, but to learn something. Learning, you should not make it fast. If at all we can cover the video in 5 hours, we would have covered in 5 hours, no? See, suppose I uploaded 10 hours marathon. If at all we can cover it in 5 hours, we would have taken it in 5 hours, right? Why the hell we take 10 hours? Why the hell we take 20 hours? So if at all you're watching at 2 times the speed, 1.5 times speed, you are not actually learning. You're only listening to the words. You are not learning. You're not analyzing. Analysis will not transmit. Understanding, you'll not get the emotion exactly. Whatever the emotion or intensity the faculty is teaching, if at all you're watching at higher speed, higher playback speed, you will never get that intensity. You will never get that connection. You just listen and leave. See, this is the reason why students, in spite repeat many a times, they still do not recollect. They still do not understand the content. Some students say, sir, some students may be faster in learning. If at all you are very fast in learning, try to listen the song at 1.5 times speed. Take any one particular song, try to listen at a higher speed. See whether you are connecting or not to it. You are listening, no? Music is audible, song words are audible, vocals and music, everything is audible. But why you are unable to connect? Connection is required with the subject. In order to establish that connection, please listen to the subject at standard speed. Even though you may be very smart, you may be very intelligent, just try that intelligence while listening to the songs also. Listen to a song at 2 times the speed. Emotion is important. In anything, any work you do, emotional connection is required. So please watch the entire content at standard speed. And I'm telling you, if at all you want to try 1 hour, if 1 hour you watch at standard speed, another 1 hour you watch at higher speed, you check back yourself where you are learning better. I think that is the best judge, that is the best decision. Just try that and then do. Because many people in YouTube are misguiding students saying, listen at higher speed, revise more number. No, that's not. Listen at standard speed. Your revision, number of times revision will naturally reduce. That's it. So continue watching the video. Thank you. Have a nice time. Bye-bye. So, hi guys. First of all, thank you very much for, encouraging our institutes, rest of us CA and CMA to this level. Anyhow, so here is a good news for all of you. From Srestha, again in respect of November 2022 exams, we are going to upload again all updated marathon classes, revision classes. Okay, we are once again uploading the videos or revision videos for November 2022 exams. And we are doing it for all 8 subjects. So who are the faculties that first of all taking all these marathon revision classes? And myself, I will take audit and I will take some 2 or 3 important chapters of company law. And so nothing but P5, mainly I'll focus on, paper 6. And Satya Raju sir will focus on paper 1 and paper 5. So you'll be getting approximately 20 plus 20, 40 hours of marathon for accounts and advanced accounts put together. Then Subramaniam sir will be taking paper 2 part A, company law main chapters. And Harish Krishnan sir will be taking paper 7, which is EAS and SM marathon. And Vikita madam is taking paper 2B, other loss marathon. And Samba sir is going to take paper 4, income tax, separate marathon for 12 hours. GST, some 10 hours, separate marathon. And Srinivas Reddy sir, paper 3, costing marathon, approximately we are going to upload for 15 hours. And coming to our another faculty, paper 8 part B, Naga sir is going to take economics marathon. And same Samba sir is going to take paper 8 part A, financial management marathon class. So from the entire Shrestha team, we are going to give you all 8 subjects revision marathon classes on YouTube. Now, first thing that you might get a doubt. So what are the things or what are the materials that you are going to use for these marathons? So before that, where you will find this marathon on the YouTube? Very simple. You just open CA Ram Harsha. Okay, there is a YouTube channel. So go to that home videos and there is a playlist. Here you will find a playlist separately for November 2022 marathons, revisions, CA, Inter. So in this playlist, you will find all 8 subjects. Now immediately you might get a doubt. Are all 8 subjects uploaded right now? No. By 10th of the September, you may be watching this video. You may be watching this video, on the date on which it was uploaded, or even maybe later. I don't know. Getting it? By 10th of September, all subjects except auditing, we will upload. Audit subject new marathon, we will upload after September 20. After September 20, audit related subject marathon will be uploaded. And you know what? The all revision classes, entire revision marathons are absolutely in English. Because we Shrestha is having 1500 plus students across 20 states in India. Not 20, I can say 26 states I think we have covered. Some 2 or 3 northeast states only we have not covered, but 26 states we are having admissions. So obviously, for us, the students across India, we can't use any particular regional language. So we have to stick to English. So entire explanation will be in English. Now, coming to a few questions which you need to understand. Okay. One. We have uploaded in May 2022 exams some video classes, marathon classes. I am telling you the same revision classes with slight modifications we are uploading. Some for few chapters we re-recorded like 1 or 2 chapters wherever there were amendments. But actually speaking, for May attempt and November attempt, the subject, the material, everything is exactly same. Because right now we are in September month 2022, right? If at all you go and check ICI website, what is the latest material available? November 2021 edition, October 2021 edition. So typically for May attempt, whatever material we are using, the same material we are going to use for November. I hope you are getting it. And now so we are using a particular material, right, for marathon, where you can download this marathon, where you can download this particular material which is used in the marathon classes. So there is an app in Shrestha for SHRE, Shrestha for CA and CMA. There is an application called Shrestha for CA and CMA. You will find right side, above me, there are 2 logos. First logo is there white color logo. That logo. If you type this name in the Play Store, you will get that logo. Getting it? Only from Android you can download the material. Suppose if you do not have an Android phone, please use somebody's Android phone and download the material. Okay, so in this application, you just download and log in. We have given in the main menu. If you go to the application, there is something called main menu. Just after opening the app, left side top, you will find main menu. Click on that, you will find study material. Inside that, November 2022 and May 2023, there are materials. Please download the materials. PDF copies, please download and keep it with you, so that it will be useful when you're watching the revision class, so that whatever faculty is actually using the material, so it is with you in hand. That's it. If at all you want to have a hard copy, you can buy that hard copy on the same application. But I don't think you require a hard copy, because it's a revision class. So whatever you already have gone through, whatever material you already learned from, please stick to that material. Take our revision classes as a additional guidance. And I'm telling you, you're going to enjoy the subject like anything from, See, generally in YouTube, you'll find many subject related marathon, but for all 8 subjects at a single place with a particular standard, uniform standard, you'll rarely find. So here, our institutes, rest of us CA and CMA is giving you that option. Getting it? So I hope you understood what we are going to deliver. Now, what are the topics that we are going to cover approximately, if at all you ask me? So, if you look at paper 1, accounting, we are going to upload 2 videos. Approximately both the videos put together will be 20 plus hours. So, these are the chapters: fundamentals, incorporation, introduction to accounting standard frameworks, AS2 and AS12, financial statements of company, bonus, investment accounts, redemption of debentures. That's it. We are not covering anything else from accounts subject. And paper 2A, company law, if you look at, me and Subramani sir, both of us are taking in this case the classes. Like if you look at accounts of companies and dividend, audit and auditors, these 3 chapters related revision I will take. Rest of the chapters, basic, incorporation, share capital, deposits, charges, these chapters revision will be handled by Subramaniam sir. Then other laws, all these topics are being covered by Vikita madam. And paper 3 costing, all these topics, 100% of all the chapters are being covered by Srinivas Reddy sir. Okay. Then part 2, see, costing video will be uploaded in 2 parts. Both together will be 15 to 16 hours. Then paper 4A, income tax. We are going to cover 5 heads of income, clubbing provision, set up and carry forward, chapter 6A, return of income, TDS and TCS. And GST, we are going to cover almost all the chapters. Then advanced accounts, introduction, few accounting standards, amalgamation, reconstruction, liquidation, partnership, consolidation. All these topics we are going to cover as part of revision. And accounting, advanced accounting is also being uploaded in 2 parts. Accounts, you will have 2 parts videos. Advanced accounts, you will have 2 parts videos. Sorry, company you will have 2 parts. Sorry, costing, you'll have 2 parts videos. Then coming to auditing, ignore auditing right now because I have not yet uploaded the marathon. Then paper 8A, financial management, these chapters. Paper 8B, these chapters. Even paper 7A, paper 7B also we are going to upload all the subjects. I told you where you will find all these videos. You will find that in the Play Store. Open CA Ram Harsha, open playlist. Inside that you will find November first playlist, November 2022 marathon. So in that playlist you will find all the 8 subjects video. By the way, you will find all these videos by 10th September maximum. Getting it? So actually I'm recording this video on 4th September. So right now after this video I'll be uploading the marathon videos. And this video will be a common video in all in all marathon videos, whatever I'm going to upload, 12 hours videos. In all the videos, this video right now whatever I'm recording will be a common video, so that every time whoever is watching a new revision class will not miss all this. Now one more important thing, now who should not watch this marathon class? If at all you are a first time learner. Now many people will ask me, sir, is it useful for a first time learner? No, this is not for first time learners at all. This is for those who are going to write exam. Okay, those who are just about to go and write the exam. No, for them only this is. See, a subject is completely covered in 20 hours. 100 marks paper is hardly being covered in 20-24 hours. A regular course will be 120-150 hours. Imagine we are reducing 1/5 time. It's a revision. First of all, understand revision is useful. Revision class will be useful only for those who already prepared the subject once. You may have prepared in self-preparation method or you may have taken coaching. That doesn't matter. That doesn't matter. But those who already prepared once, only for them this is useful. For others, strictly I'm saying not at all useful. Because don't waste your time. But I'm telling you, those who already have gone through books, who already wrote 1 or 2 attempts, getting it, or who are first timers. Maybe you are first time you're writing in November, but you already gone through the coaching. For you, these marathons are going to be a best thing in your preparation. Definitely after watching this marathon, you will definitely get a new look on the subject, new idea, new perspective on the subject, so that within next 1.5 months you can plan your preparation perfectly. That's it. Okay, take care, have a nice time. So continue the classes. Getting it? So this is an intro video. First I'll upload this normally, then again I'll upload this as part of the revision videos. Getting it? So continue. Thank you, have a nice time. Bye bye.
Hi, hello, Subodai, Vanakkam, warm warming to one and all. Myself, Satya Kolluru, practicing chartered accountant by profession, faculty for accounting and advanced accounting in CA interlevel and Faculty for Financial Reporting in CF final level. So before proceeding with the marathon session, first let me explain the agenda of this entire marathon. I'll try to cover more than 80 to 90% of the overall syllabus here. Why I used the term 80 to 90% of the syllabus? So do you skip any specific chapters here? No, I'm not skipping any specific chapter. I'll try to cover each and every chapter. But whenever an immaterial concept is there, I'll try to avoid such concept. So our basic focus is towards the heart of that specific chapter and the ancillary concept with respect to that heart of the topic. Hope you understand. Next, sir, how the structure will be. I mean, how you are going to cover the entire content. Literally, I'm using only two resources. One is Power Notes. One is Power Notes. So you can see here which is Power Notes actually. So this Power Notes is approximately for 200 pages. So here, if you check here, this is representing only for 145 pages because it is only the combination of the first 15 chapters. So one more 5 chapters is coming to takes place. I'll club it. I'll give it in the description along with the main material. This is the second resource I'm using. Are the overall content we are going to explain through the Power Notes only. Whenever a requirement is there, I'll go to the main notes to cover any specific concept or any specific problem. Is it okay, guys? And one more. So most of the persons have a doubt that how many number of hours it would be, sir. I think so. I was also not guessed till now. I think so. Approximately it will be for 15 hours, more or less, 2 to 3 hours, more or less will be there. Okay. And one more thing, sir, is it right to cover every problem for that specific chapter? That is depending upon the importance of that specific chapter and the topic. If it is necessary, I will take up. So otherwise, we will check how to manage the things. I mean, is it concept is necessary? I mean, concept is more important than the problem. Then I'll explain only the concept. That means once if you know the concept, you can easily complete the problem. No, not only the explanation of the concept is enough. We should also take up a problem to apply the concept in the specific manner in that problem. Then I'll take in combination both. That is the meaning of that. Okay, fine. So without wasting much time, let me directly entering into the topic. As per the ICAI blueprint, first, as per the ICAI blueprint, the accounting syllabus is broadly categorized into 4 sections. Let me open such sections here first. Yeah. So this is the entire ICAI syllabus. Now, out of the 4 sections, section 1 is especially related to accounting standards. I mean, here actually 3 basic chapters are covered. One is introduction to accounting standards. Out of this accounting standards, 2 specific chapters are there. One is introduction to accounting standards, and another one is application of such accounting standards. In introduction of accounting standards, we will see the history of accounting standards and the significance of accounting standards and the reason for introduction. Such all things we will see. In application of accounting standards, so the coverage in group 1 is very limited. We are going to see especially 8 accounting standards. So such accounting standards in detail we will discuss. Along with that, one more chapter, which is framework for preparation of financial statements as per accounting standards, we will see under section number 1. Coverage as per ICAI is 20 to 25%. Coming to section 2, which deals with special transaction. Maybe Such special transaction is applicable in case of every enterprise, whether it is profit oriented or non-profit oriented, whether it is a company, whether it is a partnership firm, whether it is a sole proprietorship, whatever the case may be. But is it mandatory to have such special transaction? That is up to them. If such special transaction exists, then how we should need to provide the accounting treatment, we will see in that specific chapter. That is investment accounts, insurance claims, hire purchase and installment sale transactions, which covers 3 chapters in section 2. Coming to section 3, which deals with special type of accounting. Special type of accounting means such type of accounting is not applicable to every enterprise. Such type of accounting is applicable to specific enterprises only. That is departmental accounts, branch accounts, incomplete records. Just to tell a small example, departmental accounts is applicable if the enterprise is dealing with more than one product, or if the enterprise is having more than one function, then it may want to prepare the departmental accounts. The branch accounts are applicable only if an enterprise is having head office as well as branches, then the branch accounts coming to the picture. Incompleted records are applicable if there is no proper scientific bookkeeping system is not exist. So that is the reason I told you, which is a special type of accounting is not applicable in case of each and every enterprise. For specific enterprises, as per their nature, such accounting treatment is going to apply. Now coming to the final section, which is very much important section and which covers the high voltage, which covers the high marks among all the sections. That is, which approximately covers 30 to 35%. All the different chapters which are exist in group 1 with respect to company, all are listed below. That is preparation of financial statements along with managerial remuneration, cash flow statement, which is also one of the financial statements of a company, but which we are going to see as a separate chapter. Profit or loss pre and post incorporation, and bonus and right issue, redemption of preference shares, redemption of debentures. Total 6 chapters we are going to see in section number 4. Sir, this blueprint is given not for 100 marks, which is given for 120 marks. Which is given for 120 marks because examination paper will cover 120 marks. That is total 6 questions. Out of the 6 questions, question number 1 is compulsory. You should need to attempt. You cannot take a choice for question number 1. And one more thing, question number 1 coverage is from accounting standards, that is from section 1 outrightly. That means there is no choice for section number 1. Now, coming to the remaining 5 questions, you can give answer for any of the 4 questions. Here, you have a choice. Out of the 4 questions, you can take any one question as per your requirement as choice. That is related to the question paper pattern. Now the percentage, section 1 is 20 to 25%, section 2 is again 20 to 25, section 3 also 20 to 25, but section 4 coverage is 30 to 35%. Such percentage marks you should need to calculate on 120 marks. That is 1, 2, 3 approximately covers each and every individual section in between 25 to 30 marks, more or less 25 to 30 marks. Section 1 25 to 30, section 2 25 to 30, section 3 again 25 to 30. Coming to section 4 coverage is in between to 35 to 40 marks. Why I'm giving particularly on more importance on that percentage of marks. You may design your mindset according to the importance of that marks as well, because ultimately coming to the examination pattern, our preparation and our way of explaining the things toward the subject is in examination level mode, right? So that is the reason why I'm telling the number of marks with respect to that particular section at this stage. Okay, just leave it. So now coming to your marathon sessions, how you are going to deal, I'll explain at this stage itself. I will take section 4 at the first instance, first we are going to cover section 4. Then I'll move on to section 1, that is second. Then I'll take up section 2. Then I'll take up section 3. Persons who already listened my regular classes, which are approximately for 150 hours, who are already taken classes in Shrestha, or who want to take the classes in the Shrestha for the regular course, the curriculum vitae also designed in the same way. More or less, there are small changes are there. So accordingly, the link ups. So first, we need to tell one chapter based upon another chapter is need to be introduced. So except in such situation, the same pattern I followed for the regular course as well. The marathon also I am going to deal in the same flow. Now, coming to section 4, we will take up first preparation of financial statements and managerial remuneration. Cash flow statement, we are not considering in section number 4. The reason is, out of the accounting standards, one accounting standard is AS3. The cash flow statement I'm going to deal along with AS3 in section 1. We will take up cash flow statement at particular point of time. Then after preparation of financial statements, I will take a profit or loss pre and post incorporation, then bonus and right issue, then redemption of preference shares. Redemption of debentures, again, I will not consider in section 4. Sir, when you would consider, sir, I'll consider along with, I will consider after discussing the chapter investment accounts, because there is interrelationship in between investment accounts and redemption of debentures. So once we finish it off the investment accounts, I will take up redemption of debentures. That means in section 4, we will only take up the 4 chapters at the first instance: preparation of financial statements, profit or loss pre and post incorporation, bonus and right issue, redemption of preference shares. Now coming to section 1, in accounting standards, what are the different accounting standards we are going to cover? You know, AS1 we will cover 2, 3, then 10, 11, 12, 13, 16. So total how many standards are there? 3 plus 3, 6 plus 2, 8. The same number I told earlier. Out of which first we will deal accounting standard 2. Then accounting standard 3 along with cash flow statement. I already told you. Then AS10 property, plant and equipment we will take up. AS11 we will not take up in section number 1. We will take up AS11 along with the branch accounts in section 4. Okay, because there is interrelationship in between AS11 as well as branch accounts. That's why branch accounts we will deal along with AS11. Okay, then I will take up accounting standard 12. After that, I will consider AS13. AS13 is accounting for investments. Here itself, we will discuss the chapter investment accounts. As well. So, which gives the more conceptual clarity. Whenever I'm clubbing one accounting standard with another chapter, then at that point of time, your burden will also going to reduce. The interrelated concepts also, you can easily grab it. Okay, that is the reason why I'm taking a specific standard with the relative chapter if relation exists. Then finally, we will take the accounting standard 16, borrowing cost. After completion of all those standards, at the last instance, I will take up accounting standard 1, which is disclosure of accounting policies. Okay, fine. So at the time of dealing introduction to the accounting standards itself, I will include the chapter framework for preparation of financial statements. Don't ignore the chapter framework for preparation of financial statements. The reason is in the last attempt means which was occurred in December 2021 examination. They asked 2 questions from framework for preparation of financial statements. That's why in future examinations also, we cannot skip that chapter. The chapter conceptually also highly important. Is it okay, guys? Next, then we'll shift to section 2. In section 2, we already covered investment in AS13 itself. That's why the remaining 2 chapters, insurance claims and hire purchase and installments only we are going to cover in section number 2 exclusively. Next, come to section number 3. First, we will take up the departmental accounts, then branch plus AS11, then incomplete records. The same pattern, you no need to confuse. In the material, I clearly given. I already told you in the description, I will clearly given the link for the main material as well as my power notes. Both will club, and I'll put into the Shrestha institution link where you can access the Shrestha institution link through my description, where you can go to the materials corner. You can download the respective material. The same pattern here I designed. If you check here, from starting financial statements of companies, up to the ending of accounts from incompleted records, the same pattern and the same flow just I designed. Now, sir, apart from all these things, first, the entire marathon, as a beginning, I want to start with fundamentals of accounting. It is all together, it doesn't have any relationship with the existing syllabus, but which is entire heart of the accounts. Without knowing the basics, you can't appreciate the concept properly. So that is the reason first I want to take up the marathon with the fundamentals of accounting. Please all of you concentrate. Come to the chapter fundamentals of accounting. Sir, in fundamentals of accounting, from where you want to begin the class, sir? First, I will start the class with magic of passing the journal entries, because in whatever the chapter you can take up or whatever the chapter you will go, the base itself is the passing the journal entry. If you can able to pass a journal entry, then you can easily follow the entire concept or the specific chapter. Then how to pass a journal entry for a specific transaction, sir? How to pass a journal entry for a specific transaction? Please concentrate, all of you. Come to my OneNote. Can you please all of you tell me, as per the balance sheet, as per the balance sheet, closing outside liabilities plus closing capital is equal to closing assets. Do we agree? Simply, outside liabilities plus capital is equal to assets as per the balance sheet. Do we agree, guys, all of you? Now, this is the equation of the balance sheet. This equation, we can also call it as accounting equation, balance sheet equation or accounting equation. Now, what is the meaning of closing capital here? Closing capital is nothing but opening capital plus, if the entity is attained profit for the current year, then the profit will also ultimately added to the opening capital. Then you will get closing capital. What is the meaning of profit? Profit means income minus expenses. Income minus expenses. Now the same above equation I can write in this way, right? Which is liabilities, or I can put outside liabilities. Outside liabilities plus capital plus income is equal to assets plus expenses. Do we agree, all of you? This equation is technically known as accounting equation. Now here liabilities, capital as it is, profit, under profit I considered income minus expenses, it will go to the right hand side, then it will be added to the assets. So the equation is liabilities plus capital plus income is equal to assets plus expenses. Sir, now with this equation, how we can pass the journal entry, sir? I'll explain the magic of passing journal entries with this equation. Sir, whenever there is increase in assets or expenses, whenever there is increase in assets or expenses, or there is decrease in outside liabilities or capital or income. Simply, whenever there is increase in the right hand side or decrease in the left hand side due to such specific transaction, if there is increase in the right hand side or decrease in the left hand side, such aspect should need to be debited. Such aspect should need to be debited. To put in to put it in another way, if there is any decrease, on the right hand side, there is any decrease in the right hand side, or if there is any increase in the left hand side due to happening of a specific transaction, such aspect should need to be credited. I'll give a small example. You can understand the application of the entire accounting equation approach. For the known transaction, I will tell you, sir, whenever you are paying particular salary to a particular employee, whenever you are paying salary to a particular employee, there exists two aspects, one is salary, another aspect is cash. Now salary is expenditure, there is increase in expenditure, salary should need to be debited. Cash is an asset, sir, due to occurring of the transaction, due to making payment of such salary, there is decrease in the cash resources, that's why there is decrease in the asset, that's why cash should be credited. So the entry is salary account debtor to cash account. All of you at this stage, you can pass the journal entry for any transaction, I know. But whenever the time progress, whenever we are entering into the different chapters, then you may got confusion to pass the journal entries at certain specified circumstances. At that point of time, this accounting equation approach is highly useful. Whatever the chapter, whatever the enterprise it is, whether it is profit oriented or non-profit oriented, whether it is a company partnership firm or a sole proprietor, you can apply the same accounting equation, not only for throughout the CA inter level, up to the CA final level in academics, and after getting the qualification, whenever you are crossing the confusion, then you can apply this accounting equation. This is the magic of passing the journal entries. Okay, next. Sir, what is the next issue you want to go to? You want to take up, sir? The next issue I want to take up is gap. In fundamentals of accounting, the next issue I want to take up is gap. So accounting equation here diagrammatically also I given in my main material. If you want, you can check that. Come to gap. What is this gap, sir? This is not GAAP. This is GAAP. So the gap full form is generally accepted accounting principles. All of you know that. But why we are learning the concept of gap at this stage? In future chapters, so many times, whenever the requirement is needed, I'll use the word gap. Sir, gap is a combination of authoritative standards and the commonly accepted ways of recording and reporting the accounting information. One more time, I'm repeating, which are authoritative standards. Gap is inclusive of authoritative standards issued by some policy boards, like our ICAI in India is one of the policy board. Simply indirectly, he is conveying that accounting standards issued by such policy board in India, which is ICAI, in internationally, which is International Accounting Standard Committee is there, which they are going to issue IFRS. That means gap means globally we can call it as IFRS, the standards issued by International Accounting Standard Committee in international level in the worldwide, which are known as IFRS, come to India, which are known as locally, those are accounting standards or maybe IND AS. anything. All these are gap only. Not only that, end. They are using the word end. The commonly accepted ways of recording and reporting accounting information, which are industry specific accounting practices. That is accounting standards and other industry specific accounting practices. These are commonly accepted accounting principles. Wherever you go throughout India, such commonly accepted accounting principles are agreed by all. So certain commonly accepted set of accounting principles list here it is given. Business entity concept, money, that is money measurement or monetary unit assumption, going concern assumption, consistency concept, accrual concept, historical cost concept, matching, conservatism, materiality. I'm not dealing all these different accounting principles at this stage. We are going to see different accounting principles in different chapters like framework for preparation and presentation of financial statements, as well as AS1 disclosure of accounting policies. At different chapters, we will see in all these accounting principles. That's why I don't want to dedicate my time at this stage. Just the given list I read. But out of the given accounting principles, I'll deal with one accounting principle, which is very much important accounting principle, which is the concept of accrual. Please, all of you, come to the concept of accrual, guys, to my power notes. Concept of accrual. Come here. Sir, what is the meaning of accrual, sir? So the simple meaning of the accrual is a transaction should need to be recorded in the books of accounts when it is happened. Informally, if I speak, when it is happened. To speak formally, when it is actually occurred. When it is actually occurred. Not when the cash, not when the cash received or paid. Accrual means actually occurred. I'll give a classic example here. Sir, if you sold the goods on credit basis, the transaction is occurred, actually occurred, sales occurred, we should need to consider. That means we are not recording such transaction when actually we got cash from the other party. We are recording such transaction when actually sales made to the other party. That is the meaning of the accrual. In case of income or in case of expense, whatever the case may be. Another example I given in my power notes. If you check, sir, on my stock, I took insurance on 1/11/2021 to 31st March, sorry, to 31st October 2022. That is exactly for 12 months. Insurance is for 12,000. Now I'm in the financial year 21-22. In the financial year 21-22, only 4 months are elapsed. Even though I paid insurance expenses for 12,000, out of which only the current year expenditure was 4 months. That is only the 4,000 amount. So then what about remaining the excess payment? The remaining excess payment what you paid in the current year is not related to the current year, which is not actually occurred in the current year, because such insurance is going to elapse in the next year. Such insurance expenditure is known as prepaid insurance for the current year. Prepaid for the 8 months insurance, that is 8,000, we will treat it for the current year, and the current year expenditure we will treat it only for 4,000. How many number of months? Is it 4 months or 5 months? I think so it's 5 months. I'm so sorry. So 1st November to 31st March means 5 months. Here it is 7 months. I clearly given. So 1/4/2021 to 31st March 2022, we will treat it as an insurance expenditure 5,000, and the remaining should be treated as prepaid expenditure 7,000. Just a simple example I given. So next, one more important thing just I want to explain here. Please all of you concentrate. Sir, do you know the difference between accrued and due? Accrued but not due. So many members don't know the difference. I'll give you a small example to explain the difference between accrued and due, accrued but not due. For example, in your organization, salary is paid for a particular month for the next following month of the 10th. In generally, it is going to happen. So as on the last date of that specific month, no organization will try to pay. Very few organizations are there for which the cash flows are the abundant and the liquidity position is high. Then they can try to close the salaries as on the final day. And not only that, even the liquidity position is good, we should need to close the attendance sheets and the number of absentees and consider all such things. Then only salary is going to be finalized. Such all activities are in generally completed by the payroll department in any entity. So that's why organizations are took some grace period to make the payment. Now let us assume the period is March 31st. We are in the month March. Simply we are in the month March. Now for the month of March, here also I will give, which is 2022 itself. Now we are in the month of March 2022. Anyway, I'm recording this video lecture as on 27th of March. We are in the March month anyway. Now in my organization, March 2022 salary, we are going to pay 10th of the next month. That is as on April 10th, 2022. Now my question is, can we consider the March month salary in the books of 21, 22 or not? In the books of that particular organization, they will consider March month salary as salary expenses or not? Definitely they will consider the salary of March under salaries for the year 21-22. Sir, as on March 31st, 2022, the salary is accrued. The salary is accrued. Is it ended due? Sorry, the salary is accrued but not due. The salary is accrued but not due. As on March 31st, 2022. What is the meaning of accrual? Is it employee came to the organization? Yes. Is it employee provided his services to the entity? Yes. But the actual due date is as on April 10th, 2022, which is accrued but not due. The concept is known as accrued but not due. For example, as on March 31st, 2022 itself, certain organizations gave their salaries to their employees, right? Then March 31st, 2022 is known as accrued and due as well. If payment due date is also as on March 31st, then 31st March 2022, the salary is known as accrued and due. Now, whether that specific expenditure or income is accrued but not due or accrued and due, we should need to record in the current year, because in both the concept which is accrued, whether it is due or not, irrelevant for me. Whether it is due or not, which is irrelevant for me. If it is accrued, I should try to consider into the books of accounts of that respective year, because this concept is highly useful in drafting final accounts, and as well as the concept is highly useful in calculation of a recording of interest on investments as well as interest on debentures in their respective chapters. I will give you a small example. Concentrate here. For example, debentures are there. You know the debenture, which is a liability. On debentures, let us assume interest is payable off yearly, that is 6 months once. 6 months once, as on 30th September, as on 30th June and 31st December, let us assume. Sir, our company is following the financial year for our accounting purpose, that is 31st March of that particular year is the closing. Now, on the outstanding debentures, the interest payable from 31st December to the 31st March of that specific year is interest is accrued but not due. I mean, as on 31st March of that specific year, is there any necessary to make payment to such debentures, sir? No, because 30th June is the due date. Now, I should need to wait up to 30th June to make the repayment of the interest to the debenture holders. But as on the closure of the year, interest from the last due date to the up to the closure of the financial year, interest is accrued. 3 months time elapsed, but which is not due. We should need to record interest as an expenditure based on the concept of accrual. Okay, fine. So here the conclusion is whether a particular expense or income, whether it is due or not, irrespective of the such fact, if it is accrued, it should be considered into the books of accounts. Hope you got the difference between accrued and due as well as accrued but not due as well. Okay. Next, sir, still the concept of accrual is not over. So please all of you spend 5 more minutes. 5 more minutes, then I can close the basics of the or the fundamentals of the accounting. Then I can enter into the chapter, the first chapter, which is finance statements of companies. So based on the concept of accrual, we can design 4 different concepts. I'll explain through my power notes. That is better idea. Come here. Or I can explain through my main material. Come here. Yeah. So based on the accrual total, I designed the 4 concepts. One is outstanding expenses, prepaid expenses, income receivable, income received in advance. What is the meaning of this, sir? Outstanding expenses means which is current year expenditure only. As on the closure of the business, still we at it to payable. We not paid till now in the current year, which is known as outstanding expense. Prepaid expenses means the expenditure is not related to the current year, but till we paid in the current year. So for current year, which is treated as prepaid expenses. Income receivable means we earned the current year income, but as on the date of closure of the books of accounts, still that income is yet to be receivable. That means we not received till date, which is known as income receivable or accrued income. Income received in advance. We received certain income, but which is not related to the current year income. As an advance just we received, which is known as income received in advance. Sir, in balance sheet, what is the impact of these items, sir? Outstanding expenses, we will treat it as a liability. Prepaid expenses, we will treat it as a asset. Income receivable, we will treat it as a asset. Income received in advance, we will treat it as a liability. Sir, you already seen all such concepts, not in CA inter level at your graduation or at your CA foundation or the CPT level itself. So just I'm brushing the fundamentals before proceeding to the main chapter. What is the journal entry for outstanding expenses, sir? Now, till the date, you are not recording such outstanding expenditure in your books of accounts. The reason is you not paid the payment, right? You not paid the payment. But before closure of your books of accounts, as an adjustment, you need to record right now. That is liability. Increase in liability should be credited as per accounting equation. That's why outstanding expenditure should be credited, due to which the current year expenditure is also increasing. That is expenditure should be debited. Expense to outstanding expense is the journal entry. Now coming to the prepaid expense, you already something recorded in the books of accounts. What you recorded, you know, at the time of making payment, you recorded as expenses to cash. You recorded already expenses to cash. In insurance, we already seen that at the time of making payment for the insurance, you already recorded the entire amount of 12,000, which is insurance expenses to cash initially. Initially, at the time of making payment for the 12 months, you recorded the entry as insurance expenses to cash 12,000. Now, as an adjustment, as on the date of closure of books of accounts, what you should need to adjust, is it entire 12-month expenditure is elapsed in the current year? No. Out of the 12 months, 7 months is going to elapse in the next year. That's why you need to decrease to the extent of 7-month expenditure. That's why expenditure should be credited and a prepaid expenditure should be debited. So that's why the entry is prepaid expenditure account data to expense account. which is an asset, I told you increase in asset should be debited and decrease in expenditure should be credited. The entry is prepaid expense to expenses account. Sir, but once if you habituated for the accounting equation approach, then you can see that magic. Please, all of you habituate to apply that accounting equation whenever confusion is there. That is the reason I told you, once if you are adopted, then you can pass the journal entry at any stage, guys. Next, come to the income receivable. Sir, income receivable means till now you not at all recorded any journal entry in your books of accounts. Now, as on the closure of the books of accounts, you need to adjust such income receivable. Now, first, due to the income receivable, it is related to the current year earned income. If there is any increase in income, it should be credited. That's why income account should be credited. And income receivable is an asset due to which there is increase in asset. Increase in asset is there, it should need to be debited. Income receivable account data to income account is the journal entry. Now, in the same way, coming to the income received in advance, sir, till now, you already passed one journal entry at the time of receipt. That is bank account data are to that particular income account. You are unnecessarily credited. But as on the balance sheet date, you will check, is it related to the current year income or is it related to the next year income? Then you realize that which is related to the next year income. Then what you should need to do, you should decrease this income. If there is increase in income, it should be credited. There is decrease in income, it should need to be debited. That's why the entry is income account data are to income received in advance is a liability. Increase in liability should be credited to income received in advance account. So the entry is income account data to income received in advance account. Sir, how the adjustment should need to be done, sir? And one more clarification, just I want to give before proceeding that. So most of the times you may come across that if trial balance is there, below the trial balance, adjustments will be given. Most of the times you may have a doubt that what is this adjustment? What is this trial balance? Why adjustments are given actually? So this is the practical implication that at the time of preparation of trial balance, or at the time of closure of books of accounts, we may not provide the entries for all the transactions. Certain transactions may be missing, maybe due to closure of the or closing of the activities. For example, closing stock is there. When you know the value of the closing stock after completion of the entire business activity as on 31st March, how much stock would be, you know. But do you thought that, sir, can we estimate the entire closing stock as on 31st March? No, that doesn't occur, because practically the business is going to continue till the mid of that particular year. Then how can you measure the entire closing stock at different branches, at different entities? Okay, it is not possible practically. So that's why you can estimate the closing stock for that date at a different date. Do you understand? Now, after estimating the closing stock, let us assume if you are knowing the closing stock worth is 1 lakh. Now that means till now such closing stock is not incorporated into your books of accounts. Now, after preparation of trial balance, now you can incorporate at the time of preparation of financial statements. How you can incorporate? You can incorporate in two ways. One way is you can credit to the trading account, that is debit the closing stock account. Closing stock is an asset. Increase in asset should be debited to trading account. So this is one way of recording the closing stock. Or another way, if you want to record the closing stock, you can debit the closing stock account. You can credit the purchases account, because ultimately the purchased goods are only in the closing stock, or either the opening stock is there in the closing stock. Do you understand? That means as an adjustment, till now we are not incorporating such journal entry in the books of accounts. Now we are incorporating such transaction into the books of accounts through preparation of the financial statements. Do you understand? In the same way, for example, till now, if you are not passing an entry for the depreciation, now you can incorporate as an adjustment, that is depreciation account data to asset account. That is the reason why if closing stock is given under adjustment, if closing stock is given under adjustment, you are in generally thoughting that closing stock we can incorporate it through trading account. But if the same closing stock was already adjusted in the trial balance, I mean, in the trial balance itself, closing stock is there under a debit side. What is the meaning of that? Before preparation of financial statement itself, closing stock was already considered, which is reduced from the purchases. They already passed one entry, closing stock account data to purchases account. At that point of time, the purchases information given in the trial balance is adjusted purchases, that is after reduction of the closing stock. Sir, simply what you want to conclude from this concept, sir. Whenever a transaction is given under adjustment, the meaning of that is, till now the transaction impact is not considered in the books of accounts. Now only you are considering into the books of accounts due to the practical implications. Now, if any particular item is given in the trial balance, that impact was already considered into the books of accounts, that was already recorded in the books of accounts, that was proved through closing stock. If the closing stock is given in adjustment, then the purchases are the total purchases, that is without adjusting the closing stock. If the same closing stock is given in the trial balance, then the purchases are adjusted purchases. So if I continue the flow, it will go into the other direction as well. So let me stop at this stage the concept of accrual, and as well as the difference between an item which is given in the adjustment as well as item given in the trial balance. Sir, which are the basics of the accounting, are the fundamentals of the accounting? Just I pick up certain issues. What we discussed, very few issues discussed. So one is magic of passing the journal entries I discussed. Another one is concept of gap I discussed. Another one is concept of accrual I discussed. So based on that concept, we seen outstanding expense, we seen prepaid expense, we seen income receivable, next we seen income received in advance. Then we seen difference between item in trial balance and item in adjustment. This is the summary of the discussion what we made in the fundamentals chapter. Over. Now all of you come to the main chapter, guys, which is financial statements of companies. So as per our discussion, the first and foremost chapter is financial statements of companies. Sir, in this chapter, what you are going to discuss? Basically, this chapter is very lengthy chapter coming to the regular course. But as we are in the process of revise the things for the overall syllabus, what are the issues we are going to cover and what is the heart of this chapter? I'm going to explain through one note first, which I can put it as the overall view, what we are going to see in this chapter first. The chapter is related to financial statements of companies. You can put the heading financial statements of companies. So just you can listen it, guys. Don't write anything. You cannot concentrate properly while writing and listening the things. So that is my headache. I will take care each and everything. Just you can proceed with that. You will get the entire thing in my power notes as well as the material. Just give your entire concentration on listening the things, because this marathon is highly useful for the student who are going to appear into the examination as a revision process. Okay, come here. The first and foremost issue, we will see certain important provisions of Companies Act. Important provisions, not all the provisions, very few provisions with respect to my accounting related issues. Next, we will deal format of financial statements of companies. Format of financial statements of companies. Next, we will see managerial remuneration. Managerial remuneration. Finally, we'll end this topic with concept of dividend. concept of dividend. Now, sir, why you are taking this chapter as a primary chapter at this level? Why you are taking? Sir, the concept of financial statements of a company is the universal concept. Whatever the chapter you can take up with respect to a company, the impact of such chapter is going to be carry forward. How I can tell this? Sir, without knowing eating, can you eat any product? I mean, the basic first, if you know how to eat a particular product, then you can eat any product. Just simply, logically, I'm telling. In the same manner, if you know the financial statements of a company, then if you go to the any chapter of a company, you can simply understand. That is the reason why I'm taking this chapter at this instance. Next, coming to the provisions of Companies Act 2013. Coming to the provisions of Companies Act 2013. What you are going to deal, sir? Please, all of you concentrate. This is very much important. I required exactly 5 to 10 minutes of time to know the things related to the company. So whatever the things you know with respect to the company as per Companies Act 2013 in the law, in very broader manner you will see. But with respect to our accounting, we will going to explain now. Sir, if you want to conduct a company type of business, first a company should need to be incorporated as per the Companies Act 2013. How you can incorporate a company? You can incorporate a company by filing a particular forms through the portal of MCA, Ministry of Corporate Affairs. A separate portal is there, which is a website portal. If you want, just I will open how the portal will look like. MCA. So this is the portal. This is look like this. So where you can apply the application. So each and every person will have a login ID. You can apply through that login ID. Different forms will be there under MCA services. If you check like this, we will apply. Sir, after applying for a company, MCA will issue COI, Certificate of Incorporation, which is known as COI. Just a second. It will issue COI, which is known as Certification of Incorporation. In Certification of Incorporation, the name of the company will be there. One number will be there, which is SIN number, Corporate Identity Number. So which is a SIN number. How our each and every individual is having a Aadhaar number in the similar way, which is a unique number for each and every company. After incorporation of that company, it will start conducting their business activities. Then as on the closure, as on the date of closure, it should need to prepare the financials. It should need to prepare financial statements. Sir, from starting onwards, you are using the word financial statements, financial statements. What is the meaning of financial statements of a company? Company financial statements comprising of balance sheet, statement of P&L, cash flow statement, notes to accounts. Notes to accounts. These all combinedly, we can call it as financial statements of a company. Balance sheet will tells to us the financial position of a company. The financial position we will know. Statement of P&L will tells to us performance of the enterprise. Cash flow statements will tells to us the liquidity position of the enterprise, as well as cash in and outflows from various activities we will know. Notes to accounts will provide the broader information, because balance sheet and statement of P&L is the summary information and the related content is there under notes to accounts. So which is the respective information to balance sheet and statement of P&L components. Notes to accounts are also form part of the financial statements. We cannot separate the financial statements as well as notes to accounts. That's why notes to accounts are also, I make it club into the financials. Next. Sir, once the financial statements are prepared, or the preparation of financial statements, it's whom responsibility, sir? The preparation of financial statements is the responsibility of the management. It is the responsibility of the management. Who is this management, sir? You know, company is a two-tier structure, or company have a two legs. If one leg is shareholder, another leg is management. Shareholders are owners of the company who contributed the money for the purpose of conducting the business activities. Management are the persons who actually conducted the business activities. They know about the business, though are the professional people. In generally, we will call it as board of directors. That means it is whose responsibility to preparation of the financial statements, which is the responsibility of the board of directors. Board of directors will delegate that responsibility to the finance department, who is the head of CFO, chief finance officer, in generally in any company. Once the CFO will prepare the financial statements, such financial statements are ultimately approved by whom, sir? Such financial statements are ultimately approved by board of directors. You know why? Because that is whose responsibility to prepare such financials? Board of directors. When board of directors will make it sign on the financial statements, then it is a clear representation that they are taking the responsibility of the preparation of such financial statements. Not only that, if any fraud or error occurred in such financial statements, it is the responsibility of the board of director as well. Now, the approved financials by the board of directors, is ultimately transferred to the auditor. Next, one more thing, just here I want to tell you, to approve such financials by the board of directors, they will conduct a board meeting. Actually, they will conduct a board meeting. How the board meeting will be? Company secretary will provide a proper invitation to all the board of directors to attend on a particular date. They will discuss on the affairs of the entity by seeing each and every component of statement of P&L and the balance sheet. If anything modification is required, then they will suggest. And the responsibilities also they will clearly explain in the board meeting itself through DRS, Director's Responsibility Statement. In what are the different issues we are going to responsible. You know the responsibilities, how it will look like. It is our responsibility, the preparation of the financial statements. If any fraud or error occurred in such financials, it is our responsibility. Sir, preparation of such financials as per the double entry bookkeeping system is our responsibility. While preparing the financial statements, we need to comply the GAAP, generally accepted accounting principles, which is nothing but applicable accounting standards. That is our responsibility. Such all things they will discuss along with director's responsibility statement. And one more thing, guys, in such board of directors meeting itself, they will propose the dividend as well. You know, they will propose the dividend as well, because who know ultimately on the affairs of the entity? Board of directors. They only assess the future of the entity. So that's why how much dividend need to ultimately given to the shareholders, who will give such proposal. Such proposal is given by the board of directors. So declaration is ultimately declared by the shareholders in their general meeting. That is different story. But initially who will propose? That is board of directors only. Now, the approved financials by the board of directors is on the hands of auditor. Now, auditor will issue audit report. Auditor will issue audit report by framing an opinion on the financial statements approved by the board of directors. Sir, which opinion we should need to give, how such audit report need to draft, how such audit should need to be conducted, that and all you are going to see in the chapter audit in your group 2. Now, along with the audit report, he means auditor will also affix his attestation under the financial statements. Now the financial statements are attested by two parties. One is auditor, another one is board of directors. Now the auditor plus attested financial statements are ultimately sending to shareholders. How these are sending to the shareholders, please all of you concentrate. Company will prepare a small booklet. In that booklet, audit report is there, attested financials, that I can put it as audited financials are there, plus directors responsibility statement is there. All such things will make it in a small booklet, which is known as annual report, In that annual report, it also contains an invitation to the shareholders as the last page. In such annual report, it also contains invitation to the shareholders to attend a general meeting, because who are the owners of the company? Shareholders. They should know the ultimate affairs of the entity, what is the financial position, how much current year profit we got, such all things they need to discuss with the shareholders. That's why the company should invite an invitation to the general meeting along with the annual report to fix AGM, which is annual general meeting. Such AGM only you are going to discuss in your paper 2, company law. Once the AGM is fixed, then all the shareholders will assemble in the AGM. Board of directors will also assemble. Auditor will also assemble. Then in such annual general meeting, they are going to discuss two different business matters. One is ordinary business matters. Another one is special business matters. Ordinary business matters and special business matters. Sir, ordinary business matters means it will cover 4 activities. One is declaration of dividend. So just 5 minutes back, I told you who will propose the dividend? Board of directors. Who will ultimately declare the dividend? Shareholders. So just board of directors can propose. If they propose 10%, sir, whether we can declare 10% or not, that is the discretionary power of the shareholders. But shareholders cannot enhance the dividend which is proposed by the board of directors. If they want, they can decrease, but they cannot increase. Next, appointment of auditors. Appointment of auditors for the next financial year. Who will see, sir? Shareholders as an ordinary business activities. Next, appointment of board of directors. Next, forthcoming board. Who will appoint, sir? Shareholders. Laying of books of accounts. Laying of books of accounts means ultimately they will also approve the books of accounts, because those are the owners of the company. Yes, everything we seen, okay, we approved. That is nothing but laying of books of accounts. Special business activities means other than business activity. That means if they are going to entering into the any new venture or any special issues, if they want to go to discuss, then they are discussing under the special business activities. Now, to attend this general meeting, in the annual report itself, they will provide a notice. Such a notice only in the company law, you read that, sir, 21 clear days notice should be required. Do you understand? All these are the procedural issues going to occur after preparation of the financials as well as audit before conducting of the annual general meeting, as well as on the date of the annual general meeting. Still the story was not ended. Now, after completion of the annual general meeting, such company should file 2 forms with the ROC. Such company should file 2 forms with the ROC. Sir, who is this ROC, sir? Register of Companies. Number of times I am using the word. Who is ROC? ROC is one of the regulator in Companies Act 2013. Sir, totally uh, three main persons are there to regulate the entire administrative provisions of the Companies Act 2013, or to administer the provisions of Companies Act 2013. Three different main regulators are there. One is NCLT, National Company Law Tribunal, which is the apex body as per the Companies Act 2013. Another person is regional directors. Entire India is divided into the 7 regions, each and every region having a one director. So in any issue is there in that particular region, so who is the head of that region is the regional director. That is southern region, northern region, northeast region, like the total 7 regions are there. Then for each and every specific state contains the ROC. If it is a Telangana state, in Telangana, Hyderabad, it is there the ROC. Sir, if it is the Tamil Nadu in Chennai, it is there the Tamil Nadu ROC. Do you understand? So like that, ROC for that respective state in which that company register office is located, just they are make it sent to 2 copies. One copy is AOC 4, which should need to be filed within 30 days. Another copy is MGT 7 or 7A within 60 days. Sir, why you are telling all such story right now, sir? Because whatever the financials you prepared, which is ultimately audited, which is ultimately approved by the shareholders in the general meeting, how it should know to the public at large as well as the regulator, it should need to be filed with the ROC in their respective forms. AOC 4 contains financial statement details. MGT 7 or 7A contains annual return. Annual return is nothing but who are all the shareholders are there, what is the shareholders pattern, what is the members register. So such all different information just they are giving in such annual return. AOC 4 and MGT 7A, both in generally we will call it as ROC filings in practically in a CA firm. In articles, you may file such ROC filings after completion of the annual general meeting. This is the compliance system we need to follow as per the provisions of the Companies Act 2013. Now, out of which, here I am talking about preparation of financial statements, right? Here I am talking about preparation of financial statements. This is whose responsibility? Ultimately, management, board of directors. Now, such financial statements should need to be prepared in true and fair manner as per section 129 of the Companies Act 2013. As per section, during this process, sir, there are different stages are there na? Preparation of financials, then ultimately approval by the board of directors, audited, then ultimately laying of books of accounts by the shareholders, and ultimately sending to the ROC. In all these different stages, at the primary stage, that is as per section 129 of the Companies Act 2013, the financial statement should need to be prepared in true and fair view manner. It is clearly given. What is the meaning of true and fair view, sir? True and fair view means such financial statements should need to be prepared, or such books of accounts should need to be prepared as per double entry bookkeeping system. Those books of accounts should be prepared as per the accrual basis system. Such financial statement should need to be prepared in the specified format which is given as per the Companies Act 2013, which is Schedule 3 of the Companies Act 2013. Such financial statement format should be as per the Schedule 3 format. Such a financial statement should be prepared free from errors and frauds. Free from errors and frauds. Then such financial statements are showing in true and fair view as per section 129. Now coming to Schedule 3. What is this Schedule 3, sir, all about? As per Companies Act 2013, total we have 7 schedules. Yes, not only the sections, subsections, provisions, sub-provisions, and a point, sub-points. All these are form part of the act. Not only those provisions, schedules are also form part of the act. Yes, Indian Constitution also have several schedules. As like Companies Act 2013, we have 7 schedules. So just I will show you the 7 schedules only for knowing the list of such schedule names, nothing else. Okay, just I'll open in my Google schedule as per Companies Act 2013. So just here list of schedules given. So please all of you concentrate. Schedule 1, just I'm highlighting this, memorandum and articles. Schedule 2 is related to depreciation. Schedule 3, just this is our required schedule, balance sheet and statement of profit and loss as per section 129. It is clearly given as per section 129. That means balance sheet and statement of profit and loss account we should need to prepare as per this schedule. Schedule 4, Code of Independent Directors. Schedule 5, appointment of managing director, whole-time director, and manager. Sir, one more schedule we are going to see in this chapter at the time of discussing the concept of managerial remuneration, which is appointment of managing director, whole-time director, or the manager, or the calculation of managerial remuneration. Two different schedules we are going to see in this chapter. One is Schedule 3, another one is Schedule 5. Then Schedule C is infrastructure projects. Schedule 7 is corporate responsibility. So just for knowing the schedule names, I showed here. Okay, fine. All of you, please come to my text, guys, here. Applicable provisions as per Companies Act 2013. Applicable provisions as per Companies Act 2013. Companies for which specific act is applicable. Specific act is applicable means in case of banking companies, Banking Regulation Act 1949 is applicable. In case of insurance companies, Insurance Regulatory Development Authority regulations are applicable. In case of electricity companies, Electricity Act is applicable. Any other company which need to prepare the financials as per their specific act, for which Schedule 3 is not applicable. For which Schedule 3 is not applicable. Such companies need to prepare the financials as per the format prescribed in such specific act. I'll give you a small example here. Out of the below industry, different industry based companies, we have one industry in group 2, which is the chapter name is banking company, where we will prepare the financial statements as per Schedule 3 of Banking Regulation Act. Schedule 3 of the Banking Regulation Act, not as per the Schedule 3 of the Companies Act 2013. Do you understand? For all other companies which are not covered in that specific act, where companies for which accounting standards are applicable, then Schedule 3 Division 1 is applicable. Companies for which IND AS are applicable, for which Schedule 3 Division 2 is applicable. Sir, what is this accounting standards? What is this Indian accounting standards? What is IFRS? At this stage, don't expect answers for such, because we have a separate chapters in section number 1, introduction to accounting standards. One topic is there where elaborative discussion I'm going to made regarding the accounting standards as well as IND AS and IFRS. Just for the time being, you can remember, if for a specific enterprises accounting standards are applicable, then Schedule 3 Division 1 is applicable for preparation of financial statements. For those companies for which IND AS are applicable, then Schedule 3 Division 2 is applicable. Preparation of financial statements as per IND AS or Schedule 3 Division 2, we are going to see in CA final syllabus. In CA final, FR, financial reporting paper, which is paper number 1. I'll explain the financial reporting in CA final such issues. Now coming here, either for the group 1 intermediate P1, that is paper 1, or the group 2 of intermediate, that is for paper 5, we are only going to see in the financial statements as per Schedule 3 Division 1, which is Division 1, Schedule 3 Part 1 dealing with balance sheet. Schedule 3 Division 1 Part 2 is dealing with statement of profit and loss account. That means we are going to see two different format for balance sheet as well as profit and loss account. So that's why my second issue here I'm going to take up is format of financial statements of companies. Sir, one more financial statements is there now, sir, which is cash flow statement. You are included in as one of the financial statements. Then is it for preparation of cash flow statements? Schedule 3 is not applicable? Absolutely. For preparation of cash flow statement, AS3 is applicable. AS3 is applicable. Schedule 3 doesn't applicable. For here in this both the cases, Schedule 3 is applicable. So that is the reason cash flow statement we are going to see as a separate chapter, even though it is form part of the financial statements. In the next few minutes discussion, almost the discussion will be for 15 to 30 minutes. Our entire discussion is towards the components of the balance sheet and the way of preparation of the balance sheet, as well as components of the statement of P&L and way of preparation of the statement of P&L, which is highly important to get good knowledge for other chapters as well. Please give your focus with a lot of attention while discussing the balance sheet and statement of P&L, guys. Here first we will see Schedule 3 Division 1 Part 1 format of the balance sheet. Then we will discuss a format of statement of profit and loss account. Please all of you come to my power notes. Right. Now, Schedule 3 Part 1, we are going to present in vertical format, which is balance sheet. Balance sheet items broadly categorized into two ways. One is equity and liabilities. Another one is assets. You know, in case of other than companies also, which is known as assets and liabilities and capital. Here, the equity represents shareholders fund. The equity represents shareholders fund. Liabilities will represent outside liabilities. Now, all of you, please concentrate. What are the different components we have under equity side as well as under liabilities? In case of shareholders fund, we will have share capital, reserves and surplus, money received against share warrant. These three, if you club, we can call it as shareholders fund. First, basically, what is the meaning of shareholders fund? You know already, in case of a company, shareholders are the owners of the enterprise. So the fund which is available to the shareholders or which was payable to the shareholders at the time of liquidation of the company, at the time of closure of the company, how much what you should need to make it payable to the shareholders is known as shareholders fund. Another name for the shareholders fund is also net worth of the company. Net worth means assets minus outside liabilities. Here, if you check, the total of the assets minus outside liabilities is nothing but, again, you are getting shareholders fund. Now, out of which the first component is share capital. Sir, here first we will see one by one component and how it is going to be presented. I'll check with our main material. That is how it is going to be presented in a single statement. Probably you would already known such fact, but still I'll discuss each and every issue, but which is very much important because they might ask questions based on the Schedule 3 provisions for 5 marks. Apart from the that is the main question, prepare a statement of P&L as well as balance sheet of a particular company. Apart from that question, they may also try to ask certain practical questions based on the Schedule 3 as well. Now, this discussion is highly important to crack the problem for 5 marks related to the practical question, as well as that is the main question if they at any point of time ask the full-fledged problem with respect to statement of P&L as well as balance sheet. Not only that, which is a base to build a balance sheet or the statement of P&L in any other chapters as well. So that's my sincere request to all of you, pay a lot of attention at the time of discussing the things now itself. Sir, in share capital, what are the issues we are going to give as a notes to accounts? Now, one thing you should need to know, before discussing all such things, in schedule 3, part 1 balance sheet, the basic format, I'm telling you the basic format, how it is look like. We'll start with the name of the company and the balance sheet asset so and so date. This is related to the serial number. The first column, it is subdivided into 3 columns, which is nothing but the serial number, then particulars, then note number, current year figures, and previous year figures. In academics, most of the times we will only use the current year figures. We are in generally not using the previous year figures unless otherwise the previous year information is also given in the problem. Next, you know already whether it is balance sheet or statement of P&L. In that specific sheets, we can only find out the summarized information. The detailed description of each and every component, you may get it under notes to accounts. Notes to accounts. So whenever I'm talking about the description of the individual component of the balance sheet, you can think about that specific note number. Sir, is there any necessity to provide the note number in rigid manner? Rigid manner means, sir, is it share capital note number is 1, reserves and shares surplus note number is 2? Is it always the same note numbers? No. Sir, if any specific item is not available in that specific company, no need to make it present that specific component in the balance sheet at all. So schedule 3 will give a lot of flexibility at the time of making presentation of the individual items in the balance sheet as well as statement of P&L. Is it okay, guys? Now come back to the component first. Let me explain one by one component. Under the shareholders fund, share capital, the total you may represent under the equity and liabilities, which is the bigger component, which is the first component, equity and liabilities. Under that shareholders funds, we are representing under the shareholders fund a share capital. Now in notes to accounts, what are all the different issues I need to clearly disclose? Number and amount with respect to authorized share capital, issued, called up, paid up. What is the meaning of authorized share capital as per Companies Act 2013? The maximum share capital can be issued by the company in its life is known as authorized share capital. So that means if I fix the authorized share capital as 10 crore, I cannot issue more than 10 crores to the public for the purpose of issuing, for the purpose of getting the shares from the public. I cannot eligible to issue furthermore. No, that's not the meaning. If you want to increase the authorized share capital, the sufficient backup provisions are given in the Companies Act 2013 itself. You should alter your capital clause in the memorandum of association. You know, each and every company having bylaws, which is known as MOA and AOA. Memorandum of association will tells the reason for existence of the company. Articles of association will tells rules and regulations internally followed for smooth running of the business, which combinedly we can call it as bylaws of a company. In such memorandum of association, we have different clauses, that is name clause, registered office clause, that is registered office or situation clause, capital clause, liability clause. So many clauses you may come across in your company law subject under company, in the paper law under company law subject. Am I right? Now where the authorized capital is not form part of the capital, is not form part of the actual paid up capital, but still you should clearly represent how many number of shares you can maximum issue in the life, in the total life of the company. You can clearly represent and you can put it as a separate blank. If authorized capital, if you want to shown here, that is, sir, 1 crore equity shares at the rate of 10 rupees each, total 10 crore. You can put it as a blank like this. Now this is not form part of the total paid up capital under notes to accounts. Next, out of this currently, how many number of shares you are issued to your public? That is nothing but issued capital. Now the entire issued capital is not necessary for the company. Accordingly the time frame, accordingly the necessity, they will ask money from the public. For example, if the project is ongoing, now the required amount they will ask right now. After 2 years, to complete the remaining project, they might ask the remaining amount. So that's why there is a difference in between issued capital and called up capital. Now once if you made a call, how much amount you can collected from the each and every particular shareholder, is nothing but paid up capital. Sir, I'm not here to discuss each and every part in elaborative manner because the concept of the basic issues of company accounts, you already dealt in your foundation or the graduation level. So simply I'm explaining, you need to describe number as well as amount for each and at every relevant stage, that is authorized, issued, called up, and paid up capital. One more, if any particular shareholder who holds greater than 5% of the total share capital, you should clearly describe how many number of shares he hold, what is that person name, that is the total amount held by him. You should clearly describe. In the last 5 years, in the last preceding 5 years, for example, this year there are a current reporting period. In the last 5 years, shares issued for consideration other than cash. How many number of shares issued for consideration other than cash? Sir, what is the meaning of consideration other than cash? Maybe you issued shares, you purchased an asset. On behalf of making the payment, you issued the shares. On behalf of making the repayment of a liability, you issued the shares. At the time of acquisition of another company, on behalf of giving the cash as a purchase consideration payable to the other entity, you may issue your company equity shares. Such all things you may call it as shares issued for consideration other than cash. How many number of shares issued? You should clearly provide the description. Next, number of bonus shares issued in the preceding 5 years. We have a separate chapter, things related to bonus shares, but as a disclosure, in the preceding 5 years, if you are issued any bonus shares, you can clearly give the description. In the same way, number of buyback of equity shares. Buyback of equity shares means if the company is having the adequate funds and the company is unable to utilize the amount which is collected from the shareholders, then the company want to make the repay to the amount to the shareholders. Such equity shares may directly bought from the open market. After purchase of such equity shares, they are simply cancelled with the existing equity shares, which is known as the concept of buyback of equity shares, which also have a separate chapter in your group 2 syllabus, not in the group 1. So any of such number of buyback happened in the last preceding 5 years also, you should clearly describe. Next, any convertible debentures or preference shares are converted into shares in the preceding 5 years also, you should clearly provide. Sir, here actually they might ask a practical question. What is the practical question? I will tell you, concentrate. A company issued the bonus shares in the last 5 years once, but in the disclosure, it doesn't provide the information from which resources they are issued such bonus shares. Is it violation as per schedule 3? Can you please all of you tell me the answer? The company issued the bonus shares in the preceding 5 years, but it doesn't provide the description with respect to the source from which such bonus shares issued. Is it violation as per Companies Act 2013? Maybe you may thought that it is a violation, but the answer is no. Sir, it is clearly given that we should need to provide the description with respect to the number of bonus shares issued. No need to provide any description with respect to the source from which you are issuing the bonus shares. Other than this, no description is required. No description is required. No description is required. That is source from which such bonus shares you are issued, for which no description is required. That is the practical question they might test. Okay, so not only that, some more disclosures you should need to give. Promoters contribution. Who are the promoters? You would already seen in your P2, that is company law again. The persons who have the thought process to initiate the company, that is who want to start the company, are particularly known as the promoters. Out of the existing equity share capital, promoters contribution is how much? Is it 10%? Is it 5%? Is it 20%? You can clearly establish such fact. Calls in arrears made by the directors of the company. Because why you should need to provide a separate disclosure about this fact? Sir, if the director itself is unable to make a repay at the time of making call by the company, then what about the general public? So what is happening internally in the company, everything will have a doubt. So that's why if any calls in arrears made by the directors of the company, you should specifically mention at the time of presentation of the financial statements. Now, for the share capital, the following disclosures, what I discussed till now, you should separately provide both for equity share capital as well as preference share capital. Authorized, issued, called up, and paid up. Both you should give for equity as well as preference. Next, in the preceding 5 years, sir, equity shares are the preference shares issued for consideration other than cash. Separately, you should disclose. Bonus shares and buyback, which is only related to the equity shares anyway. Am I right? Next, any convertible debentures or preference shares are converted into equity shares in the preceding 5 years also you should need to provide, and percentage of the promoter's contribution, and one more thing, calls in arrears made by the directors you should clearly describe. Next, coming to the reserves and surplus. First of all, what is the difference between reserve and surplus, and what is the difference between reserve and provision? First, let me explain the difference between reserve and provision in very simple manner. Please, all of you come to my text. Here in the fundamentals, actually, I forgot to explain the difference between reserve and provision. Now I'm going to explain. Sir, reserve is appropriation of profits. All of you, please come to the second point. Reserve is an appropriation of profits. Provision is charge against profits. This is related to the treatment. Here I am not explaining the meaning. First, I am directly go to the treatment. Sir, appropriation of profits means if profits exist, you need to create. Provision means irrespective of the profitability position, even though in the current year, if you end up with losses, still you need to provide the provision. This is with respect to the treatment. Sir, with respect to the meaning, the portion of profit kept aside for unforeseen obligations. We don't know what happened in the future. So it is better to put aside certain amount for any of the future uncertain, unforeseen obligations, which is known as reserve. Provision means which is a known liability. In future, you are going to crack such liability. In future, you are going to incur such expenses. If that is the case, in the current year, to compensate such liability or expenses, you are establishing out of the current year profits certain amount which is known as provision. Sir, in detailed discussion with respect to the provision will be there in AS 29 in the group 2, which is provisions, contingent liabilities, and contingent assets. This is not the right time to discuss things related to provision much more. Okay, fine. Now, coming to the reserve. Sir, can I utilize payment of dividend out of reserves? Absolutely. Not from all the reserves, that from free reserves. Free reserves. Yes, free reserves can be useful for the purpose of declaration of the dividend. What is the meaning of free reserves, sir? I'll explain here itself. Just hold for some time. Provision is straight away not useful because provision we are going to create in the statement of P&L. Reserves are there under the balance sheet. That is the difference. Presentation in the financials shown in the reserves and surplus under the shareholders fund, either reduced from the asset or shown under the liabilities, which is debited in the P&L as well as shown under the liability. Sir, the journal entry for creation of reserves are, you should reduce the P&L, you should create the reserve. That is profit and loss account at R2 reserves account. Such P&L is nothing but surplus. Surplus account at R2 reserves is the entry. For creation of provision, the entry is profit and loss account at R2 provision account straight away. Now this provision, you are need to make the debit under statement of P&L. Now you are reducing the surplus in the balance sheet notes to accounts, but not under the statement of P&L. That is the difference. Hope you understand. So the concept itself is quite different from reserve to provision. Reserve is created to attend any uncertain or the unforeseen obligations, to cover any unforeseen obligations. Provision you are creating for the purpose of meeting the known liability. That itself is the difference, and which is the charge against, which is the appropriation of profits. Okay, come back. Now we are in the concept of reserves and surplus. Now just now we seen the difference between reserve and provision. Now I'm going to explain the difference between reserves and surplus. Surplus is nothing but P&L. Reserves are nothing but other than P&L. Now such reserves we can broadly categorize it into two ways. One is freely usable or free reserves. Another one is restricted or specific purpose or the capital nature. Please all of you concentrate. What is the meaning of free reserves, sir? Those reserves which we can utilize for the purpose of distribution of the dividend. For the purpose of distribution of the dividend, such reserves we can in generally call it as free reserves. Sir, which type of reserves in generally we can use it for distribution of dividends, sir? that is general reserve and a profit and loss account. Even though P&L account is a surplus, we can directly utilize for the purpose of declaration of the dividend without any hesitation. That's why general reserve and P&L account are in generally known as free reserves. Restricted reserves, which are useful for only specific purposes. Capital reserve is a restricted reserve. Revaluation reserve is a restricted reserve. Statutory reserve, so the obligation of creation of statutory reserve itself is for a specific purpose defined in such specific statute or the act. Securities premium, yes, as per the Companies Act 2013, securities premium have only the limited uses. The section is also section 52 of Companies Act 2013. Do you know the uses of the securities premium? Would already learned in the paper 2 company law. Just here briefly I'm explaining the uses of the securities premium, why it is so called as a restricted reserve. Securities premium can be utilized to set off premium on redemption of preference shares, which is also useful to set off premium on redemption of debentures. That is premium on redemption of preference shares and premium on redemption of preference shares. You can utilize securities premium. Securities premium is also utilized to set off premium on buyback of equity shares. Buyback of equity shares. Securities premium we can also utilize it to set off so to set off underwriting commission or share issue expenses. Do you understand? So securities premium also we can utilize for the purpose of issue of bonus shares. Yes, these all are the different utilizations of the securities premium. Securities premium cannot be utilized for the purpose of distribution of the dividend. Okay, so in detail discussion will be there in the chapter redemption of preference shares. Again, one more time I explain in the elaborative manner things related to the securities premium. Okay, sir, now my question is it reserves and surplus can be negative? Is it reserves and surplus can be negative? Obviously, sir, the current year loss is more than the accumulated profits and accumulated reserves, then the reserves and surplus balance will become negative. That means there is no guarantee to get the reserves and surplus always be the positive. The negative figure can also we can accept. Yes. Next, one more thing. How such reserves and surplus we need to present in our notes to accounts. Whether it is a surplus, that is P&L, whether it is a reserve, we should start with opening balance. First, let me explain things related to surplus. Surplus is nothing but profit and loss balance. Opening balance is nothing but up to the previous year, what are the total accumulated profits available in P&L account. Add current year profits. Now you should reduce certain appropriations. Appropriation means if you are declared any current year dividend out of the current year profits. If you declared any current year dividend out of the current year profits, then current year profits need to be decreased. If you issued any bonus shares out of the current year profits, now you should decrease the P&L. If you are transferring any amount from P&L account to the reserves, which is in the form of appropriation of profits, you should need to reduce the current year P&L. Then the balance of P&L you can show under the surplus. Now coming to the reserves, we will start with opening balance, add current year transfers, any utilizations, any reserve, whether it is general reserve, statutory reserve, securities premium, or capital reserve, or any reserve, you can start with opening balance, add current year transfers, less current year utilizations, then automatically you will get closing balance, that is with respect to reserves. Now reserves plus surplus, you can club it, then you can show under reserves and surplus under shareholders fund. Next, coming to money received against share warrant. What is the share warrant is all about? You might again seen in the subject so-called as company law, the difference between share certificate and share warrant. So in very simple manner, what exactly the meaning of share warrant, sir? Share warrant is an instrument. Share warrant is an instrument which shows or the possession of which shows the title of that share. I mean, who is the owner of that share, sir? If such certificate is on my hands, I will become the owner. If such certificate is transferred to the another person, physically by giving to the another person, then the other person will become the owner. Simply share warrant is a negotiable instrument. At the time of making transfer from one person to the another person, there is no process of registration is involved. But in case of the normal shares transfers, first you should intimate to the company, then company will remove the old member from the register of members, then they will enter the new member into the register of members. That doesn't applicable in case of the share warrants. So simply speaking, for example, you are just going to a movie, you bought the movie ticket and you lost that movie ticket. That movie ticket is ultimately found by another person, whether he can able to see in that movie, sir? Yes, especially because which is a negotiable instrument. Sir, negotiable instrument means who is the owner, sir? That certificate is in the whose possession, that party can become the owner of that particular asset. In the same way, the situation of the share warrant is as like the movie ticket. If the share warrant is in my hands, I'll become the owner. If the share warrant is in another person, he will become the owner. But practically speaking, right now, no company is going to issue such share warrants. In the olden days, just they issued the share warrants because right now the entire share certificates are in the dematerialized forms. Just whenever the purchases and sales are occurring with respect to such shares, automatically the members registers also got updated by using the systems or the softwares. Okay, let it be, just leave it. If any share warrants are there, if you collected any money against the share warrants, you can put it here. Sir, is it form part of the shareholders fund or not? Yes, it is also form part of the shareholders fund. The holder of share warrant also got the dividend. Such holder of share warrant is having the equal right with respect to the voting as well as dividend. All are at par with the shareholder. The only difference is it should not clubbed with the share capital. It is separately shown as a shareholders fund. Do you understand? So this is the form part of shareholders fund, guys. Now come down to our format. So here under equity and liabilities, under the shareholders fund, totally we discussed these three things. One is share capital, reserves and surplus, money received against share warrants. One more thing, guys, before seeing the liabilities, before discussing about the liabilities, just I want to tell you things related to one of the important reserves and surplus. Sir, in the chapter employee stock option outstanding, that is again I'm telling you, not at all relevant for you, not at all relevant for group 1 students, which is relevant for group 2 students. Actually, share option outstanding account, one account is there which is actually form part of reserves and surplus. Sir, what is the meaning of share option outstanding account? You'd seen in the employee stock option plan. I can't explain what exactly the meaning of share option outstanding account here, which is also one type of reserves and surplus, which should be shown under reserves and surplus. Sir, why you are then emphasizing to learn such point? Because in the previous RTP, just they tested that, sir, just he given some list. Out of the given list, one of the item is share option outstanding account, where you are going to show where you are going to show under the financials. Just he asked, now you can simply represent it under the reserves and surplus. Just I am adding here for your benefit. So which is, just I'm adding here, guys, which is share option outstanding account. But don't bother. Once, if you are my group 2 student, in marathon also I will cover what exactly the meaning of share option outstanding account. Then you can get the information, things related to share option outstanding account there, because which is very big concept. We are in the revision session. I can't take up right now. Yes, come down, guys. Fine. That's it. This is related to equity and liabilities under shareholders fund. Now, one more component is share application money pending allotment. What about this, sir? As on the balance sheet date, the situation is look like this. Our company already issued the prospectus. You know, the prospectus is the document which is used by the company at the time of issue of the shares, at which price the company is going to issue, what are the terms and conditions at the time of issue, is there any underwriting assignment is there. The each and every terms and conditions are simply specified in that document, which is known as the prospectus. Now the situation is, company collected the application money, but for the allotment still pending is there. I mean, the subscription was closed. Company already collected money from the public in the form of application money, but still the allotment date is not yet started. They just not opened the applications which were received by me. They are having certain cutoff dates. After reaching that cutoff date, they will open the entire applications. If it is the oversubscription, then they will allot on the basis of pro rata allotment. That is, if you issue the 10, if you applied for the 10 shares, on the basis of that, just they may allocate only 2 shares or 3 shares according to the number of applications received by the company. Now the situation is application money received, but the allotment is pending. Then at that point of time, you can show it as a separate line item. To be frankly speaking, it is not an equity, it is not a liability as well. Not an equity, it is not an, it is neither an equity nor a liability. The reason I will tell you, sir, to tell it is a equity, it should form part of the share capital. As per the Companies Act 2013, unless otherwise a company is allotted a share, unless otherwise the company is not allotted that share, it will not form part of the share capital. Because if it is the oversubscribed, the company may give back the money to the public. That's why it is not a equity. It is not a shareholders fund. It is not a form part of share capital as well. So then is it liable? No, it is not liable right now because the allotment is not yet started. They don't know whether it is oversubscribed or not. Do you understand? So that's why till the time period, it is shown under a separate line item, which is share application money and pending allotment. But at this stage, I want to tell you one more point. Sir, allotment over, sir, but application money still is on the hands of the company, sir. Then still can I show here? No. If the allotment is over, but the application money is overdue to repay. Because if it is oversubscribed, then the excess application money is in the hands of the company, sir. Then along with the application money and commission, and interest on such application money should be need to be payable by the company to the outside party within the prescribed time limit as per the Companies Act 2013. They are specifically given that is 1 week or 10 days. I don't have a exact idea. Just leave it the number of days. But the company should need to make the repay the oversubscribed application money to the public within the prescribed number of days. If it is not payable within such prescribed number of days, it should need to incur such penal interest as well. Then under which head I need to show that application money along with interest, I need to show it as a liability where it should need to record. It should need to record under current liabilities, under other current liabilities. I'll explain you while once I'll at the time of discussing things related to current liabilities. Sir, if the allotment is still pending, then I can put as a separate line item. Allotment was over, sir, but still the application money is overdue. Still there is a need to make payment of the excess application money collected. Then it will become as a liability. Okay, just leave it that item as well. Now coming to liabilities, guys. All of you, please come to liabilities component. Under liabilities component, two things are there. One is non-current, another one is current. Sir, what is the definition of non-current liability? What is the definition of current liability? Sir, it is separately given in Companies Act 2013 as per Schedule 3. But I don't want to define the entire terms which are used in the non-current liability definition and current liability definition at this stage. It's very simple. In simple manner, non-current liability is nothing but amount payable by the company from the date of balance sheet. The amount payable by the company from the date of balance sheet, if it is greater than 12 months, amount payable to the other party, the due date is occurred for greater than 12 months, then I can put it under non-current liabilities. From the balance sheet date within 12 months, if the company is necessity to make payment to the other party, then I can put it under current liability in the simple manner to check it. But as per the definition, there are so many things covered there. That is the liability, if it is covered within the operating cycle, then which is known as current liability. Do you understand? So the other party, different terminologies just they used. I don't want to make it confused, and I don't want to make it complicated as well. In very simplest form, you can just simply remember like this. Non-current liability is nothing but from the balance sheet date, the amount payable, the due date is occurred after 12 months, then I can put it under non-current liability. If the due date is occurred within 12 months, I can put it under current liability. Now, under non-current liabilities, the components are again divided into 4 parts, which is long-term borrowings, deferred tax liability, other non-current liabilities, long-term provisions. Now, first all of you come to long-term borrowings. Sir, what is the meaning of long-term borrowings? Long-term borrowings are nothing but borrowings made by the company, either from banks or from the public or from any third party or from the private people, and which should be repayable after 12 months, which are known as long-term borrowings. I can give different examples for long-term borrowings. Consider it, guys, all of you. Sir, bonds issued by a company to the public, which is a long-term borrowing. Deposits which are collected from the public, which are repayable after 12 months. In general, long-term deposits are categorized for the long-term borrowings. Term loan taken by the enterprises from the banks. For the purpose of purchase of the factory, I took loan. The repayment schedule was for approximately 10 years. I will repay the entire amount, which is term loan. In terms, I am repaying. So all the term loans are coming the picture under long-term borrowings. Debenture issued by the company to the public, which is categorized as a long-term borrowing. To put it simply, we borrowed from either public or from the private people or from the banking companies, and the repayment is happened after 12 months, or it required for more than 12 months, then which is categorized as a long-term borrowings. Sir, deferred tax liability under non-current liabilities and deferred tax asset under non-current assets. We are not discussing at this stage, which is a group 2 topic. There is a separate standard called AS22 accounting for taxes on income, where the elaborative discussion I'm going to make things related to deferred tax liability as well as deferred tax asset. But only one thing is occur, either deferred tax liability or deferred tax asset. If you are my group 2 student, you can listen the group 2 marathon. There I will clearly explain the things related to DTL and DTA. For the time being, you can ignore. Now, other non-current liability is a residuary head. Residuary head means if it is not put under long-term borrowing, not put under DTL, or not put under long-term provisions, then you can put under other non-current liabilities. That's why we can discuss at the final level other non-current liabilities. For the time being, you can ignore. Now come to the long-term provisions. Sir, under long-term provisions, which type of provisions I can represent here? Sir, we seen provision is a charge against profit, right? The entry for provision is profit and loss account data to the respective provision. Am I right? Now you should need to debit the profit and loss account, and ultimately such provision you are need to show under liabilities. Under which head you are need to show, sir? If the provision or the liability is going to occur is after 12 months, then you are going to show under long-term provision. No, sir. The liability is going to occur in the forthcoming year within 12 months. Then you are going to show under short-term provisions under current liabilities. And one more thing, sir, what exactly represent the provision? What exactly represent the contingent liability? What is the meaning of contingent asset? You are going to see through AS29 again, which is another accounting standard of group 2. Sir, I can't avoid all such standards, sir, because literally there is no difference between group 1 accounts and group 2 accounts. Just split it off into two different papers due to the subject huge subject nature. That's it. So whenever the related sections are there, or related provisions are there, or the related accounting standards are there, I'll code whether it is related to group 1 or group 2 or the Companies Act or the income tax, whatever the case may be. Okay, fine. Sir, now can you please one example for the long term? Can you please give one example for the long term provisions, sir? I told you the liability is going to occur is for greater than 12 months. For example, provident fund need to be payable to the employee at the time of retirement. Gratuity is payable to the employee at the time of retirement. All the provisions for employee benefit expenses, you can call it as a long-term borrowings. Now, in the current year profits, you are put aside for the long-term obligations, which is nothing but a long-term provision. Do you understand? Now, some important issues I'm going to discuss here. Concentrate, all of you. So first, let me finish the current liabilities as well. Then I will discuss such important issues. Okay, please let me allow to the current liabilities as well. Sir, now under non-current liabilities, the first component is long-term borrowing. Here, the first component is short-term borrowing. Whether you can take a borrowing from the public or again from the bank or from the third parties or from the private people, you should need to represent under short-term borrowings. Sir, if it is from bank, which type of borrowings, short-term borrowings you can take up, sir? Overdraft facility, cash credit facility, Such all things are how like you took the term loans from the banks, we can categorize long-term borrowings. If you took any overdraft or the cash credit from the banking companies, we can categorize it as a short-term borrowings. Do you understand? Or if you take any borrowings from the general public, which should be repayable within 12 months, then you can categorize it under short-term borrowings. Coming to the trade payable, next item is the trade payable. Sir, trade payable is related to the trade plus payable. With respect to the business, what are the amounts we can be payable, we can call it as a trade payable. With respect to the business means at the time of purchase of the goods. At the time of purchase of the goods or at the time of raw material supplied by the suppliers, if you need to make any payment to the other parties, then we can call it as trade payable. That is nothing but creditors. That is nothing but creditors. And bills payable is also coming under the category of trade payable. So trade plus payable, during the trade, what are the amounts should be payable, which are categorized trade payable, which are form part of general creditors and bills payable. Short-term provisions. Sir, within 12 months, what are the different obligations you should need to incur? Provision for tax. Sir, for the current year profit, how much you achieved in the current year, which is nothing but in income tax point of view, which is the previous year income. Now, the assessed income in the previous year, sorry, the income which you generated in the previous year is ultimately assessed in the assessment year. At that point of time, you should need to file an income tax return and you need to pay the tax to the government. That means if from the closure of the financial year, within 12 months, you need to incur the liability of the tax, right? For that purpose, you should need to incur provision for tax. Provision for tax, where I should need to represent, sir, which need to represent under short-term provisions only. Not only that, what are all the different provisions? Maybe that is provisions with respect to the warranty expenses. Sir, your company is in the process of production of certain electrical equipments, or maybe in the electrical fittings, bulbs. Am I right? Now, depending upon the warranty period time, you may replace such item or you may repair such item. ACs, refrigerators, washing machines, all such electronic equipment warranties are there. Now, depending upon your experience, out of the assets sold, you may certain goods are come back for the claiming the warranty. At that point of time, you need to incur the warranty expenses. So such provision for warranty expenses also you can put under the short-term provisions. Other current liabilities, which is a residuary head. Other current liabilities as well as other non-current liabilities, which are residuary head. Now, all of you please concentrate here. Sir, under residuary head of other current liabilities, what are the different items will take place, sir? Sir, outstanding salary payable, where I can represent, sir. Is it a short-term borrowing? Is it a trade payable? Is it a short-term provision? No, you can represent under other current liabilities. Income received in advance, commission received in advance, sir, which is a liability. I told you in the fundamentals. Sir, commission received in advance, where I can show, sir, under other current liabilities. So all outstanding expenses, income received in advance, all such things we need to represent under other current liabilities only. Now, all of you please concentrate. Now, certain important points I'm going to discuss. The concept is related to current maturities of long-term debt. Do you listen this word anywhere? Current maturities of long-term debt, which is the amendment, latest amendment as per the notification given by the MCS circular. So if you want the circular number as well, then I'll drag this. Okay. Which is the notification given as on March 24, 2021. Here it is there. March 24, 2021 notification. Current maturities of the long-term borrowings. Earlier, they are classified under other current liabilities. Now we are classified under short-term borrowings. So before discussing all such things, first you should know one thing. What is the meaning of current maturities of long-term debt, sir? What is the meaning of current maturities of long-term debt? Please, all of you concentrate. Example here itself is there. I am going to explain through my power notes. Sir, as on 1/4/2018, I mean in the year 2018-19 beginning, in the year 2018-19 beginning, I issued 10% debentures for the worth of 10 lakhs. The terms of issue of debentures are, out of this 10 lakhs, 40% of the debentures I'm going to redeem at the end of the 4th year, and the remaining 60% of the debentures I'm going to redeem at the end of the 8 years. That is the terms and conditions at the time of issue of debentures. Now, for the financial year 18-19 ending, you know, debentures are categorized as a long-term borrowings. Tell me, guys, the repayment period is after 12 months. So that's why debentures are shown under long-term borrowings straight away. For 1920 also, the 10% debentures are showing under the long-term borrowings. Now, at the end of the 2021, please all of you concentrate. At the end of the 2021, from 31st March 2021, within 12 months, you need to repay 40% worth of the debentures out of 10 lakhs. That is 4 lakhs worth of the debentures you need to redeem within 12 months from 31st March 2021. Now, for the financial year 2021, to that extent of current maturity of the long-term borrowing, out of this long-term borrowing 10 lakh, 40% is the current maturity. Such current maturity, you should need to term it as short-term borrowing. Sir, this time I'm expecting question on schedule 3 based on this concept, which is the latest amendment occurred, which actually placed in the previous RTP as well. But even they didn't test that question. But this time I'm going to expect such question, guys. The same topic I already covered in the regular classes as well. One more time I'm emphasizing in my marathon here. Next, sir, as on 31st March 2021, the remaining worth of 60% is still we are showing under the long-term borrowings itself. Earlier, this current maturities of the long-term borrowings we shown under the other current liabilities. We shown under other current liabilities. But after amendment takes place, the current maturities of the long-term borrowings we are shown under the short-term borrowings. Sir, anyway, now it is not a non-current liability, because within 12 months the obligation is need to be incurred. It is current liability only. I do agree the 40% is under current liabilities. Which head I need to show? Is it under short-term borrowings or under other current liabilities, sir? I should need to show under short-term borrowings due to the latest amendment occurred as on March 24, 2021 notification given by the MCA. Okay, come back. Come back to my list, guys. All of you come to the text here where I am. Yeah, so I am under non-current liabilities and current liabilities discussion. Under non-current liabilities, long-term borrowings will be there, deferred tax liability will be there, and other non-current liabilities will be there, which is residuary and long-term provisions are there. Under current liabilities, short-term borrowings are there, trade payables are there, other current liabilities are there, and one more. What is that? Last one, short-term provisions are there. I explained all such things. And one more, one or two important issues actually I forgot. I'm going to cover such things through this text. Concentrate, guys. In case of long-term borrowings, it may bonds or debentures, it may be term loans, it may be deposits, it may be the loans and advances taken from the related parties. I covered everything, right? Next, other long-term liabilities, which is nothing but other non-current liabilities. Other non-current liabilities, which is a residuary head, guys. I don't want to discuss anything which is a residuary head. So which is actually point number 3. Next, long-term provisions. I skipped deferred tax liability if you see on the notes to accounts, because deferred tax liability entire discussion will be there in AS 22. Long-term provisions, sir, which is provision for employee benefits and others. I already told you provision for employee benefit expenses like PF and gratuity we are shown under the long-term provisions only. Short-term borrowings, sir, if you took any borrowings and repayable within 12 months, we can categorize the short-term borrowings. That is from banks, CC, OD, such all things will categorize from the banks. And if any of the deposits, if you take, such all things will be coming under the short-term borrowings. Now, please, all of you concentrate here. Current maturities of the long-term borrowing shall be disclosed separately in case of the short-term borrowings only. Current maturities of the long-term borrowing shall be disclosed separately in case of the short-term borrowings only. Now, come back, guys. Where is the earlier discussion? It is here, right? Now, please, all of you concentrate. I'll ask one more question for your clarity. Sir, now I am in the year 21-22. Let us assume I am in the year 21-22. As on 31st March 2022, the situation is like this. The company is not redeemed the debentures. The debentures are still outstanding for that 40% extent. Now, as on 31st March 2022, Now, to the extent of that 40%, that is 4 lakh worth of 10% debentures, where you can classify as on balance sheet date, because the company is not redeemed, right? Company is not repayable the amount to the outside party. Now, as on 31st March 2022 in the year 21-22, under which head you are going to represent? No doubt about it, which is a current liability. Now you are going to represent under other current liabilities. Sir, current maturities of the long-term borrowings you can represent under short-term borrowing. That's okay, fine, as per the latest amendment. But which is already due, but the person is unable to redeem the debentures, as well as the person also should need to pay the interest on such debentures as well. Sir, if he redeemed as on the due date, no need to repay the interest for the remaining period. If he was not redeemed as on the due date, then from the actual date of the redemption to up to the date of the actual date on which he need to be redeemed, from the date to the actual date of the redemption, you should also need to make payment of the interest as well. Then principal is outstanding, then interest is also outstanding, both the amount clubbing you should need to pay. Then at that point of time, we cannot classify it under the short-term borrowing. Where we can classify under the other current liabilities. Under which head, sir, we need to classify? I given here, which is unpaid matured debentures and interest accrued thereon under other current liabilities. Unpaid matured debentures, which is already matured. Debenture itself is matured as on 31st March 2022 in my example, but they're not paid. Unpaid matured debentures and interest accrued thereon, which is shown under other current liability. Here I gave another example actually. Sir, in 1920, as on 31st March 2020, they are going to, what is this example actually? Just a second. Yeah. So we are in the 1920. In the next year, in 2021, such debentures are going to be redeemed. Then for the year 1920, as on 31st March 2020, I will show it under short-term borrowings as current maturities of long-term debt. Now in the year 2021, still, if such debentures are not redeemed, then I should need to represent under other current liabilities under the head unpaid matured debentures and interest accrued thereon component. So this example is all about the debentures are going to be redeemed in the year 2021. Maybe the due date is, I'll clearly give, maybe the due date is 31st December 2021 is the due date, guys. Let us assume the debentures need to be redeemed as on 31st December 2021. Now the situation as on 31st March 2020. Sir, is it the debentures are going to be redeemed within 12 months? Yes, sir. From 31st March 2020 to 12 months means up to 31st March 2021. Within 12 months means this is the due date, means I need to, sorry, it is not 2021. I'm so sorry, which is 2020. Okay. The due date is 31st December 2020. From 31st March 2020 to 31st December 2020 means within 12 months I need to redeem. Then for the year 1920, I'll represent under current maturities of the long-term debt. So which is categorized as a short-term borrowing as per the latest amendment. Now for the year 2021, 31st December 2020, company not repaid the amount. Then which is not the current maturities of the long-term debt, which is unpaid matured debentures. The maturity already takes place, but we are unpaid. Now at that point of time, which is shown as a current liability, but under other current liabilities. Now the same text I'll show here. Under the short-term borrowings, current maturities of the long-term borrowings were disclosed, and under other current liabilities, unpaid matured debentures and interest accrued thereon we shown under other current liabilities. Sir, a very thin difference in between the short-term borrowing and other current liabilities. A very thin difference in between short-term borrowings and other current liabilities. In the next year, the maturity takes place, will shown under the short-term borrowings. Already matured, sir, but we're not paid, shown under the other current liabilities. Sir, whether it is debentures, whether it is the bond, whether it is the deposit, the same concept. Here he used the deposit, here he used the debentures, both are same. Next, sir, still lot more discussion is there. Things related to other current liabilities. Concentrate. Sir, under current liabilities, what are the different things will come? I already told you outstanding expenses, income received in advance. All are coming under the other current liabilities. These all are those one only. Up to this, sorry. Up to this. Interest accrued but not due. Interest accrued and due. Income received in advance. Not only interest, guys. Any expenditure accrued but not due. I already told you, accrued but not due, accrued and due. You know the difference. If it is accrued, that's it. If it is accrued and payable, it is shown under the other current liabilities. What is the difference between but not due and due? I already explained in fundamental chapter. Sir, income received in advance, which is other current liability, which is actually a liability, which is a current liability. Under which head I need to show? Other current liabilities. Unpaid dividends. What is the meaning of this unpaid dividends, sir? Unpaid dividends is nothing but dividend payable. Another name for unpaid dividend is dividend payable. Coming to the dividend, please all of you concentrate. At this stage, I can explain, not an issue. Sir, whenever the board of directors propose the dividend, no need to record such dividend by the company, because if the shareholder in the general meeting, if they declare the dividend as 0, then the liability of the company will be nil. So if the board of directors propose the dividend, then what is the accounting treatment, sir? There is no need to provide any accounting treatment in their books of accounts. Ignoring itself is the accounting treatment. Now, when the shareholders declare the dividend, then what is the accounting treatment, sir? The accounting treatment is you should debit the reserves and surplus. You can only utilize the current year profits, or you can utilize the certain reserves as well. That is free reserves for the purpose of declaration of the dividend. That's why you should need to debit the reserves and surplus, decrease the reserves and surplus, and you should make the credit to dividend payable account up to the making payment of such dividend. When there is increase in liability, it should be credited. The entry is reserves and surplus account up to dividend payable account. Then such dividend payable up to the date of making repayment, where can I show, sir? Which is a current liability. Under current liability, I need to show under other current liability. Next, one more thing. This point already discussed, guys. Concentrate. Application money received for allotment of shares or securities and due for refund and interest accrued thereon. And due for refund means allotment already over. Sir, when you know such application money is due for refund, if it is oversubscribed and the allotment is over, then to the extent of money received over the excess application money, you should need to be refunded within the prescribed number of days as per Companies Act 2013. The same point I emphasized here actually when at the time of discussing the main format. Here it is there. Sir, if allotment is pending, still application money is on the hands of the company, then we will show here. Allotment was already over, but still the application money is within the hands of the company, then where can I show, sir? I can show under the current liabilities under other current liability, which all they might tested in the examination, guys. Okay. Next issue. Come down. Yes, overall all I explained. Nothing else, guys. Okay. Sir, other current liabilities is very much important. Outstanding expenses, income received in advance, dividend payable, unpaid maturities. Unpaid matured deposits are the debentures and the interest accrued thereon. It's not the current maturity of the long-term debt. It was already matured, but still the company is not payable. Then which is coming under other current liability? Application money received and allotment already over and which is due for the refund. Then the company is not yet paid. Then coming under the other current liability only. And interest accrued thereon on such application money is also coming under other current liabilities. Okay. So this is things related to liabilities, guys. This is things related to liabilities. Come back. Now equity and liabilities elaborative discussion is over. Now coming to assets, all of you. Sir, assets are broadly categorized into two types. One is non-current assets, another one is current assets. One is non-current assets, another one is non-current current assets. Concentrate, guys. Now all of you please concentrate only things related to assets. Just leave it the liabilities portion. Non-current assets, and the first type of asset is property, plant and equipment and intangible assets. Sir, previously this head is known as fixed assets. Fixed assets. After introduction of AS10 PPE, before introduction of AS10 PPE, the title of AS10 is fixed assets. When the title of AS10 is changed to the property, plant and equipment, then the consequential amendment also occurred in Schedule 3 format on behalf of fixed assets. Now they represented it with property, plant and equipment and intangible assets head. I will tell you one thing here. Please all of you concentrate. Sir, previously AS10 head is fixed assets, now which is represented as PPE, right? Do you know the reason why the fixed assets are suddenly changed to the property, plant and equipment? There is one standard in IND AS, which is IND AS 16. The title is property, plant and equipment. Whenever IND AS 16 is coming to the picture, now the existing accounting standards entirely revamped and they are make it change it to the PPE. The only one IND AS is there in your syllabus, which is as like AS10 property, plant and equipment. So what is this IND AS? What is this existing accounting standards? Don't bother, guys. I'll explain you each and everything, but not at stage, not at this stage. Whenever the chapter comes, I'm going to explain. Okay, come back all of you. Now, PPE and intangible assets. PPE is with respect to AS10, with respect to AS10, and intangible assets standard is AS26, out of which AS10 is the group 1 syllabus, AS26 is the group 2 syllabus. The difference between PPE and intangible asset is PPE is the tangible items, intangible items are the we cannot see and touch, in generally we can call. So what exactly the meaning of intangible asset, at which value we are going to recognize, all such issues we are going to discuss in group 2 syllabus. Now coming to the PPE, what are the things we are going to show, sir? Under this head, what are the things we are going to show, sir? PPE, property, plant and equipment. Intangible assets. If such PPE is under progress, if a building is under progress, if the machinery is in progress, then which is shown under capital work in progress. If the intangible asset is under progress, then we can call it as intangible asset under development. I'll give a very simple examples here. Sir, we are in the process of construction of a big factory. Now, as on the balance sheet date, the factory is just completed the 20% work. So the basement is over, that's it. So there is no other activity is completed as on the due date. The activities are in progress. Then can I show it under the PPE, sir? No. After completion of the project, after completion as is factory, then only I can show it under the PPE. Till the time period, I can show it under capital work in progress. In the same way, a software is under the development. Now the software is not yet completed as on the balance sheet date, then where I can show, sir, that is shown under intangible asset under development. If it is completed, I can show it under intangible assets. Now coming to the PPE, in PPE, how the presentation would require, sir? All of you please come below. Yeah, here it is there. Concentrate. In the PPE, we should need to make it represent gross block, provision for depreciation, net block. Gross block means simply I can call it as before reduction of depreciation. Before reduction of depreciation, which is at original cost. Provision for depreciation. So till date, what is the total amount of the depreciation, which is accumulated depreciation? Net block means gross block minus provision for depreciation. Then I will get net book value, which is nothing but net block. Sir, is this presentation is required on individual asset basis or individual asset classification basis? So the entire property, plant and equipment will be classified into different classes. Buildings is one class, vehicles is another class, I mean machinery is another class, furniture is another class, equipment is another class. So like that, depending upon the nature and the usage and the presence of that particular asset on place basis, you may classify the total PPE into the different classes for each and every individual class of assets, you should need to make it this representation of gross block, provision for depreciation, and net block. And in that also, how you should need to present, you should start with opening balance, current year purchases, which are at additions, current year sales, which are as disposals, revaluation adjustment. So if already AS 10, if I already explained, then the things are very much easier. So, but till now you don't know the concept of the revaluation adjustment. Revaluation may be the upward revaluation or the downward revaluation. The PPE can be measured as on the balance sheet in two different methods, either on the cost method, either on the revaluation method. For any particular class of assets, if you adopt the revaluation method of measurement as on the balance sheet date, then each and every particular asset value should be need to revalue as on balance sheet date, depending upon the existing market price. If the existing market price is more than the book value, then you should it is terminated as an upward revaluation, and the existing market value of such specific asset is less than the book value of the asset, then you should need to go for the downward revaluation. Such revaluation adjustment also you should need to occur here. Then you will get closing value of the gross block, provision for depreciation, net block. Like this, you need to represent the PPE information. The same type of presentation, we should also give things related to intangible assets as well. Just a second. Let me go to Power Notes. Yeah. So the same type of representation, we should also give it for in case of intangible assets. Where it is? Here it is. How the PPE we classified into different classes like building, factory, building, plant and machinery, vehicles. In case of intangible assets also, software, know-how, patents, goodwill, like that, you should need to represent separately the intangible assets class as well. Then their gross block. On behalf of depreciation, the term used in case of intangible asset is amortization expenses. Then you will get the net block. That's why I don't want to tell once again the presentation of the intangible assets. You just leave it. Sir, after PP and intangible assets, under non-current assets, what is the next item, sir? One more thing actually, at this point, actually need to explain at the time of inception of taking the concept of assets itself. Sir, non-current assets means which can be realized in the form of cash for greater than 12 months. Current assets means which can be realized in the form of cash within 12 months. As like same in case of non-current liabilities and current liabilities, you can put the thought process in your mind in the same way. Okay, let me continue. After the PP and intangible items, the next item is non-current investments. Sir, what is this investment is all about, sir? What is this investment is all about? Sir, investments are broadly categorized into two types as per accounting standard 13. Those are current investments, and non-current investments. What is the meaning of current investment? What is the meaning of non-current investment? An investment held by the enterprise with an intention to resale within 12 months. Then such investments are called as current investments. Otherwise, the investments are known as non-current investments. That is simply other than current investments. If the investment is a current investment, as on balance sheet date, it should be going to measure it cost or market value, whichever is lower. Sir, if the investment is a non-current investment, generally such investments are measured at cost. But if there is a permanent decline in the value of investment, the decline is not temporary. The decline is not temporary. If the decline is permanent in nature, then we should record it market value. If the decline is permanent in nature, then it should be recorded at market value. Sir, if more than that, if I explain, then there is nothing will be there to explain in AS 13. So non-current investment, we will represent it under non-current assets. Current investment, we will represent it under current assets. Non-current assets are represented at generally cost, but if there is a permanent decline, we will represent at market value as on balance sheet date. Current investment, basically we will compare cost or market value as on the balance sheet date, at which is the lower, at such value we are going to carry forward. This is things related to non-current investment under non-current assets, as well as current investments under current assets. Next, deferred tax asset. I already told you deferred tax asset concept we are not dealing right now. In AS 22 we will deal. Long-term loans and advances. Sir, loans and advances is a liability na, which are not taken, which are given by us. Sir, if any advance is given to the other party, if any loan is given by you to the other party, and the repayment period is for greater than 12 months, then which is categorized as a long-term loans and advances. Sir, if the repayment period is less than 12 months, then you can categorize it as a short-term. Here it is there, check here, which is known as short-term loans and advances. Point number 5, which is known as short-term loans and advances. Is it okay? And the other non-current asset is a residuary head, and the current assets is a other current assets is a residuary head. Till now I didn't list out the current assets, but some point I already told you. Here non-current investment, here current investment, here long-term loans and advances, here short-term loans and advances, here other non-current assets, here other current assets. Remaining issues only I will deal. Inventory, closing stock. Inventory may comprises of, this is again as per AS2 guys, this is again as per AS2. Just a second. Yeah, yeah, right, concentrate. So as per AS2, inventory comprising or inventory comprises raw material, work in progress, finished goods, consumables, loose tools. All those are form part of inventory only. All those are form part of inventory only. Raw material means, you know, the material which we can use to production of finished goods are known as raw material. Work in progress means not 100% is completed, that is less than 100% completion. We can call it as work in progress, sir, as on the balance sheet date, which are not yet completed. Finished goods means 100% completed goods. Consumables, consumable means which are used in generally at the time of production. Lubricants, greases, nails, all such things are known as consumables. Loose tools, sir, loose tools means screws, wrenches, nuts, bolts, all those are, we can in generally call it as loose tools. All these are form part of inventory. Sir, at which value inventory is going to represent as on balance sheet date, sir? Sir, it is completely depending upon the measurement principle of AS2. Measurement principle of the AS2. But the basic principle I am telling you at this stage, but this principle is not applicable in case of raw material. Other than raw material, this principle is applicable. The basic measurement principle is it should be valued at cost or NRV, whichever is lower, but which is not applicable in case of raw material. I straight away telling you. So the raw material valuation is quite different, which is cost or NRV, whichever is lower, is the basic accounting principle of the inventory other than raw material for the remaining all things. So at that value, I should clearly represent under the balance sheet. Then the total amount, you can show it under the current assets. Just a moment. Yeah, total amount, I can show it under the inventory AS2. Sir, under current liabilities, how you are showing the trade payable here? Under the current asset, you can show the trade receivables. Under the trade receivables, what are the different components we can include, sir? Debtors, you can include here. Trade, I mean, bills receivable, you can include here. How here the creditors and bills payable included. Here you can include the debtors as well as bills receivable. Next, come to the last item which I ignored, which is cash and cash equivalents. Sir, in cash and cash equivalents, what I can include, sir? Pure raw form of cash on hand, cash at bank. Sir, cash and cash equivalent. Cash means cash on hand, and cash at bank is also known as cash only. Cash equivalents means DDs, checks, all such things are known as cash equivalents. And one more thing I am telling you, highly marketable securities which can be realized in the form of cash within 3 months also we can categorize as a cash equivalents as per AS3. Yes, AS3, the cash flow statement, cash equivalents contains highly marketable securities within 3 months also we can categorize as cash equivalent. It is not cash, but it is cash equivalent. Both we can show under cash and cash equivalents only. Sir, this is the brief story of Schedule 3, Part 1, balance sheet. If I open the main text, if you go to the main format, that is the summary, it will start with equity and liabilities. Consider all of you, it will start with equity and liabilities. Under that, shareholders funds, a share capital, reserves and surplus, money received against share warrant. Sir, still the allotment is not happened. Application money is at the respective company, then which is shown as a separate line item, that is share application money pending allotment. Under non-current liabilities, long-term borrowing, deferred tax liability, other long-term liabilities and long-term provisions. Then coming to the current liabilities, short-term borrowing, trade payable, other current liabilities and short-term provisions. Then coming to assets, under non-current assets, PPE and intangible items. Under that PPE, intangible asset, capital work in progress, intangible asset under development. Under non-current investment, deferred tax asset, long-term loans and advances, other non-current assets. Then coming to the current assets, current investment, inventory, trade receivable, cash and cash equivalent, short-term loans and advances, other current assets. Why I list out all the items once, whenever the head I read, the related internal components list coming to the picture to your mind. No need to remember all the items. If you tell a specific item, it should represent under which head, you should need to know. That is more than enough. For example, if I tell current maturities of the long-term debt, is a current liability. Under that, short-term borrowing. Unpaid matured long-term debentures, unpaid matured long-term deposits and interest thereon, which is a current liability, which shown under other current liabilities. Dividend payable, shown under other current liabilities. Let us assume bills receivable, where I should need to represent, sir. Trade receivable under current assets. Trade receivables under current assets. That is more than enough. Raw material is there, where I should need to represent, sir. Inventory. For example, outstanding salary is there, sir, where I should need to represent, which is a current liability. Under that, other current liabilities I should need to represent, sir. Do you understand? So like this, if you can able to identify if a particular item is coming under which head, that is more than enough. Don't by heart it, just observe, understand and remember. Okay. This is the concept of part 1, schedule 3. So next we seen schedule 3 part 2, statement of profit and loss account. Again in vertical format, but how to prepare statement of P&L, we will see with known things. I mean, in horizontal format, the preparation of profit and loss account, right? That is trading and profit and loss account. Here, there is no difference between trading and profit and loss account. Both we will club it. We can call it as statement of profit and loss account. With the known things, first let us have a look. With known things, we will derive the statement of P&L. Let us have a look about that. Come down, all of you, to our power notes. We are in power notes. Come down. Yes. Consider it, guys. First, let me explain things related to trading account issues. That is, first, let me explain the format of statement of P&L, the structure of the P&L. Then I'll come back with the known things. So the statement of P&L. Again, which is part 2, we'll start with the name of the company, P&L statement for the year ended, particulars, note number, current year figures, and the previous year figures as like that. First, we will start with total income, then total expenses. Income minus expenses is equal to profit. That is the structure. Sir, in income is broadly categorized into 2 types. Revenue from operations and other income. Sir, what is the meaning of revenue from operation, sir? At the time of establishing a company, in the objects clause in memorandum of association, you may clearly represent your main objective. Sir, we are in the construction activity. Sir, we are in the software providing service activity. Sir, we are in the finance service providing activity. Am I right? Then whatever the revenue you are getting from such main objective, which is known as revenue from operating activity, which is revenue from operations. So if myself is a chartered accountant, then we will offer the financial services to our clients. Whatever the revenue I will get from such services, I can call it as a revenue from operations. Sir, I made a fixed deposit in bank. I got interest on such fixed deposit, which is not a revenue from operation, which I put under other income. If I invested in equity shares of a particular company, then I got the dividend from such equity shares, then which is shown under other income. Do you understand? Sir, if I sold that particular investment, I got certain profit where I should represent under other income. The difference between operating income and other income decides nature of the business activities. Maybe for me, interest and dividend is the other income. If you took a financial and a company, a finance company, the company which is in the providing the services with respect to the finance, for such finance company, interest is an operating income. Do you understand? Because the company itself is conducting business activities towards the providing loans as well as providing loans and taking back such loans from the public. Then they will collect interest also along with the principal. At that point of time, the interest is we can represent under the revenue from operations, not from the other income. As like in the same way, if investment companies are there, the main objective of the investment company itself is they will procure funds from the public in the form of capitals and the borrowings. They ultimately made investments in different companies, maybe investment in equity shares, investment in preference shares, investment in debentures, investment in bonds, investment in properties, whatever the case may be. So now, if they get any interest on such investment, if they get dividend on such investment, they will represent under revenue from operations only. So that means operating income and the other income, how it differs, it is completely depending upon the nature of business conducted by such enterprise. So for one enterprise, it may be operating activity. For another enterprise, it may be treated as another income. Hope you understand the difference between operating and the other income as well. Now come to the expenses. First, let me start explaining the things related to expenses with the known trading account. Sir, how the trading account in generally build? Opening stock, purchases, sales, closing stock. The same thing, right? Opening stock, purchases, sales, closing stock. Like this only trading account we are in generally building. Now in opening stock, the inventory may be the raw material, maybe the work in progress, maybe the finished good. What about the stock in trade, sir? Stock in trade, the difference between finished goods and stock in trade is finished goods we are producing on our own. Stock in trade is just we purchase, we will make it resale. We are in the trading activity with respect to any particular good, we can call it as a stock in trade. We are producing such good on our own basis. We only the manufacture such good, then we can call it as a finished good. Except that there is no difference between finished good and stock in trade. Now in such opening stock, raw material may be there, work in progress may be there, finished goods are there, stock in trade is there. In the same way, in closing stock also, raw material is there, work in progress is there, finished goods is there, stock in trade is there. Okay. Purchases, you may purchase raw material. Yes, there is a possibility of purchase of raw material. There is a possibility of purchase of stock in trade, but there is no possibility of purchase of work in progress and finished goods, because work in progress is partly finished good and finished good is 100% finished from your side. That is the only difference, right? So that's why there is no possibility of work in progress and finished goods purchases. That's why in purchases only raw material purchase and stock in trade is included. Am I right? Next, in sales, you may sold out the goods which may be finished goods, which may be stock in trade. Anything you may be sold out. The either may be finished good or either may be stock in trade. Or you may providing services as well. Sir, if your organization is a trading entity, then you may sell of goods. As like me as a chartered accountant firm, I'm in the practice, I'm providing services to my client. At that point of time, the sales is a revenue from operations. I already told you where I should need to show. That is under revenue from operations. Now you can ignore this component. I already discussed things related to sales and other income. Sales include services as well, and other income, which is dividend income or the rental income or the interest income, whatever the case may be. That is completely depending upon the operations which you are going to conduct. I already discussed this one. Now the remaining issues, please all of you concentrate here. Opening stock of raw material plus purchase of raw material minus closing stock of raw material, I can call it as raw material consumed. I can call it as raw material consumed. Opening stock of raw material plus purchase of raw material minus closing of raw material, we can call it as raw material consumed. Such raw material consumed will be shown as a first expenses under the expense, which is cost of raw material consumed. So revenue from operations and the other income is over, then we will get the total revenue. After that, we will represent the total expenses. Then total revenue minus total expenses, we will get profit, right? Now we are dealing the expenses. And that the first issue is the cost of raw material consumed, where that I explained. And the next issue, please all of you concentrate. For purchases of stock in trade, for purchases of stock in trade is a separate component we need to put here, which is a purchases of stock in trade. And the purchases stock in trade is also over. Now the remaining components are work in progress finished goods here. Here also in the closing stock also work in progress and finished goods. This we are treated as opening work in progress and finished goods minus closing work in progress and finished goods. We can call it as change in work in progress and finished goods and stock in trade. Total three components are there. I'm so sorry. Opening stock under the closing stock, remaining total three components are there, which is work in progress, finished goods and stock in trade under opening. Under closing also work in progress, finished goods and stock in trade. Now the difference between opening and closing, we can call it as change in work in progress, finished goods and stock in trade. Such change may be positive or such change may be negative. If opening is more than the closing, such change is the positive, which is the expenditure, excess expenditure we incurred. If the opening is less than the closing, then such change is the negative. Sir, if opening and closing are same, no need to record. There is no change at all. Now, if you check here, I am combining these two things. Change in inventories of finished goods, work in progress, and stock in trade. Now, all these items, raw material consumed, purchases of stock in trade, changes of inventories of finished goods, work in progress and stock in trade. From here to here, simply they are included with the trading account items. Do we agree? Opening stock of raw material plus purchase of raw material minus closing stock of raw material is the raw material consumed. Here they taken the purchases of stock in trade, and the remaining items are opening work in progress, finished goods and stock in trade, closing work in progress, finished goods and stock in trade. The difference itself, they are termed as a change. Such a change is change in inventories of finished goods, work in progress and stock in trade. If the change is nil, no need to consider any amount, no need to represent under the statement of P&L. Next. Sir, in P&L, remaining all expenses. Out of the remaining all expenses, the major head is salaries. Salaries, we can term it as a employee benefit expenses. Not only the salaries, any bonus payable to employee, any leave encashment paid to the employee, any gratuity payable to the employee, any PF payable to the employee, where I can represent under the statement of P&L as an expense, sir, under employee benefit expenses. Any refreshment expenditure payable to the employee, any conveyances payable to the employee, any allowances payable to the employee, whatever the case may be, all are form part of employee benefit expenses. Next, one of the major non-cash expenses on the PPE, which is depreciation, on the intangible asset, I told you, which is amortization expenditure. The both you can club, you can show under depreciation and amortization expenses. And if you took any loan by the, then interest payable to such loan, which is termed as a finance cost. Finance cost. Sir, what exactly included in such finance cost? I'm going to explain through accounting standard 16. Borrowing cost. Actually, there is a separate standard is there in our syllabus itself. What exactly the meaning of borrowing cost? Not only the interest charges, ancillary charges incurred at the time of borrowing, discount on issue of debentures, premium payable at the time of redemption of debentures, part of the foreign exchange loss will also treated as a finance cost. But at this stage, I don't want to discuss all such issues. Simply finance cost is inclusive of interest. What exactly the meaning of finance cost, we will see through AS 16. And any other expenses, administrative expenses, rent, electricity, okay, whatever the expenditure you can tell, All such expenses we can put under simply other expenses. But if you want, which is a material item, a separate head need to be created, then that is up to the flexibility given to that enterprise itself. You can put it as a separate head, then you will get the net profit. This is the normal horizontal format of the trading and P&L account, right? Now the same thing, how we are representing up to this I already explained. After that, employee benefit expenses, finance cost, depreciation and amortization expenses, other expenses, then you will get total expenses. Sir, here it is there, total revenue. Here it is the total revenue. Here it is the total expenses. Total revenue minus total expenses. Then you will get profit or the loss before exceptional and extraordinary items and tax. Total before three components profit. This is exceptional items, extraordinary items, and tax. You know, anyway, we are not debiting the tax component. That's why, which is definitely profit before tax. But what about this exceptional item and extraordinary item, sir? We are dealing in AS5 in group 2. The title of AS5 itself is changes. So the title of AS5 itself is net profit or loss before exceptional items and extraordinary items and changes in accounting policies and accounting estimates. That is the title of accounting standard 5 actually. So I don't want to discuss anything here. Now the exceptional item as well as extraordinary item you should reduce separately. But I will tell you very, very few things related to exceptional and extraordinary. For example, in the particular year, loss occurred due to earthquake, or loss occurred due to floods, or maybe the loss occurred due to the pandemic situation like COVID. Such all things you can categorize as an extraordinary items. Exceptional item means those are normal items only. Those are ordinary activities only. Ordinary activities means on day to day, they are regularly happening activities only. But due to such a size and nature of transaction, separate disclosure should be given. Sir, for which items I should need to give the separate disclosure? At this stage, you don't know. That's why simply exceptional items are ordinary only, but due to such a size and nature of the transaction, we should separately shown. I'll give you one example. Only one example I'll give you. Sir, in the current year, you sold out a major asset. Maybe one factory is sold out. You earned a profit of 2 CR. You earned a profit of 2 CR. From your remaining operations, you are earning a profit of 50 lakhs. And the total profit is 2.5 crore. Sir, without classifying profit from sale of factory and a profit from operations, if you club it and simply telling to the public that our profit is 2.5 crores for that particular year, then people may believe that, or people may feel that your total profit of 2.5 crores, you are arrived through your operations, your business activities only. To give the difference, the exceptional items such as size, huge size, you should need to disclose separately, which is nothing but exceptional items. But all such things we are going to see through AS5. Okay, then you are getting profit before extraordinary and tax. Then you will reduce the extraordinary items. I already told you the extraordinary items. Then you will get the profit before tax. Now from this profit before tax, you should need to reduce the tax expense as per AS22. The title of AS22 itself is taxes on income. So many standards are here relevant with respect to group 2 only. Very few standards are covered in group 1. That is the reason actually I'm skipping so many issues. But don't worry. Again, there is one more marathon is there for group 2. If you're also writing the examinations with respect to group 2, you can watch my group 2 marathon. What are all the question marks here are there? You can get the answers in group 2 marathon. Okay. So in tax expense, current tax is there, deferred tax is there. Sir, deferred tax is deferred tax asset and liability, something we mentioned in the balance sheet, which is related to that. Current tax is nothing but provision for tax. Provision for tax. What is the difference between current tax and deferred tax? All such issues we are going to see through AS22. For the time being, you can just skip it, which is current tax and deferred tax. Then you will get profit or loss for the period. Then you will get profit or loss for the period. Still actually not over. I myself, I completely shrinked the statement of P&L, the real format. So after reduction of the tax, what you will get, profit or loss from continuing operations you will get actually. Profit or loss from continuing operations. If you are having any profit or loss from discontinuing operations, you should need to represent it as per accounting standard 24, which is again the group 2 standard. If you make it total from continuing operations profit and discontinuing operations profit, then you will get profit or loss for the period. With this, actually P&L is over. But before that, you should need to represent basic EPS and diluted EPS as per accounting standard 20, which is another accounting standard of the group 2. Sir, EPS is very simple. Earning price per share. Earning price per share means the earnings available to equity shareholders is divided with number of equity shares. What are the earnings you are getting? Such earnings with respect to equity shareholders, how much? Such earnings, if you divide it with the number of equity shares, then each and every equity shareholder, how much earned you know, which is nothing but earning per equity share, which is basic EPS, diluted EPS. What is the difference between basic and diluted EPS? Again, we've seen in accounting standard 20 especially. So now the overall theme of the statement of P&L is start with revenue from operations, other income, then you'll get total income. Sir, which component I can put under revenue from operations, which component I can put under other income is depending upon the your nature of the business. If you are in the financial services, then interest is the operating, then the remaining all are the non-operating, that is other income. If you are in the manufacturing industry, then interest income will become the other income. Then the sales generated through ultimate sale of the produced goods is nothing but your operating income. Then you will start with expenses, where start with raw material consumed, opening stock of raw material plus purchase of raw material minus closing stock of raw material. Then you will add purchases of stock in trade. Then opening stock of work in progress, finished goods, stock in trade, you will compare with closing stock of work in progress, finished goods, stock in trade. The difference you can make it term it as a change. Change in work in progress, finished goods and stock in trade. The change may be a positive, the change may be a negative. If there is no change, no need to write, simply ignore that. Then you will get, then after that you may record the employee benefit expenses which are related to the salaries and all employee benefit expenses. Then finance cost, amortization and depreciation expenses. Then you may write the remaining all are under other expenses. But if at any particular point of time, if you from your point of view, you should need to represent particular expenses by putting a separate head, that is up to you. That is completely depending upon the materiality concept. What is the meaning of concept of materiality? Sir, we seen GAAP na, under GAAP certain generally accepted accounting principles we see na. Under one of the concept is materiality. If it is material, by providing a separate head, it will grab the attention of the equity shareholders and they can take the right decision. If you want, then you can put it as a separate head. I'll give a classic example. Sir, current year I paid penalties and legal charges approximately for 50 lakhs. Penalty, sorry, not legal charges, penalties I paid approximately for 50 lakhs. Just I want to include such penalties under other expenses. But what materiality concept told to you? By putting it as a separate head, if you are providing the better information to the stakeholders, then they can take the appropriate actions, right? If you put the penalties as a separate head, then the shareholders can easily know that, sir, our organization committed certain mistakes due to which we paid the huge penalties. Or maybe the penalty amount is very less, but still you need to report under a separate head. It should not be clubbed with other expenses depending upon the materiality concept. So that's why some expenses we need to club with the other expenses or make it the separate representation. It is completely depending upon the concept of materiality we should need to apply. So then we'll get profit before exceptional item, extraordinary items and tax. Then reduce the exceptional. After that, reduce the extraordinary. Then you will get profit before tax. Then reduce the tax expense, which is a combination of current tax and deferred tax as per AS 22. Then you will get profit or loss from continuing operations. If you add profit or loss from discontinuing operations as per AS 24, then you will get the total profit or loss for that period. So below that, you can also represent the basic and diluted EPS as per AS 20. With that representation of statement of P&L is over. Sir, inner components, I mean, in that specific note, what are the things I should need to represent? No need to discuss much, guys. So just you can learn from that. That is more than enough. But one important thing here I'm telling you, sir, can I show the revenue from operations here inclusive of GST or exclusive of GST, sir? I mean, Whenever for an enterprise GST is applicable, if the turnover is more than the 20 lakhs, then the concept of GST takes place. Then at the time of sale of goods, we should need to collect the GST amount from the customers. Can I inclusive of GST with that sale amount? No, because whatever the GST you are collected from your customers, it should be ultimately payable by you to the government, which is known as output GST. The GST may be which is maybe CGST, which is maybe SGST, which is maybe IGST. So the output CGST or SGST or IGST should not be clubbed with the revenue from operation, which is taxes payable. The taxes payable should be shown under which head, which is a current liability, which should be shown under other current liability. Do you understand? So at the same time, purchases, whatever the goods you are purchased, at the time of purchase of such goods, you may pay tax to the other party. So now can I include the GST which is payable to the other party here? No, because which is the input GST? The input GST is an asset to you, output GST is a liability to you. How you can club the output GST with sales input GST to the purchases? So at the time of making representation of the sales and purchases, which should be always exclusive of the output GST as well as exclusive of the output GST as well as exclusive of the input GST for both sales and purchases. Do you understand? Okay. So this is things related to statement of P&L, guys. Please, all of you, come here. I told you before startup of financial statements of companies, we are going to discuss the important provisions. I already told the compliance system here. Then till now, I discussed the format of financial statements of companies. Hope I spent very good time things related to the financial statements of companies. Before discussing the concept of managerial remuneration and the concept of dividend, let me take up certain very few problems based on the concept of financial statements of companies that is based on the schedule 3. I mean problems, it is not related to the preparation of financial statements, that is statement of P&L and balance sheet. I don't want to take such problems under the revision sessions because we are come acrossing such type of problems in other chapters. For the time being, I will take up the practical issues on the schedule 3. Please let me open quickly. These may be asked for 5 marks. Please all of you answer along with me. In the financial statements of the financial year 2011-12, Alpha Limited has mentioned in the notes to accounts that during the financial year 24,000 equity shares of rupees 10 each were issued as fully paid bonus shares. Under notes to accounts, how many number of equity shares are issued as bonus shares? They mentioned. However, the source from which these bonus shares were issued has not been disclosed. Is such non-disclosure is a violation of Schedule 3 to the Companies Act? Give your comment. Sir, in power notes, I clearly explained such fact. Sir, if you clearly disclose the number of bonus shares issued, that is more than enough. No need to disclose the source from which you are issuing such bonus shares. Where it is there. No description of source from which bonus shares you are issuing. No need to disclose. Am I right? How many number of bonus shares he issued? That is more than enough. That's why it is non-violation. It is non-violation. Do you understand, guys? Next, come to the next question. The management of Loyal Limited contends that the work in progress is not valued since it is difficult to ascertain the same in view of multiple processes involved. They opine that the value of the opening and closing work in progress would be more or less same. Opening and closing more or less same. Opening and closing same. Accordingly, the management has not separately disclosed the work in progress in financial statements. No need to disclose if opening and closing are same. The change is nil at that point of time. No need to disclose. Comment in line with Schedule 3, which is not violation, which is again not violation of Schedule 3 because the changes become nil. Coming to question number 3, Futura Limited had the following items under the head reserves and surplus in the balance sheet as on 31st March 2011. Securities premium given, capital reserve given, general reserve given. The company had an accumulated loss of 250 lakhs on the same date, which it has disclosed under the head statement of profit and loss as asset in the balance sheet, as asset in the balance sheet. Sir, accumulated losses is there. You should not shown under the asset side. Still, you should shown under the reserves and surplus. Even though the reserves and surplus become the negative, which is appreciable as per the current Schedule 3. Securities premium is 80 plus. capital reserve is 60 plus general reserve is 90. Here itself 230, right? 230, 90 plus 60, 150 plus 80, 230. 230 minus the reserves and surplus is 250. Then the reserves and surplus will become 20 negative. Such negative figure you can show in the balance sheet, but you should not show such 250 lakhs under asset side as a P&L debit balance. That is absolutely wrong. If you are other than company, you can show P&L account debit balance under asset side, because other than a company, no need to follow the schedule 3. But as per the schedule 3, you can show it whether it is positive figure or the negative figure under reserves and surplus only. So which is a clear cut violation of schedule 3, which is violation of schedule 3. Next, come to problem number 4. Sumedha Limited took a loan from bank for rupees 10 lakhs to be settled within 5 years in 10 equal off-yearly installments with interest. Okay. First installment is due on 30th September 2011 of rupees 1 lakh. Determine how the loan will be classified in the preparation of financial statements of Sumedha Limited. Current maturities of long-term debt. Current maturities of long-term debt, we will show it under where? Short-term borrowings as per the recent amendment happened in Schedule 3 as per the latest notification by the MCA. So the current maturity, first installment is due on 30th September 2011 means that is as on 31st March 2011, which is within the 12 months, which is the current maturities of the long-term debt, which can be shown as the short-term borrowing. Out of the 10 lakh, 1 lakh is the short-term borrowing, remaining 9 lakh is a long-term borrowing. State under which head the account should be classified in the balance sheet as per Schedule 3 of the Companies Act 2013. Share application money received in excess of the issued share capital. Application money received in excess of the issued share capital, you need to make it the refund. If you are not to make it the refund within the deadline, within the time period, which is a current liability. Under current liability, I will show it under other current liability. When you know excess of amount received, if you already made allotment, now the excess of share capital you should need to make repay to the other party, which you can show under the other current liabilities. Share option outstanding account specifically mentioned, if you remember, which should be shown under reserves and surplus, which we are going to discuss under ESOP under group 2. Unpaid matured debenture and interest accrued thereon, which is other current liable. Which is also under other current liability. Yes, under current liabilities, which is also shown under other current liability. Current maturities of long-term debt is shown under short-term borrowing, but unpaid maturity debenture and interest accrued thereon we are showing under other current liability. The difference also I clearly given. Just come down. These two are not explained till now. Still a lot to be still some more need to be explained in Schedule 3. I mean the last portion, things related to contingent liability, I didn't explain, right? So now all of you please come to the contingent liability before discussing the last 2 points of problem number 5. Sir, contingent liabilities is not form part of the balance sheet items, guys. Contingent liabilities are in generally shown to the footnote, to the balance sheet. Just a second, I'll show them. Yeah, here it is there. Contingent liability. What is the meaning of contingent liability? Which is not a proper liability, whether we can payable or not, which will be confirmed by occurrence or non-occurrence of one or more future uncertain events which are not wholly within the control of enterprise. I'm giving certain examples here. For example, we gave the guarantee on behalf of another person. At the time of borrowing loan by the other company from the bank, we provided the guarantee. If the other company paid amount to the bank on due date, then the banker will not ask me. Otherwise, banker will ask me. Now, such guarantee is a contingent liability. Maybe we made certain investments in the equity shares of other companies. Now, the other company only made a part of the amount as call. Still remaining part, if the other company asked, I need to pay. That is partly paid up shares held as investment is also a contingent liability. So like that, some examples are given here. Contingent liability shall be classified as claims against the company not acknowledged as debt. Somebody filed a suit on me. As per the legal opinion given by my lawyer, still there is no need to make any payment as a damages to the other party. Claims against the company. Yes, somebody claimed from the company by filing a suit. But still we are not accepting that. We are not acknowledging as a debt, which is a contingent liability. Guarantee, I already explained. Next, commitments. Commitments, that is uncalled liability on the shares and other investments which are partly paid up, which are some capital commitments are there. All are we can shown under the contingent liability. So which we are shown as a footnote to the balance sheet, but we are not shown under the balance sheet. And one more important thing under share capital, I forgot to tell you one important thing under the share capital. Sir, here the share capital, whenever the share forfeiture account is there, whenever forfeited shares are there, what we should need to do, sir, that forfeited shares are also shown along with the share capital. Because once the shares forfeited, on that shares to the extent of amount already collected from the shareholder up to the date of reissue, up to the date of further issue of such shares, which should be under share forfeiture account. Such share forfeiture account is formed part of the share capital account. Do you understand? And one more thing, if any calls in arrears are there, to know the correct paid up value from called up, we should reduce the calls in arrears, then only you will get the paid up value. These 2 points actually I missed out at the time of explaining the share capital. So share forfeiture is form part of the share capital. Calls in arrears are there, we should need to reduce the share capital. Okay, come down. The last problem, which is problem number 5, I'm discussing. Where 2 points I missed out, right? Uncalled liability on shares and other partly paid investment, which is a contingent liability. Contingent liability. Calls unpaid, which is nothing but calls in arrears. Calls in arrears should be need to be reduced from share capital, sir, which is the latest before the RTP. Latest before RTP, November 2021, this question was asked. I already told you this type of similar models, there might be asked in the examination. There is a high scope. And the amendment which I told now, this is based on the amendment which is shown under the short-term borrowings. This is the answer I framed based on the amendment previously, which was shown under other current liabilities. Right now, current maturities of long-term debt is shown under short-term borrowings. That's it, guys. Come down. Next, the concept of managerial remuneration. I need to explain. Please check here, all of you, the concept of managerial remuneration. So remaining only 2 things are pending from my side. One is concept of managerial remuneration, another one is dividend payable. Major issues are over. 1 second. Yeah, all of you please come to the managerial remuneration. Sir, managerial personnel means key managerial personnel as per Companies Act 2013 as per section 2 subsection 51. Here for managerial personnel, who are all different persons covered, sir? Managing director, manager, whole-time director, other directors. First, let me explain the definition of each and every person as per the Companies Act 2013 in very crispy manner. Managing director is first, primarily he should be a director. He should be a director entrusted with substantial powers of the management of the affairs of the company. Substantial powers of the management means entire board will be in the direction of the managing director. Entire board will act according to the decision of the managing director. Substantial power means the major, the significant, the recognizable powers of the management of the affairs of the company within such director, then such person is known as managing director. Who is so called as manager? Manager is an individual. He may be a director, he may not be a director. A manager cannot be a director. Manager may be an individual director, but he should vest with control on whole 100% or substantially whole of the affairs of the entity. So after seeing these 2 things, for a company, either managing director or manager, only one person is possible. Both the person will not be possible. Do you know the reason? Managing directors is having the substantial powers, and the manager is having whole or substantially whole of the affairs of the entity. So a single person can have the substantial powers on the entity? No. And that too, manager is a whole and substantially whole. If manager is there, there is no managing director. If managing director is there, there is no manager. Only one person is possible. One more doubt. Sir, is this more than one manager is possible, sir? Then it doesn't possible. It is not possible, because a single person can have control on whole of the affairs of the entity. Whole means 100% control. If I already having the 100% control, how the other person will have? Now coming to the managing director, sir, for any company more than one managing director is possible? In generally the answer is no, but in special circumstances, joint managing directors is possible, because substantial powers here, not whole powers. It was actually clarified by the MCA as well. So previously, while in the regular course also the same fact I disclosed, some student actually asked doubts through Telegram channels and the WhatsApp the same question. Here I am clarifying one more time. In general, it is not possible, but in case of private limited company, joint managing directors is possible, because here it is not mentioning the whole powers. Here just mentioning the substantial powers. Whole-time director. Whole-time director is a director which he comes to the entity as like an employee. Whole time he is working under the organization only. Other directors means non-executive director. Non-executive director means for namesake they are the directors, but they are not participating on the day-to-day operations of the business, which are in generally known as the non-executive directors. Maybe they are vested with certain powers. Maybe like they have the capability of they may be the capability of grabbing the clients, or maybe they are having the I mean they are the VIP persons in the society. Maybe if you take the directors as such persons, then our loyalty or the brand loyalty will increase. So at that particular point of time, we can take it as a directors, even though they are not regularly participating in day-to-day activities of the business. Such directors are known as non-executive directors or other directors. Then the question is, managerial remuneration is completely based on profits, guys. I mean, they are not working for the purpose of fixed salary. They are working for the purpose of variable salary. Obviously, they are highly talented people. They are the key pillars of the organization. They'll never work on fixed salary basis. They'll work on based on percentage of profits. Sir, if in the companies at 2013, if there is no restriction is put in the, if there is no restriction put, then each and every company, the board or the management will draw the like as much they want, but that which is harmful in point of view of shareholders. So that is the reason why there is a clear-cut restriction made by the Companies Act 2013. To that extent only the managerial personnel can draw their remuneration in the form of remuneration. Now for such thing we are going to discuss how much they can draw overall on the individual basis. We are going to discuss. Now certain important points here I gave. Sir, in an entity, either managing director or manager, only one person will be appointed. Greater than one manager is not possible at all. Greater than one managing director, in generally not possible. But if they want, in case of private limited companies, joint managing directors, if they want, they can put it. Sir, just leave it. That is not enough, not required for us at this point of stage. Now come below. Now, this entire managerial remuneration topic is discussed by schedule 5. Earlier we already seen, I opened the schedule 5. The title of schedule 5 itself is the managerial remuneration. Different schedules we seen as per the Companies Act 2013, where schedule 1 is related to memorandum and articles, schedule 2 is related to depreciation, schedule 3 is related to financial statements of companies. Am I right? Like some independent code of independent directors, CSR, schedule 7. Schedule 5 is like that. We've seen things related to appointment of managing directors and the managers and the whole time directors and their remunerations. Now, the question is, when adequate profits are there, how much remuneration we need to give? When adequate profits are not available, then how to calculate the managerial remuneration? Consider it here. When adequate profits are available, how to calculate the managerial remuneration? Or when there are no profits at all, so where it is here, sorry, when there are no profits at all, or the profits are inadequate to pay the amount to the managerial personnel, then how to calculate the managerial remuneration we are going to see. Now, please all of you concentrate. In the first stage, when the profits are adequate, then for the overall ceiling limit will be 11% of net profits. The overall ceiling limit will be 11% of the net profits. For individual ceiling limit, if one managing director or one whole-time director, anyway manager will be one person, I already told you, exist, then individually should not exceed 5% of the net profits. If greater than one managing director or whole-time director exist, then overall for such managing director or whole-time director or manager, it should not exceed 10% of the net profits. In case of other directors means non-executive director, if MD or whole-time director or manager exists, then it should not exceed the 1% of net profits. If managing director or whole-time director or manager doesn't exist, then it should not exceed the 3% of the net profits. So to put it simply, if you see this diagram, you'll get much more clarity. Please concentrate here. Yeah, here it is there. Concentrate. Managerial remuneration. If adequate profits are available, total managerial remuneration should not exceed the 11% of the net profits. If one managing director or one full-time director or manager exists, it should not exceed the 5% of the net profits. If the number is greater than 1, it means overall amount given to the managing director or full-time director or manager should not exceed 11% of the net profits. In case of other directors, managing director or whole-time director exist, it is 1%. Otherwise, 3% of the net profits maximum we can give. Do you understand? Now, sir, what is the meaning of net profit here? This entire thing is as per section 198. This, in case of adequate profits, the remuneration is based on section 198 plus schedule 5. Now, what is the net profit here, sir? The net profit should need to be calculated as per section 197, not as the general net profit we derived in the statement of P&L. The net profit we need to calculate as per section 197. Please all of you concentrate how to calculate. Section 198, not 197. This is 197. Adequate profits dealing with 197. This net profit we are going to calculate as per section 198. Now, how to calculate the net profit as per section 198? Concentrate, guys. How to calculate net profit as per section 198? This is only applicable in case of adequate profits. Till now, I'm not discussing anything related to inadequate profits or no profit situation. Gross profit you can directly consider. This gross profit is as per trading account. For that, you can add the government grant. You cannot add any other type of incomes. I mean, securities premium. Certain list is given. So securities premium we cannot add. Balance in share forfeiture we cannot add. Profit on sale of business or capital assets. If you are selling any of the particular PPE, you cannot add such profits. Revaluation profits also we should not add. Simply you can only take the gross profit as well as the government grant. You can debit, that means you can reduce the following expenses, all as usual working charges. As usual working charges means, sir, electricity expenses paid, sir, rental expenses paid, sir, salaries paid, sir, all such expenses you can reduce. You can reduce the director's remuneration. Sir, we are calculating this net profit only for the purpose of knowing the managerial remuneration. Then if any director's remuneration is there, why you are reducing actually? This director's remuneration is with respect to director fee. Managerial remuneration is different, director fee is different. Directors will get two different amounts. One is, as per the Companies Act 2013, for every quarter, board of directors meeting should need to be conducted. That means for total per annum, minimum 4 board meetings should need to be occurred. 3 or 4, that is depending upon case to case, it is different, but certain board meetings is going to conduct. Now, if any of the director to attend such board meeting, company will pay certain fee, which is known as board fee, which is known as meeting fee, which is director fee. to work or to participate in the day-to-day business activities. For managing director, they will pay separate remuneration. For whole-time directors, they will say separate remuneration. For managers also, they will pay separate remuneration. For non-executive directors also, they will pay separate remuneration. Do you understand? This is in addition to the managerial remuneration they are paying. Such directors fee, anything is there, you can reduce. Bonus or commission, if anything is there, you can reduce. Sir, if you really read all these things, which is in very vague manner, I already list out in very crispy manner. You can remember such thing, that is more than enough. Sir, what is the reason why they are debiting? What is the reason only government grant is crediting? There are no reasons given in the Companies Act 2013, which is a specified structure given directly. Okay, then tax on abnormal and special issues. Normal income tax you should not reduce. Here it is clearly given, normal income tax you could not reduce. Only the tax on abnormal issues only you can reduce. Interest you can reduce. Repairs and maintenance you can reduce. This is another important area. Depreciation as per section 123 or schedule 2 you can reduce. Schedule 2 is related to depreciation, guys. So now if some other depreciation given in the problem, and then the additional information, depreciation as per section 123 or schedule 2 is separately given, you can consider the depreciation as per the schedule 2 or section 123. I already shown you guys, schedule 2 is nothing but only the depreciation only. Schedule 2 is related to depreciation as per section 123. If you see the highlighted part, earlier we seen, right? Now the schedule 2 depreciation only you should need to reduce. The actual depreciation, if anything is reduced, you should add back or simply ignore. Next, sir, repairs and maintenance, all these things I already told you. Legal damages, insurance, etc. you can reduce. These are repetitive, guys. It is actually there in the OneNote at the time of converting into the PDF. Sometimes it is repetitive. Don't read once again. Repairs and maintenance, depreciation already covered here as well. Next, you should not reduce. Income tax should not reduce. Voluntary damages should not reduce. Legal damages you can reduce. Loss on sale of business or capital asset you should not reduce, because profit on sale of part of business or capital asset we should not add it as a profit. That's why loss also you need not reduce. Revaluation loss also you need not reduce. Then after making all such adjustment, you will get net profit as per section 198. So it's very easy. If you consider directly the gross profit is given, you can add the government grant. Remaining all income simply ignore. If coming to expenses, all as usual expenses you can reduce. Along with that, interest you can reduce. Bonus and commission you can reduce. Directors fee reduce. Repairs and maintenance reduce. Depreciation as per the schedule 2 or the 123 you can reduce. Legal damages you can reduce. But you cannot reduce the income tax. You cannot reduce the voluntary damages. You cannot reduce the loss on sale of undertaking. You cannot reduce the revaluation loss. Then you will get the net profit as per section 198. Once if you know the net profit as per section 198, then you can apply here. Then the overall ceiling limit is maximum 11% of net profit. Individual one managing director and one whole-time director exists, then less than or equal to 5% net profit. If greater than one managing director and whole-time director exist, then overall to the managing whole-time director and manager, it should not exceed 10% of net profits. Coming to other directors, if MD or WTD exist, it should not exceed 1%. Otherwise, it should not exceed 3% of net profits. This is the ceiling limit as per Schedule 5, Section 197 of Companies Act 2013, when adequate profits are there. Come down. When inadequate profits are there, I mean the profits are not enough to make repayment to the managerial remuneration, or there are no profits at all, then based on the concept of effective capital, we will pay the remuneration. Based on the concept of effective capital, we will pay the remuneration. If the effective capital is less than or equal to 5 crore, then managing director or whole-time director or manager individually, this limit is individually, they will get 60 lakhs max. It is 5 crore to 100 crores, 84 lakhs. If it is 100 crore to 250 crores, maximum 120 lakhs per individual. If it is greater than 250 crores, 120 lakhs plus 0.01% on above 120 lakhs. That is the maximum amounts. I'm telling you, these are the maximum amount. A company can issue less than such amounts. Obviously, there is no problem at all. These are the maximum limits on individual basis for managing director or whole-time director or manager. Sir, in case of other directors, simply divided with 5. Here 60 divided by 5. Here 12 lakhs. Here 120 divided by 5. Here you will get 24 lakhs. Only you can remember this part. This is 17 lakhs. If you remember, if you divide with 17, sorry, if you divide with 5, you will not get it 17 here. So only for this part you can remember which is 17 lakhs. So then how to calculate the effective capital is the matter of discussion. Sir, how to calculate effective capital? Effective capital is paid up share capital, both equity and preference. You can add the reserves and surplus other than revaluation reserve. Other than revaluation reserve, you can add any long-term borrowings is there, you can add here. Accumulated losses are preliminary expenses not written off. Preliminary expenses not written off. If anything are there, you can reduce. Investments other than in case of investment company, you can reduce. I mean, if my company is an investment company, no need to reduce investment. No. If my company is an investment company, no need to reduce investment. If my company is other than an investing company, I can reduce the investment, because in case of the investment company, the major asset itself is investment. At that point of time, it need not reduce the investment. Sir, when a company is known as investment company, you know, their main business operating income is getting from either a dividend on such investment, either on interest on such investment. It will procure money from the public, or it can get borrowings from the banks, and the entire amount is ultimately make it invested into different enterprises. If that is the business of such company, which is known as investment company. Do you understand? Then after knowing the effective capital, then on individual basis, what is the maximum amount we can give, you know, based on the effective capital. For other directors also, simply I explained here. Am I right, guys? Fine. Sir, to explain the entire thing in very crispy manner, just I will take up a small diagram here. Please concentrate, all of you, quickly. Sir, which is the concept of managerial remuneration? If you see this diagram, the overall picture will be in your mind. Managerial remuneration. Sir, in two ways it is possible. In one way it is when adequate profits are there, or if the profits are inadequate, or there is no profit situation. In case of adequate profits, then overall limit is how much? Overall limit which should not exceed 11% of net profits, should not exceed. Sir, individual basis, that is, if one managing director, or that is, here I'll write special issues. I mean, in special cases, just a second. In special cases, what are those special cases? Total here 3 cases are there. If one managing director or one whole-time director or manager, because only anyway manager is one manager only, then individually it should not exceed 5%. Individually it should not exceed 5%. Second case, sir, if greater than one managing director or whole-time director exist, then overall for that managing director, whole-time director plus manager should not exceed 10% of the net profits. Then coming to the other directors, what we seen, other directors means other than whole-time directors and managing director. Then we seen two situations. One situation is if MD or WTD exist, it should not exceed 1%. In other cases, it should not exceed 3% of the net profits. This is related to adequate profit situation. Then if the profits are inadequate, situation, based on the effective capital, that is for whole-time director or the managing director or the manager, Sir, it is clearly given that up to how much amount, guys? Just a second. Yeah, it is here. Up to less than 5 crore. Up to less than 5 crore, the maximum amount is 6 lakhs. And greater than 5 crore, but up to 100 CR. But less than 100 CR, which is 84 lakhs. Next, greater than 100 crores, but less than 250 crores, which is 120 lakhs. If it is greater than 250 crores, 120 lakhs plus 0.01% in excess of 120 lakhs. Next, related to other directors. Simply you can division with 5. Here 12 lakhs, here 17 lakhs. Here you should not divide with 5. But again, here you can again division with 5, which you are getting 24 lakhs. Here 24 lakhs plus in excess of 0.01% of 250 CR. Like this, you can work out the entire managerial remuneration in case of adequate and inadequate profits. And one more thing, here the profit is nothing but calculated as per section 198. Here the effective capital. What is this? This is effective capital. This is based on effective capital. How to calculate the effective capital as well as profits as per section 198 clearly explained. That's it, guys. Now come to the last concept, guys. As I told you, the last concept is related to dividend. Come to the power notes, all of you, quickly. The last concept is things related to dividend. Dividend. Sir, dividend is declared only from divisible profits. What is the meaning of divisible profits? Profits which we can utilize for the purpose of declaration of dividend, we can known as divisible profits. Divisible profits are either surplus or free reserves. You know the meaning of free reserve. Free reserve is in general reserve other than surplus. Okay, so these reserves only I can utilize, that is free reserves or the surplus. Surplus means profit and loss. Only I can utilize for the purpose of declaration of the dividend. The dividend is of two types. One is final dividend, another one is interim dividend. What is the meaning of final dividend, sir? I'll try to explain in generally how the dividend proposal and declaration is going on. I already explained previously. One more time, the crux I am going to tell here. For example, we are in the year 2021. As on 31st March 2021, financial statements are not yet ready, to be frankly speaking. After 31st March 2021, once the finance team and the CFO, and after completion of their hard work, they will submit their financial statement to the board of directors. So here, as per my given example, as on 15th of April 2021, just they submitted such financials, then board of directors approved such financials as on such 15th April 2021. As on that, board of directors will propose such dividend, which is known as proposed dividend. After that, shareholders will conduct a general meeting, right? The company itself make an invitation to the shareholders to come to the general meeting. Then as on the date of general meeting, they will discuss the ordinary business activities as well as special business activities. One of the ordinary business activities is the declaration of the dividend by the shareholders in the general meeting. Shareholders can reduce but cannot enhance the dividend already proposed in the board of directors. That means the dividend related to a specific financial year is not going to declare in that specific financial year. The dividend which is related to the 2021 is going to declare as on the date of the general meeting. Do you understand? That means the final dividend can be declared in the related to that year profits or maybe related to the previous year profits as well. Do you understand? The final dividend can be prepared, the final dividend can be declared either from the respective year profits or from any previous year accumulated profits, as well as free reserves also. But coming to the interim dividend, board of directors directly declare whenever the profits are huge, they want to satisfy the shareholders, they couldn't wait up to the date of the general meeting. Board of directors will take an appropriate decision, then they can declare such dividend, which is known as interim dividend. Interim dividend should always payable from the current year profits only. Because when the concept of interim dividend coming to the picture, current year huge profits are occurred. Then for the purpose of interim dividend, no need to take the approval from the shareholders. Board of directors can directly declare. That's why in case of interim dividend, only current year profits can only be utilized. But in case of the final dividend, you can utilize the respect to current year profits as well as previous year accumulated profits or free reserves. Next. When at the time of declaration of the dividend, you can use the current year profits with respect to final dividend. But such profits you should derive after providing depreciation as per section 123. You can utilize the previous profits of the previous years as well, which is nothing but accumulated profits also. If you want, you can utilize after providing again depreciation as well. You can utilize free reserves as well for the purpose of declaration of the dividend. Sir, can I utilize government grants? Yes, if government provided the guarantee. Sir, if certain companies, how it will be, maybe those are incorporated in the backward areas, maybe due to manufacture of such products, which is not which is not viable in the sense of profit, but still government will encourage to manufacture such products because which are high necessary. Maybe government defense equipment, maybe government clothing. I mean, the defense person clothing, defense weapons, all such things are there. Government will provide the guarantee to declare such dividend. At that point of time, you can utilize the government grants also for the purpose of declaration of the dividend. But that is very rare situation, which is applicable in case of government companies only. But coming to the remaining all other companies, in case of final dividend, they can utilize the current year profits or they can utilize the accumulated profits or the free reserves. At the time of declaration of the dividend from the current year profits, without having any restriction, without having satisfaction of any further condition, they can declare the dividend. If how much they want, they can declare simply. But when the company declared dividend by utilizing the accumulated profits or free reserves, not by utilizing the current year profits, certain conditions need to be followed as per the declaration and payment of dividend rules 2014. As per the declaration and payment of dividend rules 2014, whenever a company declare the final dividend by utilizing the accumulated profits or from the free reserves, they need to satisfy certain conditions. What are such conditions? Are three are important conditions. Actually 5 to 6 will be there. I'm going to discuss only three major important conditions. The declared dividend should be less than or equal to last 3 years preceding financial year's average dividend. If you want to utilize the previous accumulated profits, previous year's accumulated profits are free reserves, the declared dividend in the current year should not exceed the last three preceding financial year's average dividend. Amount utilized from accumulated profits should be less than or equal to 1/10 of the paid up capital free reserves. Amount utilized from accumulated profits or reserves or free reserves should be less than or equal to 1/10 of the paid up capital plus free reserves. After withdrawal from reserve, the balance of reserves and surplus should be greater than or equal to 15% of the paid up capital. If you satisfy all these three conditions, then only you can declare the dividend from the previous year's accumulated profits or the reserves, and the maximum amount is whichever is lower. Whichever is lower means, for example, you declared the dividend of 10%. You declare the dividend of 10% in the current year. Just you want to declare the dividend of 10% in the current year, but the previous year's average is only 5%. How much amount I can declare? Only 5% of the dividend. I calculate if the 5% of dividend is maximum, how much it will come, I will work out. Amount utilized from accumulated profit should be less than or equal to 1/10 of paid up capital plus free reserves, right? Now I will add paid up capital plus free reserves. I will division with 10. How much amount I will get? I will put here. After withdrawal from reserve, the balance of the reserve should be greater than or equal to 15% of the paid up capital. First, I will work out the 15% of the paid up capital. How much amount is there? Let us assume which is 15 lakhs. And the balance in the free reserve. Balance in the free reserve is, let us assume 25 lakhs. Now, how much amount I can utilize? 25 lakhs minus 15 lakhs. I can utilize only 10 lakhs because after withdrawal from such reserves, the balance should be greater than 15% of the paid up capital. Now, point number 1, point number 2, this amount of 10 lakh, whichever is lower, up to that amount only I can utilize from the accumulated profits or from the free reserves for the purpose of declaration of the dividend as per the declaration and payment of dividend rules 2014. Do you understand? Okay. So let me put the same thing here, guys. The last conclusion related to the dividend. Dividend. Sir, dividend can be made out of divisible profits. Out of divisible profits. The dividend may be final dividend or the dividend may be interim dividend. It may be the final dividend. It may be the interim dividend. Final dividend declared by shareholders. I mean, proposed by board of directors, but declared by shareholders. In case of interim dividend, directly declared by board of directors. In case of interim dividend, always they will utilize the current year profits. In case of final dividend, they can utilize the respective current year profits. Sir, here current year profits means the year for which they are declaring, the year in which not they are declaring. Because the declaration of the dividend in generally not happen in the same year. The declaration of the dividend in generally occurred as on the date of general meeting. For which year they are declaring is the important. The year in which they are declaring is not the important issue. So the current year profits means the year for which they are declaring, that current year profits they can utilize, or they can also utilize previous year's accumulated profits. Previous year accumulated profits also they can utilize, or they can also utilize the free reserves. But here there are no restrictions. Am I right? There are no restrictions here. So as per declaration of dividend and payment rules, declaration of dividend and payment rules 2014, there are certain restrictions are there. The declared dividend out of accumulated profits and free reserves less than or equal to average dividend of previous 3 financial years. Previous 3 financial years declared dividend. Am I right? What is the second one? The declared dividend. The maximum amount we can be declared is 1/10 of the paid up capital and free reserves. That is the declared dividend. Maximum is 1/10 of paid up capital plus free reserves. After declaration, balance in reserves, I mean balance in free reserves should not be less than 15% of the paid up capital. Should not be less than 15% of the paid up capital. That means it should be greater than or equal to 15% of the paid up capital. Am I right? So these are the provisions we need to follow at the time of declaration of the dividend out of accumulated profits or free reserves. Sir, with these financial statements of companies chapter is over. We are not concentrating on the problem based on the schedule 3 format. The reason I already told you, we are going to see such problems in the forthcoming chapters at different levels. And one more thing, managerial remuneration problems also I didn't touch. The reason is if you know the concept, you can easily hit the problem. Now related to dividend, also the same thing, just I made it. Okay, that is more than enough things related to financial statements of companies. We'll continue the same with the next chapter, guys. Hi guys, in this slot we will try to cover total 3 chapters. One is profit or loss pre and post incorporation, and another one is bonus and right shares, and the final one is redemption of preference shares, as you know, which is actually form part of section 4. We are dealing the entire company related chapters first as a part of marathon, right? Fine. All of you please come to the chapter. let me explain the things with my power notes. Please all of you come to my power notes here. Sir, here, if a running business, it is either a sole proprietor or a partnership firm. If it is ultimately taken over by a company, or else the existing sole proprietor or partnership firm is want to convert into a company, then profit or loss prior to incorporation and profit or loss post to incorporation situation is going to arise. How it will going to arise, we can going to see through a small example. Please concentrate. First, let us understand what exactly the meaning of pre-incorporation period and post-incorporation period. Then I will discuss the profit with respect to such pre-incorporation period and post-incorporation period. Then finally, we will see the treatment of such profit as well. So the basic agenda of this chapter is how to tackle profit prior to incorporation as well as profit post to incorporation. But before seeing all such things, first our focus will going to give on what is the meaning of pre-incorporation period, what is the meaning of post-incorporation period first. Now, let us assume a company so-called as XYZ Limited is going to decide to acquire a running sole proprietorship firm or a running partnership firm as on 1/4/2020. Now, you know, we already come across to the chapter financial statements of companies. The idea who have to start a company form of business is generally known as promoters. That means it is the thought of the promoters to acquire such partnership firm business or the sole proprietor, or you can conclude it as a conversion of proprietorship into a company as well. But whenever the existing business, if they want to convert into a company, the decision is known as acquisition of the another enterprise by the company. Am I right? That was evolved as on 1/4/2020. You know, whenever they decided they cannot directly incorporate a company, I already told you, so it has certain procedural issues. They need to first reserve the company name, then they should adopt the MOA as well as AOA through certain spice forms under Ministry of Corporate Affairs. They need to file with the registrar. Then the ROC finally, if all such things are exactly filed by such company, then they will release the certificate of incorporation. So due to such procedural issues, date of incorporation, they will get it as on 1/7/2020. That means after date of acquisition, after 3 months, it got their certificate of incorporation. The date itself we will known as date of incorporation. Now, in the same example, the date of closure, we can take it as a 31st March 2021. Now, coming to the financial year 2021, coming to the financial year 2021, up to 1/7/2020, up to 1/7/2020, the period is technically known as pre-incorporation period. The period after 1/7/2020, that is after 1/7/2020, the period is known as post-incorporation period. Before getting the certificate of incorporation, the period is pre-incorporation period. After getting the certification of incorporation is post-incorporation period. So then what is the issue? What is the reason for introducing this chapter, sir? Now the thing is, after the date of acquisition and before the date of acquisition, business is ultimately conducted by promoters of the company on behalf of the company, which is going to be report under the company books only, not under the normal profits, which is under the name of pre-incorporation profits. You know, after the date of incorporation, promoters are the board of directors. Board of directors will come into the picture. Board of directors will conduct the business activities on behalf of the company with on the name of the company itself. Because after the date of incorporation, the company came into existence legally they can directly entering into the transaction with the company name itself. Their board of directors represents the company at that point of time. Am I right, all of you? Now the thing is, what is the accounting treatment for profit or loss derived after date of acquisition but before date of incorporation? And what is the accounting treatment for profit or loss after date of incorporation but before the date of closure? Simply, before incorporation profits, what is the treatment? After incorporation, what is the accounting treatment? Do you understand? Sir, before directly tell the conclusion part of that accounting treatment, first I will give you another example. Please all of you concentrate. I'll slowly connect the accounting treatment and the example which I'm going to explain. Sir, for example, as on date of acquisition, at that time you have the thought to acquire the business of the existing sole proprietorship or the partnership firm, the net asset value of the business is 5 lakh. That is the value of the business of sole proprietorship firm or the partnership firm is 5 lakhs, let us assume, which is known as NAV. NAV is nothing but net asset value, assets minus outside liabilities value, which is known as business value. Valuation of the business is 5 lakhs. Now, as a company XYZ Limited, you are acquiring the other enterprise. Now you decided to pay the same amount of 5 lakhs to the sole proprietorship firm or the partnership firm. Then you can take over that business, that is assets and liabilities of that proprietor or the partnership firm, then belongs to the company. Now the situation is, the value of the business is 5 lakhs. Now company is also going to pay 5 lakhs, which is known as purchase consideration. Now in point of company, which is purchasing the business, am I right? Which is known as purchase consideration. The consideration payable by the company to purchase the another enterprise is known as purchase consideration. Now the value of the business I am getting, which is 5 lakhs, for which I am paying also 5 lakhs. There is no profit, no loss in point of view of company. No profit or loss on acquisition of the business. Am I right? Now let me continue the same example. After date of acquisition, after date of acquisition means after 1/4/2020, company conducted their business activities. That means there is no company really in existence before the date of incorporation. On behalf of the company, promoters conducted the business. Promoters achieved the profit of 1 lakh. Now what is the situation up to the date of incorporation? That is, as on date of incorporation, what is the situation? Sir, net asset value of the business is 5 lakhs previously plus. Now promoters achieved 1 lakh profit, means this 1 lakh will be added to the NAV. Then the value of the business will become 6 lakhs. Do we agree, all of you? Now, the PC amount you decided to pay to the extent of 5 lakhs, but the NAV of business takeover, that is nothing but the value of the business is 6 lakhs. That means excess 1 lakh you are getting as a benefit in the form of company, which is PC is less than NAV situation, which is known as profit on acquisition of the business. Whenever you are paying the less amount to get the more benefit, such benefit is known as capital benefit, which is nothing but capital profits. Such capital profits are in generally make it transfer to the capital reserves. Now the question is, sir, this 1 lakh profit is after date of acquisition, but before incorporation only. Now you are comparing PC of 5 lakhs with NAV of 6 lakhs, then the excess amount you are telling, which is nothing but capital profit in the form of capital reserve. That means the pre-acquisition profits, I mean the pre-incorporation profits, not pre-acquisition, after acquisition but before incorporation, the pre-incorporation profits, I can treat it as like capital profits. I can make it transfer to the capital reserve. To tell that conclusion, I told this example. I told you before telling the example, I will connect ultimately the treatment as well as example. And one more thing, sir, you told that if it is the profit situation, we can imagine it as a capital profits and make it transfer to the capital reserve. Then if it is a loss situation, you can treat in the same way, which is a capital loss. But capital losses are in generally not make it transfer to the P&L. Such capital losses, we can make it transfer to the goodwill. How it will happen, I'll explain through example number 3. Please concentrate. So the PC is 5 lakhs, what we are going to pay, which is fixed. Now, in the current 3 months, that is after acquisition but before date of incorporation, let us assume the promoters achieved 50,000 loss. Now, NAV is 5 lakhs minus 50,000. Then the NAV will become 4 lakh 50,000. Now, all of you, please think and let me know. You are paying 5 lakhs, but you are getting the worth of business for 4 lakh 50,000. But excess amount, how much you are paying? 50,000. Excess amount of 50,000 you are paying to the sole proprietorship firm or the partnership firm. What is the reason? May I know? Maybe the value of the business is 4 lakh 50,000, but why I am paying the excess of 50,000 for the purpose of goodwill of the proprietorship firm or the partnership firm? That's why if the PC is greater than NAV, such capital loss is treated as goodwill. Simply, the pre-incorporation profits or losses, we can treat it as a capital profits or capital losses. If it is a capital profit, we can make it transfer to capital reserve. If it is a capital loss, we can make it transfer to the goodwill. But if it is a post-incorporation profits, that you know the normal accounting treatment. Sir, if it is the post-acquisition profits, means general profit and loss of a company, we are in generally make it transferred to the P&L from profit and loss account. It make it transfer to the reserves. That is the common accounting treatment after incorporation. And the next question coming to my mind is how I can derive that pre-incorporation profits and post-incorporation profits. How we can calculate this profit, how we can achieve post-incorporation profit. That is the next question coming into my mind. For that, two methods are available. Methods used for calculation of pre and post-incorporation profits. Method number one, close the books of accounts as on date of incorporation and open new books of accounts from date of incorporation. Then what will happen? From date of acquisition to date of incorporation, one set of books. These are one set of books. These are different set of books from date of incorporation to the up to date of closure. Now, if you close your books of accounts at this stage, then you will know profit or loss for pre-incorporation. Then if you open the books of accounts as on the same day, which are the new books of accounts, then you can easily achieve the profit or loss after post incorporation. But this is very tedious job. 2 times you need to finalize your books of accounts. 2 times in a particular year, you need to prepare the financial statements. So preparation of financials for annum itself is too much of difficult situation. In case of a joint stock companies, you know such fact. You can imagine the Reliance Industries Limited, how many branches they have, how many business units they have, how many different verticals they are working. It's very tedious job to conduct the closure of the books of accounts or the preparation of the financial statements. So that's why in generally method number one is not practical. People are in generally followed the method number two, which is a single set of books. What they will do, they will prepare trading account in common to achieve the gross profit. They will not differentiate pre-incorporation period and post-incorporation period. Just they will treat it as a single period for a trading account. For trading account, they will prepare as like a for single accounting year. Now, the achieved gross profit, they are going to distribute in between pre and post. Now, pre and post, the gross profit they are going to distribute in their sales ratio, because the major impact for the gross profit is the sales. If you know the pre-incorporation period sales and post-incorporation period sales, in such sales ratio, that gross profit is going to distribute to the pre as well as post. If sales ratio is not available, then you can distribute in cost of goods sold ratio as well. Cost of goods sold means opening stock plus purchases plus manufacturing expenses minus closing stock. If there are no manufacturing expenses, opening stock plus purchases minus closing stock, then automatically you will get cost of goods sold. Is it okay, guys? All of you, sir, if that information is also not available, sir, then what I can do? Then I can use time ratio. Time ratio means pre-incorporation period how much, post-incorporation period how much. Do you understand, all of you? But most of the time sales ratio will be available. The base requirement to distribute the gross profit in between pre and post is sales ratio. Okay. Then you know the pre-incorporation period gross profit, you know the post-incorporation period gross profit. Then how I can distribute all the particular items in the P&L among pre and post, sir. Certain expenses may be based on sales. Certain expenses may be based on a specific ratio which is given in the problem. Certain expenses may be based on the time proportion ratio. Certain expenses may be exclusively related to the post. Do you understand what I am telling? So then how I can know which basis I can use to distribute among the pre as well as post? Let us have a look now. First, I'll open my main notes. Please allow if you come to the main material. Sir, expenses based on the sales ratio. Expenses based on the sales ratio. Carries or carries outward. That is based on sales ratio. Selling and distribution expenses based on sales ratio. Commission to the salesman, selling agents, advertising expenses, bad debts, brokerage, sales promotion expenses, all are the basis is the sales ratio. The basis is the sales ratio. Do you understand all of you this? Next. Certain fixed common charges, we are using the time ratio. Sir, unless otherwise a specific ratio or the specific basis given in the problem, we can use that specific ratio only. But there is no basis given, then for these expenses, we can consider time ratio. Salaries, office and administration expenses, rent, rates and taxes, printing and stationery, telephone, telegram and postage, depreciation, miscellaneous expenses. Don't by heart any expenditure. Just you can connect. Sir, if something is given, we will approach that ratio, or otherwise we will simply use the time ratio. Next, I told you for certain expenses, we will only use the post incorporation period, right? So let us have a look for the post incorporation period expenses. Sir, in post incorporation period, formation expenses, which is known as preliminary expenses. Preliminary expenses related to the company, not related to proprietor or the partnership firm. That's why only categorized under the post. Interest on debentures. Debentures can only be issued by the company. Debentures cannot be issued by partnership firm or the proprietorship firm. That's why these are belongs to post incorporation period. Directors, board of directors will be there after incorporation of a company. That's why again belongs to the only post incorporation period. Directors remuneration. What is the difference between directors fee and remuneration? You know, directors fee is to be payable by the company for the purpose of attending the board meetings. Directors remuneration is related to the part of the certain profits of the company is belongs to the director as form part of managerial remuneration under section 198 as per schedule 5 of the Companies Act 2013. You already seen such things under the last chapter. Then preliminary expenses I already discussed. Share issue expenses. Sir, shares are possible only after incorporation. Underwriting commission. Underwriters concept is only applicable in case of company. Discount on issue of securities. I mean, discount on issue of shares concept is not applicable as per Companies Act 2013, but discount on issue of debentures is allowable. So if any of such discounts are there, then we can apply as only in the post incorporation period, not in the pre incorporation period. Next, one more important thing, just I want to discuss here through my power notes, concentrate. Sir, audit fee. Is it audit fee belongs to pre-incorporation period or post-incorporation period? Audit are two types, basically, with respect to the company point of the organization. One is company audit. Company audit is a pure post. Because for sole proprietor and the partnership firm, audit is not mandatory, but for a company, audit is mandatory as per the Companies Act 2013. Am I right? So that's why the company audit fee, if we can only apportion it to post incorporation period. But coming to the tax audit fee, you already know as per section 44, as per section 44 AB of the Income Tax Act 1961, if such entity, the entity may be a trust or maybe a proprietor or the company or the partnership firm or maybe the HUF, anything, irrespective of that, if the turnover is come across a certain limit as per the section 44 AB, then tax audit is applicable. That's why tax audit fee you can apportion it based on the sales ratio, because audit is based on the sales here, but here audit is based on the type of the entity. Do you understand? So company audit fee only post, but the tax audit fee based upon the sales, we can simply apportion to pre and post incorporation periods. Next, one more important thing, guys, here. This is interest on PC. You know, company should need to pay certain amount to sole proprietor or the partnership firm, right? when actually it should need to pay as on date of acquisition. But due to the lack of funding or due to the agreement entered in between the company as well as the other entity, if the company is paying such PCE on other than the date of acquisition, then the company should need to pay along with the PC amount. It should also need to incur interest on PC. Am I right? Now, up to the date of incorporation, how much interest they need to pay on the PC? I mean, the purchase consideration, if it is not going to settle before the date of incorporation, then interest up to the date of incorporation it belongs to pre-incorporation period. Interest after the date of incorporation, it belongs to the post-incorporation period. Am I right? For example, in our the basic example we taken that date of incorporation is as on 1/7/2020, right? Now the agreed amount of PC of 5 lakhs, let us assume the XYZ Limited is going to settle as on 1st October 2020. Let us assume interest rate is 10%. Now interest from 1/4/2020 to 1/7/2020, 3 months interest is belongs to the pre-incorporation period. That is 5 lakhs into 10% into 3/12. 5 lakhs into 10% into 3/12. So which is equal to 12,500. 12,500 is belongs to the pre-incorporation period interest. Sir, how much is the post-incorporation period interest? They are going to settle as on 1st October, right? 1st October means after date of incorporation, the period is 3 months. From 1/7/2020 to 1/10/2020, the period is 3 months. Again, another 12,500 is belongs to the post-incorporation period interest. Like this, you need to check the pre-incorporation period as well as post-incorporation period expenses. Sir, here just I want to emphasize 2 to 3 very good important adjustments, because you know this is the marathon session. Don't expect each and every point. Here I am only give the focus on the crux of the issues. In the major issues where the student can feel little bit toughness, or they can have their ambiguity in deciding the factors, in understanding the concept. Such issues only I'm giving the more focus. Is it okay, guys? Now certain 2 to 3 important issues I'm going to explain here. Now let's come to one note. For example, at the time of evaluation of sales ratio, at the time of evaluation of the sales ratio or in calculation of the sales ratio, most of the times in the problem, they are not directly provided the information for sales in between pre and post. How they will give for John and October month sales doubled while compared with other month sales. Then based on this fact, you need to calculate the sales ratio. The remaining information is same. So what is the remaining information? Date of acquisition is as on 1/4/2020. Is it 1/1/2020 or 1/4/2020? I think so, which is 1/4/2020. And the date of incorporation is given at 1/10/2020. Sorry, 1/7/2020. And the closure, date of closure is 31st March 2021. The basic example, where what we take in the same example I considered here. Now, if you check here, which is the pre-incorporation period, right? That is 1/4/2020 to 1/7/2020 is the pre-incorporation period. Let us assume each month sales is only X. Each month sales are generally X. Now, in the pre-incorporation period, how many number of months are there? 4 months. Then in pre-incorporation period, total sales how much? 4 into X, which is 4X. Now come to the post-incorporation period. In post-incorporation period, how many number of months are there? Total 8 months are there. Now in these 8 months, Jan month is included, October month also included. Do you agree? Do you agree, all of you? Now, other than this Jan and October, how many number of months are there in the post-incorporation period? Only 6 months. That is 6X. Because remaining all number of months, the sales are generally X per month, then 6 months, 6X. Then coming to especially Jan and October months, The sales is clearly given that which are doubled to the normal sales. Normal sales is X. Then in this particular month, the sales are 2X. Now for such 2 months, 2 into 2X, which is pre-incorporation sales, which is post-incorporation sales. Do you agree, all of you? Now here 4X is to 6X plus 2 into 2X, which is 4X. So 4X is to 10X, which is 2 is to 5 is the sales ratio. So like this, you need to work out the sales ratio according to the information given. Most of the times, these type of adjustments are given. One more important adjustments they are giving most of the times, which is related to a rental adjustment. Rent. Just I am telling certain adjustments which the students may face the difficult in generally. How they are giving from 1st October 2020, we taken the additional space. We taken additional space for the rent. For rent per month at the rate of 1,000. So the total rent it is given that 36,000. This is the information they are giving, which is the total rent for the entire 12 months. Now I need to find out the rent in between pre-incorporation period as well as post-incorporation period. That is the point. Now this 36,000 is the rent for total 12 months. Am I right? Now first let me divide it into pre-post. Am I right? Now please concentrate. First, the additional rent is how much? Let us have a focus. Additional rent is how much? Sir, from 1/10/2020 to 31st March 2021 means total we have 6 months. So the total additional rent out of this 36,000, total additional rent, which is 6 into 1,000, which is 6,000. Now normal rent is how much? 36,000 minus 6,000. Normal rent is 30,000. Now total here we have 30,000 is the normal rent and 6,000 is the additional rent. First you need to apportion the rent into normal rent and additional rent. Now first let us have a discussion with respect to the normal rent. Sir, if nothing is given, rent we are going to apportion in between pre and post in time proportion basis. Now the basic example, the pre-incorporation period is 4 months and the post-incorporation period is 8 months and the time ratio is 4:8 means 1:2. Now this 30,000 normal rent we are going to distribute in between the pre and post in the ratio of 1:2. Can you please tell me, all of you, 1:2 ratio means? Here it is 10,000. Here it is 20,000. This is with respect to the normal rent. Now coming to the additional rent. Sir, there is no additional rent in pre-incorporation period because we are taking the additional space from 1/10/2020. So the entire additional rent is only belongs to the post-incorporation period, which is 6,000. Now the total rent in the pre-incorporation period is 10,000 and total rent is the post-incorporation period is 26,000. So like this, you need to work out the rental issue as well. Do you understand? Sir, these are not quite enough. They will give so many adjustment based upon your common sense. Just you can apply which ratio is the best suitable for that. Okay. Now, sir, what is the format we are going to consider, sir? Sir, I cannot explain each and every problem here. We will directly go with the format. How the format will look like. We can start with particulars, total. These will be directly available in the problem. Basis you can consider pre-incorporation and the post-incorporation period. Gross profit, you can in generally apply the sales ratio and the remaining expenses based upon the suitable basis. Just you are going to apportion in between the pre-incorporation period and post-incorporation period. Then from gross profit, if you reduce all the expenses, then you will get the net profits. If it is the pre-incorporation period net profit, you can make it transfer to the capital reserve. If it is related to the post-incorporation period, simply you can make it transfer to the free resource, that is under I mean, sorry, surplus. Free reserves means under surplus, you can make it transfer. Like this, you need to present. Next, sir, I will take up one problem, which is quite a different problem for profit or loss pre and post incorporation period, because most of the times we may thought that, sir, for gross profit, which ratio we are going to use, which is sales ratio. But in this problem, I'm not going to use the sales ratio. Why I'm not using the sales ratio, you can understand after reading the problem. Let us have a look with that problem, guys, which is the final problem. Or before seeing that final problem as well, first let us check the latest examination question. Sorry, I forgot actually. First, let us check the latest examination question, which is quite simple. After that, I will explain that special problem. Yeah, in my material, which is problem number 1, which is asked in the recent examination happened, which is July 2021. Okay, come here. What is the question? Question is, you are required to determine the basis of apportionment above expenses between pre-incorporation and the post-incorporation periods. Let us check whether you can able to recognize the basis or not. Director fee, post-incorporation, because directors are available only in post-incorporation period. Preliminary expenses written off, which is also related to pure post-incorporation period. Salaries and general expenses, if nothing is mentioned, we can use time ratio. Time ratio. It is not depending upon sales ratio, right? Statutory audit fee, only for company which is applicable, which is post incorporation period. Tax audit fee, just now I explained, based upon the turnover, which is sales ratio. Commission to traveling agents. Commission to traveling agents. Please, all of you tell me which ratio we need to use. This is also sales ratio, provided this traveling is for the purpose of sales or the advertisement, for the purpose of promotion. Okay, next, come here, all of you. Sales promotion expenses, anyway we are using the sales. Advertising expenses, we are using the sales. Rental expenses, time proportion basis, that is the time ratio. Bad debts is based upon again sales. These are the basis actually we can use. So they tested for 5 marks, so each one carry half mark. If you provide the correct basis, you will award it with full marks, which is a recent examination question. I told you one more special question we are going to see, right? Let us have a look, which is the final problem actually, which is quite interesting question. That is the reason I am taking in the marathon. Concentrate. New Limited was incorporated on 1/8/2020 to take over the business of a partnership firm with effective from 1/4/2020, which is date of incorporation, which is date of acquisition. If you observe, if this is the date of incorporation as on 1/8/2020, so date of acquisition is as on 1/4/2020, then pre-incorporation period is how many number of months, guys? Pre-incorporation period. So total we have 4 months. And the post-incorporation period is how many number of months? Sure, 8 months. Sir, 8 minus 4, which is equal to 4, guys. April, May, June, July. That's it. Now, the time ratio itself is 1:2. Okay, fine. It provides you the following further information. For the year ended 31st March 2021. Okay, certain items are given. Gross profit, salaries, rent, depreciation, commission on sales, interest on debentures, directors fee, advertisement, net profit for the year. New Limited initiated an advertising campaign which resulted increases in monthly average sales by 25% of the post incorporation. Can you please all of you tell me one thing, guys? Advertising expenses is actually based on sales ratio, right? If nothing is given, normally based on sales ratio. If you simply apportion based on the sales ratio in this problem, then the problem will be wrong. Do you know the reason? If nothing is given, advertising expenditure, just we can make it apportion on the basis of sales ratio only. I too agree. But it is clearly given in the problem that due to advertisement, only there is increase in the post incorporation period. That means the benefit of advertising expenditure is only passes to the post incorporation period, but not to the pre incorporation period. So that's why The entire advertising expenditure, you can make it transfer to the post incorporation period. That is the first important special issue in this problem. Next important issue. Here it is there, which is point number 2. The gross profit ratio of the post incorporation increased to 30% from 25%. That means in pre-incorporation period, GP percentage is equal to 25. But in post-incorporation period, the GP percentage is equal to 30%. Do you understand, all of you? Now, here gross profit is there now, which is 9 lakhs. You cannot apportion the gross profit directly on the basis of sales ratio. In generally, the gross profit we are going to apportion in between pre to post on the basis of sales. But here they are directly given the different GP percentage for the pre and post. Now what you can do, if you know the sales for pre-incorporation and post-incorporation period, then sales into GP percentage for pre, I mean GP percentage for pre is how much? 25. That is sales into 25%. That is nothing but pre-incorporation period total gross profit, and post-incorporation total gross profit are nothing but post-incorporation sales into GP percentage, which is 30%, which is the post-incorporation period, which is nothing but the GP ratio. Do you understand what I am telling? Now, all of you please concentrate here. Sir, do you know the sales ratio, or do you know the, do you know the sales for pre and post incorporation? You don't know the exact sales, but you know one thing. What is that? Monthly average sales in the post incorporation period is increased by 25%. Let us assume the monthly sales are X. In pre incorporation, which is 4 into X, which is 4X. We already know the pre incorporation period is only 4 months. And the post incorporation period 8 into X plus 0.25X, which is 1.25X. Monthly sales are increased by 25%. Now, which is 4X is to 8 into 1.25, how much? Which is equal to 10X. Now, the sales are 4X is to 10X, or you can call it as 2X is to 5X. That is 2 is to 5. Now, the gross profit percentage, 25%. Sales for the pre-incorporation period, if you can assume, which is 2X. 2X into 25% is 2. Sales for the post-incorporation period, which is 5X. 5X into 30%. Now you can find out this ratio, guys, which is 0.5X is to 1.5X. The ratio is 1 is to 3. Now you can apportion the given gross profit is to 1 is to 3. Do you understand? So if GP percentage from pre to post is different, then you cannot apportion the gross profit directly on the basis of sales ratio. Then sales into GP percentage, the pre-incorporation, and post-incorporation sales into post-incorporation GP percentage, then you will get the post-incorporation gross profit. In that proportion, you can apportion the GP for pre and post. So the same thing I explained through my power notes as well. If you check here, calculation of gross profit related to pre and post. Okay, so sales ratio we can directly easily get depending upon the information given through point number 1. That is post incorporation period sales are 25% more than the pre incorporation period sales. Then the sales ratio I got 2X is to 5X. Now gross profit is equal to pre incorporation period sales into the GP percentage of the pre incorporation, and the post incorporation period sales into GP percentage of the post incorporation. Then you will get the GP ratio of 1 is to 3. Once you will get that, remaining all are dead easy. That is, for GP ratio, I used the 1 is to 3 ratio, and advertising expenditure, I only considered the post. Remaining all, salaries time proportion, rent time proportion, depreciation time proportion, commission on sales, sales ratio, interest on debentures, only post incorporation, directors fee, only post incorporation. Then you can find out the pre-incorporation period profit or loss. Then you can transfer to the capital reserve. That's it, guys. That is the end of profit or loss pre and post incorporation period. So the major important points I discussed. Hope I discussed right. Fine. And the next chapter is bonus and rights issue. Bonus shares and right shares. Sir, in this chapter, what we are going to see? Accounting treatment. For bonus shares, we are going to see accounting treatment. For right shares, we are going to see. Now, before going to see the accounting treatment, first let us have a good discussion about the meaning of bonus shares and certain provisions with respect to the bonus shares. Bonus shares are offered to the existing equity shareholders at free of cost. You know that part already. Right shares are also offered to the existing equity shareholders at less than the market price, which is offered at a discounted market price, not offered at a discount to the face value, which is offered at discount to the market price. Okay. Sir, when a company can go for the bonus share, sir, if company have the abundant reserves and surplus, if the company have abundant reserves and surplus, simply they can convert such reserves and surplus into the bonus shares. I mean, simply meaning of bonus shares, we can also tell in this way: capitalization of profits. If you observe here, capitalization of profits. In case of bonus shares, what will happen? Reserves and surplus are going to convert into the capital. There is no change in equity. There is no change in equity before and after issue of bonus shares. Before and after issue of bonus shares. Equity means, you know, which is nothing but shareholders funds. Equity means not the equity share capital or not the share capital. Equity means shareholders fund. Sir, before issue of bonus shares, the fund is there under reserves and surplus. But after issue of bonus shares, reserves and surplus is going to decrease and the share capital is going to increase. But there is no change in equity. Sorry, there is no change in shareholders fund. Is it okay to all of you now? Provisions with respect to Companies Act 2013, that is section 63, majorly discuss about bonus shares, which is very, very important issue. Please all of you concentrate. So before discussing these things, such important provisions, I'm going to discuss through my OneNote. Concentrate. Sir, for issue of bonus shares, we can have two ways. I'm so sorry, not two ways. Yeah. So bonus shares, I mean, issue of bonus shares can happen in two ways, not can happen in two ways. Number one, issue of fully paid up bonus shares, issue of fully paid up bonus shares. And issue of bonus shares through conversion of partly paid up shares into fully paid up shares. To be frankly speaking, there is one provision as per section 63 of the Companies Act 2013. Bonus shares cannot be issued unless otherwise all the existing equity shares are fully paid up. That means you can issue the bonus shares if all the existing shares are fully paid up, or you can issue the bonus shares to convert the partly paid up equity shares into fully paid up equity shares. So through such issue of bonus shares, all the equity shares are going to the fully paid up. Am I right? So in two ways, we can issue the bonus shares, as if all the existing shares are if all the existing shares are fully paid up, you can directly issue the bonus shares. Or at least with the issue of bonus shares, the existing partly paid up shares should become the fully paid up shares. Now, if all the existing shares are fully paid up, then if you are going to issue the bonus shares, then which type of reserves we can utilize? You know, we can utilize free reserves. Free reserves. Sir, free reserves means always, you know, which is general reserve, P&L. Free reserve means general reserve P&L. You can also utilize securities premium. Securities premium. You can also utilize capital redemption reserve. Capital redemption reserve. Sir, what is this CRR, capital redemption reserve? Please hold for some time. In this slot itself, I'm going to explain the concept of redemption of preference shares, where we are in detail discussing about the capital redemption reserve. So for the time being, just you can remember it as like other reserve. Okay, but what is the significance of such CRR? What is the meaning of that reserve exactly? We are going to see through the next chapter, which is redemption of preference shares. Okay, one of the utilizations of the securities premium as per section 52 of Companies Act 2013, securities premium can be utilized for the purpose of fully paid up bonus shares. You may read such type of provisions in your company law P2 as well. Am I right? Okay, sir, if all the existing equity shares are fully paid up, then if you issue bonus shares for such fully paid up equity shares, you can utilize the free reserves, or you can utilize the securities premium, or you can utilize the CRR. But for the purpose of conversion of partly paid up shares into the fully paid up shares, you can only utilize free reserves. You can only utilize free reserves. You cannot utilize securities premium and capital redemption reserve for the purpose of issue of bonus shares in case of conversion of partly paid up shares into the fully paid up shares. Who told such all facts, sir? Provisions of Companies Act 2013 as per section 63. Now, the next issue. Coming to the accounting treatment, if all the existing shares are fully paid up, then what is the treatment, sir? The first and foremost entry, you should decrease the reserves and surplus. The portion of the reserves and surplus, you can make it credit to the bonus to shareholders account. The entry is, you can use the general reserve account at R, profit and loss account at R, or securities premium account at R, or CRR account at R. You can use these resources, right, to bonus to shareholders account. Bonus to shareholders account is a temporary account. There is a decrease in reserves. If there is decrease in profit, it should need to be debited. That's why we are debiting the reserves. Then bonus to shareholders accounts, we make it credited, which is a temporary account. Now, bonus to shareholders account, you can cancel. Now you can increase the share capital by passing the entry bonus to shareholders account at R to equity share capital account. Now, what happened with these journal entries, in balance sheet? In these journal entries, the following actually occurred before and after issue of bonus shares. Please concentrate. If this is the balance sheet, if you observe, this is the balance sheet. Just a second. So if this is the balance sheet, then what happened here, reserves and surplus are here, share capital is here. Am I right? So the normal balance sheet just I'm taking. Now, the reserves and surplus balance is going to decrease, and there is increase in share capital due to issue of bonus shares. How much decrease is there in the reserves and surplus? To that extent, there is increase in the share capital. That is the reason I told you there is no change in equity or the shareholders fund before and after issue of bonus shares. Is it okay, all of you? This is the accounting treatment in case of fully paid up shares. So then what is the accounting treatment in case of conversion of partly paid up equity shares into the fully paid up shares, sir? First, you can make a call. From the partly paid up equity shareholders. What is the journal entry at the time of making a call, which is a normal entry? That is equity share call account at R, or equity share final call account at R. to equity share capital account. To equity share capital account. This is the final call. Am I right? Now, before issue of bonus shares, first you should need to decrease the existing free reserves only in case of conversion of partly paid up shares into fully paid up equity shares. You cannot utilize the securities premium and CRR. So that's why you can write the entry like this. That is P&L account debtor or general reserve account debtor to bonus to shareholders account. Bonus to shareholders account. The third entry is you can cancel the equity share final call, then you can debit the bonus to shareholders. The entry is bonus to shareholders account debtor. In generally, you are receiving the money for that call. The entry is bank to share call account. But here you are not receiving any amount from the shareholder. On behalf of that, you are giving the bonus shares. Am I right? That is bonus to shareholders account debtor to equity share final call account. On behalf of debiting the bank balance, now you are debiting the bonus to shareholders. That is the accounting treatment you need to follow in case of conversion of partly paid up equity shares into fully paid up equity shares. Such a simple accounting treatment in generally we are going to adopt in case of bonus shares chapter. Okay, come back to my power notes, guys. So the same thing I explained here. So free reserves, securities premium, CRR, we can utilize in case of fully paid up bonus shares. But in case of conversion of partly paid up shares into fully paid up shares, we can only utilize the free reserves. The same fact I explained in these 2 points. Only free reserves can be utilized in case of conversion of partly paid up shares into fully paid up shares. Next. Okay. Come to the next issue. That is the next concept is right shares, right? The next concept is right shares. You know, sir, the right shares are offered to the existing equity shareholders. Sir, what is the accounting treatment for the right shares, sir? What is the accounting treatment for right shares? That is normal accounting treatment. How in generally at the time of issue of normal shares, you are going to pass the normal entries in the same way at the time of issue of right shares we will apply. What is that? If the right shares are issued with premium, entry is bank account debtor to equity share capital account to securities premium account. Or if you want to write like this, that is bank to share application and allotment, then share application and allotment to share capital at the securities premium. That is the as usual entries. Sir, your accounting treatment doesn't have that much of significance. Those are the normal entries only. But what is the significance here? You know, one concept is significance in case of right shares. That is nothing but value of right. What is the meaning of value of right? What is the meaning of value of right? So before explaining such value of right, first let me explain the concept of right shares practically. How it is going to work out, I will tell you. In generally, companies will announce that we are going to issue right shares in near future, or they will tell the date as well, as on which date we are going to issue the right shares. Now, the date of announcement happened as on which date, which is known as announcement date, So let us assume the announcement date is as on 1st June 2021. Let us assume, just I put some date. Now, in the announcement date itself, they clearly told that who are all purchase the shares, or who are all having the shares as on a specific date, The specific date is, let us assume, which is 30th September 2021. Who are all having the shares as on that date, such all shareholders will get right shares in the ratio of 2:1, or in the ratio of 1:2. 1:2 means for each and every 2 shares, the company is offering 1 right share. That is 1/2 now. 1/2 equal to 0.5 share. That is nothing but for every 2 existing equity shareholders, they are getting 1 right share. Now, this date is technically known as record date. Record date. Now concentrate. Practically in a market, what will happen, you know, when the company announce things related to the right shares as on announcement date, then the share market price is started coding like this, is started coding up like this. Now the shares up to the record date is technically known as come right share, is technically known as come right share. Sir, why the share is increasing like that in the open market? You know, in the stock exchanges, everybody or everyone is interested to buy your existing equity share. The reason is, if such equity share are in my hand as on the record date, I will get the right shares from the company at less than the market price. Am I right? That is the reason why in generally people want to buy such company shares in the open market or the stock exchange. That is the reason the existing equity shares are known as come right share. Such share value we can assess along with the right share. Such share is known as come right share. But once the record date is over, once the company issued the right shares, then the existing share price is going to decrease. Now, after this record date, that market price is technically known as, X right price. X right price. Now, what is the value of this right, sir? The difference between come right share price and X right share price is known as value of right. Value of right is equal to come right share price minus X right share price. X right share price is technically known as value of the right. What is the meaning of that? How much value we can place for that right, sir? How much value we can place for that right is nothing but the difference between come right market share price and the X right market share price. Now, why the market price before issue of right shares is hike that much? Which is due to the value of the right. But how much included in that market price due to such right shares, we don't know. If you compare such come right share price with the X right share price, then the difference you will get it as due to the value of the right. Because once the right shares are issued, the existing share price is decreased like anything, right? Decreased like anything, right? Now, if you compare before issue of right share market price with after issue of right share market price, the difference itself you can assign it as a value of right. Now, the next question is, sir, come right share price is generally given in the question. At the time of evaluation of the value of right, generally come right share price, they're directly given in the problem. But X right share price, we need to calculate. Sir, how to calculate X right share price, which is also known as theoretical X right share price, which is known as TERP. In generally, such TERP you are going to calculate in AS20 EPS in group 2. The same calculation I'm going to adopt right now. Please all of you concentrate here. Sir, the existing number of equity shares are before issue of right shares, let us assume 1000. And the market price is, let us assume, at the rate of 120 before issue of right shares, which is the market price before issue of right shares. Now, as per the announcement made by the company, each and every existing equity shareholder will get 0.5 share. That means for 1000 equity shares, the number of right shares are going to offer 500. Is going to offer at the rate of 500. Sir, each right share is offered at the rate of less than market share price. That is, let us assume at the rate of 80 rupees. So the company is offering to subscribe such each and every right share at the rate of 80 rupees. This is the thing they are given. Now I need to calculate the X right share price, and another one you can call it as theoretical X right share price. How we are going to calculate, you know? Sir, existing number of shares worth how much? Existing number of shares worth are 1000. Each and every share worth is 120. Plus, how many number of right shares company is going to issue? Company is going to issue 500 shares. The worth of the 500 shares is 500 into 80 rupees. Now I am calculating the theoretical ex-right price divided by total number of equity shares, which is 1000 plus 500, total 1500 shares. Now you can work out, then you will get theoretical ex-right share price 1000 into 120, 500 into 80, grand total you will get, which is 1,60,000 divided by 1500. I got this is 106.67 per share. Now, if you check, the share price was 120 rupees before issue of right shares, which is 120 here. But once after the right issue happened, then the share price is 106.67, which is 106.67. Now, the difference between 120 and 106.67, which is cum right share price, is 120 minus X right share price is 106.67. The difference is approximately 13.33 per share, which is known as the value of the right. Now, how we calculated the X right share price, which is nothing but worth of the existing shares, that is number of equity shares into cum right share price plus proceeds from right shares, which is nothing but proceeds from right shares divided by total number of shares after rights issue. Then you will get theoretical X right price. If you want, I'll write the formula as well for you. Number of existing equity shares into market price, which is cum right market price, plus proceeds from rights issue. This is the total worth of the existing shares. Now, before issue of the right shares 1000, and after so the number of right shares are 500, the total 1500 worth of the shares are 1000 plus 120 plus 500 multiplied with 80, which is the total worth of right shares. It should be divided with number of equity shares after rights issue. Then you will get theoretical X right share price. If you compare that with cum right share price, then automatically you will get value of right. That is the important question. Just if they want, they can test in the examination. So except that there is no peculiar things are there. There are no special issues are there in case of bonus and right shares. If you want, we can check one question on the value of right. Remaining all are the normal questions. That's why I don't want to take up here as well. But one thing they might, if they want, they can ask after issue of bonus shares. They may ask to prepare the balance sheet. You know, the changes after issue of bonus shares, there might be decrease in the existing reserves and surplus. There is increase in the share capital. That fact you can consider at the time of rebuilding of the balance sheet after issue of bonus shares. That point also regularly testing in the examination. Okay, we will check the value of right, that question. Yeah, I think so, which is problem number 7. Sir, if you are observing me, I'm trying to avoiding a big problems, but I'm telling the impact as the conceptual clarity I'm giving. So because you know this is a marathon session, don't expect each and everything. So if the two lengthy issues are there, then it will killing my time. That is the reason I'm only taking very soft corner issues. So people were in generally facing the trouble. Okay. A company offers new shares of rupees 100 each at 25% premium to the existing shareholders on 1-for-4 basis. The existing shares are 4, then the company is going to issue one right share, which is the existing. And such existing share market price is given at 150 and the right share is offered at the rate of 125. 25% premium means 125. Calculate the value of the right. First, you need to calculate X right share price. X right share price or the theoretical X right share price is equal to number of existing shares. That is, the number of existing shares are 4 multiply with the market price. So the market price itself is 150 plus proceeds from right issue. You will get the proceeds from right issue 1 into 125 divided by total number of shares after rights issue, 1 plus 4, which is 5. Then you can get the X right share price. How much, which is 4, 150, 600 plus 125, 725 divided by 5, which is nothing but 145. So existing market price, which is the cum right share price, is 150 minus X right share price is 145. The difference is nothing but the value of the right. Do you understand, all of you? Like this, you can calculate the value of right. So remaining all are normal issues. I don't want to take up here. Now, please, all of you, come forward with the next chapter, which is the important chapter, which is redemption of preference shares, guys. Redemption of preference shares. So in case of bonus and rights issue, there are not that much of special issues to discuss. So that is the reason why I am giving my focus on redemption of preference shares. First, sir, in this chapter, what we are going to try to cover, sir? We are going to cover few major issues. I will tell you what are such few major issues. Please concentrate here. All right, I'll show in one note. The major issues I'll show in one note. The major issues were, first we will check the concept of redemption. The concept of redemption of preference shares, or the meaning of redemption of preference shares, we will see. Then we are going to explain Companies Act 2013 with respect to redemption of preference shares. I mean, how we can redeem, what are the provisions we need to adopt at the time of making the redemption. Okay, such all issues we are going to see. Then we will check methods of redemption. Methods of redemption. After it, we will check minimum number of shares to be redeemed. Minimum number of shares to be redeemed. In two different situations, we are going to see that minimum number of shares redeemed through fresh issue. Through fresh issue, we are going to see in two different circumstances. One is to complete the section 55, and another situation is in respect to the fund approach. I'll tell you one by one, no worries. First, initially, just I'm giving the outlook. Then finally, we will check certain combination problems. I mean, the combination problem means bonus and right shares plus redemption of preference shares. Maybe there is a high scope to ask such type of problems. So that is the reason we will see such things as well. Okay. Now let me explain one by one with my power notes. All of you come to my power notes. Sir, what is the meaning of redemption of preference shares? Redemption of preference shares is a contractual right to the company to redeem certain number of shares at a predetermined price and a predetermined date, which is a contractual right. How the company will get such contractual right? At the time of issue of such preference shares itself, they are clearly described the terms and conditions with respect to the redemption. The same thing is also happened in case of redemption of debentures. In case of redemption of debentures also, as on the date of issue of such debenture, they will clearly prescribe the terms and conditions with respect to the such redemption. That's why it is clearly given as a contractual right to the company to redeem certain number of shares at a predetermined price at a predetermined date. Now, what are the important provisions, sir? The redemption of preference shares, we can make it from divisible profits or through fresh issue of shares. Now, sir, in case of fresh issue of shares, what happened? In case of divisible profits, what happened? First, I'm going to explain. Please concentrate. Sir, in case of fresh issue of shares, the existing preference share capital is going to decrease. due to issue of the fresh shares, there is increase in other class of shares is there is increase in other class of shares. I mean, totally there is no change in the share capital. For example, if this is the balance sheet, here preference shares are there, here preference shares are there. Now what you are going to do, you are going to issue certain fresh equity shares. Now here you will get the amount as well. Now with that amount, you are going to redeem the preference shares. Now preference shares gone and the bank balance also gone. Now what happened? Previously, how much is the total share capital? Now also there is no change in the share capital. Previously, I mean, before redemption of preference shares and after redemption of preference shares, there is no change in the total share capital. Do you understand? In the case of fresh issue of shares, that's why I mentioned that no need to create CRR, but listen for the time being, what is the CRR, such all things. Okay. Now come to the fact of divisible profits. All of you, please come down, come to the fact of divisible profits. Here it is there. Utilization of divisible profits. What will happen in case of divisible profits, sir? Concentrate, all of you. Sir, I have equity share capital of 10 lakhs. I have equity share capital of 10 lakhs. Sir, here in my power notes, it is actually broken into the two parts. Okay. So just let me come to the one note. You might confuse here and here, the same facts are given. So just please let me come to one note. I'm going to explain the same diagram here. What is happening? First, where we are explaining the provisions of Companies Act 2013. That is, the redemption is going to occur in two ways. One is through fresh issue of shares. One is through fresh issue of shares. Another one is by utilization of divisible profits. By utilization of divisible profits. Now first, come to the fresh issue of shares. Sir, in case of fresh issue of shares, what will happen? I will explain. Concentrate. Sir, let us assume share capital is there for 10 lakhs here. The share capital is also, you can consider, which is preference share capital. Preference share capital is there for 10 lakhs. Let us assume. Okay. Now you are issuing currently equity shares. Currently, you are issuing currently equity shares for the worth of 10 lakhs. Let us assume. You are issuing 10 lakhs means bank balance also you have 10 lakhs. Now, what is the impact with the existing bank balance? You can simply make it redeem the preference shares. Then the bank balance is going to close. The bank balance is going to close, as well as preference share capital is going to remove. Now the impact is, previously there exists only 10 lakhs in the share capital. Now in the form of equity share capital, we have 10 lakhs. That is the reason why I told you there is no change in share capital. Now come to this situation, guys. What is the situation? Situation number 2, redemption happened through divisible profits. You know the meaning of divisible profits, right? Divisible profits means those profits which are freely available for the purpose of distribution of dividend. We can call it as divisible profits or free reserves, whatever the case may be. Now let us assume the situation is again in the same mode, which is preference share capital we have 10 lakhs. But there we also have reserves and surplus is exist. Let us assume in reserves and surplus, general is there for 10 lakhs and P&L account is there for 5 lakhs. Just let us assume certain figures. Now the related reserves and surplus bank balance will also be available here, either in bank balance or either in investments or either in any other assets. Let us assume. So the bank balance, how much we have? We have here the bank is 8 lakhs and the investments we have 7 lakhs. Just let us assume this is the 10 plus 5 and the related assets in the form of bank or investments we have 7 lakhs. Now the issue is we are going to redeem these preference shares out of the divisible profits. Out of divisible profits means we are going to utilize these profits. We are going to utilize these profits means The related assets we are going to utilize for the purpose of redemption of preference shares. Now you can sold out such investment in the outside market. Then you will get the 7 lakhs, let us assume, and the total contribution is 15 lakhs, right? Out of such 15 lakhs, we can only need it to the extent of 10 lakhs. We can only need it to the extent of 10 lakhs. That's why a less utilized for redemption of preference shares, 10 lakhs. Then the balance of the bank still we have 5 lakhs. Am I right? Now preference shares are also gone. There are no preference shares at all. Now the bank balance decreased to 5 lakhs and the preference shares are also vanished in my balance sheet. The next issue is, now out of such reserves and surplus, the total amount of 15 lakhs, to that extent of 10 lakhs, you utilized for the purpose of redemption of preference shares, right? Out of this 15 lakhs, you can make it transfer to the extent of face value of preference shares, to the extent of face value of the preference shares redeemed. You should need to make it transfer to CRR, capital redemption reserve. For creation of such capital redemption reserve, you can only utilize free reserves. You can only utilize free reserves. Now, out of this 15 lakhs, you are already utilized to the extent of 10 lakhs for the purpose of redemption of preference shares. From these reserves and surplus, you can make it transfer to CRR. How much amount I should need to make it transfer to the CRR? 10 lakhs, right? Let us assume this general reserve you are utilized. Let us assume this general reserve you are utilized. Now general reserve gone. Now general reserve gone. On the place of general reserve, CRR will take place due to the provisions of Companies Act 2013. Sir, why we need to make it transfer? I will tell you, just hold for some time. Now, what is the impact here? P&L balance is 5 lakhs. CRR balance is 10 lakhs. Am I right? Now, this CRR is not useful for any purpose. Not useful for any purpose. To be frankly speaking, the CRR balance to the extent of the bank balance also we are not having. Only we are having the P&L account 5 lakhs balance. Here also the bank balance 5 lakhs. Now just there is a unique figure is there under the reserves and surplus with the name of CRR. This CRR cannot be utilized for any purpose except issue of bonus shares. Just now we seen in the previous chapter in the bonus and right shares, I clearly discussed such fact. What is that? Bonus shares can be issued out of capital redemption reserve. Now this CRR, with the help of this CRR, we can have only one use. That is, we can issue fully paid up bonus shares. We can issue fully paid up bonus shares. So bonus shares means equity share capital. So that means in future, if you want, you can issue only the equity share capital to the extent of 10 lakhs. Then CRR will gone, equity share capital will coming into the picture. Now, what is the impacts are here? Now the equity share capital in the balance sheet is 10 lakhs and the preference share capital is removed. Previously also what happened? Through fresh issue of equity shares, there is decrease in the preference share capital, there is increase in the equity share capital. Now in the second case, through utilization of divisible profits also what happened? There is decrease in the preference share capital. Ultimately, there is increase in the equity share capital through utilization of capital redemption reserve to bonus shares. Do you understand, all of you? Now, this is the base concept of redemption of preference shares happen either through fresh issue of equity shares or either through divisible profits. Now, the next question coming into your mind is, sir, why you are transferring face value of the preference shares redeemed? Face value of the preference shares redeemed. In case of divisible profits, face value of preference shares redeemed through capital redemption reserve from free reserves. The reason I will tell you here. Sir, you are going to redeem the preference shares right now itself, right? Right now itself means in your company, you may have certain debenture holders. In your company, you may have certain suppliers balance, that is creditors. You may have certain bills payable. You may take in certain lending. You may already have certain lending activities from your banking companies. There are so many other liabilities exist. If it is the liquidation states the company first will going to pay secured creditors first, then unsecured creditors, then preference shareholders, then finally to the equity shareholders. But now during the process of redemption of preference shares, before making payment to the other liability holders, you are paying amount to the preference shareholders, right? Then how you can protect the interest of the other parties to the extent of face value of the preference shares if you are make it transferred to the capital redemption reserve, and such reserve you cannot be utilized for any other purpose except bonus shares, such a CRR will ultimately protects the interest of the other persons. That is the reason for making transfer amount to the CRR. The reason is to protect interests of other liability holders or other liability holders. I mean, before making payment to the debenture holders and the banking persons and the creditors or the bills payable, you are directly making payment to the preference shareholders. If you are transfer out of the existing reserves and surplus to the extent face value of the preference shares redeemed to CRR, that amount or that fund is blocked. It cannot be utilized for any other purpose. I mean, sir, is this CRR can be utilized for dividend distribution? No, they cannot utilize further. But if you are not making transfer to CRR, if it is still there under the general reserve can be utilized for the purpose of distribution of the dividend, or general reserve may be utilized for any other purposes as well. You are restricting for such a use by making transfer to the capital redemption reserve. And further, if company wants, they cannot utilize it for any other purpose except for making simple transfer of the except for making issue of the bonus shares, such CRR. Do you understand? Sir, by making transfer to the CRR, there is a high protection in point of view of other liability holders. That is the reason why in case of utilization of the divisible profits, if redemption happen to the extent of face value of the preference shares redeemed, should be transferred to the capital redemption reserve. But in case of fresh issue of equity shares, no amount can be transferred to CRR. The reason is here there is no question of protecting the interest of the other liability holders, because I'm straight away issuing another class of shares out of the fund what we are getting. Such fund is only we are utilizing to redeem the preference shareholders. We are not touching the existing reserves and surplus. That's why there is no question of protecting the existing liability holders. Do you agree, all of you, with me that fact? Now come to my power notes. Consider it, guys. The redemption may happen through divisible profits or through fresh issue of shares. If the redemption is happened through the fresh issue of shares, no need to create any capital redemption reserve. But if the redemption is going to happen through divisible profits, to that extent of face value of the preference shares redeemed out of divisible profit should need to be transferred to capital redemption reserve. Such CRR is going to be created from free reserves only. The reason also we seen why we need to CRR by in case of utilization of divisible profits for the purpose of redemption. Okay, fine. Such fact, do you all have the clarity? Sir, if the redemption happened through fresh issue of shares, no need to create any CRR. If the redemption of preference shares happened through existing divisible profits, then you should need to create to the extent of face value of the preference shares redeemed to CRR. Remaining all issues are normal. First, based on such issues, I can directly go with the accounting treatment. But before directly going to the accounting treatment, we can see one more important provision of the Companies Act 2013 with respect to section 55. Concentrate. That is, I can't tell exactly the section 55, which is an interlink in between section 52 and section 55. Concentrate. This is important. You know already the provisions of section 52. What are the provisions of section 52? Which are utilizations of securities premium. Section 52 is utilization of securities premium or uses of securities premium, to put it simply. Sir, securities premium can be utilized for the purpose of issue of bonus shares. We already seen in the last chapter. Yes, for the purpose of fully paid bonus shares, not for the partly paid, for the purpose of fully paid up. Because in case of conversion of partly paid to fully paid up bonus shares, sorry, partly paid up to fully paid up shares, if you are going to issue the bonus shares, you can only utilize the free reserves. So fully paid up bonus shares, we can utilize securities premium. And we can also utilize the securities premium for the purpose of write-off share issue expenses or underwriting commission. Okay, that we can call it as share issue means preliminary expenses. Preliminary expenses in general. Preliminary expenses or underwriting commission. The same securities premium also we can utilize to set off premium on redemption of preference shares or the debentures Securities premium you can also utilize for the purpose of buyback of equity shares. Buyback of equity shares. One more utilization is there, which is the final utilization, which is used to set off discount on issue of securities. I mean, you know, equity shares cannot be issued at discount. We can make it set off the discount on issue of debentures and all other discount on issue of bonds, such all things. These are the utilization of securities premium as per section 52. This is not as per accounting, guys. This is as per section 52 of the Companies Act 2013, which is very important question in the P2 as well. You may already come across this situation. Okay, so securities premium can be utilized for issue of bonus shares, and the securities premium can be utilized for the purpose of write off the preliminary expenses or underwriting commission, and the securities premium can also be utilized to set off the premium on redemption of preference shares or the debentures, or it can be utilized for buyback of equity shares, or it can be utilized to set off the discount on issue of securities. Securities premium have the restrictive uses, which is not a free reserve. So that is the reason which is having only the restricted uses, as like the below, only it have 5 uses as per the Companies Act 2013. Now the issue is, now we are in the chapter redemption of preference shares, right? Now my question is it securities premium can we utilize to set off premium on redemption of preference shares? Again, one more time I'm asking the question, can we utilize securities premium to set off premium on redemption of preference shares? What is the meaning of premium on redemption of preference shares? We are making the redemption by paying the more value than the face value. For example, if the face value of the preference share is 100, but we are going to make it redeem at the rate of 120 rupees, then the excess amount we are paying over the face value, we can call it as premium on redemption of preference shares. Now, such premium on redemption of preference shares, can we make set off with securities premium? That is my question. So the situation is like this. Before Companies Act 2013, you can directly utilize the securities premium to set off the premium on redemption of preference shares or the debentures. But after the evolving of Companies Act 2013, the situation is quite different. How it is? If the company is covered, under section 133, such section 133 is nothing but companies for which accounting standards are applicable. Accounting standards means those are the existing accounting standards or the IND AS, whatever the case may be. Are the companies not covered under section 133? Companies not covered under section 133. Those are different industry based companies like banking companies, banking, insurance, etc. Any other different industries companies for which accounting standards are not directly applicable, their respective acts, Banking Regulation Act or the insurance development regulations, such all things are going to applicable. Now, if section 133 covers, then the accounting standards are covers, then such companies cannot utilize securities premium to set off preliminary expenses or underwriting commission or premium on redemption of preference shares or debentures. That means if the company is going to be covered under section 133, then securities premium cannot be utilized to set off preliminary expenses or underwriting commission or premium on redemption of preference shares or the debentures. But if the company is not covered under section 133, then you can simply utilize for all the purposes. I mean, all the purposes means the given all the 5 purposes. You can directly utilize. You can directly utilize for all the 5 purposes. The company is covered under section 133. You only utilize for 3 purposes. That is for bonus shares, buyback of equity shares, and to set off discount on issue of securities. But you cannot utilize for the purpose of set off premium on redemption of preference shares or the debentures or the preliminary expenses or underwriting commission. Now coming to our situation, that is section 55 is related to redemption of preference shares. Redemption of preference shares. Now in case of redemption of preference shares, can we set off premium on redemption of preference shares with securities premium? Now the answer is, if you assume all the companies are covered under section 133 and it is clearly given in the institute material as well, you can simply assume all the companies which are asked in the examinations are covered under section 133. Therefore, we cannot utilize securities premium to set off the premium on redemption of preference shares. Then what we can utilize? We can utilize free reserves. We can utilize free reserves to set off premium on redemption of preference shares. We cannot utilize securities premium. We can utilize only free reserves to set off the premium on redemption of preference shares. Now the conclusion, blindly you can take a one thumb rule. What is that? If at all at the time of redemption of preference shares, if any premium on redemption of preference shares is coming to the picture, now such a premium on redemption on preference shares, you can directly make it set off with free reserves, either with general reserve or the P&L, but you cannot utilize the securities premium. One more important fact I am revealing here. Sir, if you are unable to utilize the securities premium to set off the premium on redemption of preference shares, anyway, you cannot utilize the securities premium for the purpose of redemption of face value of the preference shares as well. One more time repeating. Sir, if the existing securities premium, if you are unable to utilize to set off the premium on redemption of preference shares, how you can expect that the securities premium amount you can utilize it for redemption of face value of the preference shares? So outrightly securities premium, you can simply make it remove, which is not a useful resource for the purpose of redemption of preference shares, either for the premium or either for the face value. That's it, guys. Okay, fine. Sir, what is the accounting treatment? Till now, you discussed major points with respect to the Companies Act 2013. We understood that. Then what is the accounting treatment, sir? Sir, accounting treatment is depending upon methods of redemption. Accounting treatment is depending upon methods of redemption. I mean, methods of redemption means, you know, the existing preference shares we can redeem through fresh issue of shares. Fresh issue of shares. Or we can redeem through divisible profits. or you may redeem combination, or you may redeem in combination. Now, if method of redemption is through fresh issue of equity shares, then what is the accounting treatment? If you are using the divisible profits for the purpose of redemption, what is the accounting treatment? In combination, how you can going to work out, we are going to see. Now, come here. If it is through fresh issue of shares, first you should provide the journal entry for issue of shares, right? That is, if the issue is at premium, bank account data to equity share capital account to securities premium account. But one thing you have to know at this stage, this securities premium cannot be utilized to set off premium on redemption of preference shares, as well as this securities premium cannot be utilized to for the purpose of redemption of preference shares, that is face value of redemption of preference shares as well. Am I right? Next, preference shares. If the preference shares are redeemed at par, let us assume, then first you should need to cancel the existing preference share capital, which is preference share capital account debtor. If the redemption is happened at par, then you can make it directly transfer to preference shareholders. But if the redemption is at premium, that is face value 100, but we are going to redeem at 120, then the excess amount payable over the face value, you can make it debit to premium on redemption of preference shares to preference shareholders account. Am I right? Now you can make it payment to the preference shareholders because you already have the sufficient cash through issue of fresh issue of equity shares. Then the entry is preference shareholders account debtor to bank account. Preference shareholders account debtor to the bank account is the journal entry. Next, the premium on redemption of preference shares. Is there such premium on redemption of preference shares? You can make it set off with free reserve, that is either profit and loss account, or you can set off with general reserve as well, but you cannot utilize securities premium to premium on redemption of preference shares. Such a simple accounting treatment. Sir, in case of fresh issue of equity shares, there is no need to make it transfer any amount to CRR. We already learned. Now, in case of divisible profits, first you should need to start with making transfer to CRR. Here CRR concept is applicable. For the purpose of creation of CRR, you can utilize either profit and loss account, or you can utilize general reserve as well, either profit and loss account or general reserve to capital redemption reserve account. How much amount, guys, we need to transfer to CRR? To the extent of face value of preference shares redeemed out of divisible profits. You know, such CRR cannot be utilized for any other purpose except for issue of fully paid up bonus shares. Next. Now the remaining entries, that is as usual, this entry will not come because fresh issue of equity shares will not going to occur. This entry doesn't occur in case of divisible profits. You can make it pass the same entry, that is preference share capital account debtor, premium on redemption of preference shares to preference shareholders, and preference shareholders to bank account. And this is also the same entry as like this. Next, the premium on redemption of preference shares, you can make it transfer. You can make it set off with profit and loss account or general reserve. This is the only difference. In case of fresh issue, you may issue the further shares, but in case of divisible profits, there is no fresh issue of shares occur, but you should make it transferred to the face value of the preference shares redeemed to capital redemption reserve. Next, come to the combination issues. Combination issue means here redemption, certain portion is going to occur, portion of redemption happened through fresh issue of shares, and the remaining portion of redemption, happened through divisible profits, Okay, now if this is the combination problem, they may ask it completely in three ways. That is, they will give how much portion, that is, they will directly provide the information, in the problem. What is that? How much redemption happened through fresh issue as well as divisible profits. They are directly given in the problem itself. No worries. They are directly provide the information that how much redemption is going to occur through fresh issue of shares and through divisible profits. They are directly given. That is one way of asking the question. In another way, they are asking to question in case of minimum number of fresh issue of shares, used for redemption. This minimum number of fresh issue of shares used, they may ask in two angles. One is to comply section 55, and another method is fund approach. I will tell you one by one, don't worry. But these are the problem facing issues. Sir, if the information is directly provided, then there is no hesitation, guys. No hesitation means, for example, I'll give one small illustration for better understanding. So the existing preference share capital, let us assume, which is the 10% preference share capital, is there for 5 lakhs. So preference shares are going to redeemed at the rate of 10% premium. 10% premium. And it is clearly given that out of this fresh issue of shares issued by them were 10,000 at the rate of 120 rupees each. That is, face value is 100. Remaining through divisible profits. It is directly given. The information is directly given like this. Then what is the accounting treatment? Then you need to apply both the accounting treatments. That is, in case of fresh issue of shares, the accounting treatment what you followed. In case of divisible profits, what the accounting treatment you followed. According to the portion you need to apply. Am I right? Now, first you need to check how much amount of preference shares they are going to redeem through fresh issue of shares. That is 1 lakh into 100 rupees only you can utilize. You cannot utilize the securities premium. I already told you, right? That is, sorry, 10,000 into 100 only you can utilize. Face value, we can put 10 rupees, guys, not 100. I'm so sorry. I'm changing the figures. Face value is 10 rupees. This is issue price is 12 rupees each. Fine. Now, out of the 12 rupees, you can only utilize to the extent of face value only for the purpose of redemption. I already clarified such fact because securities premium itself we cannot utilize for premium on redemption of preference shares. Then how you can thought securities premium can be utilized for face value of redemption of preference shares. So that's why out of this 5 lakhs, in the form of fresh issue, it is occurred at 10,000 into 10, which is 1 lakh, which is through fresh issue, remaining through divisible profits. That is through divisible profits, which is simply 4 lakhs. We are using 4 lakhs. Now, accounting treatment. So what is the accounting treatment here? First, you can issue the fresh issue of shares. For fresh issue, first we are passing the account, we are passing the journal entries, that is bank account data. How much? Total you are getting 10,000 into 12, which is 1,20,000 to equity share capital, which is 1 lakh, to securities premium, which is 20,000. This is the fresh issue entry. Next, immediately you should pass one more entry. What is that? For the purpose of making transfer to the extent of face value of the preference shares redeemed to capital redemption reserve, because 4 lakhs you are utilizing divisible profits for the purpose of redemption. Am I right? So for that entry, free reserves, simply I'm writing the free reserves because the individual reserves balance I'm not giving here, which are free reserves account debtor to capital redemption reserve to the extent of face value means, which is 4 lakhs. Am I right? This is for this purpose. Next, remaining all are common entries. So the common entries I'm going to pass here, concentrate. These are the common entries. What are the common entries, guys? Those two are only the special entries. Common entries are preference share capital account debtor. That is 10% preference share capital. How much? Total 5 lakhs. Preference shares are going to redeem it with premium. So premium on redemption of preference shares. Premium on redemption of preference share capital account debtor. How much premium, guys? At the rate of 10%. That is 5 lakh into 10% is 50,000 to preference shareholders account. That is 5,50,000. Now, divisible profits 4 lakhs we have, and the bank balance, which is existing 1,20,000. So remaining other resources, other existing bank balance also we may have. So with that, we can simply make it payment to the preference shareholders. That is preference shareholders account debtor to bank account, which is 5,50,000. One more, this premium on redemption of preference shares, we can make it set off with free reserves. We cannot utilize securities premium here. So free reserves account debtor to premium on redemption of preference shares, which is 50,000. So don't think that, sir, we are only having the bank balance of 1,20,000, but how you paid the bank amount of 5,50,000? Just I only wrote the entry only for fresh issue. We have the remaining bank balance for divisible profits with respect to or some, maybe if any other investments are there, we may sold out. Such information is not given by me, simply the required information given. So only if it is the direct information is given, how much redeemed through fresh issue, how much redeemed through divisible profit, you can differentiate. So redemption happened through divisible profits, you can make it transfer to CRR, and through the fresh issue, the normal generally you can make. Remaining all are common entries. That is preference share capital premium to preference shareholders to bank, and premium on redemption of preference shares, you can make it set off with free reserves. But now coming to this issue, what is that? Minimum number of fresh issue of shares used for redemption. Now he is indirectly conveying that we can use minimum number of fresh issue of shares for the purpose of redemption. That means you can utilize maximum amount of divisible profits. First, you can have a look here. To comply with section 55 means what is the maximum amount available for divisible profits? Maximum divisible profits available for redemption. Because if the maximum divisible profits available for redemption are there, then we can go with very minimum number of fresh issue of shares for the purpose of redemption. Am I right? That is the only our target. Minimum number of fresh issue of shares can be used for the redemption. That means we are using the maximum divisible profits available for redemption. Am I right? Now, sir, maximum, the difference only we can issue the number of shares. We can make the redemption through. The difference only we can make it redemption through fresh issue of shares. That is, I mean, what is that? Total face value of preference shares redeemed is compared with maximum divisible profits available for redemption. The difference we can make it redeemed through fresh issue of shares, which are the minimum number of fresh issue of the shares to comply the section 55. Now the next question coming into my mind is, sir, how you know the maximum divisible profits available for redemption? That's very easy. First, you should need to check the total amount of the free reserves. How much balance is there? Is the total free reserves? You know, free reserves balance means either P&L or general reserve. How much balance is there? You need to check. Out of that, certain portion is useful for the purpose of making set off with premium on redemption of preference shares, because premium on redemption of preference shares is ultimately make it set off with free reserves only. That means out of these free reserves, premium on redemption of preference shares, to set off the premium on redemption of preference shares, how much is needed? You should put aside. And sometimes apart from that, board of directors will decide that we cannot touch certain portion of the free reserves. Maybe P&L is there 5 lakhs, but out of that you can't touch 1 lakh. That is, board of directors restricted certain amount, anything is there, that amount also you cannot utilize for the purpose of redemption of preference shares. Now, out of the existing free reserves, certain free reserves is used for the set of premium on redemption of preference shares, or as per the board of directors discretionary power, if they put aside certain amount, the remaining free reserves only you can utilize for the purpose of redemption of preference shares, which is the maximum amount is available for the purpose of redemption. Now, out of the total face value of the preference shares redeemed, if you can compare the maximum divisible profit available for redemption, the difference of amount is nothing but minimum number of fresh issue of shares used for the redemption. Now, therefore, minimum number of fresh issue of shares to be issued to comply the provisions of section 55. Comply the provisions of section 55 is equal to the above difference. Just I don't want to write one more time. Just I simply write the above difference, or you can put the figure it as a divided by face value of the issued share divided by face value per issued share, or simply face value per fresh issue of the share. You cannot take the issue price here. Because we are comparing the total face value of the preference shares redeemed with maximum divisible profits available for redemption. The difference itself is the face value. That's why you should need to divide with the face value per fresh issue of shares you are going to make. Then you will get minimum number of fresh issue of the shares necessary for the purpose of redemption to comply the provisions of section 55. Now, once again, I'm repeating, certain number of times what they will try to ask. They are not directly providing the information out of the existing preference shares, how much you can redeem through divisible profits, how much you can redeem through fresh issue of shares. At that point of time, they will give a hint that to comply the provisions of section 55, you can utilize the minimum number of fresh issue of the shares for the purpose of redemption. If they provide the hint like that, then you should utilize the maximum divisible profits for the purpose of redemption. Then first you should decide the maximum divisible profits available for redemption. How? The total amount of free reserves, out of which you should put aside certain free reserves for premium on redemption of preference shares, or at the discretion of the board of directors also you can put aside certain free reserves. Now the remaining free reserves are available for redemption of preference shares. Now with that, you should compare with the total face value of the preference shares to be redeemed. Now the difference itself is face value of the preference shares to be redeemed through fresh issue of the shares. Now, so the A is nothing but face value of the preference shares to be redeemed with fresh issue divided by then face value of the issued share. Then you will get minimum number of fresh issue of shares to be issued for the purpose of redemption to comply the provisions of section 55. Now come to fund approach. All of you please come to fund approach. Sir, what is the meaning of fund approach, sir? I'll discuss here, concentrate. Or if you want, I'll discuss here, not an issue. Sir, what is the meaning of fund approach? Can you please explain? Fund approach is all about assets approach. Assets approach means how much balance is available, how much balance of assets, the balance is in the form of bank or investments, is available for redemption. First you need to work out, it should be compared with total balance required for redemption of preference shares. Total balance required for redemption of preference shares, that is including premium. How much cash balance you required? Total bank balance or cash balance required for the redemption of preference shares, including premium. That should be compared with the existing balance. How much balance is available for redemption, which is existing balance. If you compare such two different figures, then you will get balance required for redemption. How much amount of bank balance we required for redemption? It should be divided with issue price of the further number of shares. What we are going to calculate again, minimum number of fresh issue of the shares used for the redemption. In case of the fund approach, we are calculating. Still, we required the difference of amount, which is balance required for redemption. If it should be divided with the issue price, because this balance is the inclusive of premium. Here also in the denominator, you can use the issue price. Then you will get the minimum number of fresh issue of shares. Minimum number of fresh issue of shares made for redemption in case of fund approach. And one more thing I am telling you, while calculating this minimum number of fresh issue of the shares to comply the section 55, or in case of the fund approach, if any fraction figure is coming, then the nearest you should make it present to the nearest fraction, nearest figure. If it is coming 233.33 shares, then you should make it 234 shares. That provision also clearly explained in the section 55 itself. Now the overall theme, sir, this is the gray area. Please all of you concentrate. The gray area is, sir, if they directly provide the information in combination problems, how much portion you can redeem through fresh issue, how much portion you can redeem through divisible profits, then the problem is dead easy. You can simply apply the relevant provisions of Companies Act 2013, that is out of a utilization of divisible profits, you can make it transfer to the CRR, and through fresh issue, you should not make it transfer to the CRR, but you can pass the issue entry. Remaining entries are common, that is preference shares, premium to preference shareholders. Premium you can make it set off with the P&L or the general reserve. Issue is over. But They are not directly providing the information how much portion of the preference shares redeemed through fresh issue, how much portion of the preference shares redeemed through divisible profits. But they provided the hint that minimum number of fresh issue of the shares you can utilize for the purpose of redemption. To comply with section 55 is one approach. Minimum number of fresh issue of the shares you can utilize for the redemption through fund approach is another level of questions they are asking regularly in the examination. Now it is to comply with section 55. The minimum number of fresh issue of the shares we are going to utilize means the maximum amount of divisible profits we can utilize. What is the maximum amount of divisible profits we can utilize, which is nothing but existing free reserves minus free reserves useful for premium on set off for premium on redemption of preference shares, and at the discretion of the board of directors, if they want to stay any amount of the free reserves in the balance sheet itself, in the organization itself, we can't touch such free reserves. The remaining free reserves are only available for redemption. Now it should be compared with the total amount of face value of the preference shares to be redeemed. Then we will get the amount required to redeem the preference shares through fresh issue of the shares. That amount, if you divided with the face value per share which you are going to issue, then you will get minimum number of fresh issue of the shares to be issued to comply the section 55. In the another approach, that is fund approach, you should check that how much existing bank balance as well as investments we have. It should be compared with the required bank balance to redeem the preference shares. Then you will get the balance amount required for the purpose of redemption. If it is division with the issue price, then you will get the minimum number of fresh issue of the shares should be made for the redemption in case of the fund approach. Do you understand? This is the major discussion in case of redemption of preference shares. If you understand these methods of redemption of preference shares, then there is no confusion in providing the accounting treatment. For better understanding, I'll take up these two problems. What are these two problems? Combination problems, because sir, these problems are dead easy. Fresh issue of the shares and the divisible profits, if they are directly asking only one method you can follow, then which is very easy. Then combination also, if they provide the direct information, that is also dead easy. But if they ask to find out minimum number of fresh issue of the shares to comply the section 55, or in the fund approach, if they build the problem, then student may face a little bit aggression at that point of time. So let me take up such problems for the discussion now. Let me open my material. Please come to like problem number 7 or 8, I think so. Those problems are, yeah, you can come to problem number 8. This is not related to accounting treatment. Directly calculate the minimum number of fresh issue of the shares to be made for the purpose of redemption. I'll read the problem one from line by line. Concentrate. The board of directors of a company decided to issue minimum number of equity shares, face value 9, to redeem 5 lakhs worth of preference shares, to redeem rupees 5 lakhs worth of preference shares. Okay. The maximum amount of divisible profits available for redemption is 3 lakhs. Directly given. Maximum amount of divisible profits available for redemption. Sir, total face value of the preference shares to be redeemed 5 lakhs, and the maximum available amount for out of divisible profits we can utilize for redemption worth 3 lakhs. Then the difference of the face value is 2 lakhs. It should be divided with the face value of the share we are going to issue, which is 9. Then we will get minimum number of equity shares we can issue for the purpose of redemption. The question is, calculate the number of shares to be issued by the company to ensure that provisions of section 55 are not violated. Okay, that is 2 lakhs divided by 9 means how many number of shares? That is direct question, which is 22,222.22 shares. But I clearly told you, as per the provisions of section 55 and Companies Act 2013, if any fraction of share appeared, then it should be modified to the nearest share, that is 22,223 shares. Am I right? Next, one more issue, guys. One more. Also determine the number of shares if the company decide to issue shares in multiples of 50 only. So if company decide to issue the equity shares in multiples of 50, then we may convert this figure to 22,250 shares. That's it. If the company can able to issue the one share, then we can make it convert to 22,223. But if the company can able to issue the shares in multiples of 50 only, then what we can do, we can only convert it to 22,250 shares only. Is it okay, guys? All of you, if you want, you can cross check that. They can issue the shares in multiples of 50 rupees only. Then at that point of time, you can convert into these number of shares only. Okay. This is related to problem number 8. Now all of you please come to problem number 9, guys. Problem number 9. X Limited gives you the following information. That is one more model. What is that? Fund approach. Minimum number of shares to be issued for the purpose of redemption to follow the fund approach. X Limited gives you the following information. Share capital given, reserves and surplus is there, trade payable also given. Under assets, PPE, non-current investments, current assets, cash and cash equivalent, that is bank balance given at 31,000. The share capital of the company consists of 50 rupees each, equity shares of rupees 2,25,000 and 100 rupees each preference shares of worth of 65,000 issued on 1/4/2011. That is 2,25,000 plus 65, which leads to 2,90,000. This is nothing but the total 2,90,000. Simply he is telling that out of that, equity is 2,25,000, preference shares is 65. That's it. Next. In order to facilitate the redemption of preference shares at premium of 10%, the company decided to sell all the investments for rupees 15,000. Now it have 15,000 balance. Plus, to finance the part of the redemption from the company funds, subject to leaving a bank balance of 12,000, we can take the other bank balance. Now, if you check here, the bank balance of the entity is 31,000. Out of 31,000, it is clearly given that you should leave the 12,000. You should leave the 12,000. Leaving a bank balance of 12,000, you can utilize the remaining balance, which is 19,000, right? Now, for this 15,000 proceeds from investment plus 19,000 bank balance, you can utilize. The total balance we have was 34,000. In terms of fund for the purpose of redemption, we have 34,000. What is the total amount required for the purpose of redemption actually? That is for 65,000 into 110%. 65,000 into 110%. The total bank balance required is 71,500. But we have with us only 34,000. For the difference, we can issue equity shares, which are minimum number of equity shares to be issued for the purpose of redemption. Okay, let me read the further points. Then we can know how much we can put a issue price here. Next point number C, to issue minimum number of equity shares of rupees 50 each share to raise the balance of funds required. Now the issue price is also the face value, which is directly given 50. If the issue price is given at 60 also, you can consider that we are directly taking the issue price. Now the difference is 71,500 minus 34,000 divided by 50. I required 750 further number of shares for the purpose of redemption. You are required to pass the necessary journal entries to record the above transactions and prepare the balance sheet as on completion of above transactions. I will only pass the journal entries. I can't take the headache to prepare the balance sheet in the marathon. Okay, because my time is very precious. You know, I need to cover a lot of things. So let us give our focus on journal entries, guys. Please, all of you come to our OneNote, or it's better we can watch our Power Notes. I'll open directly that problem. I'm going to explain through Power Notes. Concentrate. That is problem number 9, right? Problem number 9. So fine, I already worked out this. That is, I got the 750 shares, which are the further number of shares to be issued for the purpose of redemption. Am I right? We already worked out. We got the 750 shares. This is the working note. Here also they provided minimum number of fresh issue of the shares made for the purpose of further fund of redemption of preference shares, which is 750 shares. Do we agree, all of you, with me? Now, the accounting treatment. First, you can pass the entry for further issue of the shares. You can pass the entry for further issue of the shares, that where it is bank account data to equity share capital 750 into 50, which is 37,500. Next, they sold the investment, investment for 15,000. If you check here, non-current investments are there at 18,500. They sold 18,500 for 15,000. For that entry, bank 15,000, lost 3,500, entire non-current investments gone. Am I right? Next, you can go for the redemption. You can go for the redemption entry, preference share capital account data. That is 65,000. It is clearly given the face value is at 65,000. Premium on redemption of preference shares. which is 6,500, 10%. To preference shareholders account 71,500. Preference shareholders account are to bank account 71,500. Over, am I right? These are the normal entries. And one more thing, you should need to pass to the extent of face value of the preference shares to be redeemed out of the divisible profits, you can make it transfer to the capital redemption reserve. Sir, now the question is how much amount I can make it transfer to the capital redemption reserve? How much amount I can need to be transferred to the capital redemption reserve? Now, the total amount of the face value of the preference shares to be redeemed, how much? 65,000. 65,000. Out of the face value of the preference shares to be redeemed, how much they utilized through fresh issue of the shares? That is 37,500 they utilized through fresh issue of the shares. Remaining face value of the preference shares to be redeemed out of divisible profits only. The difference is 65,000 minus 37,500, which is 27,500. I should need to make it transfer to the CRR. So that's why here P&L account data to capital redemption reserve account, which is 27,500. I separately provided a working note, which is the face value of the preference shares to be redeemed was 65,000, out of which proceeds from fresh issue of the shares. Here proceeds means face value of the preference shares to be redeemed out of fresh issue of the shares, which is 37,500. The difference 27,500, you can make it transfer to the CRR. And one more thing, this premium on redemption of preference shares, you can make it set off with profit and loss account, that is P&L account data to premium on redemption of preference shares. Sir, once if you know the minimum number of fresh issue of the shares to be made, the entries are common. First, if you want, you can pass the entry for CRR. Then fresh issue of the shares you can pass. Okay, if any investments are there, you can sold. Then preference shares, premium to preference shareholders, P&L to premium. Over. Do you understand, all of you? So these are the special issues, and these are the two different issues. In generally, students are showing certain aggression during the examination hall. Hope I clarified such issues as well. Okay. The final part before closing the chapter redemption of preference shares, the major important issues, what they are asking. At the time of fresh issue of shares, how to make the redemption, you know. At the time of utilization of divisible profits, how you should go for the redemption of preference shares, you know. In combination, if they directly provide the information, then for part divisible profits, part from fresh issue, how you should provide the accounting treatment, you know. If they are not directly providing the information, but indirectly they are conveying that minimum number of fresh issue of the shares to be made for the purpose of redemption to comply the section 55, or a minimum number of fresh issue of the shares to be made to get the required fund for the purpose of redemption. Like that, if they given how to handle the situation also, I explained. Am I right, guys? And one more thing, the basic provisions of Companies Act 2013 are, in case of fresh issue of the shares, no need to make it transfer any amount to the CRR, but in case of utilization of divisible profits to the extent of face value of the shares to be redeemed out of the divisible profits, you can make it transfer to the capital redemption reserve. One more important thing, throughout the chapter, securities premium cannot be utilized for premium to set off the premium on redemption of preference shares on the assumption that all the companies which are given in the material are covered section 133. So that's why we cannot utilize the securities premium as per section 52 provisions. That is the conclusion part. I made it. Now, before closing the chapter, as per my promise, I need to discuss one more thing. What is that, you know? Combination problems. Sir, if bonus shares as well as redemption of preference shares, if both they asked in the examination, how to handle? Just I will read the problem. I will complete, or I will explain the problem again through power notes. I don't want to take time again to write each and everything. So please concentrate. So PPE gross block given, depreciation given, which is net block, investments, inventory, trade receivables, cash and bank balances given. Under the liabilities, share capital, that is redeemable preference share capital, equity share capital, both it is given, which leads to 10 lakhs, but which is irrelevant information for me because the relevant information is issued, subscribed and paid up capital, which is 1 lakh, 1 lakh. Reserves and surplus, general reserve is there, securities premium is there, P&L is there, current liabilities and provisions are also given. For the year ended 31st March 2012, the company made a net profit of rupees 35,000 after providing 20,000 depreciation. So he is talking about the year 31st March 2012, but this information is up to 31st March 2011, but the information for the year end key is giving a net profit of 35,000 after providing a 20,000 depreciation. Now, the following additional information is available with regard to company's operation. The preference dividend for the year ended 31st March 2012 was paid. Except cash and bank balances, other current assets and current liabilities as on 31st March 2012 was the same as on 31st March 2011. Okay. The company redeemed the preference shares at a premium of 10%. Redemption happened. Company issued the bonus shares in the ratio of 1 share for every equity share held on 31st March 2012. To meet the cash requirements of the redemption, the company sold the investments. Investments sold at 90% of the cost. You are required to prepare the necessary journal entries to record the redemption and the issue of bonus shares. You know how to pass the journal entries for redemption. Along with that, you know how to pass the journal entry for bonus shares. In combination, they asked. I told you which is the last model. In combination, they may try to ask the questions in the examination. Now, the first and foremost thing, what should I need to do, sir? Sir, for the purpose of redemption of preference shares, for the purpose of, sir, these are normal entries. What is that? Sir, dividend paid. Okay, remaining balances are same. Further, the entry is normal. For the purpose of making the payment of preference dividend, what is the entry? Preference dividend payable accounted are to bank account. So preference dividend is how much? 1 lakh into 10%, which is simply 10,000. So further, the entry is preference dividend payable to bank account. That is the normal general entry, not related to redemption of preference shares as well as bonus shares. But coming to the entries with respect to the preference shares redemption, first, how much bank balance you required for the purpose of redemption of preference shares? How much you have, first you need to check. So here, for the purpose of redemption of preference shares, the total amount required is with the premium, right? That is 10% means 1 lakh into 10%. I required 1,10,000. He clearly told that investments are sold at 90% of the cost. Where are the investments here? Anything given? They are not given the investments, but indirectly telling that investments just sold at the rate of 90%. There is no other information given. So if there is no investments information given in the problem, we can't continue the problem under fund approach, you know, because first we should know out of this preference shares, for the purpose of redemption of preference shares, how much happened through fresh issue of the shares, how much happened through divisible profits. Sir, if there is no information with respect to the existing bank balance, there is no information with respect to the existing bank balance, then fund approach doesn't work out. Then which approach is work out, sir? The approach is section 55. To comply the provisions of section 55, I need to check. And one more thing, sir, to comply the provisions of section 55, how many minimum number of fresh issue of the shares we need to work out. First, you need to check the maximum divisible profits required. The maximum divisible profits we have. Sir, divisible profits we have is more than 1 lakh, sir. We required only the face value of the preference shares to be redeemed is only 1 lakh. But the existing divisible profits are, it's more than 1 lakh. If you check here it is 1,20,000. And the profit and loss account balance is also 18,500. Plus the current year profit and loss account also we have 35,000. Maybe after declaration of the dividend, maybe it's quite decreased. But we have a sufficient divisible profits. That means the entire redemption is going to occur to divisible profits. First, you need to decide this. Divisible profits only. Entire redemption is happened through divisible profits. Sir, if the redemption is happened through divisible profits, first and foremost thing what you should need to do, to the extent of face value of the preference shares to be redeemed should be transferred to CRR. The entry is, you can utilize the general reserve for the purpose of making transfer to the CRR. That is general reserve accounted to capital redemption reserve is the first and foremost entry. If you check here, which is general reserve to capital redemption reserve. Am I right? Next. Don't worry. The next entry. Sir, preference shares accounted are premium on preference shares accounted are to preference shareholders accounted are to bank account. Those are the two common entries. Those are the two common entries, second and third. Am I right? Now this premium on redemption of preference shares, you should make it set off with a free reserve, either P&L or the general reserve. You are making set off the general reserve or the you can make it set off with general reserve in the given answer. Next, I told you one basic entry is there for the purpose of declaration of the dividend. You should need to pass the entry that is dividend payable account debtor. Actually, I didn't wrote the entry because they already told that was paid. I'm so sorry. Was already paid. Was already paid means they might already pass with the entry. That's why I'm not passing the any entry. Okay. The next issue is issue of bonus shares. With that, redemption of preference shares over, because face value of the preference shares redeemed transfer to CRR happened. Preference shares face value as well as premium transfer to preference shareholders, then preference shareholders to bank entry over. Premium on preference shares you made set off with the general reserve, that entry over. That is related to the redemption of preference shares. Now coming to the issue of bonus shares. The first and foremost entry is free reserves you can utilize, or securities premium you can utilize, or CRR also you can utilize to bonus to shareholders, then bonus to shareholders to equity share capital. Then how many number of bonus shares you are going to issue here? It is clearly given. The company issued bonus shares in the ratio of 1 share for every equity share. How many number of existing equity shares we have? As per the problem information, we have 1 lakh, that is 10,000 equity shares means we are going to issue 10,000 bonus shares. 10,000 into 10 means 1 lakh. We required 1 lakh. Sir, first, which resource can I utilize, sir, out of this? Free reserves na, securities premium na, CRR na? Already there na CRR. At the time of redemption of preference shares, you are transferring to the extent of face value of the preference shares transfer to the CRR na. I required 1 lakh. I think so, which is there exactly for 1 lakh. CRR is there for 1 lakh. That 1 lakh you can utilize it for the purpose of issue of bonus shares. The entry is CRR to bonus to shareholders account and bonus to shareholders account to equity share capital account. Like this, they might also ask the combination problems, which is bonus shares chapter plus redemption of preference shares chapter. They might sometimes add the problems, add the point related to redemption of debentures, but till now we not discussed the concept of redemption of debentures. That's why I don't want to take up the problem based on redemption of debentures. So with this, we completed total 3 chapters in this slot. That is profit or loss prior to incorporation, bonus and right issue, and redemption of preference shares. Out of the 3 chapters, the little bit technical chapter is redemption of preference shares. Hope everything is clarified in this chapter. Hello, my dear soldiers. Happy Ugadi to one and all. And this slot is purely dedicated to accounting standards. What we are going to see in this slot: introduction to accounting standards, framework for preparation and presentation of financial statements, and the discussion will be on certain exclusive accounting standards like AS2, AS3, plus the main chapter cash flow statement, then accounting standard 10, property, plant and equipment, which is a very big standard. The only one IND AS, which is there in your syllabus, which is AS10. Then our discussion will be continue with AS12, accounting for government grants. Then AS13, investments plus investments accounts, main chapter. Then redemption of debentures also I am going to try to cover in this slot. I mean, it's very big slot and the coverage is also huge. Fine. Now, please allow me come to the introduction to accounting standard topic. So if you really observe, we shifted our focus from section 4 to section 1 as per the blueprint I'm talking. So section 4 is with respect to company chapters. So except certain chapters like cash flow statement and redemption of debentures, we covered all the chapters in section 4. Then our focus is shifted towards section number 1. The chapters which I left in section 4, I'm going to cover through the accounting standards as well. Okay. Sir, before discussing things related to accounting standards, First, let me tell you the structure of our ICAI, which is Institute of Chartered Accountants of India. You know that, right? Sir, in Institute of Chartered Accountants of India is completely administered by council, which is known as council. So council elections are in generally is going to occur for 3 years once. Approximately council contains 32 elected members plus 8 nominated members. Approximately total 40 members will be there, more or less. Okay. So these 32 members are completely elected by the members of the ICAI, which is nothing but qualified chartered accountant who take the membership from the ICAI. Either they are in the employment or they are in the practice, whatever the case may be. These 32 are completely elected by the such members. Those members are coming from different regions like southern region, northern region, western region, eastern region, and the central region of the India. These 8 nominated members are nominated by central government for the purpose of having interaction in the policy making or in the decision making. Certain government nominated people will also be form part of such council. Apart from this, ICAI contains different committees, maybe for the purpose of administer the various activities of the Indian economy, or maybe for the purpose of issue of accounting standards, for the purpose of issue of auditing standards, for the purpose of drafting certain provisions, okay, providing guidance to the society at large. ICAI will frame certain committees. Such committees are broadly categorized into 2 types: standing committee, non-standing committee. What is the meaning of standing committee and non-standing committee? These committees who will frame? Council will only frame. If council will frame a committee with an intention to run in the long run in nature, which is a permanent committee, which the presence will be there forever, then such committees are known as standing committees. Non-standing committee means such committees are framed with a specific objective, and that committee is temporary in nature. Once the objective is fulfilled, then the committee may be dissolved. That is the meaning of the non-standing committee. Now, ICAI, as per the decision of the council, one of the non-standing committee like accounting standard board is introduced, which is actually a temporary based committee, but still the necessity is continuing. That's why it was not dissolved yet. Now, out of the non-standing committee, one of the committee is accounting standard board. Such accounting standard board have right to issue accounting standards in the Indian economy. So ultimately, the accounting standards which are issued by the ICAI will ultimately approved by the council of the ICAI. Such approved accounting standards directly used by the non-corporate entities. You know, non-corporate entities means sole proprietors, partnership firms other than companies. But coming to the company form of organizations, after getting approval from the council of the ICAI, that is, which are nothing but standards issued by accounting standard board, such standards are ultimately suggested by NFRA to the central government. The full form of NFRA is National Financial Reporting Authority. Sir, if I want to tell things related to NFRA, before introduction of or before commencement of Companies Act 2013, NFRA is had another name actually. NFRA is so called as NACAS as per the Companies Act 1956. The full form of NACAS is National Advisory Committee on Accounting Standards. At that point of time, what is the objective of framing such NACAS? The accounting standards which are ultimately approved by the Council of ICAI are suggested by the NACAS to the central government. Just it have a suggestory power. It doesn't have any regulatory powers. But after introduction of Companies Act 2013, the NACAS itself is dissolved, then itself the change to NFRA, which is National Financial Reporting Authority, which is evolved as per section 132 of the Companies Act 2013. If you open section 132, they are clearly giving things related to NFRA. If you want, I'll open section 132 in my Google. Section 132 of Companies Act 2013. The central government may by notification constitute a national financial reporting authority to provide for matters relating to accounting and auditing standards under this act. Okay. So the National Financial Reporting Authority shall perform its function through such divisions as may be prescribed. Now, such NFRA will have all the powers as like NACAS. Apart from that, it have also certain regulatory powers. What are such regulatory powers, sir? If any company which is deviated in applying a particular accounting standard in preparation of their financial statements, then NFRA have a right to question that particular company, and it will also provide the suggestion to the ROC to remove such company from the database of the ROC. Do you understand? Such regulatory powers are now vested with the NFRA. Such type of regulatory powers are not vested with NACAS earlier, as which was framed as per Companies Act 1956. Do you understand? Now, in case of companies, once the accounting standards are framed by the accounting standard board, which are ultimately approved by the council of such ICAI, now such accounting standards are ultimately suggested by the NFRA to the central government. Then central government, through a notification, release such accounting standards, which are all different accounting standards applicable to the corporate entities with the help of Ministry of Corporate Affairs, MCA. MCA is a form part of the central government. Central government means under the central government, the wing is, the ministry is MCA. I already shown number of times the MCA website. If you want, you can see the NFRA website as well here, which is a separately established body by the central government, which is National Financial Reporting Authority. So if you check about us, about the organization, is there, right? So just I'm opening the about the organization. Just a second. Yeah. Here it came. Functions and duties. If you check here, so it have the following functions: recommend accounting and auditing policies with the approval of the central government. It will also monitor and enforce compliance with accounting standards and auditing standards by each and every company or not. Okay, so it has certain members, it has certain acts, rules, notifications, so many things are there separately in the National Financial Reporting Authority. Their head office place is located in Delhi. Okay, come back. So ultimately, a non-corporate entity can directly use the accounting standards which are ultimately released by the ICAI with the approval of the council. But in case of the company, if such standards are ultimately suggested by the NFRA, and if it is released through a proper notification, then only such accounting standards are used by the companies. Am I right? Fine. Then, what are the objectives of introduction of accounting standards? Sir, why accounting standards need to be introduced in the Indian economy? If accounting standards are not exist, what happened? I already told you, accounting standards is form part of the gap, generally accepted accounting principles. If such gap is not there, what will happen? Or with which object to the accounting standards are going to be introduced in the Indian economy? The following objectives are given. Standardization. What is the meaning of standardization? Sir, if accounting standards are not there, then I will use an accounting policy as per my discretionary criteria. Another entity may use another accounting policy as per their discretionary criteria. Accounting policy means, for example, for the purpose of valuation of inventory, I may use FIFO method, which is my accounting policy. And another enterprise may use for the purpose of valuation of inventory, they may use LIFO method. That is their accounting policy. Then where is the standardization? So standardization means each and every enterprise should use the same set of rules and regulations. So to bring such standardization, accounting standards are introduced. Additional disclosures. Apart from the provisions of Companies Act 2013, or apart from the provisions of that specific statute, if any additional disclosure which is necessary to provide decision making for the users of the financial statements, such additional disclosures each and every enterprise can need to be provided based on the accounting standard. Because if you take the schedule 3, maybe in schedule 3, as per the schedule 3, certain additional disclosure information may be missing. There is one standard called AS1, disclosure of accounting policies. To comply such standard, each and every enterprise should disclose all the accounting policies followed at a single place. Such all disclosures are only possible through introduction of accounting standards, even though statutes are in existence. Comparability. If you want to compare your financial statements of the current year with your previous year financial statements, then you should need to adopt the same accounting policies. You should need to adopt the standard set of practices. Then only intra comparison is possible. Intercomparison means if your company financial statements or your entity financial statements, if you want to compare with the another entity financial statements, then both the entities should need to follow the same set of policies and the rules and regulations. Then only comparability of such financial statements will be possible. Sir, which entity is performing well, sir? When we can tell if both the entities followed the same set of rules and regulations. Am I right or wrong? Just I will give a simple example here. Sir, can we compare a CA foundation student result with CA final student result? No, because the set of rules and regulations applicable for CA final curriculum vitae is quite different from CA foundation curriculum vitae. But a CA final student result, we can compare with another CA final student result, because both the persons will acting in the same environment. So that's why for the purpose of comparability, both the entities should need to follow the same set of practices and the principles. Reduction in creative accounting. Reduction in creative accounting means, sir, if I want more profit, then I will adopt one method. If I want less profit, I will adopt another method. That is nothing but creative accounting. I mean to say, there is window dressing is possible if accounting standards are not exist. If accounting standards are came into existence, then window dressing will be completely reduced. Do you understand? So no one will create their own accounting treatment. All the persons should need to follow the same set of compliances. That is the need for introduction of accounting standards in the Indian economy. Okay. Once in a specific area, if the ICAI want to establish an accounting standard, then what is the set of procedure need to be followed? This is standard setting process. It is clearly given. In case of standard setting process, who will ultimately issue such standard? Accounting Standard Board of ICAI. We already seen, which is one of the non-standing committee. Then Accounting Standard Board of ICAI will decide the particular area in which accounting standard is needed. I mean, is it needed in construction sector, or is it needed things related to employee benefit expenses? Do you understand? Sir, is it things related to a property, plant and equipment? The area who will ultimately fix, or is it related to the agriculture sector? A standard is required. The area will be ultimately decided by such accounting standard board. Once if the area is fixed, then the accounting standard board will frame a particular study group. What is the background story of such study group, sir? Such study group will contain experts who are nothing but persons who can take from the members of the ICAI, or maybe members of the other bodies. Then they will frame it as a particular study group. Such study group will deeply understand about that particular area. They will see the practical implications as well. If any other available resources are there, they will consider such resources as well. Then after completion of all that research activities, they will frame objective of the standard. To understand that particular standard, they will frame different definitions, scope, that is applicability, so to which part it is applicable, the aspects, that is recognition, when a particular income or expenditure should need to be recognized as per that standard, measurement, at which value such component need to be measured in the financial statement, how it should be presented in the financial statements, what are the disclosures need to be presented under notes to accounts. They are clearly established in such document. Then they will release a preliminary draft. Preliminary draft means which is a primary draft copy. Such a draft copy is ultimately sent to the different parties, that is council members of the ICAI, Institute of Chartered Accountants of India, Institute of Cost Accounts of India, Institute of Company Secretaries of India, to the different council members of the different bodies at the board. We will send. Then after taking comments from, or after giving approval from that authorities, we will draft an exposure draft, which is an exposure draft. Such exposure draft will be released to the public, to the various members of the professional bodies and the universities and the public at large. To take comments from that persons, we will release such exposure draft to the various persons. So I will also get various mails. Each and every member will get various mails. Sir, this is the exposure draft recently released by the Accounting Standard Board of ICAI. Can you please provide a comment on that? We can give a comments. Based on the valid comments, they may modify the exposure draft according to the comments received, and it will be ultimately approved by the council. It will be ultimately approved by the council. Then such accounting standard will be released by the Accounting Standard Board of ICAI. For the time being, I'll show you certain exposure draft came to my mail. Just a second. Yeah, exposure draft. Yes. So if you check the mail came from ASB of ICAI. Am I right? This is my official mail ID, guys. I'm the member of the Chartered Accountant. That is the reason why I'm getting regularly mails from Accounting Standard Board of ICAI. So here also there, members update. Comments are invited on the exposure draft of ICAI something. So exposure draft of guidance note on audit of the banks. Comments are invited on the exposure draft on ICAI and the valuation something. Regularly I'm getting updates to provide a comment on the exposure draft released by the ICAI. Do you understand? Okay, come back. So this is nothing but a particular standard setting process. So the same thing is there actually clearly I established through my main material as well. Identification of the area, constitution of the study groups, and preparation of the preliminary draft, then ascertainment of different views, then they will finalize the exposure draft, ultimately comment received on the exposure draft, modified the draft, then issue of the such accounting standard. Then the next point is, sir, how many accounting standards are there? Effectively right now 27 standards are there. Effectively right now 27 standards are there. Coming to the existing accounting standards, I mean, before seeing number of accounting standards, first I will tell you the story behind the standards introduction locally as well as globally. First let me explain that part. That is the better idea, I think so. Okay, just a second. Yeah, hope you know such thing already, but the basic thing I want to explain here. Sir, accounting standards basically globally right now two different set of standards are there. One is IFRS or IAS, another one is IFRS, which are globally. Coming to India, in Indian scenario, again two different set of accounting standards are there. One is existing accounting standards, another one is IND AS. Sir, in detail discussion will be there. If you hold for some time, I will tell you each and everything. That is, what is the meaning of IAS, IFRS, accounting standards, and IND AS. Each and everything I'm going to discuss. Now, I'm talking about this accounting standards only because this is only a form part of our syllabus. Right now, how many accounting standards are there, sir? Effectively 27 accounting standards are there. Effectively 27 accounting standards are there. After merging AS6 depreciation with AS10 PPE, right now 27 accounting standards are takes place in India with respect to the existing accounting standards. Okay, fine. Come down, guys. I'll discuss, sir. Still, the discussion is not yet over. Things related to the accounting standards globally as well as India in detail discussion I'll be made. Next. The next question coming into my mind is, sir, is it accounting standards mandatory in case of companies? Yes. This is as per the provisions of Companies Act 2013. As per the provisions of Companies Act 2013, compliance of accounting standards is mandatory. So through different sections I mentioned here, as per section 129 subsection 1, each and every enterprise at the time of preparation of financial statement, it should comply accounting standards prescribed in section 133. Accounting standards prescribed in section 133 are nothing but NFRA suggested standards ultimately notified by the MCA of the central government, or which are prescribed under section 133. Do you understand? Each and every enterprise as per section 129 subsection 1 at the time of preparation of financial statement should need to comply the accounting standards which are prescribed under section 133. That is the one compliance. That is the reason compliance of accounting standards is mandatory in case of companies. Another section, as per section 129 subsection 5, at the time of preparation of financial statements, if an enterprise deviate from any particular accounting standard, such fact should need to be disclosed. Such fact should need to be disclosed in the financial statements notes to accounts itself under the disclosures. Do you understand? That means we are in generally, we should not deviate from any accounting standard. If you deviate from any accounting standard, then such fact should be clearly disclosed under section 129 subsection 5. According to these two sections, it is mandatory to comply the each and every accounting standard. Next, not only that, coming to auditor point of view, statutory auditor point of view, as per Companies Act 2013, statutory audit is mandatory. Hope you know that. Statutory audit means each and every company, whether it is a private limited company or public limited company, 1-person company or a small company, or section 8 company or holding company or subsidiary company, whatever the case may be, if it is a company, if it is Indian company or the foreign company, if it is the company, then audit is mandatory. It should need to be audited by a practicing chartered accountant in India. Now, while issuing our audit report under section 143 subsection 3 clause E, 143 is the love letter issued by the auditor, which is for 143. So just as a joke, I told you 143 is section which relevant for the audit report, which relevant for the audit report. As per 143 subsection 3 and clause E, in audit report, auditor should provide a comment whether the enterprise is following the accounting standards at the time of preparing their financials or not. Is they comply accounting standards for the purpose of preparation of financial statements or not? Auditor should provide a comment. If the management will follow, then he will provide the positive comment. If the management will not follow, he will provide with the negative comment. These three different sections mandate the companies to comply the accounting standards. That is the reason why we are learning such accounting standards as well. That is only for companies. Sir, next, coming to the applicability. Sir, is it all the accounting standards applicable to all different enterprises? No, no. For the purpose of applicability of accounting standards, enterprise were broadly categorized into two types. That is corporate entities, non-corporate entities. Non-corporate entities means other than companies. Simply other than companies. Corporate entities means which are companies. Now, other than companies, the enterprises are broadly categorized into four types. level 1, level 2, level 2, level 3, and level 4. Total 4 levels. Level 1, level 2, level 3, level 4. Now come to level 1 enterprises, which are large enterprises. In bracket I showed which is for L, large enterprises. Level 2 are medium enterprises. Level 3 are small enterprises. Level 4 are micro enterprises. L2, L3, L4 are put together. We are known it as MSME, micro, small, and medium enterprises. L2, L3, and L4, we can call it as MSME, medium, small, and micro enterprises. Do you understand? Now, coming to the large enterprises, which is L1. When a particular non-corporate entity will be categorized under L1. Sir, first, why this classification, sir? Why you are making this classification? For the purpose of applicability, I told you, right? For L1 enterprises, as well as non-SMC, under corporate companies, together broadly, they are segregated into non-SMC, SMC. Non-SMC means other than small and medium company. Non-SMC means other than small and medium company. SMC means small and medium company. Simply saying, those are big companies. In case of big companies, as like L1, non-corporate entities, for both the entities, there are no exemptions. I mean, they need to follow each and every accounting standard. Out of the prescribed 27 effective standards, all the standards they should need to comply. But coming to L2, L3, L4, and SMC, they have certain full exemptions from certain accounting standards and partial exemptions from certain accounting standards. What is the difference between full exemption and partial exemption, sir? Full exemption means that accounting standard itself doesn't applicable to that particular enterprise. Partial exemption means out of all the provisions of such accounting standard, certain provisions are only applicable, remaining provisions no need to comply. Do you understand? Now, come to the L1 enterprise or the large enterprise. All accounting standards are applicable, no exemption. In case of non-SMC also, the criteria is same. That's why I told here which is under L1. The criteria for L1 under non-corporate and non-SMC under corporate, both are same. What is that criteria? Listed or in the process of listing. The company was already a listed company or in the process of listing, then which is categorized into L1. There are no exemptions for the listed enterprises. Listed enterprises means such companies are listed in the stock exchanges and their shares are coded in the stock exchanges. Such companies are known as listed companies. Any bank or financial institution or an insurance company, there are no exemptions. Preceding financial year turnover greater than 250 crores. In the preceding previous year, the turnover sales are greater than 250 crores, then there are no exemptions. It should need to comply all the accounting standards. Borrowings in the preceding financial year at any time, at any particular point of time, if it is greater than 50 crore. Sir, at least in a particular month, the borrowings are greater than 50 crores. Then for the current year, it can be categorized as a level 1 enterprise or subsidiary or holding of the above company. Subsidiary or holding of the above company. You know already the meaning of subsidiary and the holding company. You might see in different papers, that is like P2 company law. You may see in subsidiary company means a company in which the other company holds greater than 50% of the voting power, or it have the control on the composition of board of directors. Then the primary company is known as subsidiary company and the later company is known as the holding company. So subsidiary or holding of above 4 criteria satisfied companies are also categorized into level 1 enterprises. Okay, the same criteria is also applicable in case of non-SMC as well. Now come to L2, L3, L4. When a non-corporate entity is categorized under L2, turnover is less than or equal to 250 crores but greater than 50 crores. This is outrightly greater than 250. This is greater than 50, less than or equal to 250. Borrowings here greater than 10 crores and less than or equal to 50 crores. Holding are the subsidiary of the above. Coming to L3 category, turnover greater than 10 crore and less than 50 crores. Borrowings greater than 2 crores and less than 10 crores. Holding are the subsidiary of the above. L4 micro enterprises other than, not covered under L1, L2, L3, covered under L4. Do you understand? In very simple manner, just I given the criteria to decide a particular non-corporate entity as L1 or L2 or L3 or L4. Coming to corporate, non-SMC is as like L1, SMC is other than non-SMC. SMC is other than non-SMC. Okay. Now, one more important fact here I am revealing. Please concentrate, all of you. I told you for L2, L3, L4 as well as SMC, they have certain exemptions, but L1 as well as non-SMC, they doesn't have any exemptions. Outrightly, they need to comply all the accounting standards. For example, in the previous year, not in the current year, in the previous year, the entity is either L1 or non-SMC. That means in the previous year, all the accounting standards are applicable. Now coming to current year, the entity will becomes as L2, L3 or L4 or from non-SMC to SMC. Simply from bigger enterprises to smaller enterprises. Then once they will become, they will have certain relaxations from the accounting standards, right? In generally, but such relaxations are straight away not applicable to such enterprises. The reason is the exemptions which are available to that particular level will not be applicable unless otherwise it continue for 2 consecutive periods with that lower level grade. Then if it will continue with the L2 or L3 or L4 or SMCs for a minimum continuous period of 2 years, then in the next year, third year, then the exemptions will be applicable. Do you understand? It's very quite simple, guys. For example, this current year is 22-23. Yes, guys, right now we are at April 2nd, I think so. Am I right? As on Ugadi festival. We are in the year 22-23. Now in the year 21-22, a particular entity is L1, let us assume. Now for the year 22-23, it become as L2. Now, can I provide certain relaxations from particular accounting standards as per the exemptions available to level 2 enterprises in the year 22-23? No. For 22-23 and 23-24, if it will still continue under the level other than L1, that is either L2 or L3 or L4, then from the year 24-25 onwards, I will provide the exemptions. The reason is very simple, guys. Sir, in 22-23, you should need to provide the current year figures as well as previous year figures, right? If current year figures, if you categorize it as L2, and for the previous year figures, which is an L1, how the comparison will look like? For the purpose of comparability of financial statements, the previous year figures are quoted at L1. That's why the current year figures are also quoted at L1, even though it relates to other than L1 category. That is the important point. Next, just leave it. Sir, what are such relaxations, sir? What are such relaxations? Just I will show you such relaxations here. Just give a moment. Yeah, relaxations. Now, coming to level 2, level 3, and level 4 enterprises, which is level 2, level 3, and level 4 enterprises, fully exempted. Certain standards are fully exempted. Certain standards are partially exempted. Sir, how to remember all these standards, sir? That is very simple. Please, all of you follow my methodology. For a level 2, what are the standards are fully exempted, sir? Level 2 means, you know, the turnover is greater than 100 crores and less than 250 crores. And borrowings limit is also there. The borrowings limit. What is that borrowings limit, guys? That is greater than 10 crores and less than 50 crores. And the holding or subsidiary of the above companies are known as level 2, like that level 3, level 4. Now, level 2 exemptions fully exempted are 21, 23, 27. These three are related to consolidation. Consolidation in case of holding and subsidiary is 21. Associate and investor is in case of 23. 27 are joint venture. Both the three standards are related to consolidation. If you check, these consolidation standards are straight away exempted for a level 2. There are no consolidation concept is applicable in case of such level 2, level 3, level 4. I mean, consolidation means if holding subsidiary relationship are there, then they should need to prepare a single set of financial statements. We are going to learn such consolidated financial statement concept in group 2, actually. Okay. AS3 cash flow statement is not applicable. AS17 segment reporting is not applicable. AS20 EPS is not applicable. 25 interim financial reporting is not applicable. 3, 17, 20, 25, apart from 21, 23, 27. Now, if you check the level 3, additional 2 more standards added here. Just to these standards, additional 2 more standards, which is 18 and 24. If you shifted to the level 4, 2 more additional standards are added, AS14 and AS28. Like this, you can remember. No need to remember each and every standard at every time. For the difference between level 2 and level 3 is these two standards. The difference between level 3 and level 4 standards are these two standards. Now coming to partially exempted, 15, 19, 28, 29. Here the additional standard in case of level 3 are 10 and 11. In case of level 4 are the additional standards are 13, 22, 26. That's it, guys. If you just remember like this, level 2, level 3, level 4, then automatically over. So then what about SMC and non-SMC, sir? Sir, SMC and non-SMC more or less same. I mean, for non-SMC, all these are exempted. All these are exempted. For SMC, for all the standards are applicable. Sir, all the standards means, is it level 2 or level 3, level 4? You can consider the level 4 for non-SMC. You can consider the level 4 for the non-SMC, more or less 1 or 2 more standards here and there. That exemptions are also clearly given. Accounting standards not applicable to SMC entirely. I given here, which is 3, 17, 21, 23, 27, 25, and partially exempted also I given clearly. I think so, which is the criteria as like level 2. Sorry, as like level 2. If you check in level 2, 3, 7, 20, 21, 23, 25, 27 is there. Here also 3 is there, 17 is there, 21, 23, 27, 25, all are there. I think so, except one is missing. 20 is missing, except 20 is missing, all are covered. This is like level 2. Level 2 exemptions for SMC. For SMC, the exemption list. So accounting treatment in respect of which relaxations from certain requirements, that is partial exemptions 15, 19, 20, 28, 29, which is the exemptions for SMC, which is exemptions for level 2, level 3, level 4. So the idea of remembering the aspects also, hope I explain. Okay, fine. Come back, guys. So now we started our journey with the standing and non-standing committees, and in case of the non-corporate entities, who will issue the accounting standards. In case of corporate entities, who ultimately suggest such accounting standards to the MC of the central government. We've seen objective of accounting standards. We've seen standard setting process. I discussed the major important issue, which is applicability of accounting standards for non-corporate and corporate entities, as well as exemptions or relaxations with respect to non-corporate entities and corporate entities also I discussed. Am I right? Fine. Now come to the accounting standard scenario. I told you, sir, global standards are there. In India, existing accounting standards and IND AS are there. First, let me explain the international scenario or the global scenario of accounting standards. In the period like 1970s, that is in 1973, a London-based committee, which is an UK-based committee, framed a body called IASC, which is International Accounting Standard Committee. In IASC, almost more than 50 countries are members at that particular point of time. That is 1970 means very few countries are there. Right now, the number of countries are increased to more than 200, but at that point of time, very few countries are there. It's like 120 or 130 countries are there, out of which more than half are members of such IASC. All the countries are members of such International Accounting Standard Committee. Such IASC issued international accounting standards, which are known as IAS, International Accounting Standards. Now, in 2001, the IASC is completely restructured according to the new economic environment and the global policies, and the way of conducting the business practices are completely outrightly changed due to the technological issues. So now the International Accounting Standard Committee is restructured as IASB, which is International Accounting Standard Board. IASB is going to issue IFRS, which is International Financial Reporting Standards. That means, to put it simply, one second. To put it simply, globally or internationally, two different set of standards are exist. Two different set of standards are exist. One is IAS, another one is IFRS. Who issued IAS? IASC, International Accounting Standard Committee, which are older standards. Who issued IFRS? IASB, which is new body, International Accounting Standard Board. This is the global scenario which ultimately issued by the London-based committee. London-based committee. Now coming to the Indian scenario, in India, what is happening? We already have our own local standards. We already have our own local standards, which are framed by Accounting Standard Board of ICAI. We know which are known as accounting standards. We already have. It doesn't have any relationship with global standards, which are accounting standards, which are already there in India. Now, if a country who want to follow global standards, either IAS or IFRS, if they want to follow such standards, then they have such country they have two options. They have two options. Option number one, they can adopt. Option number two, they can go for convergence. So what is the difference between adopt and convergence? If a particular country, if they want to follow the international accounting standards, they can directly adopt such accounting standards, or they can apply the method of convergence. Adopt means straight away they directly use the same standards which actually developed by such international practices or developed by such international committees. Convergence means we will take over such global standards. We will make the minor modifications, that is additions and deletions, according to our economic environment we will use. That means in the process of convergence also we are using the same global level standards more or less, except a few modifications. Now coming to the Indian scenario, to follow such global standards, we applied the second method, that is option number 2. We go for convergence method of applicability of the global standards. Such a converged IFRS, here IFRS includes IAS as well. Whenever I'm using the word IFRS, it includes IAS as well. Now such converged IFRS or IAS are particularly known as IND AS in India. Do you understand? Now in global level, there are two different set of standards are there. One is IAS, one set of standard are older version, and another set of standard is newer version, which was IFRS. IAS are introduced by the International Accounting Standard Committee. IFRS are introduced by the International Accounting Standard Board. Now in India, apart from the global level of set of practices, our Accounting Standard Board of ICAI already issued the local standard, which is known as local gap, which are the accounting standard. But to compete globally, to have the standard set of practices in India also, certain entities they need to follow IFRS or IAS, but we are not directly adopting the global standard. We adopted the method of convergence. So the converged IFRS or IAS are technically known as IND AS in India. So Indian accounting standards are nothing but converged global standards. But how the numbering will be there, you know, if in globally, which is IAS 1, in India, which is known as Indian Accounting Standard 1. In internationally, if it is IFRS 1, then in India we will adopt which is IND AS 101. That is the reason Indian accounting standards we have numbering from 1 to 100 as well as 100 plus as well. Do you understand? So if it is internationally, it is international accounting standard, we will call it as from IND AS 1 with the same numbering. If it is international financial reporting standard, we will add 100 plus that numbering to differentiate IAS as well as IFRS. But here both are actually same, both are who developed, that is globally developed, but which are the older version, but which are the newer version. This is actually your CA final entire syllabus is only based upon these IND AS only. But for CA Inter, we are only discussing things related to accounting standards, which are issued by the Accounting Standard Board of ICAI. So now let us go to our power notes. I'm going to explain the things with power notes. Please consider it all of you one by one. Sir, the London-based committee, which are all the countries are members of that London-based committee, which ultimately issued the International Accounting Standards, which is an international accounting standard committee ultimately issued. Now in 2001, which was restructured as an International Accounting Standard Board. So which issues the IFRS, which is International Financial Reporting Standards. Any country can have two options. They can directly adopt or they can apply the process of convergence. Then coming to India, we applied the method of convergence. So IFRS or IAS plus certain modifications is equal to IND AS. That is the reason why in our India, now we have existing accounting standards as well as IND AS. Is it okay? Now, sir, I told you there are certain differences in between IFRS or IAS to Indian AS. There are certain modifications are there, right? Which are technically known as departures. Departures in between IND AS and IFRS. Sir, what are the differences between Indian accounting standards and IFRS? Totally 4 different set of differences are there. One is terminology based differences. Another one is which are not carve-outs. The name itself is not carve-outs, which is not resulting into carve-out. The difference is not resulting into carve-out. Another difference is resulting into carve-out. Another difference is resulting into carve-in. First, let me explain terminology difference. Sir, what is the meaning of terminology difference, sir? Sir, terminology difference means in IFRS, they use a different terminology, but quite we are using our terminology according to our business practices. I'll give certain examples. Sir, in IFRS, in India, in India, as per IND AS, we will call it as statement of P&L. To know the performance, we will prepare the statement of P&L. But as per the IFRS, they will call it as comprehensive income. They will call it as comprehensive income. So which is statement of P&L in case of IND AS, but as per the IFRS, they can call it as a comprehensive income. The terminology itself is different. We may call it as balance sheet. They may call it as statement of financial position. Statement of financial position. So both are same, but the terminology is quite different from IFRS to IND AS. Next, not resulting into carve out. Carve out means to be specifically known as material difference. Carve out is nothing but a material difference. Not resulting into carve out means which is a difference, but which is not that much of material. What is that? More options as per IFRS. Sir, IFRS gave 2 options. Either you can apply the method number 1 or method number 2. But according to our economic and business practices in India, we are not giving the options. We are only for the purpose of consistency, only one option is evolved as per the IND AS. As per IFRS, we have 2 options, but as per the IND AS, we have only one option of method of accounting treatment for the purpose of consistency, which is a difference only, but which is not that much of material. That's why we are treating as not resulting into carve out. Sir, principal based difference, not related to optional difference. Principal itself is difference. As per IFRS, which is treated as a capital expenditure, we can add it to the cost of the asset. But as per the IND AS, which is treated as a revenue expenditure, we should need to be charged to the profit and loss account, which is a principal based difference, which is a major difference. We can call it as a carve outs. Next, additional guidance we can be provided as per the IND AS, which are not there in the IFRS. As per the, according to the Indian economic system, we should need to provide such additional guidance. Such scenario is not applicable globally. That's why certain additional provisions we are going to add, which are known as carve-ins. So total, the departures in between IND AS and IFRS are broadly categorized into 4 types: terminology based differences, which not resulting into carve out, which resulting into carve out, which resulting in carve-in. Terminology based differences means as per IFRS we use the different terminology, but the same statement here we are naming at different terminology. We are using a different terminology. And not resulting into carve out means as per IFRS we have more options, but as per the IND AS we have only one option. There is no alternative mechanism is possible as per IND AS for the purpose of consistency. With such differences are known as not resulting into carve out. Resulting into carve out means which is a material difference, which is a principal based orient difference. Carve-ins means which is an additional guidance which will be provided as per the IND AS. Such guidance is not available as per the IFRS. Next, come to the last scenario, guys, which is a roadmap to the IND AS. Roadmap to the IND AS means I told you for each and every enterprise, no need to comply the IND AS, but they are giving certain roadmap which type of enterprises they need to adopt the IND AS at the time of preparation of the financial statements, from which date it is mandatory. For that purpose, the entities are broadly categorized into 4 types: companies, banking companies, NBFC, insurance companies. Companies other than banking, NBFC and insurance, from 1/4/2015 voluntary. If they want, they can adopt. But once they adopt, once they need to follow, once they applied such IND AS in their preparation of financial statements, they should need to continue. They cannot escape. They cannot escape. They should need to continue. So once, if they applied voluntarily, they need to continue forever. That means entry is there, no exit, even though they apply voluntarily also. Now from 1/4/2016, certain mandatory basis, certain enterprises need to comply the Indian accounting standards. That is either listed or unlisted companies, whose net worth is greater than 500 crores. Net worth means assets minus outside liabilities, or the capital plus reserves and surplus is greater than 500 crores. They need to follow on the mandate basis from 1/4/2016, that is 16-17 financial year onwards. They need to comply the IND AS. They need to prepare the financial statements as per IND AS. Do you understand the financial statements as per IND AS means? I told you in the finance statements of companies chapter, they should need to adopt Schedule 3 Division 2. We prepared the financial statements as per Schedule 3 Division 1, that is balance sheet and statement of P&L. Part 1 balance sheet, part 2 statement of P&L. Am I right? But as per such Division 2, that is completely a statement of P&L and other comprehensive income, schedule of changes in equity, and the balance sheet. The format itself is quite different. You are going to learn such format in the financial reporting. I will discuss such issues in the CA final level. Okay, the entire syllabus of CA final level is purely dedicated to or is purely based on Indian accounting standards only. Okay, fine. From 1/4/2017, again mandatory basis, all listed enterprises irrespective of their net worth, whether the net worth is greater than 500 crore or less than 500 crore, if it's a listed company or is in the process of listing, it is mandatory from 1/4/2017. For unlisted enterprises for whose net worth is greater than 250 crores, then they need to comply the Indian accounting standard at the time of preparation of their financials. 1/4/2015 voluntary, 1/4/2016 for listed or unlisted if net worth is greater than 500 crores. From 1/4/2017 for all the listed enterprises irrespective of their net worth, for unlisted enterprises if net worth is greater than 250 crores. Next, come to banking companies. Sir, still implementation is deferred. Actually, first they introduced, again RBI provided a circular that we can just defer the applicability of the IND AS to the banks. So that's when right now all the banking companies they are not preparing their financials not as per IND AS, as per the regulation of the banking regulation act 1949. As per the regulations of the banking regulation act 1949, simply just they followed. Now come to the NBFC. Sir, what exactly the meaning of NBFC? I can't tell you at that particular point of time. You have a separate chapter called NBFC in your group 2, where I detailedly explain, or if you can see the marathon related to group 2 also, you can easily understand the meaning of NBFC. For the listed or unlisted NBFC, if it is greater than 500 crores from 1/4/2018, then which is mandatory, that means before 2018 there is no mandate. From 1/4/2019, if it is a listed enterprises or unlisted enterprises net worth is greater than 250 crore, then which is mandatory. So in case of insurance companies also, IRDA deferred till the further notice. Whenever they issued the relevant notice, then applicability of IND AS is coming to the picture. This is the applicability of the Indian accounting standards to the Indian companies and banking companies, NBFCs, as well as insurance companies. Okay. Sir, now in this introduction to accounting standards, what are the different things we learned, sir? Who issued the accounting standards in case of corporate entities, in case of non-corporate entities? The objective behind the introduction of a particular accounting standard we've seen. How an accounting standard in general is set up by the Accounting Standard Board of ICAI we've seen. What are the different accounting standards are there globally as well as in India we've seen. I mean, in globally IFRS, IAS are there. In India, existing accounting standards and IND AS are there. How the IND AS and IFRS differs in terms of their terminology, or in the terms of not resulting into carve out, in terms of resulting into carve out and resulting into carve in. And we also seen the applicability of the existing accounting standards in between the corporate entities and the non-corporate entities. Non-corporate entities divided into level 1, level 2, level 3, level 4 enterprises, and the corporate entities are divided into non-SMC and SMC. The criteria for level 1 and non-SMC both are same. We've seen the different criteria as well as different exemptions. That is the full exemptions and partial exemptions applicable to level 2, level 3, level 4 and SMC enterprises also we've seen. Am I right? This is the basic introduction to accounting standards. Sir, one more chapter is there, which is framework for preparation of financial statements, which also very much important chapter. Why I'm telling it as very much important chapter? In the last examination, almost 2 different 5 marks question, 2 5s are 10. The chapter is very small, but 2 different questions actually tested from such framework. There is a high possibility to ask questions in the next future sessions, either from the introduction to accounting standards or the framework. For let me continue a framework for preparation and presentation of financial statements now. So right, coming to framework for preparation of financial statements. First, let us start the discussion with meaning of the framework. What exactly framework of preparation of financial statement means? Which is the basic structure or assumptions on which financial statements are going to prepare. On which assumptions the financial statements are going to prepare. Sir, in generally, the common meaning of the framework means, which is a basic structure. Am I right? Framework, certain rules and regulations on which the financial statements are going to prepare, are the assumptions which you need to follow at the time of preparation of financial statements, or what is the structure you need to follow at the time of preparation of financial statements we are going to see. You may have a doubt that, sir, this framework is developed by whom? This framework is ultimately developed by Accounting Standard Board of ICAI itself. ASB of ICAI itself developed this entire framework. But at the time of introduction of accounting standards itself, I clearly told you, sir, accounting standards will not prevail the statute. I mean, if any provision is there in any act like Companies Act 2013 or any other specific act, the provisions as per that statute will prevail than provisions in accounting standards. Then provisions in accounting standards will prevail than provisions which are going to discuss in the framework. So that's why I clearly given this prevailing structure. So the first importance we should need to give to the statute, then accounting standards, then finally framework. I mean, accounting standards will work under the purview of the statute. framework will going to work under the purview of the accounting standards. Okay, so then ultimately in this framework for preparation of financial statements, what you are going to discuss, sir? We are going to discuss what are the different components what are the different components we will see in case of financial statements, or in such financial statements certain other components in individual each and every balance sheet or statement of P&L will contains, like asset, liability, I mean the residuary interest like equity, the income, expenses. Such definitions also we are going to see. Then what are the good characteristics of the financial statements? What are the qualitative characteristics of the financial statements? We are going to see. We are also going to discuss certain fundamental accounting assumptions. Here itself I discuss now what are the assumptions on which financial statements are going to prepare. Certain fundamental accounting assumptions also we are going to see, which is also form part of AS1 disclosure of accounting policies. Then we will see the concept of capital maintenance. I will explain one by one for better understanding. So first let me take up the concept component of financial statements. You already know through the chapter financial statements of companies, we've seen what are the different statements are form part of the financial statements. That is balance sheet, statement of P&L, cash flow statement, notes and explanatory materials. Notes means notes to accounts to the financials. Out of which balance sheet will tells what is the objective of preparation of balance sheet. It will shows financial position of an entity. Financial position means how much it is worthy in terms of assets, how much it is liable. That is nothing but financial position. Statement of P&L, the objective of preparation of statement of P&L is knowing the performance of a specific time period of that entity, that is profit or loss. The objective of preparation of cash flow statement is knowing cash flows from different activities for decision making purposes. Balance sheet and statement of P&L is going to be prepared based on schedule 3 format. We already seen. Cash flow statement we will discuss in later sessions. That is the entire cash flow statement is going to be prepared based on accounting standard 3. So the same objective of financial statements given here: balance sheet financial position, statement of P&L performance, and the cash flow statement cash flows. Next, sir, who are the users of the financial statements? Ultimately, enterprise is going to prepare the financial statement, right? The basic compliance is the responsibility of the management to prepare the financial statements as per the Companies Act 2013. Now, ultimately, the financial statements, who will use? The first and foremost user is investor or the shareholder, to take the various decisions. Employees will also use such financial statements because based upon the performance of the entity, they will decide whether we can continue with the organization or not. So their remuneration also matters for them, right? Then suppliers are creditors. That is the persons who providing the credit facilities in terms of supplying the raw material. Okay, they are also eagerly waiting for the financial results because whether how much credit period they can maintain, they know the liquidity position, whether the company can able to repay the entire amounts to them or not on time. They will check all such issues. Customers, that is debtors. Sir, how far the company will going to continue? Because the going concern of the entity will also depending upon the financial results of the entity sometimes. Because if an entity is continuously suffering the losses, then no one can want to continue their business activities. At that point of time, they cannot buy goods from our entity. That's why customers are also eagerly waiting. And the government at large, because for the purpose of getting taxes. Am I right? So society at large. So the entire society will also eagerly waiting for users of the financial statements, like credit rating agencies, because the credit rating agencies will provide the credit rating based upon that the bankers whether they can able to lend money to such specific entity or not. So that's why each and every entity, that is banker, government, society, credit rating agency, customers, suppliers, employees, investors, all the persons are eagerly waiting for financial statements. Those are the users of the financial statements. Next, Sir, why I used the government, not only the taxation. In case of MCA, Ministry of Corporate Affairs, each and every company should need to file two forms, MGT 7A and AOC 4. AOC 4 is with respect to the financial statement, MGT 7A is with respect to the annual return. Both they should need to file within 30 days of conducting the annual general meeting. They should need to file a AOC4 within 60 days of conducting the AGM. They need to file the MGT7A. Those are the practical scenarios you are going to see in your articleship. Okay, so that's why government is also one of the users of the financial statements. Next, I told you we've seen certain fundamental accounting assumptions as well. What is the meaning of fundamental accounting assumptions, sir? Fundamental accounting assumptions means these are the basic assumptions with which financial statements are prepared. Inbuilt at the time of preparation of financials of each and every enterprise mindset, these assumptions will be inbuilt. Do you understand? And these are inbuilt assumptions. That's why if the entity is prepared based on such fundamental accounting assumptions, no need to provide a separate disclosure. But if such entity is violated while preparing such fundamental accounting assumptions, then such fact should be clearly disclosed. That's why I clearly wrote that if such fundamental accounting assumptions followed while preparation and presentation of financial statements, no need to provide any disclosure. But if such fundamental accounting assumptions are violated, then that enterprise should need to provide a separate disclosure as per accounting standard 1. The same term also clearly given in the framework for preparation and presentation of financial statements. So then what are such fundamental accounting assumptions, sir? Going concern, accrual, consistency, GAC. Going concern, accrual, consistency, out of which accrual concept we already seen through the basic the fundamentals of accounting. Am I right? So where I discussed the outstanding expenses, income received in advance, receivable income, okay, that is prepaid expenses, all such issues we've seen. That is as per the accrual concept. If a particular transaction or event was occurred, it should need to be recorded in the books of accounts. It should not be recorded on the cash basis. Accrued and due, accrued but not due, what is the reference? All such things I already discussed. That's why again I don't want to discuss anything about the accrual concept. If you already inbuilt, if you prepare your financials based on the accrual concept, no need to provide separate disclosure. But if you violated, I mean, you are not recording the outstanding expenses. What is the reason for not providing the accounting treatment based on the accrual concept? You can clearly provide a disclosure. Do you understand? Now come to the going concern concept. Sir, what about going concern concept, sir? Unless otherwise specifically mentioned, the entity will not curtail their business operations in the foreseeable future. I mean, the entity is not going to close in the nearest future. The entity will continue. Their business operations. Sir, why the type of assumption need to be taken at the time of preparation of financial statements? If I didn't took the type of assumption, then the concept of closing stock itself is meaningless. When the concept of closing stock will be occurred, if your enterprise is going to be continue in the next year, sir, if you are not able to continue your business in the next year, then what about the concept of closing stock? Maybe certain point of times we are going to measure the property, plant and equipments on historical cost basis. If you are following the cost method as per AS10 property, plant and equipment, I not discussed anything related to AS10, but as a base point, I told you as per AS10, the enterprise can able to measure as on balance sheet date either following the cost method or either following the revaluation method. If the entity is adopting the cost method of measurement, then each and every property, plant and equipment, it is going to measure at the historical cost after reduction of the accumulated depreciation. Then if your entity is going to close in the near future, then still why you are following the cost method? Because your entity is going to close means your entire business is going to sell in the outside market. Then each and every individual property, plant and equipment have their different realizable value while compared with the existing historical cost value. Do you understand? So that is the reason why if your entity is able to continue business operations in the foreseeable future, then the accounting treatment is in general But if your entity is not going to continue your business operations in the future, then different accounting treatment need to be adopted. Do you understand? So that is the reason why if the entity is by default inbuilt, if they are just continued their business operations as like that, then there is no need to provide a separate disclosure. The normal accounting treatment they can provide, that is, they can record the closing stock at cost or NRV, whichever is lower. They can continue the historical cost base of measurement of the property, plant and equipment. But if once the fundamental accounting assumption of going concern is violated, the company is going to close in the near future, then the same fact should need to be disclosed. And you should also change your accounting treatment that at that particular point of time, all the assets and liabilities should be measured on realization basis, not at their cost basis, or you should not apply the normal accounting principles as per the normal accounting standards. You should measure all the assets as well as liabilities based on realization basis. Do you understand? So that is the reason why if fundamental accounting assumption of going concern followed, no need to provide a separate disclosure. If you are violated, you should clearly provide a disclosure. Then come to the concept of consistency. Unless otherwise specifically mentioned, the accounting policy which you adopted in the previous year, the same accounting policy you followed in the current year as well. So first, what is the meaning of accounting policy here? Actually, intentionally, I hide the concept of accounting policy because we are going to discuss the meaning of accounting policy in AS1. Okay, but anyway, here time permits to discuss about the concept of accounting policy. First, let me discuss the meaning of an accounting policy. Accounting policy is an accounting principle and methods adopted to follow such accounting principles. It is an accounting principle or methods adopted to follow such accounting principles in preparation and presentation of financial statements. I'll give an example, then you can easily appreciate the concept of accounting policy. You know, as per AS2, inventory is going to be measured at cost or NRV, whichever is lower. So this principle is applicable for other than raw materials. Why I'm going to explain in the next slide itself, which is the concept of inventory valuation. So the basic principle is cost or NRV, whichever is lower, which is the principle. Principle means wherever you will go, whatever the enterprise you can take in, such enterprise should need to measure the inventory in India as on balance sheet date based upon this principle. That is nothing but an accounting principle. To follow that principle, the enterprise may adopt FIFO method, or the enterprise may adopt weighted average method, or the enterprise may adopt specific identification method, or the enterprise may adopt retail method. So they have certain methods of allowable methods of measuring the cost. So now to follow such accounting principle, I can adopt different methods. Such methods are also form part of the accounting policies. Now, what the consistency concept ultimately tells to us, if you are adopted one method of accounting policy in the previous year, the same method you should need to continue for the current year as well. That is nothing but consistency. Same accounting policy should be continued from time to time. But in certain exceptional circumstances, you can change. Certain exceptional circumstances, you can change from one accounting policy to another accounting policy. If a statute prescribes, statute means act. In Companies Act 2013, it is clearly told that all the companies should need to follow this method of measuring of inventory only. If I previously adopted another method, then I can change to the method which is prescribed in the Companies Act. That is nothing but if statute prescribes. Any accounting standard prescribes. Recently, when accounting standard is introduced as per that standard, so previously multiple options are there. Right now, such all options due to the standardization process, all options lapsed. Only one method you need to follow. Then at that point of time, you can change from the previous method to the current method for better presentation of the financial statements. If your enterprise feels that rather than adopting the old method, if you are accustomed to the new method, then the financial statement will show the true and fair view. For better presentation of the financial statement, then you can adopt the new method. Except in these three circumstances, you cannot change any accounting policy. In such circumstances, even though if you change an accounting policy, you are not categorized as non-violation of consistency concept, because the exceptions itself clearly prescribed in the standard itself. That is in AS1 itself, it is clearly prescribed. We can change one accounting policy to another accounting policy in these three circumstances. So that's why if you are not violating the consistency concept, no need to provide a disclosure. But if you are violating the consistency concept, sir, earlier one method I used, right now another method I am using, then you can provide the same fact under the disclosures. These are the fundamental accounting assumptions based on which the financial statements are prepared. I mean, unless otherwise specifically mentioned, it is simply assumed that our business is going to be continue in the future, and all the items, whether it is income or expenditure, asset or liability, is recorded on the basis of accrual concept. So all the policies which are followed in the previous year are going to be continued in the current year as well. So based on these fundamental assumptions, the financial statements are in generally prepared. If these are violated, no need to provide a disclosure. Sorry. Yeah, if they are not violated, then no need to provide a disclosure. But if any of the fundamental accounting assumption is violated, you can provide a separate disclosure. Okay. Next, come to the next issue, which is qualitative characteristics of the financial statements. Sir, what is the meaning of qualitative characteristics of the financial, sir? Attributes which increases the usefulness of the financial statements. Or financial statements are good enough when you can feel. Financial statements are betterly represented when we can said. If such financial statements qualify these attributes, then in generally we are telling that such financial statements are showing true and fair view, and such financial statements are presented in the better manner. What are such attributes? What are such attributes? Those are understandability, relevance, reliability, comparability. Sir, once upon a time asked a theory question for 5 marks. Please concentrate here. Understandability. If a person who have minimum knowledge on the financial statements or a minimum knowledge on such business activity, who is a financial illiterate, sorry, who is a financial literate, not illiterate, who is a financial literate, if he can able to understand the prepared financial statements by the management, then such financial statements are said to be in understandable manner. I mean, whatever the financial statements prepared, such financial statements should be understandable in nature for the persons who have the minimum knowledge on the finance. That is the attribute of the understandability. It should not be much more complicated. It should be so simple. It is a meaningful. It is an understandable. Relevance. Relevance means all the relevant information for the purpose of decision making of the investor should need to be present in such financial statements. Material information should not be avoided. What is the meaning of material information? If non-disclosure of such information will change the decision of the decision maker, if non-disclosure of such information will definitely impact the decision of the decision maker, then such information is a material information. Absolutely. Sir, relevance. I'll give a proper example here. Sir, our entity paid in the current year penalties to the extent of 10 lakhs, let us assume. But I have not disclosed separately such penalties under a separate head in the statement of P&L. Just I simply clubbed such penalties under legal charges. But do you think that clubbing of such penalties with the legal charges, is it relevant? No, because providing that information separately will definitely influence the decision maker, will influence the decision of the decision maker. Then at that point of time, it is better to provide the relevant information separately. That is the meaning of relevance. Next, coming to the reliability. Sir, what is the meaning of reliability? The financial statement should show true and a fair view. Such financial statement should not be prepared on bias. Such financial statement should not provide the positive corner to the particular set of people, which are independently prepared, which are reliable, which are free from misstatements, which are free from misstatement. Misstatement means which is any error or fraud, which is an error or fraud may be occurred due to omission or maybe due to intentionally, which should be free from such all misstatements. Then such financial statements are showing true and fair view. The financial statements are reliable in nature, effective in nature. Do you understand? Then only such financial statements are should to be presented in the proper manner. Then only the financial statements are prepared. Then only the financial statements are set to be prepared in the correct manner. Next, comparability. Ultimately, what are the financial statements you prepared? You should able to compare your company current year financials with the previous year financials, as well as your company current year financials with another enterprise financial statements within the same industry. That comparability feature is also highly necessary, because one of the objective of preparation of the financial statement itself is also for the purpose of decision making by comparing the two different enterprises financials. If such comparability is not possible, then financial statements may not provide the best results. Do you understand? So these are the minimum attributes. These are the minimum attributes. Should based on such things, based on such attributes, we are going to prepare the financials. That is understandability, relevance, reliability, comparability. So asked for 5 marks previously. Please allow you remember. The same thing also I clearly given in my material as well. What I discussed in terms, the same thing I put it here for understandability. Just a second. Oh my God, where it is. Yeah, so I will highlight here. Please concentrate. Readily understandable by the users with reasonable knowledge of the business as well as accounting. And the relevance, sir, relevance means all the material items, materiality, all the material items should be clearly included in the financial statements. A piece of information is said to be material if its misstatement can influence the economic decisions of a user taken on the basis of the financial information. Reliability, the information must be reliable. That is to say, they must be free from material error. They must be free from material misstatements. Comparability, comparison of financial statements is one of the most frequently used and most effective tools of the financial analysis. The financial statement should permit both inter firm and intra firm comparison. Inter firm means within the industry, one company financials with another company financials. Intra firm means our company current year financials with previous year financials. Okay, come down. Next, the next issue is components of the financial statements. I mean, what are the individual items we have both in balance sheet as well as in case of statement of P&L? One is asset, liability, equity. These terms I already explained in fundamentals of accounting through accounting equation. If you really remember what we learned, that is liabilities plus equity is equal to assets. Based on this only, I developed the accounting equation. That is assets plus expenses is equal to outside liabilities plus capital plus income. That is the larger form of the accounting equation. Okay, so out of this accounting equation, now he is going to discuss about the meaning of liability, the meaning of equity, and the meaning of asset. What exactly the meaning of assets are? Sir, asset is a resource controlled by the enterprise. Asset is a resource. The controllability is in the hands of the enterprise, which have the capability to generate the future economic benefits. Which is a resource. Resource means it have the reproducing capacity. Reproducing capacity of what? Future economic benefits. It have the capability to generate the future economic benefits, and the controllability is within the hands of the enterprise. What is the meaning of controllability, sir? The future economic benefits which generated from such assets can only be enjoyed by your enterprise, which are not available to use by the others. If you can able to restrict such usage by the others, then the controllability is said to be in your hands. So that's why to set to be a particular item as an asset, which should be a resource, and the controllability is within the hands of your enterprise, and it have the capability to generate the future economic benefits, then such particular item is known as asset. Then coming to the liability, sir, what is the meaning of liability, sir? Liability is a obligation, present obligation you need to incur now, which is a present obligation arised due to past events. I'll give one example. Sir, I purchased goods from the other party. Due to purchase, your enterprise became a creditor to the other enterprise. Am I right? So that's why the liability is a present obligation arised due to past events, and outflow of resources embodying economic benefit to settle that obligation is necessary. Outflow of resources, sir, after arising the creditor, you need to repay the amount to the outside party, obviously in the future, which is an outflow of resources, not only in the form of cash, maybe in the form of any other assets also. There is a necessity to repay that obligation, then such obligation is technically known as liability. Liability is a present obligation arising due to the past event, and outflow of resources embodying economic benefit to settle that obligation is necessary, then such present obligation is treated as liability. That is the definition of liability. Next, coming to the definition of equity, the equity is the residuary interest of the net assets. That is simply assets minus outside liabilities, which is residuary interest of the net assets. I mean, after realizing all the assets, out of such realizations, if you made repayment to the outside liabilities, what are the portion of the assets remaining in the entity is known as residual interest in the net assets, which is known as equity. Income is nothing but inflows to the entity, or there is increase in equity. Expenditure is nothing but outflows to the entity, there is a decrease in equity actually. Sir, based on this accounting equation approach, the recent examination, they asked one question. I'll show you the same question actually I covered in my regular course as well. I want to cover the same through in marathon as well. So please let me check that recent examination question. One second, I'll directly open such question with Google. Okay. Which is the recent examination question, guys. Intermediate course, paper 1 accounting, where question papers. December 2021. Fine. Which is the recent examination question, guys. So come to the last paragraph. Yeah, here it is there. Concentrate. Mrs. A is showing the consolidated aggregate opening balance of equity, liabilities, and assets of 6 lakhs, 4 lakhs, and 10 lakhs respectively. Just give a moment. I'll download it. That is a better idea, I think so. Yeah. Just give a moment, friends. Oh my God, but still it is in protected mode. We can't write anything. Okay, not an issue for me. So just only for reading the problem only, right? We are using only for reading the problem. No worries. I will explain the answer with my OneNote. Now all of you only please focus on the problem. So Mr. A is showing the consolidated aggregate opening balance of equity, liabilities, and assets of 6 lakhs, 4 lakhs, 10 lakhs respectively. That is, the equity is 6 lakhs and the liability is 4 lakhs. 6 plus 4 is equal to assets equal to 10 lakhs. That is as per accounting equation, you know. During the current year, Mrs. A has the following transactions. Point number 1, received 20% dividend on 10,000 equity shares of rupees 10 each held as investment. The amount of 70,000 is paid to creditors for settlement of 90,000. Salary is pending by 20,000. Mrs. A drawing is 20,000 for her personal use. You are required to prepare the statement of the effect of the aforesaid each transactions on the closing balance sheet in the form of assets minus liabilities equal to equity after each transaction. The same to same problem actually I covered in my material. I'll show you here. Sir, my material was prepared before evolving the examination related to the December 2021. But believe me or not, such type of problem was already covered in my material. So this is problem number 3. This is my material actually, if you check. So that is the reason why I told you I will clearly put my materials under the description of the below video. I will take it as a challenge. Each and every model I covered in my material. The persons who actually attended in the regular course, so without any hesitation, they can easily crack any type of problem, because the entire concept was covered 100%, and the all different types of questions by picking in the multiple resources of the Institute of Chartered Accountants of India. I clearly typed this material. Do you understand? So that's why I took a lot of efforts for preparation of this material itself with 100% without having any second thought. You can blindly follow my material to get good marks. I mean, the good marks is not an exemption. To get more than 90 marks, the material is more than enough. Okay, let it be. Leave it. Come back. Let me directly resolve such problem through my OneNote. Concentrate. The problem is related to, what is that? That is December 2021. Out of that, question number 6, A problem. So just they required the impact of all these transactions in that accounting equation. What is that accounting equation actually? Assets minus liabilities is equal to equity, or you can call it as like this as well. Assets is equal to equity plus liabilities. Both are same, right? Now, so opening assets given how much? 6 lakhs. Okay. And opening liabilities given how much? Sorry, opening assets given at 10 lakhs, not 6 lakhs, which is given at 10 lakhs, minus opening liabilities given at how much? Which are 4 lakhs, and equity they are getting 6 lakhs. This is the equation they are giving. Now, one by one transaction impact, let us have a look. Received 20% dividend on 10,000 equity shares of rupees 10 each held as investment. Now we had certain investments made in the another enterprise equity shares. Now we are getting a dividend. How much amount of the dividend we are getting? That is 10 rupees per share into 20% per share, 2 rupees, 10,000 into 2, 20,000. What is the entry at the time of receipt of dividend? Bank account debtor to dividend account. Am I right? Bank account debtor to dividend account. So dividend is an income. Income will be ultimately closed and transferred to P&L. That is dividend to P&L. Now the ultimate impact is there is increase in bank balance. There is increase in profit as well. Now, if there is increase in bank balance, it should need to be increased under assets. That is 20,000, which leads to 10 lakh 20,000 minus 4 lakhs. Sir, if there is increase in profits, automatically equity balance is increased, because equity is opening capital plus profit or loss. So current year profits are increased to the extent of 20,000. So which is 6 lakhs 20,000. This is the impact of the first transaction for accounting equation approach on accounting equation approach. Next, come to the second item. The amount of 70,000 is paid to creditors for settlement of 90,000. The amount of 70,000 is paid to creditors for settlement of 90,000. Sir, creditors we have 90,000, but as a full and final settlement, we made it as 70,000. Remaining is profit. So the amount of 70,000 is paid to creditors for settlement of 90,000. So now There is a decrease in creditors, liabilities for 90,000. So first 4 lakhs minus 90,000, which leads to 3 lakh 10,000. There is a decrease in bank balance of 70,000. 10 lakh 20,000 minus 70,000, which leads to 9 lakh 50,000. Now, due to which there is increase of 20,000 of the profit. Am I right? Now 6 lakh 40,000. Now you can cross verify the difference as well. 9 lakh 50,000 minus 3 lakh 10,000, which is equal to 6 lakh 40,000, because profit, there is increase in profit means there is increase in equity. That is the impact of the second transaction on the accounting equation. Next, come to the third transaction. Salary is pending by 20,000. If salary is pending by 20,000, what is the journal entry, guys? That is salary account debtor to outstanding salary account. Salary will be closed and transferred to P&L, that is P&L to salary. Ultimate impact, there is increase in liability, there is increase in expenses. If there is increase in expenditure, there is decrease in equity. First, increase in liability, how much? That is 20,000. So 3 lakh 30,000. There is decrease in profits. I mean, increase in expenditure means decrease in profits and decrease in equity. How much? 20,000, which is 6 lakhs 20,000. So there is no change in assets, which is 9 lakh 50. So 9 lakh 50 minus 3 lakh 30, which leads to 6 lakhs 20,000. Now come to the final transaction, which is a transaction number 4. Mrs. A's drawings 20,000 for her personal use. Mrs. A's drawing is 20,000 for her personal use means, which is the entry for drawings. What is the entry for drawings? Drawings account debtor to cash account. How much amount? 20,000 again. So drawings will be closed and transferred to capital, then capital to drawings, 20,000. The ultimate impact is there is decrease in asset for 20,000. There is decrease in capital also by 20,000. There is decrease in equity by 20,000 means here, which is 6 lakhs. There is decrease in asset also by 20,000 means here, which is 9 lakh 30,000. 9 lakh 30 minus 3 lakh 30, which is equal to 6 lakhs. This is the impact of each and every individual transaction on accounting equation. So 4 items. So just they asked for 5 marks. If you wrote correctly for each and every carries 1.25 mark, then you will be awarded 5 marks. Is it okay? This is based on framework for preparation and presentation of financial statements only. Come back. So till now we completed the meaning of framework, components of financials, objectives of the financials, users of the financials, fundamental accounting assumptions, qualitative characteristics of the financial statements, and the individual components of the financial statements, and the accounting equation approach impact due to each and every individual transaction. Next, come to the one of the final concept, which is measurement basis for financial statement components. Just a shocking fact here I'm telling you, this question is also tested in the examination. This question is also tested in the examination. The two concepts, the two beside concepts are directly tested in the examination. What are the different measurement basis we can use for these measuring these financial components? You know, the financial components means asset, liability, equity, and income and expenditure. To measure such components, what are the different measurement criteria we have? Historical cost basis, current cost method, realizable value method, present value method. I will explain one by one, which are dead easy. Historical cost method means price occurred at the time of acquisition of that particular asset, or price occurred at the time of incurring of such liability. Now the same price we are going to continue as on the reporting date, then which is known as historical cost method. Price occurred at the time of acquisition, that is at the time of original purchase, how much price you occurred, the same price if you are going to continue, which is known as historical cost method. Let us assume a building was purchased 10 years back at the rate of 10 lakhs. Now with the same value is going to show in the financial statement after reducing the depreciation, then such a method of measuring the buildings are known as historical cost method. Current cost method. What is the meaning of current cost method? Entry price. Sir, if you want to buy that building right now, how much price the enterprise is going to incur is known as current cost, which is known as entry price. To remember simply, entry price, to enter into the transaction, how much cost incurred right now, which is known as current cost approach. Price required to acquire the component of the financial statements currently. Then how much cost you incurred, which is known as the current cost approach. Coming to realizable value approach, which is known as exit price. If you want to sell that particular building right now in the outside market, then how much you would get from the society, which is known as realizable value method. Price at which component of the financial statement going to realize in the outside market currently, which is known as realizable value method. Present value method. What is the meaning of present value method? You are having one asset with you, right? From that asset, you may generate certain future economic benefits, certain future cash flows. If you make it the present all such future values, then how much value you can assign, that is known as measurement based under the present value method. For example, I can provide that building on rental basis. In future, I can enjoy the rentals for 30 years. Then if you take it all such rentals to the present value, how much value you will get it, which is known as the present value of the future economic benefits generated from that asset, is the one of the measurement basis. So total 4 measurement bases are there. One is historical cost, another one is current cost, another one is realizable value, another one is present value. I clearly mentioned such fact under my notes as well. I'll open, I mean my material as well. Just take a second. Yeah. So which is historical cost basis, current cost basis, realizable value, and present value. Historical cost is means acquisition price. Current cost is acquisition right now, that is entry price. If you want to acquire, how much cost it would be. Realizable value means if you are going to resell, which is exit price. Present value means present value of the future economic benefits. So the same question was tested again in the recent examination question under category 6 only. I will open that question, just a moment. I told you, right, 2 questions actually they covered in the framework. This is the other question actually. Yeah. What is meant by measurement? What are the basis of measurement of elements of the financial statements? Explain in brief. What is meant by measurement? What are the basis of measurement of elements of financial statements? Explain in brief. So I directly given in my material the measurement meaning itself. Measurement is the process of determining the money value at which an element can be recognized in the balance sheet or in the statement of profit and loss. The money value at which the component of the financial statement is going to be recorded either in the balance sheet or P&L is known as measurement process. Simply measurement process means assigning the monetary terms, assigning a monetary value to a particular element of the financial statements which is going to be recognized at which in balance sheet as well as statement of P&L is known as measurement process. So I clearly given, and the basis I already explained. Is it okay, guys? Which is asked for 5 marks. Fine. So this is the beauty of the concept of framework. In the last examination, they tested 2 questions from the framework. Okay. Get back to my power notes, guys. One of the last concept, which is nothing but capital maintenance. What is the meaning of capital maintenance? Comparison between opening and closing equity is known as capital maintenance. To be frankly speaking, capital maintenance is going to discuss about retained earnings. Retained earnings. You know, the meaning of retained earnings means how much current year profits actually stay with the organization. If the closing equity is greater than opening equity, that means certain retained earnings are within the entity. Certain retained earnings are within the entity. And one more thing I am telling you, always the entity should need to maintain the capital of the closing, at least it should be equal or greater than with the opening equity. Because if you are not maintaining the closing equity at least as like the opening equity, that means your net worth is going to be decreased. You are unable to repurchase your assets and liabilities because your closing equity is going to be decreased. Your closing net worth is going to be decreased. So that is the reason why, even though in the current year we got the huge profits, but out of such huge profits, how much amount of dividend we can declare, sir? We can declare the dividend up to the value at which the closing equity should be greater than the opening equity or equal to the opening equity. I'll give an example here. Please concentrate. Sir, opening equity value is 15 lakhs. We have assets minus outside liabilities at 15 lakhs. Current year, we get profits of 5 lakhs. Then 15 plus 5, it will become 20 lakhs. Now, let us assume we declared the dividend of 6 lakhs. Now, 20 minus 6, it will become 14 lakhs as the closing equity. Now, if you compare the opening equity with closing equity, then the closing equity is decreased by 1 lakh. To maintain the closing equity as equal to or greater than the opening equity, retained profit should be greater than or equal to 0. But here retained profit is -1. Because current year profit is 5 lakh, but if you declare the dividend of 6 lakhs means where is the retained profit? Retained profit is less than 0 here. That is the reason why the closing equity is less than the opening equity. If you want to maintain the closing equity at least equal to the opening equity, then the retained profit either equal to 0 or greater than 0. If you are declared the dividend of 5 lakhs, then at least the closing equity will be equal to the opening equity. But if the retained profit is if the retained profit is greater than 0, for example, if you declare the dividend of only 3 lakhs, at that point of time 5 minus 3, still the retained profit is 2 lakhs, then the closing equity should be greater than opening equity. That means, sir, capital maintenance is nothing but how much retained profit you have, or the closing equity, whether it is more or less than the opening capital, how much. This is highly useful for the purpose of dividend decision making. So then how to calculate the capital maintenance? You know, capital maintenance is nothing but closing equity minus opening equity. For that measurement of capital maintenance, we have 3 approaches. I'll show you. We have 3 approaches. One is financial capital maintenance at historical cost basis, financial capital maintenance at historical cost basis, and another one is financial capital maintenance at current purchasing power, and another one is physical capital maintenance at current cost. What are these 3 different measurements, sir? Historical cost basis means all the assets and all the liabilities, that is component of the financials, we are going to measure it historical cost. Then we will calculate the opening capital, that is opening assets minus opening liabilities. In the same process, we will also measure the closing assets and closing liabilities based on the historical cost. Then the closing capital and the opening capital difference is nothing but financial capital maintenance at historical cost, which is opening and closing assets are stated at historical costs. Then we can calculate the capitals at different intervals, then which is known as the capital maintenance and historical cost basis. Now coming here, financial capital maintenance at current purchasing power. What is the meaning of this? Current purchasing power means, you know, right now, as on the balance sheet date, if you want to purchase that particular asset, how much cost would be, which is known as current purchasing power. So restatement at closing prices using average price indices. Sir, by taking the average cost of each and every component of the asset and liability, if you can work out the closing assets as well as the opening assets, both opening assets are also going to work out on the basis of the current purchasing power, as well as closing assets also you are going to work out on the current purchasing power. If you make a difference, which is known as the financial capital maintenance at current purchasing power, but the price what you are deriving is the average price, which is the average cost. In case of the physical capital maintenance under current cost, the approach is same, but on behalf of the average price indices, you are taking the specific price indices. You are taking the specific price indices. For each and every individual asset, you can consider the current value, how much it is. Average price indices means on a group of the assets, if you want to purchase, how much cost would be, which is nothing but average price indices. Specific price indices means for each and every individual asset, if you want to purchase, then how much cost it would be. That is nothing but specific price indices. That is the only difference between the last 2 methods. This is nothing but capital maintenance. Knowing the capital maintenance for the purpose of taking the dividend decisions. Okay, this is the final concept of in framework for preparation and presentation of financials. So actually 2 questions which they asked in the previous examination, I already discussed. The conceptual things also I clearly gave. Okay, next guys, so the next issue is AS2 inventory valuation we are going to discuss. Please all of you concentrate here. AS2 inventory valuation, we entered in discussion of the accounting standards, sir, which is very much important standard. Regularly for 2 attempts once, they quite asked the problem from this standard AS2 inventory valuation. So right, before seeing AS2, first I will tell you one thing, guys. I'll start the discussion with definition of an accounting standard. What is the meaning of accounting standard, sir? Accounting standard are written policy documents, which are written policy documents. Issued by whom, guys? These are issued by Accounting Standard Board of ICAI. These are written by somebody, you know who wrote, which is Accounting Standard Board of ICAI. They cover the aspects of recognition, measurement, presentation, disclosure. So accounting standard, any accounting standard you can take in, out of these four aspects, at least the accounting standard should discuss about one or more aspects, at least. For example, if you took the AS2 inventory valuation, which going to discuss about the measurement aspect. If you took the AS9 revenue recognition, which is one of the group 2 standard, which is discussion about recognition concept. If you take the AS3, which is the cash flow statement, presentation of the cash flow statement. If you take the AS1, which is going to discuss about the disclosure issue. So once upon a time, they asked the question, define the accounting standard and what are the aspects on which such accounting standards is going to cover. So accounting standard is a written policy document issued by Accounting Standard Board of ICAI covering the aspects of recognition, measurement, presentation, and disclosure. They might ask such type of questions also in the examination for 5 marks. Okay, fine. Let it believe it. Now come to AS2 valuation of inventory. Sir, any accounting standard, I'm not talking about AS2, any accounting standard, how the structure will be. This is the structure not given by me. This is the structure actually given by ASB. They itself developed the accounting standard, which is known as text of the accounting standard in this structure. Okay. They started with objective. What is the reason for introduction of this accounting standard, or what this accounting standard try to cover? Why this accounting standard introduced? Now, under the different terms or technical definitions, which they might commonly used to explain such standard. So first, they are giving the definitions as well for better understanding the standard. Scope, you know, you already seen the overall scope of the accounting standards under applicability of the accounting standards like corporate entities, non-corporate entities, level 1, level 2, level 3, SMC, non-SMC, such all things we already seen. But coming to this, the scope is individual accounting standard applicability. Is it okay, guys? So that is, we are going to see in the scope as well. Then the remaining aspects here, we may not tell in the proper way. They try to cover for recognition aspect, might the standard is for the measurement basis, quite the standard is for presentation issue, or it may be for the disclosure issue. Do you understand? So recognition means when that particular aspect should need to be recognized in the financial statement. Measurement means at which value it is going to be measured such component in the financial statement. Presentation means how it should need to be presented in the financial statement. Disclosures means what are the additional notes to accounts we can able to provide along with the financial statements. Those aspects are very much important while discussing the accounting standards. Those accounting standards are issued only to discuss about such aspects. So then coming to the inventory valuation, AS2, how such structure would be, sir? How such structure would be? I'm going to explain through my OneNote, concentrate here. So the AS2 inventory valuation structure. What are the different issues we are going to cover in AS2? You know already the basic structure of the accounting standard, which starts with objective. Here also we are going to see with objective. Then we'll discuss meaning. Then we are going to discuss about the meaning. I mean, the meaning means definitions, right? Definitions. Then we will see objective. Sorry, objective covered, right? Sorry, objective, definitions. Then scope. Scope or applicability. Anything you may call it here. Here, for which aspects we are going to discuss AS2 for measurement, the value at which the inventory is going to be shown in the financials, which is nothing but measurement. We are going to see in measurement, we are going to see separate measurement concept for work in progress and finished goods, and for separate measurement for raw material and supplies. Okay. Then after measurement, we are going to see what is the meaning of cost, or what are the different components involved in the cost. We're also going to discuss the meaning of net realizable value. What is the meaning of NRV? Okay, just here I'm putting what are the different issues we are try to cover, nothing else. Next, we are going to explain different techniques or methods used for measuring the cost, which are nothing but cost formulas used. Then finally, we will close the standard with disclosures. So this is the structure of the inventory valuation. Sir, out of which, first let us start the standard with objective. Sir, what is the basic objective of introduction of AS2, sir? AS2 is introduced with an objective of measure the inventory, to measure inventory at which value in the financials, at which value in the financial statements. That is the first and foremost objective is measurement of inventories, which is for measurement of inventories in the financial statements, both in statement of P&L, both in balance sheet, at which value I am going to measure. You know, in the statement of P&L, where we consider the inventory, that is change in work in progress, finished goods, stock in trade, raw material consumed. In so many items, there is a significance to measure the inventory. To know the values of inventory is necessary to know the correct profit or loss. But if you are not talking in the company point of view, if you are going to talk in either sole proprietor or the partnership firm point of view, to measure the opening stock or to measure the closing stock itself, we should require the inventory value. Am I right? That is in balance sheet under current assets, we are going to show the inventory. In both the statement at which value the inventory is going to be measured is the basic objective. And one more thing, the standard is also introduced for the purpose of prescribing the cost formula, because in one of the measurement criteria, you know, which is cost or NRV, whichever is lower, at which we are going to measure, out of which cost formula I can use. Is it FIFO method? Is it LIFO method? We are going to see all such cost formulas which we are in generally using for the purpose of measuring the inventories, and how the net realizable value also going to be measured. This standard will provide the guidance, sir, which is the main objective, which is the ancillary objective. Is it okay? Next, come to the definition. Sir, under the definition, which definition we are going to see, sir? We are going to see in the definition of inventory. Inventory is an asset, which is not a liability. That is the reason why we are showing under current assets. Under current assets, we shown the inventory. Inventory is an asset which is held for sale in the ordinary course of business. Held for sale in the ordinary course of business means either it is a finished good or either it is a stock in trade. Finished good means we itself manufactured our own. Stock in trade means we purchase and we resell. That is held for sale in the ordinary course of business. Ordinary course of business means in day-to-day business, what we are going to sell are used in process of production for such sale. Sir, to produce that finished good which might used, which is work in progress. Or here itself covers the raw material, but I covered the raw material separately in the third component. So anyway, just you can consider it as a work in progress, which is in process of production, in the process of production, which is under production process, which is work in progress, or the raw material, which is 0% of finished good, which is quite a raw material, which is used ultimately for the purpose of finished good, or any supplies, supplies means maintenance things, consumables, and loose tools, all are put together, we can call it as supplies. Sir, I will give certain examples for consumables. You might use the grease. You might use the grease for the purpose of putting the correct maintenance of the machinery, which is maintenance as a grease or a consumables. Maybe certain pins, nuts, bolts, they might consumed. Such are also form part of consumables. Loose tools means wrenches, toolkits, what you are using, such are known as loose tools. All things are form part of the inventory. Inventory is an asset held for sale in the ordinary course of business, that is either finished good or used in the process of production for such sale, which is work in progress, or raw material or suppliers. Now, my question is, sir, is it spare part, servicing equipment, and standby equipment? Is it inventory? First, sir, what is the meaning of servicing equipment? You know, spare part means another part we are using. Okay, spare part. If the original part, if the original part is facing any issues, then suddenly we can't stop the entire manufacturing process. So that is the reason we actually putting it in spare, which is nothing but spare part. Okay, that is replacement to another part, which is nothing but spare part. Servicing equipment. Servicing equipment means which will provide certain services. I'll give a beautiful example here. Fire extinguishers are there, right? Fire extinguishers. Sir, fire extinguishers, can I treat it as an inventory, or can I treat it as a other than inventory? I mean, other than inventory means property, plant, and equipment. Sir, these items are, can I treat it as an inventory or property, plant, and equipment? And standby equipment. You know, standby equipment means another additional equipment which in general we are not using unless otherwise the original equipment is damaged. You know, most of the times for four-wheelers, cars, one spare tire will be there, you know, right? Which is a standby tire. So whenever a particular tire is damaged due to punctures and all other issues, then we might change the standby tire, which is nothing but a standby equipment. In case of aircrafts also, actually they have the two engines. Once suddenly one engine is failed, then automatically they will run the aircraft with another engine, which is the standby engine. Do you understand? So such all things, is it form part of AS2 inventory, or is it form part of AS10 PPE? These actually I'm going to explain through accounting standard 10, guys. If such spare parts, servicing equipment, and standby equipment will satisfy the definition of the PPE, then those are categorized as per AS10 PPE. But if those are the not satisfy the definition of the PPE as per AS10, then such spare parts, servicing equipment, and standby equipment are categorized under AS2 inventory. So that means whether they are related to inventory or PPE, not decided by AS2, decided by AS10. You don't know the criteria when a particular item is PPE at this stage. If it satisfies the PPE definition criteria, then these are termed as PPE. Otherwise, we can classify it as an inventory. One more important question just I want to ask here, guys. Under the definition itself, based on the definition, I will ask one more question. What is that? Sir, is it empty bottles? Is it empty bottles? Can I treat it as inventory? This is one of the important practical question, quite multiple times already tested in the final examinations. Is it empty bottles? Can I treat it as an inventory? I'll give a practical question, then you can think and let me know. Sir, in a bar and restaurant, you know, generally the liquor is going to supply in such bar. How the liquor is going to supply? So the barrels itself, just they serve that liquid in the glasses, then the customers just they will drink the wine or what are the liquor, whatever they want. Then ultimately the bottles, whatever the bottles they have with their bar and restaurant itself. Now, such the liquor empty bottles is ultimately stored by such bar and restaurant, and after collecting the huge empty bottles, then the bar and restaurant may call for the tenders. then the person who quoted the higher amount, then they can simply sell it off. That is the procedure adopted in such bar and restaurant. Now the question is, as on balance sheet date, they have certain empty bottles in their godown. Then can I treat such empty bottles as inventory? That is my question. If I ask that question like that, you can't tell just like that the answer. Because first you should need to see the definition of the inventory. What is the meaning of inventory? Sir, inventory is an asset which is held by an enterprise, which is held by an enterprise to resale in the ordinary course of business. To resale in the ordinary course of business, held for sale in the ordinary course of business. Is it your ordinary course of business is purchasing of the bottles and reselling of the bottles? I mean, collecting the bottles and reselling of the bottles? No. Is it your business is used in production for such sale? Are you using such empty bottle for production of your wine? No. Is it raw material? That bottle is the raw material? No. Sir, is it any supply or a consumable? No. But still, even though it directly not satisfying the definition of the inventory, it is indirectly satisfying the definition of the inventory. How you know? Without taking the help of the bottles, can you sell your wine? Then in which medium you are going to store such wine? It is not possible to store such wine without having such bottles. That means such bottles are ancillary products. Such bottles are ancillary products for sale in the ordinary course of business. Without having such bottles, you cannot sell such product. So even though which is not directly used in the ordinary course of business, but to sell in the ordinary course of business, these are highly helpful. Without having such, you can't make that sale. So that's why such empty bottles are treated as inventory only. One more thing, guys, before directly discussing with the definition of inventory, you should also check one more thing. Asset. Inventory is an asset. Is it empty bottles is an asset? First, you can check that. What is the definition of an asset? Asset is a resource which is controlled by an enterprise and having the capability to generate future economic benefits or future cash flows. Now, coming to the empty bottles, which is a resource, yes, which definitely through sale of such resource, we will generate the future economic benefits. The control is within the hands of the bar and restaurant only, because once the customer, once the bar and restaurant served that wine to the customers, after that the empty bottles are stay with the bar and restaurant only. No one customer will take that empty bottles along with them. So they're ultimately stored in the warehouse, and the warehouse keys are kept with them only. So that's why the resource cannot be enjoyable by any other party. They can simply restrict the usage. They can simply restrict the benefit arriving from such empty bottles. So that is the reason we can simply tell the controllability is within the hands of the bar and restaurant only. So that's why, which is a pure asset, and the amount is also material, which is not immaterial. The amount is also material. That's why empty bottles we can simply read it as a inventory. So in the two angles, we can write the answer first. What are the two angles, guys? Why the inventory we can treat it as inventory? So it is an satisfy the definition of an asset. How it satisfy the definition of an asset? Which is a resource. Through making a sale, we will get future economic benefits, and the controllability is within the hands of the bar and restaurant only. So that's why empty bottles satisfy the asset definition. And another one is, even though which is not directly sale in the ordinary course of business, which is ancillary, which is useful for such sale made in the ordinary course of business. So that's why, even though it is an ancillary, it is mandatory. Without having that, we can't sell. So that's why empty bottles are treated as inventory. Sir, but if the amount is immaterial, you may not treat it as inventory. You may treat it as a scrap. So you know the difference between scrap and the stock. So scrap means you can completely make it transfer to the P&L in the year of occurrence itself. But in the case of stock, you cannot directly transfer to the P&L. When it is in generally make it sale, the year in which you are going to treat it as a sale. That is the difference between scrap and sale, scrap and stock. So if the amount is the immaterial, you can treat it as a scrap, but if the amount is material, you can treat it as a closing stock. So that is the thing I'm going to discuss related to the empty bottles. Can we treat empty bottles as an inventory? Yes, which is an asset, a resource controlled by the enterprise having the future economic inflows. So as on the balance sheet date, if the inventory is indirectly useful for the purpose of held for sale in the ordinary course of business, so which is the material amount, that's why we can treat it as an inventory. If it is immaterial amount, we can treat it as a scrap. So empty bottles are, we can treat it as inventory. So this is the thing related to definition. We already completed two things. One is objective, another one is definition. Now come to the scope paragraph, guys. Sir, scope. Is it this accounting standard is applicable to all type of inventories? Even though it satisfies the definition of inventory, for certain type of inventories, the standard is not applicable. Work in progress in case of construction contractor. For example, I'm a contractor. My business activity is building the buildings. I will hand over such building and will get money from my customer. That is my business. Now, as a contractor, as on the date of balance sheet, certain buildings are still is in progress. Then for such work in progress arising in case of construction contractors, is it AS2 applicable? No. AS7, there is a separate standard you are going to learn in your group 2, which is construction contracts. So work in progress arising in construction contract, AS7 is applicable, but not AS2. AS2 is not applicable. Work in progress for service providers, as like me. Service provider means I'm not in the trading activity, I'm not in the manufacturing of the goods. I'm simply providing services to my clients. Now, certain audit 30% is completed, which is work in progress for service providers. Is it for which AS2 is applicable? Sir, work in progress, can I treat it as an inventory? No, for which AS2 doesn't applicable. You know, in case of service providers also, the work in progress is applicable, but such work in progress, they may not treat it as an inventory as per AS2. The reason I will tell you, you performed 30% work, right? Is there any guarantee to get money basis on the basis of that 30% of the work? How you can treat it as an asset? Do you understand? But if you want, you can treat it as an asset under the debtors, but not under the closing stock. So that's why work in progress for service providers is not treated as an inventory. Next, if your enterprise is an investment enterprise, investment company, you are regularly making investments in various enterprises. Your ordinary course of business itself is purchase of investment and sale of investment. Then investment is a stock in trade for you. But still, even though the investment is a stock in trade, in general stock in trade is covered under the inventory definition, but still the stock in trade held as investment is not covered under AS2, which are going to covered under AS13. Shares, debentures, financial instruments held as stock in trade. For an investment enterprises, generally they are held as stock in trade, for which even though it is an inventory, AS2 doesn't applicable. Accounting standard 13, accounting for investment is going to be applicable. We are going to see an accounting standard 13 in our group 1 syllabus itself. Next, producers inventories. Producers inventories means like the farmers, they are going to produce the agricultural products. Agricultural produce will be there, na? Jawar, kapas, paddy, all such things are agricultural produce. Sir, agricultural produce is an inventory for a farmer. A person who is conducting the agriculture business, he may get the such agricultural produce from the agricultural plants. Is it, can I treat it as an inventory? It is an inventory, but for which AS2 doesn't applicable. Because for all such things, the measurement basis is applicable based on the NRV. I'll tell you another example. Sir, what is that? A poultry industry. In case of poultry industry, what will happen? They will regularly in the ordinary course of business, they will produce that hence, whatever the case may be, or maybe the X, what are the products they have. They can regularly produce such products in case of the poultry farms. Now, which is a producer inventory? For such producer inventory is an inventory for the poultry farm, but still they are not measuring such inventory based on the principles of AS2. Simply they will directly measure it on NRV basis. That is livestock. Livestock means all these goats, mens, which are related to animals, forest and agricultural produce, mineral, oil, ores and gases, which are naturally generated resources. For all such things produced inventories, AS2 measurement principle is not applicable, which is directly going to measure at NRV. In scope, totally, we discussed 4 issues. Work in progress arising for construction contract, AS7 is applicable, but not AS2. Work in progress arising in case of service providers, AS2 doesn't applicable. Shares, debentures, held as stock in trade, AS13 is applicable, but not AS2. Producers inventories, AS2 measurement principle not applicable, which are directly going to measure on the basis of NRV. So which is coming to scope paragraph, applicability paragraph. Next, come to measurement issue, guys. Come to the measurement issue. Sir, in case of measurement, the inventory, total we have mainly three types of inventory: raw material, work in progress, finished goods. You know, finished goods is 100% completed, work in progress is certain portion only completed, raw material is 0% completed. That is the difference. Now first come to work in progress and finished goods, at which value we are going to measure. You know, which is the common measurement principle, which is going to measure it cost or net realizable value, whichever is lower. Cost or net realizable value, whichever is lower. So then what about raw material and suppliers? At which value we are going to measure as on balance sheet date? The measurement is depending upon the measurement of the finished good. It is the measurement depending upon the finished good measurement. If the finished good is sold at above the cost price, if the finished good is sold at above the cost price, or simply if the finished good is sold at profit, or in bracket greater than or equal to cost price, then raw material is measured at cost price. Otherwise, at replacement cost. Otherwise, at replacement cost. Now, I told in layman approach. If I talk in technical manner, the finished good in which this raw material is used, the finished good in which this raw material is used, is going to sell at or going to sell at greater than or equal to cost price of such finished good, then the raw material is going to measure at cost price. If the finished good is going to sold at less than cost price, which is sold at loss, then the raw material is going to measure at replacement cost. Because raw material doesn't have the net realizable value. We are going to use such raw material for the purpose of production of finished good. What is the intention of the raw material? What is the intention of the purchase of the raw material? Is it for resale? No, it is not for resale. For the purpose of production of finished good. That's why the measurement of the raw material is simply linked up with measurement of the finished good. If the finished good is going to measure at, if the finished good is going to sold at greater than or equal to cost, then the raw material is measured at cost price. Otherwise, the raw material is measured at replacement cost. This is actually as like NRV only, but we are not calling it as an NRV. First, let me check about one by one components. Please, for the time being, you can put aside the measurement principles, because first you need to know what is the meaning of cost, what is the meaning of NRV, what is the meaning of this replacement cost. First, let me try to explain all such issues. Then again, I'll come back to the measurement principle. This is the heart of entire AS2. I'll explain one more time the measurement issue after discussing the cost, NRV, and the replacement cost. Now, all of you, please first come to the cost component. Sir, what exactly the meaning of cost, sir? What exactly the meaning of cost? Which type of components are included in the cost? Which type of components excluded in the cost? Come to my power notes. Come to my power notes first. Sir, what is the meaning of cost of inventory? I already told you, intentionally I ignored the measurement. Intentionally, I'm not explaining the measurement in deeper manner. So I'll come back, then I'll explain one more time. Now, first, all of you, please concentrate the cost of inventory. Cost of inventory comprising of cost of purchase, cost of conversion, and other cost. What is the meaning of cost of purchase, sir? Which is purchase cost. If it is the raw material, purchase price, at which price you are going to purchase, which is nothing but purchase price. Non-refundable duties and taxes. For example, if you are paying any customs duty in case of imports, if you are paying any non-refundable GSTs, such all things you can include another duties and taxes. Freight inward. Sir, now the material should come from the other person place to your places, right? What are the transportation cost incurred to reach that inventory to your location, which is nothing but freight inward. Any other cost incurred during this process. Any other cost means if you paid any commission, maybe certain point of times you might purchase that material through agent, any agency commission, loadings or unloading amounts, any insurance during the transit, such all costs are form part of cost of purchase. If any trade discount, if the other party allowed, you should need to reduce, because trade discount is not form part of cost of inventory. Trade discount is not at all recorded in the books of accounts itself. Rebate means quantity discount. If you buy in lots, if you buy the bulk amount, then he will provide certain additional discount, which is nothing but rebate. You can reduce that discount as well, then you will get the cost of purchase. Then after purchase of the raw material, to produce the finished good, you should need to incur cost of conversion. You might already learned the concept of cost of conversion in your cost accounting, that is in P3, I think so. So cost of conversion means cost incurred to convert raw material into finished good. Cost incurred to convert raw material into finished good. Sir, to convert raw material into finished good, what are the different costs you are going to incur? You are going to incur direct labor. Already raw material is there. That's why you cannot count raw material once again. Already raw material is there. To convert raw material into finished good, what are the different costs going to incur is known as cost of conversion. That is direct labor, direct expenses, and indirect material, indirect labor, indirect expenses put together, you can call it as overheads. Hope you know the difference between direct expenses and indirect expenses. Direct expenses are those expenses which can be directly identifiable with the production process. Indirect expenses are may not directly identifiable. Am I right? So just I told you the outlines only. In very deeper manner, you might already learn it in your cost accounting. Now, direct labor, direct expenses, and under the overheads, those are broadly categorized into variable overheads, fixed overheads. Sir, what is the difference between variable overheads and fixed overheads, sir? Variable overheads will vary in direct proportion with the number of units of production. But the fixed overheads are fixed irrespective of the number of units of production. For example, if you take the watchman salary, whatever the number of units you produced in such factory, the watchman salary is fixed, which is nothing but fixed overheads. But coming to the electricity consumed will vary along with the number of units of production. Am I right? So which is known as variable overheads. So rent of such premises is fixed irrespective of the number of units of produced, which is known as fixed overhead. So that is the difference between variable overheads and fixed overhead. Now, out of this, direct labor, direct expenses, and variable overheads will going to be absorbed on the basis of actual production. On the basis of actual production. Sir, what is the meaning of absorption, sir? Absorption means, let us assume, sir, in the current year, we produced 10,000 units. In the current year, we produced 10,000 units. The total direct labor expenditure is 1 lakh. Then per unit, how much, sir? 1 lakh divided by 10,000, which is 10 rupees per unit. The total direct expenses we are going to incur 50,000. Then what is the direct expenses per unit, sir? That is 50,000 divided by 10,000, which is again 5 rupees per unit. Sir, variable overheads, we incur total 50,000, which is 50,000 divided by 10,000 units, which is 5 rupees per unit. If you made it total direct labor per unit plus direct expenses per unit plus variable overhead per unit, then I will get 20 rupees per unit. What is the meaning of that? Sir, to produce a particular item, I incurred in the form of labor, expenses, and variable overhead per unit is 20 rupees per unit. Sir, if I produce 1 lakh unit, then these expenses should be 1 lakh into 20 lakhs. Do you understand? Which is the meaning of absorption on the basis of actual production. But now coming to the fixed overheads, fixed overheads are going to be absorbed on the basis of the normal capacity if actual production is less than the normal capacity. The same fixed overheads are going to be absorbed on the basis of actual production if the actual production is greater than the normal capacity. Before explaining this, first I will let you know what is the meaning of normal capacity. What is the meaning of normal capacity? Normal capacity is the capacity of the plant at which generally if the entity produce after considering normal losses. I mean, sir, the entire plant should require certain maintenance time. In the entire plant, certain point of time, the labor may work for lesser time in the as usual in certain peak times. After considering all such factors, what is the total number of units of production in generally if everything is going smoothly for a particular year is known as normal capacity. To give the better definition of the normal capacity, I'll explain through my material. Please concentrate here. Hope I given here the definition of normal capacity. Yeah, concentrate here. Normal capacity is the production expected to be achieved on an average over a number of periods or seasons under normal circumstances. That is after considering the normal loss and the loss of capacity all other, taking into account the loss of the capacity resulting from planned maintenance. So after considering the maintenance time and all such factors, how much production, how many number of units you are going to produce is in generally decided as normal capacity. Now, if the actual production is less than or equal to normal capacity, then the base factor you should consider it as a normal capacity. Sir, if the actual production is greater than the normal capacity, then fixed overheads is going to be absorbed on the basis of actual production. I will give you the reasons, sir, why if the actual production is less than normal capacity, the base you are considering as normal capacity. If the actual production is greater than the normal capacity, why you are taking the base as actual production? I'm going to explain through a small example. Please concentrate. Why? What is the reason why you are taking like that? Just a second. Concentrate here. Sir, here totally we are considering three cases. Case 1, case 2, case 3. Coming to case 1, normal capacity is 1 lakh number of units. On average, our plant is going to produce 1 lakh units. And the actual production also we produced 1 lakh units. And the total fixed overheads for that particular year was 10 lakhs. Then what is the fixed overhead per unit? Here, if you take the normal capacity as the base or actual production as the base, both are same. That's why 10 lakh divided by 1 lakh per unit is 10 rupees per unit. If you produce in the current year, let us assume if you produce in the current year at the rate of 10,000 units, then 10,000 into 10 rupees is the total fixed overheads. You can simply put it. Do you understand? Sir, if you have the closing stock for 5,000 units in your godown, then 5,000 into 10 rupees per unit, which is the fixed overhead per unit if normal capacity is equal to actual production. Now coming to the case number 2, normal capacity is 1 lakh units, but the actual production is only 90,000 units. You are producing at less than the normal capacity. You are producing at less than the normal capacity. And the total fixed overhead doesn't change now. Watchman salary and the rent of the premises, it doesn't change now. So that's why the fixed overheads is 10 lakhs. Now, if the actual production is less than the normal capacity, then the base you should need to be adopt is normal capacity. If the actual production is less than the normal capacity, then the base you can consider is the normal capacity. So the total fixed overheads 10 lakhs divided by normal capacity is 1 lakh unit. That is 10 rupees per unit. That is 10 rupees per unit. Now all of you please concentrate here. Please concentrate. So let us assume we have the stock in our example. In our example, the actual production is 90,000 units, right? Please consider all of you. If the actual production is 90,000 unit means how much overheads are included in that stock? Let us assume that is 90,000 into 10 rupees means 90,000 into 10 rupees means which is equal to 9 lakhs. So the total fixed overheads included in the stock is 9 lakhs. All of you, please concentrate. 10 rupees per unit means the actual production is 90,000 units. 90,000 into 10 rupees means 9 lakh worth of fixed overheads are already included in the stock. But what is the actual amount of the fixed overheads? 10 lakh. But you only consider 9 lakh worth of fixed overheads into the stock, right? Still 1 lakh worth is there, right? That 1 lakh worth is under absorption. Due to the lower actual production, you are having the under absorption of 1 lakh, which should be need to be charged to the profit and loss account as per your cost accounting methodology. That means in the current year, even though you incur the 10 lakhs worth of fixed overheads, but still you are only including 9 lakhs worth only into the stock. The reason is the actual production is not at par with the normal production. Your actual production is less than the normal production. That's why the under absorption you can charge it to the profit and loss account. But if you really included such 1 lakh also into the closing stock, unnecessarily you are increasing your closing stock. If you are increasing your closing stock, what will happen? If your stock is increasing, your gross profit is increasing. If your gross profit is increasing, your net profit is increasing, which is against the prudence concept. So why I am taking, if actual production is less than the normal capacity, why I am taking the base as normal capacity? To satisfy the prudence concept. Unnecessarily, we don't want to book the profit. Do you understand? So that's why I extended the example. So just to know the impact, if I took the base as the actual production, 10 lakhs divided by 90,000 on behalf of taking the normal capacity. If I take the actual production as the base, then fixed overheads per unit is 11.11 per unit. Then fixed overheads included in the stock is 10 lakhs, which is against the prudence concept. Then on behalf of showing the closing stock at 9 lakhs, if you are showing the closing stock at 10 lakhs, then there is increase in stock to the extent of 1 lakh, which have a direct impact in the increase of the profits. Unnecessarily, you are increasing your profits, which is against the prudence concept. To satisfy that, we are absorbing the fixed overheads on the basis of normal capacity if actual production is less than the normal capacity. Do you understand? You might listen the same story at different faculties, but my explanation is quite different. Here I am not only explaining the provision, I told you the background of the provision as well. Then you can easily store the provision impact. Next, come here on the basis of actual production. If actual production is greater than the normal capacity, sir, then here why you are using the actual production as the base? I'll tell you again by taking an example. If the normal capacity is 1 lakh and the total fixed overhead doesn't change, which is 10 lakhs, actual production is 1,20,000. Okay, because actual production is greater than normal capacity. First, let us follow the principle, actual principle. If I follow the actual principle, the total fixed overheads divided by base is the actual production, then per cost unit is 8.33. Per cost unit is 8.33. Am I right? Actual production is 1,20,000 using na 1,20,000 into 8.33. So the total I'm going to absorb on the basis of 8.33, then total 10 lakhs will be there under the closing stock. 8.33 into 1,20,000, then the total fixed overheads will be 10 lakhs. Then the total fixed overheads are there in the stock itself. But on behalf of considering the actual production, if I consider the normal capacity, then 10 lakhs divided by 1 lakh, which is equal to 10 rupees per unit. Then the actual production is 1,20,000. 1,20,000 into 10 rupees per unit. Then the total fixed overheads will get 12 lakhs. Is it total fixed overheads is 12 lakhs? The total fixed overheads is only 10 lakhs. It is not 12 lakhs. That means if actual production is more than the normal capacity, if you consider the normal capacity as the base, then you may absorb the more amount, which is greater than the actual fixed overheads incurred. But the actual fixed overhead incurred is only 10 lakhs. But if you take the base as the normal capacity, then the total fixed overheads will come to 12 lakhs. Do you understand the logic here? It's very quite simple. If normal capacity and actual production is same, anything you can use. Sir, if the actual production is less than the normal capacity, you should consider the base as normal capacity itself. The under absorption, you can charge it to the profit and loss account to satisfy the concept of prudence. If actual production is greater than the normal capacity, you should consider the base as the actual production. If you consider the base as normal capacity, then you would may absorb the more fixed overheads into the stock, which is quite against again the prudence concept. because if you are consider the total fixed overheads as 12 lakhs, which is actually greater than the actual fixed overheads that incurred, then if you consider the total fixed overheads as 12 lakhs, then the closing stock again increase, due to which profit again increase. That is the reason why if actual production is less than the normal capacity, the base we are taking as normal capacity. If actual production is greater than the normal capacity, the base we are taking as the actual production. That is with respect to fixed overheads. We are in the process of explaining things related to cost. If you really observe, we are in the process of explaining things related to cost. Am I right? Out of the cost, we already discussed two issues. Once again. One is cost of purchase, another one is cost of conversion. Cost of purchase includes purchase price, non-refundable duties and taxes, freight inward, any other cost incurred to bringing that inventory during that process. That is like insurance charges, loading and unloading, and trade discount and rebate you can reduce. And cost of conversion includes direct labor, direct expenses, and overheads, variable overheads, and fixed overheads. Direct labor, direct expenses, variable overheads absorbed on the basis of actual production. Overheads, that is related to fixed overheads, absorbed based upon the actual production is less than the normal capacity, based on the normal capacity. If actual production is greater than the normal capacity, based on the actual production. And coming to the other cost bringing the inventory to present location and condition. What are all the other costs incurred? Directly incurred to bringing the inventory to present location and condition. What are all the different other costs you are going to incur? Such all other costs are form part of cost of inventory. I'll give an example here. Sir, you are using certain molds. For the purpose of production of inventory. Can I consider such mold cost under the cost of inventory? Yes, absolutely, because such molds are necessary bringing that inventory to the location and condition. To put it in that shape, that mold is necessary. So that's why that mold cost I can include it into the other cost. All these are form part of cost of inventory. Next, sir, which costs are excluded from the cost of inventory, which is quite important at the time of writing the answers in case of practical questions. They might ask questions from this concept. Guys, all of you please concentrate. Which cost I cannot include in the cost of inventory? Interest cost. What is it all about, sir? Sir, I took a loan from the SBA for the purpose of purchase of raw material, and ultimately by using that finance, I purchased the raw material, I produced the finished goods, which is in my closing stock. At the year end, on the loan which I took, I paid the interest for 1 lakh. Can I add such interest to the cost of the inventory? Can I add the interest to the cost of inventory? The answer is not told by AS2. The answer will be explained through the help of AS16. As per AS16 borrowing cost, if the asset is a qualifying asset, then the interest cost we can add it to the cost of the qualifying asset. If the asset is not a qualifying asset, then the interest cost we should not be added to the cost of such qualifying asset. We should charge it to the profit and loss account. Then to understand that, first you should know one thing. What is the meaning of qualifying asset? Qualifying asset is an asset which takes substantial period of time for its intended use. Again, I am repeating. Sir, to add the interest cost on a particular asset or not is ultimately dealt by AS16. As per the provisions of accounting standard 16, borrowing cost directly attributable on the qualifying asset, we can capitalize, we can add it to the cost of the qualifying asset. If the asset is not a qualifying asset, then the borrowing cost incurred on such asset, we cannot be added to the cost of the asset. We can be simply charged to the profit and loss account. Then what is the meaning of qualifying asset? To complete that particular asset, if it will take a substantial period of time, for example, building is there, minimum it will take more than a year. Sir, to construct a plant, it should take more than a year. Is it your inventory to produce that inventory? Is it will take more than a year? Then you can consider the inventory as a qualifying asset. No. To produce the inventory, it will take more than a year, sir. So, to produce that inventory, if it doesn't take more than a year, it is not a qualifying asset. If it take more than a year, then I can treat it as a qualifying asset. Most of the times, all the inventories we can produce for less than 12 months only. That's why inventory is not categorized in general under qualifying assets. So that's why whatever the interest you incurred to purchase the raw material or for the purpose of production of finished goods, such interest cost in generally not form part of the cost of inventory. But if the inventory is a qualifying asset, in very remote cases, certain times the inventory is satisfying the criteria of the qualifying asset. I'll give an example. If you take liquor manufacturing companies, or if you take certain inventories, which might quite take more than an year. For example, railway wagons are there. My company is in the process of production of railway wagons, or my company is in the process of production of ships, in the manufacturing of ships. Now, for my company, the ships or the railway wagons, whatever the case may be, which are inventory. Now, to produce that inventory, I took certain loans. We are having certain interest expenses on such loans as on the balance sheet date. Now the question is, such interest costs, can I add it to the cost of my inventory? Yes, in that particular circumstances, those assets are qualified to set to be as qualifying asset, because to generate such asset, it will take substantial period of time. Then the interest cost, you can add it to the cost of inventory. Do you understand? So I'm taking back the liquor example. Just I'm giving the example of the manufacturing of aircrafts, or the manufacturing of ships, or the manufacturing of railway wagons, whatever the case may be. For that particular industries, the inventory is a qualifying asset. They can add the borrowing cost, that is interest cost, to the cost of inventory. Okay. So here I clearly given, if the cost of inventory, as per accounting standard 16, if the inventory is satisfied for qualifying asset, then interest on qualifying asset should be added. Then here also the cost of inventory we are adding. But if the inventory is not a qualifying asset, then interest is charged to the profit and loss account. We are not adding to the cost of inventory. That's why it is not straight away exclusion. It is depending upon whether the inventory is a qualifying asset or not. Hope you understand. Next, come to the second one, storage cost. Sir, can I include the storage cost into the cost of inventory? First, my question is it storage cost is necessary to bringing that inventory to present location condition? I mean, sir, the production process is over. Now the finished goods just we produce, the finished goods just now we stored. Our company is a watch manufacturing company. Now the watches, whatever the manufactured, just I stored in my godown. Okay. Now such storage is necessary for manufacturing of watches? No. Why you are storing? Maybe due to there is no lack of demand, or maybe you are producing much more goods than the demand. Maybe you have a certain gestation period for the purpose of transportation. Such and all are not the reasons which are. Is it necessary directly for the purpose of production of the inventory? No, that is not necessary. Even without storage also we can produce the goods. Yes, that happens. That's why at that particular point of time, storage cost is not from part of cost of inventory. But not like that. Certain special circumstances, storage cost is from part of cost of inventory. It is necessary to bringing the inventory to present location and condition. I'll give a classic example here. For example, we are in the process of manufacturing of alcohol. You know, in generally the alcohol is going to be manufactured with grape pulp, and they will add certain chemicals. So after mixing all such chemicals along with the grape pulp, the entire liquid is going to be stored in a big tanks under the bent of the earth. So they will cover up the entire storage tank with a big lid. It should not be disturbed for a particular period of time. So after getting certain inner chemical reactions, then it will slowly converting as a alcohol. You know, the quality of alcohol is increasing with the period of increasing of such storage as well. Now, the storage cost what you are incurred for the purpose of building such a big storage tanks and lids and the structures for such all things, what are the thing you incurred as it as a storage cost at that particular point of time, which is necessary to bringing that inventory to present location and condition, then at that particular point of time, you can include the storage cost to the cost of inventory. So that's why straight away interest cost is not excluded from cost of inventory. If the inventory is a qualifying asset, then you can include interest cost to the cost of inventory. If the inventory is not a qualifying asset, you can exclude. Coming to the storage cost, if that storage cost is necessary to bringing the inventory to present location and condition, then we can include the storage cost to the cost of inventory. No, which is not necessary, then storage cost is excluded from the cost of inventory. Next, come to the abnormal losses. Sir, normal losses are form part of cost of inventory, but abnormal losses are not form part of cost of inventory. What is the meaning of abnormal loss? Maybe theft, maybe it lost due to fire accident, maybe it lost due to floods, anything. Such type of abnormal losses are not form part of cost of inventory, but normal losses are form part of cost of inventory. Here I'm giving a classic example. This model are also regularly testing in the examination. Please concentrate. What is the example is all about? Sir, we required a petrol. We have the bunk. The petrol bunk is there in the Hyderabad, which is a central location. Now the petrol, the industry, the refining industry is there in Delhi actually. So in Delhi, the petrol is transported to the extent of 10,000 liters of petrol at the rate of 100 rupees. At the rate of 100 rupees. Now, yes, it more or less, it is more than 100 rupees right now. Quoting in the market, it is approximately at 110 rupees like that, depending upon city to city. Just I put it as 100 rupees. Now, after reaching the Hyderabad location, the tanker contains only 9,500 liters. Now, what about the difference of 500 liters? The difference of 500 liters, out of which 300 liters was evaporated due to the nature of the product. Okay, maybe in between the transportation, up and downs will be there, certain air flows will be there. So the petroleum itself have their nature of evaporation. So that's why, which is a normal loss, which is nothing but normal loss. But 200 liters is abnormal loss, maybe happened theft or maybe some other reason, which is an abnormal loss. Now the question is, now at the year end, coming to the Hyderabad location, at the year end, we have only 1,000 liters in our godown. Now the question is, calculate the value of inventory of the such 1,000 liters. The question is, calculate the value of inventory of 1,000 liters. We might sell during the year. Now we have 1,000 liters in our godown. Now, as a process of measuring the inventory, we should need to measure the 1,000 liters value. Now, first question. Initially, how many liters actually they transported? 10,000 liters. But out of which 300 liters were evaporated. 300 liters we lost due to the evaporation, which is a normal loss. Now, 9,700 liters actually we need to receive. Because abnormal loss just put aside. Out of this 9,700 liters, 200 liters is abnormal loss, but the actual liters need to be received is 9,700 liters. Now the cost of such 9,700 liters is 10,000 into 100, which is 10 lakhs. You should not multiply with 9,700 into 100 because normal loss is ultimately borne by the customer. We should need to increase the price per liter because it is the nature of the petrol. Who will bear that expense? Is it you? No. It should be ultimately borne by the customer itself. That is the reason I am not multiplying with 9,700. I am directly multiplying the total cost with 10,000. That is 10,000 into 100, 10 lakhs. If you check here, per liter cost, how much that is? Cost per liter is equal to 10 lakhs divided by 9,700. Then cost per liter is 103.09. Earlier, which is 100. But due to the evaporation, the cost per liter is increased to 103.09. Now, this 103.09, you can multiply with closing stock, which is 1,000 liters, 1,000 into 103.09, which is the value of the closing stock. So then what is the value of abnormal loss, sir? Abnormal loss value is 200 liters into 103.09, which is the value of the abnormal loss. I mean, with this illustration, what I can conclude? If normal loss is there, you can reduce the normal loss number of units to know the cost per unit. Automatically, you are including the normal loss into the cost. By reduction of the normal loss units, you are automatically including the normal loss to the cost of inventory. Do you agree? Because here the cost of inventory, to know the cost of inventory, you are multiplying with 103.09 means you are including the normal loss into the cost of inventory. That's why I shown here normal loss is added to the cost of inventory. But if the abnormal loss is there, Abnormal loss number of units, do you decrease it here while evaluating the cost per unit? You are only making division with 9,700 units. You are not making division with 9,500 units. That means abnormal loss, you are not included into the cost of inventory. You are separately work out the abnormal loss and you are charged to the profit and loss account. So that's why abnormal loss is not form part of cost of inventory. So this type of illustration, they are regularly testing in the examination. Please check. One more thing, administration expenses and selling and distribution expenses are also not form part of cost of inventory. Sir, maybe audit fee you paid in the current year. Can you add such audit fees also cost of inventory? Certain selling agents commission you paid in the current year, certain advertising expenditure you incurred, use such expenditure, can you increase in the cost of inventory? If you add such all expenditures, then the inventory value is increased like anything, due to which unnecessary profits you are creating, which is again against the prudence concept. That's why administration expenses and selling and distribution expenses are not form part of cost of inventory. So to put it simply, inventory cost comprises only three components: cost of purchase, cost of conversion, other cost. Under the cost of purchase, purchase price, non-refundable duties and taxes, and like freight inwards, and any other cost like insurance expenses and loading and unloading charges and rebates are going to be reduced, as well as trade discounts are also going to be reduced in case of cost of conversion. That is, direct labor, direct expenses, and variable overheads should be absorbed on the basis of actual production. And coming to the fixed overheads, we are going to absorb on the basis of normal capacity. If actual production is less than the normal capacity, we are going to absorb on the basis of actual production. If actual production is greater than the normal capacity, any other cost bringing the inventory to present location and condition, also we can include it to the cost of inventory, like molds, jigs, any cost is incurred in shaping up that inventory. Next, certain cost we may not take form part of the cost of inventory, which are like selling and distribution expenses, which are like administration expenditure. Storage cost is not form part of cost of bringing that inventory to present location and condition. If the inventory is other than a qualifying asset, then the interest cost are also not should form part of cost of inventory. Am I right? Next, one more thing, one more important issue just I want to explain here. Then I'll go back to the measurement concept. First, let me allow to explain the concept of net realizable value. Sir, what is the meaning of net realizable value? Because in the measurement, if it is other than raw material, like finished goods and work in progress, it is going to be measured at cost or NRV, whichever is lower. We already seen the components of the cost. Now we are going to discuss the meaning of net realizable value. Net realizable value means sale value of the finished good minus expenditure incurred to such sale. Maybe the brokerage, maybe the advertising commission, maybe the sales agent commission. Those are expenditure incurred to sale. If it is related to finished good, which is sale value of the finished good minus expenditure incurred to sale. Sir, but if it is a work in progress, then we should need to reduce, apart from this component, we should need to reduce further production cost to complete the product. Given certain examples here, we are measuring the NRV of FG. Sale price of the FG is 120, let us assume. Commission incurred to sell such FG is 5 rupees. Then the NRV of the finished goods, we can call it as 115. Coming to the work in progress, cost incurred till date was 60. Further processing cost incurred to complete it as a finished good is 30 rupees. So cost incurred till now 60, and further production cost to convert it into the finished good is 30 rupees. Now how to value the net realizable value? First, you can take the sale value of the finished good itself, because work in progress doesn't have any realizable value in the outside market. You can consider the sale value of the finished good. What is the sale value of the finished good? Which is 120 minus expenditure incurred to such sale, which is 5 rupees. 120 minus 5. Additional component also you should need to reduce further production cost to convert the finished good into the to convert the work in progress into the finished good. We require 30 rupees. You can reduce such 30 rupees as well. Do you understand? Now the NRV we are getting as a 85. So that's why NRV in case of work in progress is sale value of the finished good minus cost incurred for such sale minus further production cost incurred to convert the work in progress into the finished good. So first, if you convert the existing work in progress into the finished good, how much cost incurred also you should need to reduce to get the net realizable value. This is very much important if they ask the question from work in progress NRV. So NRV is nothing but simply realizable value minus expenses incurred to realize that product minus Further production cost incurred to convert the work in progress into the finished good. Okay, fine. Come down. Sorry, come above, not come down. Where I left actually, I left here. Under the measurement principle, actually I left. I told you in case of the measurement principle that is related to other than raw material and supplies, that is work in progress and finished goods, the inventory is going to be measured at cost or NRV, whichever is lower. Now you know the real meaning of the cost and what are the different components are included in the cost. You know the meaning of NRV, how to calculate the NRV for finished good, how to calculate the NRV for work in progress also you know. Now you will compare the cost or NRV, whichever is lower at that price, you will measure the inventory other than raw material and supplies. If it is related to the raw material, first you should check the valuation of the finished good. If the finished good is sold at or above the cost price, the finished good in which this raw material is used, sold at or above the cost price, that is sold at profit, then the raw material should be valued at cost price. If the finished good is sold at less than their cost price, I mean the finished good is valued at NRV at that point of time. If the finished good is valued at NRV, because if it is sold at less than cost price means NRV value is less than cost. Nah, if the finished good is measured at NRV, then raw material is measured at replacement cost. Then the raw material is measured at replacement cost. Sir, what is the meaning of replacement cost? Replacement cost is nothing but amount you will get at the time of replacement of that product, because raw material we are not purchasing with an intention to resale. If you want, you can replace the raw material at that particular point of time. How much you will get, that is nothing but replacement cost. Do you understand? Sir, for better thing, what we learn right now, with that basis, let me take up one previous examination problem which is quite directly asked the question from the measurement concept itself. Let me take up that question for the discussion, guys, which is the recently happened examination only. I mean Jan 2021, not that much of recent, that is before the recent examination. Okay, uh, yeah, please allow if you come to 1C here with the base measurement concept, what we learn, whether we can crack this problem or not, let us have a look. Mr. Jatin gives the following information relating to the items forming part of the inventory as on 31st March 2019. His enterprise produces product P using raw material X. Finished good is product P, raw material is X. Now, point number one, 900 units of raw material X purchased at the rate of 100 rupees per unit. Replacement cost of the raw material X as on 31st March 2019 is 80 per unit. Cost is 100, replacement cost is 80. In case of raw material, 400 units of partly finished goods, which is work in progress. In the process of producing P, cost incurred till date is 245 rupees per unit. The units can be finished next year by incurring additional cost of 50 rupees per unit, which is further production cost. Coming to point number 3, 800 units of finished goods P and the total cost incurred is 295 rupees per unit. What is the requirement? So before reading the requirement, one more point is there. What is this? Expected selling price of the product B is 280 rupees per unit, which is outside selling price of the finished good, subject to a payment of 5% brokerage on the selling price. So which is cost incurred to sell that product. Determine how each item of inventory will be valued as on 31st March 2019. Also calculate the value of total inventory as on 31st March 2019. Okay, come to my OneNote, guys. I'm going to explain the problem with the help of my OneNote. So this question is tested from Jan 2021 attempt. Once again, so just give some space here. Yeah. So which is tested from Jan 2021. So question is question number 1C. Question number 1C. Now they are given totally 3 components, right? They are totally given 3 components. One is raw material. Another one is finished goods. I mean, let me write work in progress. Then the last one is finished goods. I'll come from left to right. I'll come from left to right first. So first let us measure the finished goods valuation. So 800 units of P and the total cost incurred is 295 rupees per unit. Now the finished goods is going to be measured at cost or NRV, whichever is lower, right? Cost or NRV, whichever is lower. This is the basic principle of the finished goods. Now cost price is given how much? So cost price is given how much, guys? 295 rupees per unit. That is 800 into 295. Or NRV 800 into NRV here. The selling price is 280 and the brokerage they need to incur 5%. That is 280 into 95%. 800 into 280 into 95%. Whichever is lower. You can calculate here 800 into 295. 2,36,000 or 800 into 280 multiply with 95%. Here I'll get 2,12,800. Whichever is lower gate, that is at the rate of NRV. Whichever is lower means at the rate of NRV, which is 2,12,800. That is the value of finished good. Now coming to the work in progress, here also cost or NRV, whichever is lower only we are going to use. Whichever is lower. Now coming to the work in progress cost, 400 units cost is 245 rupees per unit. 400 into 245 or NRV 400 into, first I should need to work out the NRV of work in progress per unit. NRV per unit of work in progress. Let me work out how to calculate the NRV of the finished good, that is 280 minus cost incurred to sell that product, which is 5% brokerage na. 280 into 5%, which is 14, minus further production cost to complete the work in progress into the finished good. What is the further production cost? It is given 50 rupees per unit. So minus 50. Then you will get NRV per unit of work in progress, which is how much, guys? 280 minus 14 minus 50, which equal to 216 into 216. Now whichever is lower, 400 multiply with 245, which equal to 98,000, or 400 multiply with 216, which equal to 86,400. Whichever is lower, guys, that is 86,400. So this is measured at, again, NRV. So here I am writing, that is at the rate of 86,400. This is the final answer for work in progress. Now come to the raw material, guys. Now the valuation of the raw material is depending upon the finished goods. Is it finished goods sold at profit or loss? Finished good cost at 2,36,000, but they are selling at 2,12,800. So finished goods sold at loss. Then the raw material should be valued at replacement cost straight away. If the finished good in which this raw material is used sold at profit, then you might value the raw material at cost. So here now the raw material should be valued at replacement cost. Replacement cost per unit is directly given, which is 80 rupees. Now 900 into 80, which is 900 rupees into 80. How much it is? Which is 72,000. So this is the individual value of raw material, work in progress, and finished good. He also asked that determine how each item of inventory will be valued as on 31st March 2019. Also calculate the value of total inventory as on 31st March 2019. Therefore, total value of inventory. Total value of inventory is equal to raw material is 72,000 plus work in progress is 86,400 plus finished goods is at 2,12,800. Total how much? 72,000 plus 86,400 plus 2,12,800. So total is 3,71,200, guys. This is the value of inventory. So which is a direct question asked in the examination. Okay, fine. Come back to my power notes. So which is the measurement principle with respect to inventory other than raw material as well as raw material. Sir, what are the other issues, sir? What are the other issues we left? In the cost itself, I forgot to tell you one issue, which is joint and byproducts. Come to the joint and byproducts. I forgot here. Please come to all of you joint and byproducts. You might already learn this concept from your costing faculty. Sir, what is the difference between joint products and byproducts? In case of joint products, the production process is going to be continued jointly up to certain point of time. From there, it is going to divide into two different products. Then the two different products evolved after incurring certain specific cost. After incurring certain specific cost, having relatively some material value, then such two products are known as the joint products. Now in the same process, one product have the material value and another product have the immaterial value. Then the products are known as one is main product, another one is byproduct. Do you understand? They incur the joint cost. Now at a particular point of time, the point is known as split up point. After the split up point, individually for the two joint products, we incur certain specific cost. The cost incurred up to the split off point is known as joint cost. Now, the evolved two products are the material in value. Then the two products are known as joint products. No, one product is material in nature, another product is having the immaterial value. Then one product is known as main product, another product is known as byproduct. That is the difference between joint products and byproduct first. Then first, let me discuss the issue of joint products first. After that, we are going to discuss about joint and main and byproducts. Now, the question is, sir, in case of joint products, how to measure the value of inventory? How to measure the value of inventory? You know, the measurement of inventory, the principle doesn't change. That is cost or NRV, whichever is lower. But how to value the cost of such assets? The cost of such assets, because here up to certain portion joint cost is there. After this portion specific cost is there. You know the specific cost, the individual specific cost, but how to apportion the joint cost in between the two joint products is the matter of discussion here. The joint cost we are going to apportion to the individual units or individual products on the basis of sales value after incurring at specific cost. Sales value after incurring specific cost, that is at the end how much sales price they have, that is 20 rupees here, 30 rupees here, that is 1000 into 20 is to 500 into 30 rupees. In that ratio we are need to apportion. Or if they have certain sales value at split off point itself, then the selling prices at split off point also you can consider as the basis. I mean, here we are in the process of evaluation of the cost of the joint products. For that purpose, we know the specific cost. If you know the joint cost individually for the two products, then joint cost of the each product plus specific cost of that product, then you will get the total cost of that product. Then the total cost you can compare with NRV cost or NRV, whichever is lower is the cost of such product. Now in that process, how to apportion the joint cost in between the two products is the matter of discussion. Now the joint cost can be apportioned on the basis of the selling prices of the individual products after incurring the specific cost, or the joint cost may be apportioned on the basis of the selling prices at split off point if such joint products have having certain prices at the split off point itself. So that's why you can use sales value after incurring the specific cost or the sales value at split off point, any price you can use there. That is the concept of joint products. Now come to main and byproduct. First of all, byproducts are always valued at the rate of NRV. Always valued at the rate of NRV, because the value itself is immaterial. At how much price we can resell in the outside market, we can simply say, we can simply check with that price directly byproducts we will value. And the value of the byproducts we are not shown in the inventory as well. The value of the byproduct, that is NRV, we are ultimately reducing from the cost of the main product. So the NRV value of the byproduct will be reduced from the cost of the main product. Then the cost of the main product is going to be reduced to the extent of the NRV of the byproduct. That's why byproducts never we are considered as an inventory. Those are ultimately reduced from the cost of the main product. That is the treatment of main and byproduct in evaluating the cost of inventory. Hope you understand. Next, come to my OneNote, guys. So we are discussing, right? We are discussing the issues. Still, what are the pending? Just here I wrote now. Certain issues are pending. So where it is? Just a second. Objective over, definition over, scope over, measurement already discussed for work in progress and finished goods, and raw material and supplies also I discussed. Concept of cost and components, different components included in the cost we've seen. The meaning of NRV also I discussed. Now two more issues are pending. Techniques or methods used are the cost formulas used in evaluation of the such cost. First we are going to see. Please concentrate here. Come down. Right. Different cost formulas we can use to measure the cost, which also we can known as techniques of measuring the cost. I'll give an example first. Sir, in my godown, what happened? Totally we have 50,000 units purchased at the rate of 10 rupees, only related to one product. One product, let us assume the product is A. 50,000 units of A at the rate of 10 rupees purchased, 1 lakh units of A at the rate of 9 rupees purchased, 50,000 units of A purchased at the rate of 8 rupees. Total, at 3 different dates, we purchased at different rates, but the product is only single product. Now, out of this 50, 1 lakh 50 plus 50, 2 lakhs, total of 2 lakhs units. In the current year, we already sold out 1 lakh units of the goods. Then out of 2 lakhs, if 1 lakh units of goods are sold out, remaining closing stock is how much? 1 lakh units. Remaining closing stock is how much? 1 lakh units. Fine. Now, out of this 1 lakh units, if you can specifically identify which units are sold out and which units are there in the godown, if you can specifically identify, then you can apply the specific identification method. I mean, let us assume out of this 1 lakh units, just I'm telling you for the time being, I'm telling you, out of this total 2 lakh units, 1 lakh units are sold out. Now the remaining 1 lakh units are, let us assume, these only. Then 1 lakh into 9 rupees, 9 lakhs is the value of cost of the stock. That is nothing but specific identification method. No, sir, not like that. These 1 lakh, out of these 1 lakh are, the closing stock, these 1 lakh are 25,000 from first purchase units, remaining 75,000 units from second purchased units. These are ultimately sold out. We know clearly. Then 25,000 into 10 and 75,000 into 9, which is nothing but specific identification method. When, if you can able to identify specifically, the units which they are in the godown is related at which price, then you can apply the specific identification method. Okay, fine. Sir, specific identification method is not possible if you are unable to identify the goods lying in the closing stock is at which price. Maybe you purchased 50,000, 1,50,000 at different time intervals without having any procedure. Simply you issued. Maybe some units are issued these one, some units are issued these one. So all are clubbing, but you are unable to identify which price at which such goods are there in the closing stock. Then at that point of time, either you may apply FIFO method or weighted average method. Both methods are accepted by AS2. If specific identification method fails, then you can apply either FIFO method or either weighted average method. In case of FIFO method means, which is first in, first out. First in, first out means 1 lakh units sold out, right? First purchased 50,000 units you sold out. Out of the remaining 1 lakh, 50,000 units are also sold out. That means the remaining closing stock of 1 lakh units, 50,000 at the rate of 9, 50,000 at the rate of 8. That is 50,000 at the rate of 9, 50,000 at the rate of 8. You will get 9,50,000 as the closing stock under FIFO method. But if I follow the weighted average method, I thought of on average, all the goods are there in the closing stock. I mean, here 50,000 into 10, 5 lakhs, 1 lakh into 9 rupees, 9 lakhs, 50,000 into 8, 4 lakhs, which is the total cost of the total inventory divided by 2 lakhs. Then you will get the cost per unit, which is 9 rupees per unit. You can multiply with the closing stock number of units, which is 1 lakh into 9, you will get the 9 lakhs. In case of weighted average method, the formula is W1x1 plus W2x2 divided by W1 plus W2. Here the weight is number of units and the X is price of the unit. Then you will get the weighted average price. With that weighted average price, you can simply multiply with the closing number of units, then you will get the value of the closing stock. If specific identification method is not possible. Sir, FIFO method or weighted average method is also not possible, sir, for me, for my industry. Then you can apply certain costing techniques, what you are learn in your costing syllabus. Standard costing. In case of standard costing, you may work out standard raw material cost, standard direct labor, standard direct expenses, standard fixed overhead, standard cost of variable overheads. If you add all such standard cost, then you will get the standard cost of the product. But provided standard cost should be approximately equals to the actual. The variance is very nominal. The variance is not phenomenal. The variance is very much nominal. Then you can apply the standard costing, which is quite equal to the actual cost. Or else you can apply the retail method as well. If the specific identification method fails or the FIFO or weighted average method fails, then you can apply the retail cost method as well. So retail cost method is in generally suitable in case of the retail industries where the product's margin is uniform. The product's margin is equal. You know the MRPs, right? From MRP, if you reduce the margin, then you will get the cost price. So soaps, for example, if you take the soaps, more or less the margin is same. You may have Lux, Lifebuoy, Liril, Santoor, okay, Rexona, whatever the case may be. So so many soaps are there, right? So from the MRP, if you reduce the uniform margin, then you will get the cost of the inventory in very easy manner. So just according to the industry and the nature of your business, the suitable cost formula you can apply. If specific identification method is possible, you can go for the specific identification method. Otherwise, you can go for the FIFO or weighted average method. Based upon the, if your industry, if standards are equal to the actuals, then you can apply the standard costing method. If you are belongs to the retail industries method related to a specific item, you are having deal with more than one brand, more or less the margins are same, then you can simply reduce from the MRP margin, then you'll get the cost of inventory. These are the different costing techniques and the formulas you are going to use to know the cost of that specific product. Next, sir, before going to see the disclosure, first let me explain one more important issue. Sir, I told you in the measurement concept, whether it is related to work in progress and finished goods, you are comparing cost or NRV, whichever is lower, right? Now my question is, sir, can I compare the total cost of the entire inventory and the total cost of the NRV, whichever is lower? Or on individual item basis, I will provide the answer here. Comparison between cost and NRV, individual item by item basis, you should need to work out. Sir, A type of material is there or A type of finished good is there. You can compare the total cost of A and the total NRV of the A, that is individual item by item basis. But if the items are similar in nature, you can club the total cost and the total NRV of the similar items also, then you can compare. In generally, you are making the comparison on individual item by item basis. If such individual items are similar in nature, then by clubbing also you can compare the cost and NRV, then you can measure the inventory. Then finally come with the disclosures, guys. Sir, in case of disclosures, what are the additional information we need to provide along with financial statements? Accounting policy used for measurement of the inventory. What is the accounting policy? I told you accounting policy includes accounting principle or method adopted to follow such accounting principles. What is the principle you used for measurement of inventory? Sir, if it is a finished good or work in progress, which method you are used? Cost or NRV? Sir, if it is the raw material, the finished good is sold at profit, then raw material is valued at cost, otherwise at replacement cost. That policy or that principle you should clearly disclose. And the cost formula you used, which cost formula you used, I mean, are you using the specific identification method in measuring the cost? Are you applying the FIFO method? Are you applying the weighted average method? Are you applying the standard costing technique? Or are you applying the retail method? Which formula you used? Next, what is the carrying amount after measuring cost or NRV, whichever is lower, or in case of the raw material at cost or replacement cost? What is the value of raw material? What is the value of work in progress? What is the value of finished good? What is the value of loose tools? What is the value of stock in trade? For each and every individual item, the carrying amount you can clearly provide under the disclosure. So if you want, I will quickly open one company, guys, which is a BHEL. Just give a moment. How they are going to measure, I'll show you. How they are going to show their accounting policies under the disclosures. I'll show you here. So BHEL annual report. So just I taken, which is the 15-16 annual report. Let me directly go to inventory. Okay. Yeah. So please check here, all of you. This is the disclosures. They started the disclosing the things here one by one. Significant accounting policies now. So now under the disclosures, they clearly established the accounting policy need to be followed in case of the inventory. Now, in case of the inventory, what is the accounting policy they followed? Inventory is valued at actual estimated cost or net realizable value, whichever is lower. Cost or NRV, whichever is lower. Okay. So some things they are giving, right? So in respect of raw materials and component, loose tools, stores and spare parts. So certain cost formula they are using, weighted average cost formula they are using. Okay. So like that, the disclosures, they should need to be clearly provided. So this is the practical explaining of the policies followed by the BHEL actually, which is a Navaratna company, which is a government undertaking enterprise. Okay, come back. So this is the concept of inventory, guys. This is the concept of inventory as well as AS2. So if you want just a simple mind map, that is entire structure of AS2 also I given in my material itself. That's it. With this, I successfully completed AS2. But one more time, I'm repeating, guys. This is the marathon session. Don't expect each and every item with the roots in deeper manner. So the syllabus is huge. I need to try to cover each and every issue. So sometimes I'm pitching here and there. You can catch my flow itself. These classes are highly useful for the purpose for the persons who are already having certain knowledge on the accounting issues, but the revision part is too difficult for them. If they are listen these issues, then they can try to recollect the things. But for the beginners, I thought of this is not much useful, because for the beginners not knowing much things, they can directly go for the regular course first, then they can watch each and everything, then they can take up this revisionary sessions at the end. Okay. Hi all. How are you guys? Hope you all are busy with your lectures and your preparations, right? So till the last lecture, we covered total 10 chapters. Half of the syllabus is completed, guys, related to group 1 accounting. Still 10 more are there in the syllabus. I hope you all are enjoying with watching the lectures, and you can easily understand once the lectures all got completed, the entire content. And so once all the lectures got completed, I will also add up certain lectures related to the recent revision test papers as well as mock test papers, and analysis on the recent examination question paper. at the end. So once the 10 more are completed, after that 10 more are going to complete. After that, I'll put such lectures also for the purpose of benefit of larger audience. Okay, right. Now, today's video lecture, the chapter is accounting for government grants. You know, the chapter is very small compared with the past chapters what we deal. So the standard title is AS12, which is AS12 actually accounting for government grants. So please all of you put the heading in your notebook, AS12 government grants. First, I will tell you or I will discuss entire accounting standard 12 government grants in from our OneNote perspective. I mean to say, just I will give the entire introduction part as well as main content entirely in OneNote. So once I complete the entire part in our book, then I will shift it to my text and I'll start doing the discussion. Okay, please all of you concentrate here. Sir, in this standard, what you are going to discuss, that is overview. We will see always overview, right? In case of overview, we will discuss the following things. So, you know, the topic is started with introduction, or you may call it as objective as well. Then we will see definition part. Then we'll discuss scope. Then we'll discuss about accounting treatment. Accounting treatment at the time of receipt of government grant. Accounting treatment at the time of receipt of government grant. The same way, we are going to discuss accounting treatment at the time of refund of government grant. Finally, we will end the standard disclosures. So that is introduction or objective, definition, scope, accounting treatment at the time of receipt of government grant, accounting treatment at the time of refund of government grant. And finally, we will end the standard with disclosure. Such a small standard, guys. Now, coming to introduction or objective. Sir, why this standard is introduced? What is the reason behind the introduction of AS12? Accounting standard 12 is introduced if at any point of time entity received, if at any point of time entity received assistance like subsidies, cash incentives, duty drawbacks, extra. If entity received assistance like subsidies, cash incentives, duty drawbacks, etc. from government, how would we deal? Entity received assistance like subsidies, cash incentives, duty drawbacks, etc. from government, then which type of accounting treatment which type of accounting treatment needed at that point of time? For that purpose, AS12 is introduced as a separate standard. So that means here two things you need to observe. One is the assistant should received from the government. That is very, very important. Another thing is it should be in the form of assistance. It should be in the form of assistance. Then only the standard is applicable. Sir, if the assistant is not received from the government, the standard is not applicable. Even though we received something from the government, it is not in the form of assistance, the standard is not applicable. Am I right or wrong? So in the introduction or objective, what we know after seeing these things, to apply particularly the standard, the assistant should be in the form of government grant. Simply, it should be need to receive from the government. And another thing, from the government, whatever you are getting, this standard is not applicable. From the government, if you are getting assistance, that is in the form of grants, like subsidies, cash incentives, duty drawback, then only this standard is applicable. And the standard why introduced at the time of receipt of such assistance, which type of accounting treatment we are going to adopt, which type of accounting treatment needed in the books of accounts, what is the accounting treatment we are going to do. For that purpose, the standard is introduced. Next, coming to definition part, all of you. Sir, which definition we are going to deal in this standard? That is nothing but government grant definition only. Government grant definition. What is the meaning of government grant? Consider it, all of you. Just now we already told government grant is a assistance. It is a assistance provided by the government. Assistance provided by government in the form of monetary, or non-monetary. Anything may be possible. It is in the form of monetary or non-monetary. Government grant is an assistance provided by the government in the form of monetary or non-monetary with compliance of certain conditions. In compliance of certain conditions. Okay. That is, to put it simply, in compliance with certain conditions. Sir, government grant is an assistance provided by the government in the form of monetary or non-monetary in compliance with certain conditions by our entity. With the compliance of certain conditions by our entity. Sir, such conditions may be past conditions or may future conditions is also possible. So such conditions may be either past conditions or such conditions may be either future conditions. So now to put it simply, government grant is an assistance provided by the government either in monetary form or in non-monetary form with compliance of either past conditions or need to comply certain future conditions after receipt of government grant. So anything is possible. Now, coming to the definition part. So coming to the major issues of the definition part, monetary, what is the meaning of monetary here? Simply in the form of cash. Monetary means in the form of cash. Non-monetary means in the form of kind. Maybe government giving certain cash, maybe government giving certain non-monetary benefits, like it offered at free of cost land. Maybe it offered land at a concessional price. Maybe it given a plant and machinery at concessional price. Maybe it gives building for the purpose of construction of a factory at concessional rate, or maybe at free of cost. Maybe the godown they are providing at a they are giving cash for the purpose of construction of godown. That is 25% of the construction cost of the godown they are giving as a cash. Let us assume. So all these are, we can treat it as a in cash or in kind government grants. Right. So that is the definition of government grant, guys. So which is simply an assistance provided by the government, either in the form of cash or either in the form of kind. So in compliance with certain future conditions, or maybe due to already compliance of certain past conditions. Maybe anything is possible. Next. But two things should be need to it should comply. That is, one is it is in the form of assistant and it is provided by the government, and certain conditions need to be complied. If both the conditions satisfied, then only we will recognize the government grant in the books of accounts. That is simply I can put it under recognition criteria as well. I will discuss it later, that point. That is, I'll write that as recognition. Okay. After discussing the scope paragraph, I will discuss about the recognition. Not an issue. Now coming to scope or applicability, guys, all of you. Scope or applicability. Sir, government grant is applies to all type of entities except these are actually exceptions. I'm discussing only exceptions. Okay. As to GZ is applicable to all type of entities except entities in which I mean to say entities ownership in which government is part. Entities ownership in which government is part. What it means, sir? Simply is telling that government companies, for government companies. Sir, in case of government companies, the shareholding pattern, that is more than 50% shareholding, are in the hands of either central government or state government or other government oriented companies, right? Sir, and one more thing here, government includes either central government or state government. Anything may be possible. Okay. Now, one of the exception, entities ownership in which government is part. Sir, entities ownership means shareholding pattern. Am I right? Sir, in such shareholding pattern, if government is one of the owner, government is one of the shareholder, then for all the government companies, there are separate guidelines may be issued by the government in generally. For all such things, the standard is not applicable because the government itself is form part of the government itself is one of the part in such ownership. So at that point of time, a lot of benefits may be enjoyed by such government companies. Maybe certain budgetary allocations will also be there for certain for such a government oriented entities. Am I right? So at the time of receipt of all such benefits, the standard is not applicable. Why? Because such benefits are not specific to the entities. Such benefits are almost applicable for all the government companies. That's why this standard is not applicable for such type of entities. Okay. Next, point number 2. This standard is not applicable for the standard is not applicable for the amount received from the government other than for the assistance. I'll write like this: for the assistance. It may not be in the amount as well, right? So the standard is not applicable for the assistance received from the government other than in the form of government grant. So this standard is not applicable for the assistance received from the government other than in the form of government grant. I can give so many examples, guys, here. All of you, please concentrate. You know, as per Income Tax Act, we get certain benefits like tax holiday periods. Tax holiday period means tax holidays simply. I'll write tax holidays. Tax holiday period means those entities who are operating under special economic zones, tech parks, which are recognized by the government. Okay. For such entities, maybe for the period of 5 years, for the period of 10 years, no need to pay any taxes. Am I right? So such particular type of entities, they are also getting the benefit from the government, but it is not in the form of government grant. It is not in the form of government grant. You know why it is not in the form of government grant? This is not specific to a particular entity. Okay, because if any entity who wants to conduct the business activities in such special economic zones, then they will get the benefits. And one more thing, such benefits are derived due to a special act. So there is a which is evolved through the law. So that's why we may not be treated as a government grant. Next, tax holidays, then tax benefits based on investments, tax benefits based on investments, extra. So simply the taxation benefits, we may not count it as a government grant. That is the point he is telling. I can give one more example. Please consider it, all of you. If any assistance received from the government other than in the form of government grant. For example, I'll take this example. This is better. You know, all of you, the company is so-called as Bisleri, right? You know Bisleri. This is Bisleri, or this is IRCTC or Indian Railways. Anything you can take. IRCTC or Indian Railways. So one side, the company Bisleri is there. Another side, so the government, IRCTC or Indian Railways, which is the central government entities. Am I right? Now, Bisleri providing their services. Bisleri providing their services to IRCTC. What is that services? That is packaged drinking water. Am I right? Packaged drinking water. Packaged drinking water. So as a result of providing such service, that is packaged drinking water or sale of products, Bisleri company is getting something from the Indian Railways. Bisleri is something getting from the Indian Railways. That is, they are getting the cash from the Indian Railways. Now, Bisleri cannot tell that this cash is in the form of government grant. Why? Because for Bisleri, which is one of the trading operation, what I mean to say from this example, I can put this example number one. What I can say from this example, government grant can be differentiate from normal trading operations. So the normal trading operation of Bisleri in this case is selling of the packaged drinking water and getting cash from any entity, not only for the government. Am I right? Now this is in the form of normal trading operation of the Bisleri. So during such trading operation, it getting something from the IRCTC or the Indian Railways. How can you treat it as a government grant? So that's why I told you, whatever the thing you are received from the government is not a government grant. If you are providing service to the government, you will receive amount from the government as well. Am I right? But such things you cannot put it under a government grant. So that's why to put it, the amount or the assistance which is received from the government as a GZ, which should be different from the normal trading operation, then only we can call it as a government grant. So under the scope or applicability, we saw different issues. That is, so entities ownership in which government is part and parcel, then AS12 is doesn't applicable for such entities. And if the assistant is not in the form of government grant, that is like tax holidays and tax benefits, then the standard is not applicable. And the government grant should be differentiate from the trading operations, then only AS12 is applicable. If it is form part of one of the trading operation, if you are getting something and if you are getting something from the government, which we may not treat it as a government grant. Am I right? So we saw the objective, definition, scope. Now let me discuss about recognition part, guys. All of you please concentrate. Recognition. This is also one of the reasons for which AS12 is introduced, not only for the purpose of accounting treatment, for the purpose of defining the recognition criteria as well. Sir, when I should need to recognize the government grant into books of accounts, the first and foremost condition, to put it simply, entity have assurance to comply conditions attached with government grant. Entity have an assurance to comply conditions attached with government grant. Number two, it is probable that government grant will be received by the entity. It is probable means there are high chances that we are getting the government grant. If these two conditions simultaneously satisfied, then only we can recognize government grant. So entity have assurance to comply conditions attached with the government grant, and it is probable that government grant will be received by the entity, then only we can recognize such government grant into the books of accounts. So, the recognition means it should be recorded in the books of accounts. Then how we are going to record, that is the next level of discussion. Sir, before discussing about the accounting treatment, I will tell you one thing here. Concentrate. Sir, government grant accounting, will be possible either following capital approach or revenue approach. There are two approaches exist. One is capital approach. One is capital approach. Another one is revenue approach. So then can I follow capital approach or revenue approach? That is depending upon the type of grant you are receiving. That is depending upon the type of grant you are receiving, which approach I need to follow. We have to check. So government grant accounting is depending upon the type of grant you are receiving. Sir, what is the meaning of capital approach? What is the meaning of revenue approach? Capital approach means you can treat government grant as capital receipt, as capital receipt. Revenue approach means you can treat government grant as revenue receipt. So there are two approaches. One approach is capital approach. Another approach is revenue approach. Capital approach means you are treating government grant as capital receipt. You are treating government grant as revenue receipt. Then when government grant is treated as revenue receipt, when government grant is revenue receipt, is depending upon the type of the grant you are receiving. Am I right? So that one I will discuss right now. Now all of you please concentrate. This is accounting treatment. Accounting treatment at the time of receipt of government grant. Accounting treatment at the time of receipt of government grant. Concentrate guys, all of you. For example, we are receiving government grant as promoter's contribution. Then what is the accounting treatment? If you receive non-monetary government grant, if you receive non-monetary government grant, then what is the accounting treatment? If you receive monetary government grant, and finally we may check government grant related to revenue expenses. So totally we are dealing with 4 types of grants. If government grant received as promoter's contribution, in case of receipt of non-monetary government grant, monetary government grant received for depreciable fixed asset, or we can call it as PPE, or for non-depreciable fixed asset. Okay, please all of you concentrate. One by one, I am going to discuss. Sir, government grant received as promoter's contribution means you received the grant for which purpose? When promoter coming into the picture at the time of startup of any business activity. Now, the government grant is also getting by an entity for the purpose of startup of any business activity. That means government is providing assistance for the purpose of purchase of the fixed assets, for the purpose of startup of the business. Sir, I incurred 1 crore expenditure. Out of such 1 crore, 25% assistance is provided by the government for the business. That is 25 lakhs we are going to receive. Now, promoters' contribution is nothing but government will contribute something for the purpose of startup of the business. So simply a promoter's contribution means for startup of new businesses. If government provide anything as assistance, then as per the capital approach, we will treat it as a capital receipt and it should be transferred to the capital reserve. The reason is here, sir, government told that once we are giving this receipt, you never return back to me. You never return back to me. You can utilize such assistance for the purpose of startup of the business. Now, I'll write such facts. Please, all of you concentrate. Here, entity, that is business entity, receive GZ for startup of their businesses, and no need to return back after making investment. So it is transferred to, come on guys, all of you. So it is transferred to capital reserve. So it is transferred to capital reserve. That is a catchy point here, guys. So it should be transferred to capital reserve. Next, in case of non-monetary government grant. Sir, non-monetary government grant means there may be a scope of offering such non-monetary government grants at concessional price. Or maybe they offered that completely free of cost. Maybe they offered completely at free of cost. Sir, what it means actually? Non-monetary government grant means, in kind actually, kind. For example, let us assume government told that we offer the plant and machinery for you at a concessional price. Our government told that we are giving a building, we are allocating a building to you at concessional price. Now, if it is offered at a concessional price, then we are going to record such non-monetary item at their concessional price. What is the accounting treatment? Which is in-kind consideration, right? Not in the form of bank. Okay. Now here I'll write the here I'll write the journal entry as well. Please all of you check here. Bank account debtor to capital reserve. Okay. Now if it is offered at concessional price, then that is the building or plant and machinery account debtor to bank. Why? Sir, such building or plant and machinery, they are not offering at free of cost. They are offering at concessional price. Now I need to record at the rate of concessional price. CP is transfer concessional price. I need to record, I need to pay such price to the government. Then I'll get such plant and machinery as well as building on subsidy basis. Now at free of cost, sir, government will offer the entire building is at free of cost. Now at that point of time, what should I need to do? Sir, if I am not paying any single rupee to the government, then no need to record such plant and machinery or such particular PPE into the books of accounts. No, you need to record. At which value you need to record? At nominal price. At a nominal price you need to record. That is, sir, building account at to bank account, 100 rupees, 1000 rupees. That is up to you. For example, your business operations are in rupees crores, then you can report at 1000 rupees. Why you need to record? You know, sir, even though even though it is offered at free of cost, you are utilizing such plant and machinery or such building, right? It should be it was existed physically, right? Now, as an outside parties also, such item is in existence, such fact should be known to the outside parties as well, right? Sir, if such facts are known to the outside parties, when it should known? When it should known really? If they are presenting in the books of accounts, then at the time of conducting the audit, okay, auditor will also check that why this building is shown at that much of less price. Okay, that means something they are getting it as at free of cost from the government. Then the proper disclosures are given by the entity or not, also he will check. Okay, under the disclosures, one of the disclosure you should need to provide, if any property, plant and equipment, if they are getting at concessional price or at free of cost, then the fact should be clearly disclosed. Just now in the previous lecture only we completed AS10. I mean to say, just now we completed AS10. Am I right? Sir, in case of AS10 property, plant and equipment, at the time of assessment of cost of such PPE, government grant will also taken into consideration. Am I right? For the purpose of assessing the value of cost of the PPE, government grant will also impacted at that point of time. Am I right, guys? So that's why, even though if you are received at free of cost, still you should report under the books of accounts at a nominal price. But if you are getting such property, plant and equipment directly in the form of non-monetary government at grant at concessional price, you can record at such concessional price. Yes, guys. Now coming to monetary government grant. Now coming to monetary government grant for depreciable fixed asset. Actually, here two methods exist. Concentrate here, guys, all of you. Here two methods exist. Either you can follow method number 1 or you can follow method number 2. Sir, in method number 1, the government grant received in the form of money for the purpose of purchase of depreciable fixed asset. For the purpose of purchase of depreciable fixed asset. In method number 1, government grant GZ is reduced from cost of depreciable fixed asset. And depreciation will be provided, and the depreciation will be provided on reduced depreciable fixed asset value. Then depreciation will be provided on reduced depreciable fixed asset value. In case of method number 2, GZ is credited to deferred government grant. Deferred government grant. And credited to profit and loss account in proportion, and credited to P&L account in proportion of depreciation over the life of such fixed asset. I'll explain each and everything, no worries. First, let me allow to write. Now, all of you please concentrate. In method number 1, government grant is reduced from the cost of depreciable fixed asset, and depreciation will be provided on reduced depreciable fixed asset value. Let me take one example, guys, for better understanding, all of you. So let us assume the fixed asset cost in the outside market is 10 lakhs. Now I'm getting monetary government grant. Monetary government grant for the worth of 6 lakhs. I'm getting monetary government grant for the worth of 6 lakhs. Now all of you, and one more thing, useful life is 5 years. Residual value nil. This is the information, guys. Now what is the accounting treatment, sir? Sir, now at the time of purchase of fixed asset, that is a journal entry, normal journal entry, fixed asset account debtor, fixed asset account debtor, that is at which price we are going to purchase in the outside market, 10 lakhs. 10 lakhs to bank account. To bank account. Now, after purchase of this fixed asset, we are receiving the government grant in monetary form. In monetary form. Sir, if you are receiving the government grant in monetary form, then what is the journal entry? You are receiving, that's why bank account debtor, which is 6 lakhs. Under method number 1, it is clearly given that government grant is reduced from cost of the depreciable fixed asset. Now you can reduce the cost of the fixed asset, guys, by making credit to fixed asset account, that is 6 lakhs. Now all of you can tell with me, you can participate along with me. Now how much balance is there under fixed asset account? How much balance is there under fixed asset account? That is 10 lakhs debit, 6 lakh credit. Net 4 lakhs balance is there. Am I right? Net how much balance is there? 4 lakhs balance is there. Now at the end, you need to provide depreciation, right? That is depreciation account debtor. Net 4 lakhs is only there. 4 lakhs. Sir, scrap value is 0. Divided by 5 years is the useful life. How much? 4 lakhs minus 0 divided by 5, which is 80,000 is depreciation. Depreciation to fixed asset account. Now such depreciation should be need to be charged to profit and loss account. That is P&L account debtor to depreciation account. How much amount? 80,000. So let us assume the same facts are also applicable for method number 2 as well. In case of method number 2, all of you concentrate. The government grant is credited to deferred government grant account. It is treated as deferred government grant. So once you received the government grant, this is the common entry. What is the common entry? First entry is the common entry. You can write one more time, not an issue. Fixed asset account debtor 10 lakhs to bank account. This is common entry. Now, at the time of receipt of government grant, you should not reduce from the cost of the fixed asset. You should treat it as deferred government grant. That is bank account that are to deferred government grant account, which is also 6 lakhs, right? 6 lakhs. Now concentrate. Now at the year end, I need to provide depreciation, right? First, you can provide depreciation. On which value you are going to provide depreciation right now? Now the depreciation you are going to provide on 10 lakhs, which is 10 lakhs minus scrap value 0 divided by 5 years. So depreciation is 2 lakhs. It's not 80,000, which is 2 lakhs. To fixed asset account, which is also 2 lakhs. Now one more thing. In the balance of deferred government grant, you should make it credited to P&L. Government grant is credited to deferred government grant and credited to P&L in proportion of depreciation over the life of such fixed asset. Now, government grant is need to be credited to the P&L in proportion to the depreciation. Sir, over the period of 5 years, 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs means equal amount of depreciation. Now, this deferred government grant is also need to be amortized to the profit and loss account. Over the period of the useful life. Then how much amount you can make it credited to P&L? That is deferred government grant account at are 6 lakhs divided by 5 years. That is how much? 30,000 to profit and loss account, which is also 30,000. So the entry is deferred government grant account that are to profit and loss account. Am I right? Now depreciation anyway, you may charge it to P&L account, right? That is profit and loss account that are to depreciation. That is as usual. If you remember, I told you, sir, whether you followed method number 1 or method number 2, the impact is same. But you may have a doubt that, sir, how the impact is same, sir? Here you are providing a depreciation of 80,000. Here you are providing a depreciation of 2 lakhs. How the impact is same? Impact is different, huh? No, I'll prove here. Please all of you concentrate. Whether you followed method number 1 or method number 2, impact is same. I'll prove here. Please all of you concentrate. First, I'll start with impact of method number 1. Impact of method number 1. Please concentrate. Sir, in case of method number 1, if I go to P&L account, if I go to profit and loss account, may I know how much amount you are charged in the form of depreciation? P&L account are to depreciation 80,000, right? That is in P&L, depreciation is 80,000. That is the only impact in the P&L, right? Now let us see impact of method 2. Impact of method 2. Sir, due to method number 1, the impact is in the form of depreciation. We debited the P&L to the extent of 80,000. Impact of method number 2. Now, if I go to the P&L account, sir, here we gave two impacts. One is deferred government grant is created to P&L. That is in P&L by deferred government grant. Am I right? So 6 lakhs divided by 5 years. It's not 30,000 years. Sorry. Clerical mistake. How much it is? 1,20,000. 6 lakhs divided by 5 years, 1,20,000. So deferred government grant to P&L means in P&L by deferred government grant, 1,20,000. And P&L to depreciation means here to depreciation 2 lakhs. Now, if you check in profit and loss account, net debit is how much? 2 lakhs minus 1,20,000 means net debit is how much? 80,000 only. Here already in P&L account, debit how much? 80,000. That means whether you follow method number one, or whether you follow method number two, the impact is same. You are making the debit of 80,000 in the form of depreciation in method number one. So by crediting 1,20,000 for deferred government grant, by debiting depreciation 2 lakhs, the net debit you are also making in the form of 80,000 in method number two. That's why whether you follow method number one or method number two, it doesn't impact statement of profit and loss account. Am I right or wrong, guys? So now we are in the process of discussing accounting treatment at the time of receipt of government grant. We already done with government grant received as promoter's contribution, non-monetary government grant that is in kind at concessional price and at free of cost. Just now we discussed at the time of receipt of monetary grant related to depreciable fixed asset under method number one, method number two, what is the accounting treatment. Am I right? Now coming to non-depreciable fixed assets, all of you coming to non-depreciable fixed asset. Sir, in case of non-depreciable fixed asset, for example, conditions already complied, conditions complied in past. That means no need to comply in future. Non-depreciable fixed asset means I can tell like land, etc. So there is no depreciation on such fixed asset. The best example is land. We are getting a land at free of cost directly. Then non-monetary government grant is applicable. Then non-monetary government grant case is applicable. Here we are receiving cash for the purpose of purchase of land. Here we are getting cash after purchase of the land. Am I right? We already complete certain conditions, then we are getting certain cash after purchase of the land. Then what you should need to do, you should not reduce such cash from land cost. You should not reduce such cash from the land cost. You can treat the government grant as capital reserve. You can treat it as capital reserve. Already conditions complied in the past. Conditions need to comply in the future. Need to comply in future. Let us assume in future I need to comply certain conditions. Then the received government grant can be credited to P&L account in proportion of expenses incurred to comply those conditions. So please all of you consider here. Sir, we purchased a land. Now we are getting a government grant in the form of money. Sir, we already completed the conditions in the past. You can treat it as a capital receipt. You can directly transfer such amount to the capital reserve. Okay. Once again, you can directly transfer such amount to the capital reserve. Sir, conditions need to comply in the future, sir. Conditions need to comply in the future. Then what should I do? It can be credited to the profit and loss account in proportion of the expenditure incurred to comply those conditions. Why? Because you need to comply certain conditions, right? Maybe a certain land development cost you need to incur. Maybe such land you need to use for such particular purpose. Maybe for that purpose I incurred certain expenditure. The proportion in which you are incurring such expenditure over the period, in the same proportion you need to credit the amount of government grant as well. It can be credited to the P&L in proportion of expenditure incurred to comply those conditions. Okay, just a second. Right, guys, please concentrate. We are having only one under the receipt of government grant, only one item is pending, which is government grant related to revenue expenditure. What it means, sir? Government grant related to revenue expenditure means maybe government grant issued for the purpose of incurring certain revenue expenses, maybe like for the purpose of purchase of raw material, which is a revenue expenditure, maybe for the purpose of incurring of salaries, maybe for the purpose of incurrence of certain utility expenses like electricity expenses, power expenses. Maybe if they are provided in the form of government grant, then what I should need to do? Then, sir, revenue expenditure is in generally debited to P&L, right? So at that point of time, the government grant is also treated as revenue received. GZ can be credited to, or GZ will be, so government grant will be credited to P&L account under other income, under other income. So in statement of profit and loss account, revenue from operations and other income, two different heads are there na. Under other income, you can directly make it credit, or you can, or government grant can be reduced from such revenue expenses directly, such revenue expenses directly. So anything is correct only. Either you can reduce it from expenses or you can treat it as a separately as income under other income. Are you understand the point? Now let me summarize the things, guys. All of you. This is the main content of AS12 government grant. This chart gives the overall picture of accounting treatment at the time of receipt of GZ. Sir, if we receive the government grant as promoter's contribution, if we receive the government grant as promoter's contribution, let us assume so if we receive the government grant as promoter's contribution for startup of new businesses, no need to repay back, no need to repay back once if you invested such amount into your business, then at that point of time we can treat it as capital receipt under capital approach, and we can transfer it to the capital reserve by passing the entry bank account data to capital reserve account. If we are getting a non-monetary government grant, that is in kind directly, if it is offered at concessional price, we are going to record at such concessional price. If it is offered at free of cost, then it is need to record at nominal price. Am I right? So even though if it is offered at free of cost, you should assign certain nominal value. Now coming to monetary grant. Now coming to monetary government grant. Sir, in case of monetary government grant, you may receive for the purpose of purchase of depreciable fixed asset one type of accounting treatment, non-depreciable fixed asset another type of accounting treatment. If it is for the purpose of purchasing the depreciable fixed asset, so you already purchased, after that you are getting that monetary government grant. Then under method number 1, either you can follow method number 1 or method number 2. Under method number 1, the government grant received we can directly reduce from the cost of the asset, and depreciation need to be provided on the revised value. That is, on the reduced cost of the fixed asset, we need to provide depreciation for all the future years. In case of method number 2, government grant received is treated as deferred government grant, and it can be credited to P&L account over the period of useful life of the asset in proportion to the depreciation. Either you follow method number 1 or method number 2, the impact is same. Am I right? So the conclusion, what we made here, in method number 1 or method number 2, impact is same. I'll write here. So whether you follow method number 1 or method number 2, So whether you follow method number 1 or method number 2, the impact is same, guys. Am I right? Next, coming here, that is non-depreciable fixed asset. We purchased the land and we got certain monetary government grant. Now, if you already complied the conditions in the past, then only government released the grant. At that point of time, we can transfer it to the capital reserve as like promoter's contribution. No conditions need to comply in the future. Then at that point of time, in proportion of the expenditure incurred to comply such conditions, we may credit to the profit and loss account. Why? Because at that point of time, you need to comply certain conditions, means you are going to incur such expenditure in the future. At that point of time, we are not treating as a capital receipt, we are treating as a revenue receipt, but entirely we may not transfer to the P&L account in year one itself. Why? Because if it takes more than 1 year to comply the conditions, so over such period, you are going to transfer to the credit of the P&L account in proportion of the expenditure incurred to comply such conditions. Next, government grant related to revenue expenditure. Sir, it's treated as pure revenue receipt and we will show under other income, or you can reduce it from the expenditure for which you are received such government grant. Am I right? So this is the accounting treatment we are need to be adopted at the time of receipt of government grant. Okay, still the discussion is not at over, guys. For accounting treatment at the time of receipt of government grant, discussion is over. But the next discussion is there under AS12, accounting treatment at the time of refund of government grant. Now, if you observe here, we started with objective, then saw definition, then completed the scope, then check with recognition. Just now we completed accounting treatment at the time of receipt of government grant. So the next issue is accounting treatment at the time of refund of government grant. Please consider it, all of you. Accounting treatment at the time of refund of government grant. Accounting treatment at the time of refund of government grant. Now consider it, guys, all of you. First and foremost point here I'm telling you guys, at the time of refund of government grant, it is treated as extraordinary item. Extraordinary item in P&L and a cash flow statement as well. We saw in the cash flow statement now, sir, that is earthquakes, loss occurred at the time of earthquake, maybe insurance claim received at the time of earthquakes. Okay, so like that, if you are refunding your government grant, again back to the government due to non-compliance of conditions, when you are internally refunding the grant to the government, if you are unable to comply such conditions, so it's treated as extraordinary item either in P&L account or cash flow statement. Okay, that is the first point you should remember here. Then coming to AS12 perspective, so this is as per AS5 actually. This is as per AS5. Okay. Now coming to AS12 perspective, what is the accounting treatment at the time of refund of government grant? First point I'm emphasizing here, refund of government grant accounting treatment is depending upon policy or method followed at the time of receipt of government grant. Policy or method followed at the time of receipt of government grant. I mean to say, for example, at the time of receipt of government grant, if you treated it as promoter's contribution and if you transfer it to the capital reserve, now at the time of refund of government grant, to the extent of refund amount, I should need to debit the capital reserve account and a credit to the bank account. Simply at the time of receipt, bank to capital reserve, no, capital reserve to bank. To the extent of the amount you are refunded. To the extent of the amount you are refunded. Am I right? Now, for example, I received the government grant in the form of non-monetary government grant. Now you are recorded concessional price, right? Now at the time of refund of government grant, what you should need to increase the fixed asset price to the extent of the refund. That is fixed asset to bank. Earlier you are recorded free of cost. Now you should again increase the value of the fixed asset to bank. For example, if it is related to depreciable fixed asset, it is again also depending upon which method you followed. If you followed method number 1, I should need to appreciate the value of fixed asset by crediting the amount of refund, by crediting to the bank to the extent of amount of refund made to the government. That is fixed asset account data to bank account. Why? In method number 1, you are reduced from the cost of the fixed asset. Now you should add back. In method number 2, what you do made, sir, government grant is credited to deferred government grant account, right? Now, for example, at the time of refund of government grant, first you should make it reverse the balance of deferred government grant account. Still, if something is there under deferred government grant, you should reverse such deferred government grant. Now you should make debit the deferred government grant account. For example, refund amount is 5 lakhs, but deferred government grant balance is only 3 lakhs. First, what should you made? Deferred government grant account data 3 lakhs. Sir, the remaining balance of deferred government grants, you already make it credited to the P&L, right? Now you should make it debit such P&L account. That is deferred government grant account at 3 lakhs, profit and loss account at 2 lakhs, to bank account 5 lakhs. Are you getting my point, guys? All of you. For example, for non-depreciable fixed asset, at the time of receipt of government grant, you are treating as a capital reserve. Now you should make debit the capital reserve. Are you getting? Sir, in case of non-depreciable fixed asset, if you are crediting to the P&L, now you should make the debit to the profit and loss account. In the same way, in case of government grant related to revenue expenditure, if you are credited to the P&L, now you should debit the profit and loss account and credit the bank account. So that's why simply the refund of government grant accounting treatment is completely depending upon policy or method followed at the time of receipt of government grant. Refund depending upon accounting treatment for refund. I'll write that one as well. Accounting treatment for refund depending upon policy, depending on policy or method followed at the time of receipt of government grant. That is very, very important. Okay. Now, to put it simply, so consider it, guys. To put it simply, now refund of government grant is related to promoter's contribution. Promoter's contribution. So to the extent of refund amount, which entry you need to pass? Debit to the capital reserve. Capital reserve account debtor to bank account. So always amount is how much? Always at the time of the amount for all the cases at the rate of refund amount. At the rate of refund amount. Okay. Next, for example, it is for non-monetary. It is for non-monetary. What is the entry? You should need to increase the fixed asset or the PPE account debtor to bank account. If it is related to monetary, coming to depreciable fixed asset. Two methods are there, na? Under method number 1, again I should need to increase the fixed asset value. Why we are decreased? We are decreased the fixed asset earlier, fixed asset to bank. In case of method number 2, what should I need to do? First, the balance of deferred government grant. The balance of deferred government grant can make it debit. Still it is not enough, then you can make debit the P&L. So deferred government grant account that are profit and loss account that are to bank account. If it is related to non-depreciable fixed asset, non-depreciable fixed asset, so in case of past conditions, you already complied the conditions in the past, then again capital reserve account that are to bank. Why? At that point of time you treated it as a capital reserve, right? Now future conditions, I need to complete the conditions in the future. At that point of time you are crediting to P&L. Now you should make it debit. P&L account that are to bank account. Next, coming to revenue expenses. So debit profit and loss, credit bank at the rate of refund amount. Sir, in all the cases, the amount is at the rate of refund amount. If you want, you can mention that. So amount is at the rate of refund amount in all the cases. Okay, such a simple accounting treatment at the time of refund, guys. That means to understand better, to understand in better way related to the refund cases, first you need to understand the accounting policy or the method of accounting you adopted at the time of receipt of government grant. Then you can easily provide the accounting treatment for refund. So one of the last thing is pending from my side, guys. So refund of government grant case is also over. Now we are going to discuss about disclosures. All of you please concentrate. Till now, even a single line or single word not touched in my text, guys. So entirely discussing through my OneNote. So once I will finish it off, I will discuss through my text. Disclosures. What are the disclosures need to be disclosed under notes to accounts? The first and foremost one, accounting policy or method used for providing accounting treatment at the time of receipt of government grant. At the time of receipt of government grant. Why? Because various methods are possible, right? Sir, which accounting policy or which accounting method you used? Which accounting policy or which accounting method you used for providing accounting treatment at the time of receipt of government grant? For example, are you treating under capital approach, or are you followed method number 1, or are you followed as are you transferred to other income, or are you reduced from the related expenses? Which method you are followed? Which accounting policy you adopted for providing accounting treatment at the time of receipt of government grant? Various methods we saw, right? That is capital approach, revenue approach, basically method number 1, method number 2. So various things we saw. So which method or which policy we adopted at the time of receipt of government grant, we need to recognize. Number 2, in case of non-monetary grants, that was already told you. Once again, I am confirming here. In case of non-monetary grants, concessional prices or nominal values at which PPE are recorded clearly disclose. In case of non-monetary grants, concessional prices or nominal values at which PPEs are recorded, we need to clearly disclose. Okay, so because at the time of seeing such disclosures, at the time of reading such notes to accounts, people can easily find that why such PPEs are recorded concessional prices, why such PPEs are recorded nominal prices. Then they can easily understand that. So in case of non-monetary government grant, they are receiving such PPE, so that's why they are recorded at concessional prices or nominal values. So these two disclosures you need to give under notes to accounts at the time of receipt of grants, guys. Okay, so it is a very small standard. So entire content I discussed in my OneNote. Now let us have a discussion through our text, guys. All of you, please concentrate. All the issues I discussed. So just we are confirming the things with my text. Accounting for government grant. Introduction or objective, anything you can call introduction or objective. AS 12 deals with accounting for government grants such as subsidies, cash incentives, duty drawbacks. Sir, subsidy. What is the meaning of subsidy? What is the meaning of cash incentive? What is the difference? What is the difference between subsidy and cash incentive? Subsidy is given to reduce the burden, actually, to reduce the burden of the business person. Cash incentive is given to encourage, for the purpose of encouraging. If they achieve something, if they achieve, or for the purpose of motivation, for the purpose of encouragement. So subsidy is given to any particular industry or particular organization to reduce the burden, actually. Maybe huge expenditure is involved in such thing. That's why government is providing assistance. Cash incentive, the word incentive itself, it is clearly shows that when you are getting incentive we are getting only if you achieve something. Okay, for example, you are achieving the exports of certain figure, then you will get certain cash incentives. So like that, if you achieve something as a motivational factor, government will provide the cash incentive. Duty drawback means the duty which paid right now will be refundable at later point of time. In generally, it is applicable in case of customs duty. For example, at the time of importing of the goods, you need to pay certain customs duty. You need to pay certain customs duty to the central government. Now, if you are doing the exports, then the duty paid on the imports, you can get it back in the form of duty drawbacks. So which is also in the form of grants. So duty drawbacks, any duty drawbacks are there. Such duty drawbacks are also related to the government grants, and it specifies that the government grant should not be recognized. There should not be recognized until there is a reasonable assurance that the enterprise will comply with conditions attached to them. So simply in the objective itself, we clearly told that, sir, this standard is only introduced for the purpose of providing accounting treatment, sir. Accounting treatment at the time of receipt of subsidy or cash incentive or duty drawback. And moreover, you need to recognize such government grant only if you have a reasonable assurance that your enterprise will comply with conditions attached to them. Then only you can recognize. Otherwise, revenue recognition should be postponed. You need to postpone the recognition. Next, coming to the definition of government grant. So if you observe the same objective, I also explained in introduction, assistant like subsidies, cash incentives, duty drawback from the government, which type of accounting treatment need to be adopted, which type of accounting treatment need to be adopted. For that purpose, only AS 12 is introduced. Am I right? So the major concern of issue of AS 12 is for knowing accounting treatment. Am I right? Next, definition of the government grant. Government grants are assistance by the government in cash or kind. that is in monetary form or non-monetary form, to an enterprise for past or future compliance with certain conditions. They exclude those forms of government assistance which cannot reasonably have a value placed. I was not explained in my OneNote this point. Please all of you concentrate. They exclude those form of government assistance which cannot reasonably have a value placed, which cannot be measurable. Simply he is telling we cannot place a value. We cannot place a value which is not in measurable condition. How can I tell, sir, which cannot place a value means they are not providing in the form of cash, or maybe they are not providing in the form of kinds. Maybe for example, in case of tendering process, they are giving preference to you. They are giving preference to you. Or maybe for the purpose of getting licenses, maybe a single window system they are developed for the purpose of that particular industry. Then in such cases, which is also an assistance, maybe the assistance not only in the form of cash, the assistance in the form of help, the assistance in the form of governance, the assistance in the form of fast completion. Yes, anything may happen. Sir, for such assistance, we may not place any value, right? We may not place any value of cash. That's why those government grants which cannot be expressed in terms of a value, which cannot be expressed in terms of the cash, are excluded from this standard. And here one more word is there, and transactions with the government which cannot be distinguished from the normal trading transactions of the enterprise. I already explained this one under scope paragraph. Actually, I am not explained under definition. I explained under scope paragraph under the second example. Sir, government grant can be differentiated from the normal trading operations. If it is not differentiated from the normal trading operations, which should be excluded from this standard. Are you with me, all of you? That means if you are unable to place the value for the government grant, then the standard is not applicable. As well as if the amount which is received from the government is not differentiated from the normal trading transactions of the enterprise, then also we are excluded from this standard. Example, receipt of cash on sale of packaged or drinking water to railways by Bisleri. I already explained in my OneNote. Next, coming to the scope paragraph. This standard does not deal with this standard does not deal with government assistance other than in the form of government grants, income tax holidays, investment tax credits, accelerated depreciations. We covered, right? Entity for assistance in the form of, for the assistance received from the government other than in the form of government grant, other than in the form of government grant. We already explained, right? So if it is other than in the form of government grant, then AS 12 is not applicable. Next, government participation in the ownership of the enterprise. That is in case of government oriented entities or government companies. So they are getting in general benefits. Why? Because government participation itself is there. For such type of entities, the standard is not applicable. Next, recognition of the government grant. When we should need to recognize into our books of accounts, it should need to complete two conditions. One condition is entity have an assurance to complete the conditions attached with the government, and it is probable that government grant will received by entity. The two same conditions are given here. The enterprise will comply with the conditions attaching to it, and the grant will be received. So a government grant is not recognized until there is a reasonable assurance that the enterprise will comply with conditions attaching to it, as well as the grant will be received. So receipt of a grant is not itself a conclusive evidence that the conditions attaching to the grant have been or will be fulfilled. Because if you are need to comply the conditions in the future, you may receive the grant right now. But if you are unable to comply such conditions in the future, you may refund such government grant. So that's why he is simply telling that, sir, receipt of government grant is not a conclusive evidence that you already complied the conditions. Receipt of government grant is not a conclusive evidence that you already comply conditions. Maybe if you already complete the past conditions, that is different thing. But maybe for certain circumstances, at the time of issue of government grant itself, they will clearly tell that you should need to comply certain conditions. Otherwise, the grant which you received need to be refunded. Okay. Next issue, guys. Please all of you concentrate. We are almost at the end. So once we confirmed these things, we can close this video lecture. Accounting treatment of government grants. Two broad approaches may be followed for the accounting treatment of government grants. That is either capital approach or income approach. In case of capital approach, it is treated as part of the shareholders fund, simply capital reserve. In case of the revenue approach, it is taken to the income over one or more periods, that is to the profit and loss account. So it is directly taken as a capital receipt under shareholders fund capital reserve. In case of income approach, we are transferring to the profit and loss account. So it is generally considered appropriate that accounting for government grant should be based on the nature of the relevant grant. That is depending upon the type of the grant you are receiving. If the grants are related to the promoter's contribution, you may treat it as capital reserve. Why? Where the government grants are the nature of promoter's contribution, they are given with reference to the total investment in the undertaking. You are making a certain investment in your business or by way of a contribution towards its total capital outlay. And no repayment is ordinarily expected in respect thereof. Therefore, those grants are accounted on the basis of capital approach and treated as capital reserve. Simply, grants related to promoter's contribution is depending upon total investment in the undertaking. For example, sir, if you made the investment of 100 lakhs, if you are getting 25% of the grant, then you are getting 25 lakhs as government grant. Now, at the time of receipt of grant to capital reserve, what is this central investment subsidy scheme? Let us see what is the central investment subsidy scheme, guys. All of you, please concentrate here. Central investment subsidy scheme. Central capital investment subsidy scheme, all new industrial unit. If you observe here, all new industrial units and existing industrial units on their substantial expansion, for new industrial units on their startup or for existing industrial units for their expansion, would be eligible for capital investment subsidy at the rate of 15% of the investment of plant and machinery, subject to a ceiling of rupees 30 lakhs. So this is at the time of startup of the business activity or at the time of expansion of the business activity, you are getting 15% as assistance. Now such assistance you can directly transfer it to the capital reserve. So which is example given, central investment subsidy scheme. Next, coming to non-monetary government grants, guys. Government grants may take form of non-monetary assets such as land, other resources like building, plant and machinery, give at concessional rates. In these circumstances, it is usual to account for such assets at their acquisition cost. Non-monetary assets given at free of cost are recorded at nominal value. We already done with such things, right? That is related to non-monetary government grants, either at concessional prices or at free of cost. At concessional prices or at free of cost. Next, grants related to specific fixed assets. If the grants related to specific fixed assets are government grant whose primary condition is that an enterprise is qualifying for them should purchase, construct, or otherwise acquire of such assets. That means they are giving the monetary government grants. With that money, what you should need to do, you should purchase or you should construct the building or you should acquire such assets. Otherwise, you should refund such government grants. Treatment related to depreciable fixed asset. Method number 1. We will reduce from cost of the fixed asset, right? The grant is shown as deduction from the gross value of the asset concerned in arriving at its book value. The grant is thus recognized in the profit and loss statement over the useful life of depreciable asset by way of reduced depreciation charge. Now, once if you reduce the government grant from the cost of the asset, now you should provide depreciation on reduced value. That is the point he is mentioning. Where the grant equals the whole or virtually the whole, the cost of the asset is shown at the nominal value. For example, you purchased 10 lakhs worth of the asset, that is building to bank, 10 lakhs. Now government grant received amount is also 10 lakh. Then bank to GZ, sorry, that is bank to building, 10 lakhs under method number 1. Now building value becomes 0, right? At that point of time, no need to record these two things. On behalf of recording these two things, you can simply record that building to bank at the rate of nominal price. At the rate of nominal price he is telling. Okay, then what I do with the bank balance, the excess bank balance I got now, what I do, you purchased the building already, now you received the bank, right? It is credited to the P&L at that point of time. The building you can only shown at the very nominal price, so which is the gain now. So the entire gain you can make it transfer to the profit and loss account, and the asset should be shown at a very nominal value, very nominal price. Okay, now coming to method number 2, grants related to depreciable asset are treated as deferred income under method number 2, which is recognized in the profit and loss account statement on a systematic and rational basis over the useful life of the asset. Such systematic and rational basis means in proportion of depreciation. We right? We already done with all such type of issues, guys. If you check here, so monetary government grant related to non-depreciable fixed asset, that is, sorry, monetary government grant related to depreciable fixed asset, method number 2, government grant is treated as deferred government grant and credited to P&L in proportion of depreciation over the life of such fixed asset. The same thing is given that in the systematic and rational basis over the useful life of the asset, you need to credit. Treatment related to non-depreciable fixed asset, which is non-depreciable. So earlier we discussed depreciable, now we are discussing about non-depreciable. So grants related to non-depreciable assets are credited to capital reserve if you already complied the conditions in the past. If grant related to non-depreciable asset requires the fulfillment of certain obligations in the future, the grant is credited to P&L over the same period over which the cost of meeting such obligations is charged to P&L. You can observe here, guys, non-depreciable fixed asset conditions comply transfer to capital reserve. Conditions need to comply in the future can be created to P&L in proportion of expenditure incurred to comply those conditions. Am I right? Next, grants related to revenue. Grants related to revenue are sometimes presented as a credit in the profit and loss statement, either separately or under the general heading under other income. Under other income, you need to show. Alternatively, they are deducted in the related expenses as well. So both I already discussed. Next, refund of government grant. Very few provisions are there. Please all of you bear with me. Refund of government grant. Government grants sometimes become refundable because certain conditions are not fulfilled. Why? Certain conditions are not fulfilled and treated as an extraordinary item as per AS5. You know, extraordinary items should be always shown separately in the statement of P&L as well as cash flow statement. Where a grant which is in the nature of promoter's contribution becomes refundable in part or in full to the government on non-fulfillment of some specified conditions, the relevant amount recoverable by the government is reduced from the capital reserve to bank at the time at the rate of refund amount. The amount refundable in respect of government related to a specific fixed asset is recorded by increasing the book value of the asset or by reducing the deferred income balance as appropriate by the amount refundable. In the first alternative, where the book value of the asset is increased, depreciation on the revised book value is provided prospectively. So once you refunded the government grant in case of method number 1, then you should need to increase the book value of the asset, right? Then you need to provide depreciation on the revised book value prospectively in the future over the remaining useful life of the asset. Okay. The amount refundable in respect of government grant related to revenue is applied first against any unamortized deferred credit. At the time of making the refund, if the refund amount is more than the unamortized deferred credit, unamortized deferred credit means the balance which is appearing under the deferred government grant. First, you should set off the deferred government grant. Still, if it is not enough, then you can make the debit profit and loss account. That's why it is clearly given that the amount refundable in respect of government grant related to revenue is applied first against unamortized deferred credit remaining. That is the balance of the deferred government grant. First, you should need to apply to the extent that the amount refundable exceeds any such deferred credit where no deferred or where no deferred credit exists, the amount is charged immediately to P&L account. That is the entry we passed. That's why at the time of refund of government grant, first we debited the deferred government grant, guys. If you check here, first we debited the deferred government grant. After that, if amount is not sufficient, you may debit the P&L account. Okay, first you should always utilize the deferred government grant account, which is unamortized balance of the deferred government grant account. Next, Finally, we will end up with disclosures, guys. The accounting policy adopted for government grants, including the methods of presentation in the financial statement. What are the methods you used? What are the methods you used for recording such government grants? The nature and extent of government grants recognized in the financial statements, including grants of non-monetary assets given at concessional rate or at free of cost. So the same thing we are need to disclose, that is accounting policy or method used for providing accounting treatment, and in case of non-monetary assets, concessional prices or nominal prices at which PPs are recorded, clearly disclose. So this is the entire theory part related to AS12 government grant, guys. Okay, we are dealing problems in the next video lecture, guys. Almost total 10 problems are there. We are going to discuss all the problems in a single video lecture. Okay, so just I want to try to finish it out entire problems in one video lecture itself, as like how we completed the entire theory in this video lecture. Okay, so please all of you revise the content which you learned in this lecture before watching the video lecture related to problems. Bye friends, have a nice day.